In the Middle East, of course, that was really the driver. So as energy prices go higher and continue to do so overnight, much higher on Brent, much higher on gas prices, we are factoring in something quite negative for the start of the trading day. Let's have a look at the futures picture, because, Tom, we do seem to have crossed something of a Rubicon over the last couple of days or so. Energy infrastructure now seems to be fair game to some degree from both sides. President Trump trying to distance himself from what the Israelis have been doing, but there have been attacks from both sides on energy infrastructure, on gas fields, and that is really having an impact on expectations around how quickly anything can be brought back on stream, even if we did see an end to hostilities, which doesn't seem likely.
So we zero in then on the energy space, of course, today, given the price spike that we're seeing in natural gas in Europe, up 24%, and Brent up 6.5%. So energy stocks will be in focus, of course, today on the back of that news. This is now an energy war, it seems, in the Middle East. Chip stocks also in focus. Interesting in terms of the CapEx spend coming through from Micron, a commitment of $25 billion through this fiscal year, and Samsung coming out in the last couple of minutes committing to more than $70 billion worth of CapEx spend as well. So we look at the chip stocks in Europe for any reaction to that. HSBC with an announcement or some reporting from Bloomberg suggesting they may cut a quite significant number of jobs, potentially 20,000, as they embed AI, potentially, Anna.
So, Tom, as markets then start to reassess, rethink how elevated energy prices are going to be in the first quarter and remain in the second quarter, what does that do to markets here in Europe, to stock markets here in Europe? We've seen energy stocks performing pretty strongly on days when energy prices have gone higher, and perhaps that is the knee-jerk reaction we see once again today. But at some point, we have to ask questions about demand destruction from higher prices, and so that will no doubt be part of the conversation as we go through this morning as well. So the FTSE 100 is out of the gates, and it's decidedly negative, as expected. All of these markets expected to open firmly into negative territory. So we're down by 1% on the FTSE 100. The CAC 40 down by 1.2%. The IBEX down by 1.5%. Looking for the Xetra DAX to open up. The longer these markets take to open up, the less they can rely perhaps on the energy sector to prop them up. The DAX doesn't have much in the way of energy stocks, and so perhaps we'll see a little bit more downside there. But we are seeing negativity not just on the CAC and the IBEX, but also on the FTSE 100 this morning. And I wonder where that energy narrative takes us, Tom, as we see gas prices jumping by more than 20% this morning. Energy is the only sector in positive territory right now, up 0.7%. Basic resources, the biggest pain point across your sectors, falling more than 3%. We've seen pressure on copper, on iron ore, on silver, and on gold as well. Basic resources taking a big hit then. That sector down 3%. Travel and leisure falling 1.7%. Banks under pressure. Earlier this week, banks have performed relatively well as a sector. Currently, that sector's down 1.6%. Autos also taking a hit, down 1.5%. Every single sector in negative territory so far in the session, apart from energy, which is up just 0.6%. Worth noting as well that there's a pretty significant sell-off in gilts right now, more significant than we've seen in their European counterparts. That is something we've seen and has echoed since the start of this conflict. Yields are up 10 basis points right now at the front end when it comes to gilts. So selling of the sovereign debt in the UK, gilts yields jumping, price down. Again, across your sectors, it's just energy in positive territory. And basic resources, by far and away, the worst performer, down by 3%. We've got Fresnillo as the worst performer within that sector. And interesting to note that gold prices are on the back foot this morning. Silver prices down 5%. Gold prices down by 1.8%. Obviously, when you see other markets quite so risk-off, your mind goes to, well, what are investors going to have to sell to meet margin calls? And maybe that's gold, maybe that's the function, the liquidity function that it's providing today, rather than the haven function that it sometimes has provided. So 2 minutes into our session, Tom, let's get a perspective, shall we, on energy stocks.
Patrick Plurumi joins us now from Armstrong, of course. Patrick Armstrong, I should say, CIO. I've just merged your name and the title of your house. Patrick Armstrong, CIO at Plurumi Wealth. Patrick, good morning. So you say that the market is probably too pessimistic. The market is probably too pessimistic on inflation over the next year. Really?
Well, if you look at inflation break-evens over 10 years, they're at 2.4%. And that's too complacent about inflation, but inflation break-evens over 1 year are 5% right now. And I don't think we get to that over the next year. I do think we get above 4% in the summer and probably come back down, maybe based on a too optimistic view on the war that it does peter out as we get into the summer. But the cloud of war, fogs of war, you don't know where things are going to go. There's going to be many twists and turns, but 5% break-evens over 1 year does seem very pessimistic about the inflationary outlook.
Do you think equity markets broadly are showing complacency at this point?
Perhaps. They've definitely reacting to the bad news. Stagflationary fears are definitely rising and plausible coming into the year. Didn't look like they were plausible given a very strong consumer, but energy prices choke many things. And a little bit too complacent because the Fed narrative is weakening. You're getting some politicization of the Fed to some extent. I do think Warsh is going to be minded to cut. I probably think he gets appointed, but it's a higher bar now. So Powell's discussions last night, relevant, but not as relevant as they'd typically be because we're going to have a new chairman coming in who is going to be minded to cut. Whereas Powell would probably be minded to hike even as this year progressed. It sounded like he was more hawkish. I think he thinks we're at neutral. I think Warsh thinks we're at restrictive levels because of AI productivity that's going to be coming in.
Patrick, yes, no doubt. We'll talk about AI and technology in just a moment. Just to linger on the energy theme a little longer. I mean, energy stocks have been this knee-jerk positive when we've seen days where oil prices have gone a lot higher. So Brent's up 6%. Energy stocks are the only sector in positive territory. Does that continue? At some point, do we have to start asking about demand destruction for that particular sector?
You do. If oil prices, I think 100, 110 is the point where it does start to squeeze either profit margins or consumption. It's got a lot of consequences. And I think 80 to 100, the market can shake it off. Sorry, Taylor Swift. But once you are at these levels, and if there is further supply disruptions, you have the risks that it goes higher. You do have to think about the consequences in terms of higher input prices, consumption, and we're at the levels now where it is starting to hurt.
So you don't think that, you think the market is factoring in too much inflation in the short term then. Is that because, I think you were citing the US there, and is that because the US is a little insulated, and what should we be expecting in the rest of the world?
You've got a very strong dollar right now, which offsets some of it. You've got the US, which is still energy self-sufficient. Oil is a global commodity, so when it rises in Europe and the Middle East, it does go up in the US, but it is self-sufficient there. And 5%, it's just hard to see how we get there, and that's where break-evens are. And I think I'm one of the biggest inflation hawks that I know, but I do think 5% is a little bit over-egged in the short term. But in the long term, people are just way too complacent about it. Populism, nationalism, trade wars, debt-fueled spending, that's going to be very inflationary. So 10-year break-even's way too low. I think the 1-year break-even's a bit high.
Okay, long-term inflation is there, and there's structural reasons for that, is your argument. As you look at your portfolio, Patrick, how are you thinking about timing around this conflict?
It's very difficult, and the winning strategy right now is take a little bit of profits on up days because the next day is down, add on those dips the next day, and we do have a cycle where we've got Trump speaking positively, but then refineries being damaged and back and forth. So Trump definitely doesn't want this to go on any further. Unfortunately, it's not like the taco trade of April on trade war. This is a real war, and you can't pivot from that as quickly because you need Iran to play ball. It's not just Trump's decision. So I think any chance he has to take a win, he'll be looking to do that.
Yeah.
But Iran's not giving him the chance to take that clear win.
So when you take profit and you put that in cash, or you put that elsewhere? Where are you looking to deploy that?
I like to sell put options on stocks I'd love to own if we do get to the point where market gets oversold. So you're getting really good vol right now. Implied vol's 24, 25%, and it's not even that backwardated, so you can go further out. And if you have a stock you'd love to own, if it was a bit cheaper, you get paid a very nice premium to create that buying discipline. And it's really hard to have that buying discipline because when the market's going down, there's a reason people are scared. But if you find companies with great business models, companies that are going to come through this war, and at the end of this year, you know their business model is going to be sound, that's a winning strategy.
And Patrick, do you find those winners in the AI sphere? Do you find companies that meet your criteria in the tech space right now? How are you thinking about AI?
I love the high bandwidth memory stocks, so Micron, Samsung, Hynix. I do think they are cyclical companies. It's essentially commodities they're producing. But if you're picking them up at less than 10 times forward earnings with the growth they have, I do think we've got a runway of many quarters ahead of us.
So the market,
really strong results.
So the market shouldn't worry quite so much about big capex numbers, do you think?
You have to worry about it, because it is going to happen. I just think it doesn't happen as quickly. It's insatiable demand, and I think that's going to be the story probably for the next 6 to 8 quarters. And yeah, history always repeats itself. It's like shipping or oil commodities. You do get an overbuild, but the demand is insatiable right now, and they've sold everything they can produce through 2027, even with the capex they're targeting. So I wouldn't be surprised if Micron's up by the end of the day, because when the U.S. retail market opens, investors love high growth. They love being able to pick up a stock less than 10 times earnings, and I do think this is something that has several quarters ahead of us. Maybe not several years, but
where else within the AI ecosystem are you looking in terms of how much conviction do you have that the build out and the capex spend continues, and that the move up the curve in terms of the models and the innovation continues?
I want to own all the companies that are receiving money from the hyperscalers. I think they're 100% committed to their spending. That will change at some point. The market forces will push back on their capex if they're not generating profits. But right now, they're just laser focused. We're spending, we're building our cloud compute, and companies like NVIDIA, Micron, Samsung, they're the beneficiaries of it. I also like electricity generators. Uranium is going to be part of that. So it's clear to me these hyperscalers are going to spend. It's not clear to me they're going to be incredibly profitable. They might be, but I love to own the companies where that spend is going today.
And are you leaning into Asian companies in this space? Because before the Iran war, that seemed to be the big pivot. It was all about Asia hardware versus US software. Where are you on that one now?
Well, so Samsung and Hynix are Asian. It's not that they're a play on Asia, but those are two stocks I think fit in right with Micron. I think they're all very similar companies, business models. They've got an oligopoly and just incredible pricing power.
I've seen some concern being voiced that the money out of the Middle East, the sovereign wealth funds, and the capital that have been pouring in, a lot of it into tech, is going to start to dry up now.
Interesting, yeah.
Is that a factor that we need to start thinking about as they have to prioritize rebuilding their energy infrastructure and other parts of the economies there?
Makes sense to me, actually. I haven't heard it before, but yeah, and unfortunately rebuilding energy infrastructure that's being destroyed, things like that too. It's going to be at the margin, though. They're not going to do a 180 pivot away from technology, but you may start to see other aspects being allocated to. And the world, the equity market is very tech-centric, and I think not just Middle Eastern and sovereign wealth funds, but investors as a whole. It is a broad market rally is what we had before the war. I think we get back to that by the end of the summer, and technology is not the only way to play. We are in an environment where there is still growth. It's a strong job market that's definitely weakening, and I think that sets a tailwind for equities.
What about some of the havens that haven't been quite so haven-like? I mean, gold...
It's not a safe haven anymore. It's a speculative asset. It's just, you can't call gold a safe haven given the amount it's run up. It's going to be a source of funds when there is risk aversion, and when there's risk aversion, generally you see yields moving higher. Not usually seeing the yields moving higher, but in a stagflation, which is what gold should be a safe haven for, you get higher yields as well, and that's going to be toxic for equities, long duration bonds, and gold, I think. So I do like the gold miners, because gold doesn't have to go up for the gold miners to generate incredible profit. But I think gold's a speculative asset, not a safe haven.
That's really interesting. When did gold become a speculative asset?
January.
When the implied volatility on gold got higher than the implied volatility on equity, and that's where we're at right now. So gold implied volatility is at high 20s, equity volatility is at 26%. So if equities are a speculative asset, gold's more speculative than equity.
Really interesting. Patrick Armstrong, thank you very much indeed. Flurimi Wealth CIO. Let's check in on the core 6 right now. Of course, on another day of pressure across European and global equities. Nestle is down 1% with that focus, of course, on the consumer. Schneider Electric, with that exposure to the data center story, but down 2% in the session today. ASML as well, down 1.7%, not benefiting from the pledges around increased capex coming through from the likes of Samsung and Micron, at least not now. Rheinmetall in the defense space is the only stock in that core 6 which is gaining today, up 1.7%, as you can see. LVMH in the luxury space. Luxury has been affected, of course, by the war in the Middle East, and that's down 1.4%. And you're seeing Novo as well. Also a little softer by 2, close to 3 points, down 1.1%. Let's check in on some of the other individual stocks on the move this Thursday and bring in Charlie Wells. Charlie.
Good morning, Tom. So we're going to start off with the miners because we are seeing them under pressure this morning. This really is one of the emerging stories that we're starting to see. Rio Tinto, Glencore, and Fresnillo all down significantly this morning. And I think the question here is, are traders starting to interpret some of this negativity, the significant negativity in the Middle East, as a long-term issue, impacting that economy long-term? I think that's one of the key themes we're starting to see this morning in this movement. Let's flip and take a look at Equinor, because they are, again, tied to this energy crisis. They are tied to the Middle East conflict, but they are up nearly 5% this morning. Now, this is interesting because this is an energy company that does not have direct exposure to the Middle East. That has been a positive story for the stock over the past few weeks, but they also have some news out today talking about a reorganization, trying to create more value and splitting some units to create more value for shareholders. And at least right now, that is a story that is looking like it's giving a boost to Equinor. Let's flip and take a look at a different European stock. We're thinking about Lanxess. This is the German chemicals company. They are down over 8%, almost 8.5% this morning. Now, we know the chemical sector here in Europe has been under pressure. Europe really is awash in chemicals. There is a lot of kind of supply issues there, but they issued a disappointing earnings report, a forecast that disappointed as well, also talking about job cuts. So not looking great in this sector, but also for Lanxess more specifically. Now, there's another big story that we've been talking about all morning, and we want to watch this. It's HSBC. So people familiar with the matter have said that HSBC is considering significant job cuts as they experiment with gaining more efficiency because of AI. We want to see how this plays out because there's negativity now, but there's a flip story that I think we should watch out throughout the course of the day, which is some investors like the announcement of AI-related job cuts because it means efficiency, because it means companies are spending less on labor. So that is a story to watch out. Not huge moves right now, but let's see if that flips to green or stays in the red throughout the day.
Thanks, Charlie. Charlie Wells with a rundown of some of those movers this morning. Something else, Tom, that's on the move is the gilt market, and we have gilt yields higher across the curve, notably a little higher than the rest of Europe. So if you're looking at the 10-year tenor, we're up by 8 basis points against France and Germany, up by 5 and 3 respectively. If you click into the UK curve, you see we are up by more than that, of course, at the short end. So 2-year yields now up by 11 basis points. This ahead of the Bank of England later.
Traders now pricing in more than one hike from the BOE this year, 36 basis points by December. And that's despite the fact that we had jobs data reminding us that jobs and unemployment remains near 5-year highs here in the UK. So a soft labour market, and yet markets and traders are pricing in closing into two hikes from the BOE.
Yeah, absolutely. So as the wages story, we get some of the heat coming out of that. The rest of the market, labour market story, though, it is possible to tell a bit more of a positive story. The jobs market faring a bit better than had been feared ahead of the Bank of England meeting. But they are still worried broadly about the jobs market, and now they have to worry about the inflation side of things as well. It is 8:16 here in London. Coming up in the programme, we will continue coverage of our HSBC scoop, more on the potential job impact of the bank's bets on AI. That's next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is the opening trade. Welcome back to the program, everybody. 19 minutes into our trading day, and there's a lot happening. European equity markets very much on the back foot this morning, down by 1.3% on the stock 600. It's kind of across the board as well. So even the geographies, which are slightly cushioned from the worst of the selling by the fact they have a high representation of energy stocks, not really outperforming much today. So the FTSE 100 is down by 1.2%, as is the CAC 40. And actually, Tom, energy stocks now in negative territory. So we started with that as the only positive, and now they are at least flat, if not just into the, well, flirting with the flat line, let's say.
Let's focus in on the banking space right now. The Bloomberg scoop around HSBC, learning Bloomberg that HSBC is considering cutting roughly 20,000 jobs, which would account for about 10% of its global workforce in the coming years. The cuts will target back office and service center roles as CEO George Elhedery bets on AI to handle more tasks. Let's bring in Tom Metcalf, who leads our EMEA finance and investing coverage. Tom, what do we know about these plans then?
Yeah, I mean, under consideration and over the medium terms, we're talking, a few years. For me, the most interesting thing is lots of Wall Street executives have been touting, the efficiencies to be gained from AI, and this is kind of the first tangible sign of what maybe shape that might take, right? And certainly makes a lot of sense. It's those repetitive tasks that, HSBC has big global service centers around the world, and they're trying to look for ways, hey, maybe we can reduce the headcount. And then I think the quantum's interesting as well, like 10%, significant amount, but does go to show, it's not like in one go AI is going to completely transform the workforces of finance. It's multi-stage, multi-year, and of course very early stage at HSBC.
Yeah, and these are really complex and regulated businesses, aren't they? Which means, of course, there's going to be plenty of opportunity for AI like everywhere else, but it's going to have to be done really carefully. I mean, how does this fit with what else we're seeing from this? I mean, still relatively, do we still say relatively new CEO, Tom? I mean, he's been there a little while now.
Yeah, no, he joined in September 2024, but no, absolutely, his tenure has been marked by kind of like a radical restructure, and I would describe it as. And yeah, this is probably just one element. So directionally, this is absolutely what George Elhedery, the CEO, has been saying all along, is I'm looking to reshape this bank. We're a big global bank, but, it doesn't mean we need to be kind of baggy. They've got something like 208,000, 100,000 jobs. So it's a big old enterprise, and obviously there's, in his view at least, ways they can kind of shrink it and continue to deliver the service.
And Tom, you mentioned other Wall Street executives and their AI plans. How does this fit into what you're seeing? How broadly are the bosses of banks embracing AI? How broadly are they looking to reshape their workforces as a result of some of these technologies?
Yeah, I think this is the first clearest indication, but behind the scenes, I imagine most people will be reading this going, yeah, that sort of chimes with, certainly is what I kind of would make sense to me, and what I think most people in the industry are probably.
You don't think HSBC is an outlier then?
No, I don't think so. And as the time goes on and more clarity gets around this technology, I suspect you'll certainly see more announcements. I mean, look, Morgan Stanley's come out already saying it's cutting 3% of jobs. That's a fairly common thing a lot of those lenders do, but some of that will be AI driven, and I suspect we'll probably see plenty more of these, at least think-ins and discussions going forward.
Tom, thank you very much. Bloomberg's Tom Metcalf with the latest on the banking sector. Let's go to the oil story. Still dominating headlines from the Middle East, of course. Oil prices higher and European gas prices jumping more than 20% just this morning after attacks on major energy facilities in the Middle East, marking a significant escalation of the ongoing conflict. Iran carried out attacks on an LNG site in Qatar following Israel's strikes on the Islamic Republic's giant South Pars gas field. Anthony de Paula is our Middle East energy reporter, joins us from Dubai. Let's focus in on the gas story first, shall we? What damage then do we know has been done, Anthony, to the Qatari installations?
Good morning. Yeah, that's right. The Qatar's Ras Laffan area was hit last night, and that's a huge area which has multiple LNG export trains. So these are the facilities, lots of pipes, lots of high-pressure towers where they take the gas, natural gas extracted from Qatar's biggest offshore field in the world for natural gas. They take that gas, compress it, and cool it down so that it can be turned liquid and then put on ships. So those are highly complex facilities, very susceptible to damage if any of those pipes or pressure units are damaged. They also have there the Pearl GTL plant, which is a plant run by Shell. At the time when that was built over a decade ago, that was the single biggest investment in Qatar's energy industry by one company at one time. That was sustained severe damage, according to Qatar Energy, the state company, and as well as Shell, which has just said it's assessing damage at the facility. So we have some damage at various facilities there between the LNG as well as the gas. Of course, that field, the Qatar's North Field, is the Qatari side of what Iran calls South Pars. So that is the world's largest field, and that was what was attacked by Israeli military yesterday, and that sparked the retaliation by Qatar on the gas field and on U.S. interests as well. Of course, ExxonMobil is one of the U.S. companies that's a big shareholder in some of those facilities in Qatar. In fact, Qatar Energy even named one of their biggest LNG carriers after Rex Tillerson, the former Exxon CEO and former U.S. Secretary of State.
Anthony, can you help us explain what's happening in terms of the spread widening, the gapping that we're seeing in terms of prices between Brent and WTI?
Yeah, of course, the gas prices are shooting up on this, not because any fuel is getting out of the Persian Gulf. Of course, the Strait of Hormuz remains closed, largely closed. There are some Iranian vessels getting through, and the Iranians have let some vessels go to other countries. But things like LNG are not getting through the Persian Gulf, so they're not being exported to markets. But what traders are really watching here are the prospects for a quick startup for Gulf energy facilities should the Strait of Hormuz be opened. That's been a major focus of the military campaign, of politicians talking about when they can get Hormuz open and how they can get it open. But if we're seeing damage to facilities there, that's going to mean repairs, that's going to mean facilities out for longer periods of time, and that's really what's influencing those prices. As traders see some damage come through, they are seeing a longer outage there because of damage, and it still remains unclear when Hormuz would even open anyway. So we're still in very unclear waters here.
Bloomberg's energy reporter, Anthony de Paula. Anthony, thank you for that update. Of course, in the energy space, again, European gas prices up more than 22% so far in today's session. Coming up, the S&P is delivering a rate decision in a few minutes. We're going to break it next. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning, everybody. Welcome back. This is the opening trade. 30 minutes then into our session, and things looking pretty negative across these European equity markets. The Xetra DAX was down by 2%, now just shy of 2% lower on the day. Some negativity then around these markets on the back of higher energy prices, oil and gas shooting higher. Gas certainly shooting higher by 20%, more than 20% in just this morning's session. All of this, of course, because of the huge amount of kinetic activity in the Gulf, now directed, it seems, Tom, towards energy infrastructure. That is not just weighing on risk appetite, it's even weighing on energy stocks this morning. They're not quite the cushion that they have been. What do you see in terms of the movers under the hood?
Yeah, so far just 36 companies in the Stock 600 in positive territory. On the downside, 560 then selling off in today's session on that energy crisis that continues, of course, to reverberate through these markets. Volumes currently down about 8% versus a 20-day average. That compares to a bigger drop in volumes yesterday. Let's flip the board and have a look in terms of how this breaks down in terms of the leaders versus the laggards. Not unsurprisingly, amongst the leaders, it is the energy giants. As a sector, you're seeing energy off. But in terms of some of the individual names, you are seeing a bit of a lift for the likes of BP, up 1.6%, as Brent jumps, 5-6%? Gas prices up, as Anna was saying, up 22%. Equinor then gaining 5.6%. It has exposure, of course, Equinor, to the gas space. Rheinmetall in defence getting a bit of a lift, up 0.3%. On the downside, let's flip the board. Interestingly, in the semiconductor space and that supplier of kit and equipment, ASML is down 2%, despite the fact that you've had pledges of more capex spend from Micron and Samsung through this year. Siemens down 3%, has that exposure to data centers, but also supply chain constraints as well, potentially a headwind for Siemens, down 7 points or 3%. HSBC, Bloomberg reporting they're looking at potentially cutting up to 10% of their workforce over a period of time as they embed AI. That stock currently down 1.7%. Anna.
Tom, let's focus in on some of the other stories we're covering this morning. Sticking with the tech theme, in fact, Samsung plans to spend more than $73 billion on capital expenditure and research this year. The company says the investment will go towards securing its leadership in AI technology and shifting production to address the historic shortage of conventional memory chips. European gas and Brent crude are surging this morning after Iran and Israel traded strikes on key energy facilities in the Middle East. President Trump responded by pressing for a de-escalation of attacks on energy sites in the region. Fed Chair Jay Powell says the Middle East conflict has added fresh uncertainty to the inflation outlook, adding that the US central bank won't cut interest rates again until inflation resumes cooling. Tom.
Talking of central banks, Sweden's central bank, the Riksbank, coming through with a decision as expected to hold its policy rate at 1.75%. Again, as expected, the Riksbank rate will remain at this level for some time, the Riksbank says. And in terms of the currency, I'm looking at the euro and krona cross, and you're seeing a little bit of a move lower in terms of the euro versus the krona. So the krona getting a bit of a lift, up 0.2%. The Riksbank saying underlying inflation has been unexpectedly low. The Riksbank saying that Swedish conditions are favourable for recovery, but again, the red head across the terminal as they hold rates at 1.75 is that the Riksbank rates will remain at this level for some time.
So a bit of guidance there. The SNB in focus as well, and the focus here, not so much on the policy rate, on the currency, and we pulled up the Swiss franc so you can see what it's doing as I read out these headlines, but the SNB policy rate staying at 0. So that was the expectation. We'd get no change. We would not see the SNB drop into negative territory in terms of its interest rates, and of course it's now wrestling with war in the Middle East, just like all of the other central banks around the world. They are saying on the currency they're prepared to intervene in the currency markets if needed. Excessive franc appreciation would jeopardize price stability. Let's get some analysis on what's happening with these global central banks. Jana Randau joins us live from Frankfurt. She's across the ECB, but also across the SNB for us. Jana, good to have you with us on the programme. So no change from the SNB, but they have made these comments on FX, prepared to intervene in currency markets if needed. Excessive franc rise would jeopardise price stability. That seems to be where their head is at, thinking about the FX.
Yeah, so the SNB is in a very difficult situation. Of course, policy rates are at 0. The experience they had in the past with negative rates, wasn't so great. So the policymakers are reluctant to go there if they can help it. And of course, for Switzerland, the Iran war is all about the currency. The franc is a haven, so it's appreciated quite a bit since the war started. That, of course, puts downside risks or downside pressure on inflation at a time when inflation is already closer to 0 than to 2%. And that's exactly what we saw from the SNB statement. Inflation, they said, would be higher in the very short term. That's, of course, because of oil. But then in the medium term, inflation pressure is slightly lower than previously expected, and that is because of the currency. And as expected, policymakers said they have an increased willingness to intervene on behalf of the franc to make sure that they don't need to go where they don't want to go on interest rates, and that is below 0.
And of course, a different story for the euro, which has been under pressure as a result of these higher energy costs. And Jana, you have been a long-time tea leaf reader at the ECB. You're standing there in Frankfurt for us. What are you going to be watching for, Jana, when it comes to the ECB decision and what we hear from Christine Lagarde?
Yeah, so in the run-up to the meeting, she said the ECB wasn't going to rush into decisions, and that's what we've seen, of course, from all the central banks that have decided yesterday and today so far. So a very careful analysis, a look at the situation, a look at the impact. We are getting new forecasts. How much value they hold remains to be seen, but some scenario analysis as well that will outline, how inflation risks shape up. And then the interesting thing to watch, of course, is how Christine Lagarde explains the reaction function of the ECB. So that is how the ECB will react to certain risks playing out. This is what everybody will focus on. How high is their tolerance threshold? How much willing are they to look through those energy price spikes? We all remember 2022 when they said it was temporary, and then it wasn't, and inflation ran all the way above 10%. So those scars run deep. The president said she will spare European consumers, European businesses that experience. So, it's all about words at the ECB. We don't expect a reaction, but, we might understand a little better how the ECB looks at the risks and how they will prepare a potential response.
Okay, that's a valuable framing ahead, of course, of that decision from the ECB coming from Jana Randau on the ground for us in Frankfurt. Jana, thank you for that analysis. Meanwhile, the escalating conflict, of course, in the Middle East and the resulting energy shock is set to dominate as well the EU Leaders Summit today. Oliver Crook, Bloomberg's chief Europe correspondent, joins us from Brussels. Ollie, what is Europe's view right now on the conflict in the Middle East as it seems to be, again, stepping up in terms of the extent of damage that we're seeing, particularly when it comes to energy infrastructure? Where does Europe stand at this point?
Yeah, this was a summit that was supposed to be about competitiveness, which is the big agenda item for the European Union for the last sort of year and a half, and has been put on hold perennially by all of the different activity from the United States, whether it's a trade war, whether it's the Greenland sort of moment, and now, of course, the war in Iran, which has direct consequences and obviously also trickle-down consequences. In terms of the direct consequences, you have fairly universal consensus here in Europe among European leaders that basically there is no place in the active military part of this war for Europe at all. That is not a place for NATO, it is not a place for the EU, and that they're going to stay away from it. That has obviously prompted a lot of criticism from the United States and Donald Trump, who even yesterday was talking about getting allies to step up and potentially relinquishing responsibility for the whole Hormuz Strait after the war is over to the allied countries. He used sort of sneer quotes on that to take responsibility of it for those who use it. And of course now for EU leaders, this is their first moment to get together since the war began. We've just been seeing Micheál Martin, the Taoiseach of Ireland, walking in. That is obviously a relevant person because he's one of the people who's most recently sat down with Donald Trump to sort of brief. And again, we're watching very closely what the collective language from the Europeans is going to be. It's sort of interesting when you look at the European continent. Those most far to the east have been most on board with this idea of potentially NATO entering into the Straits of Hormuz. You heard that from the Baltic states. You have France taking a much more measured approach, saying there is no really place for them militarily right now, but potentially in the future to help safe passages of ships. And of course, the Spanish were expecting Pedro Sanchez to walk in any moment now, who has been very outspoken since the very beginning of this war, calling it illegal.
Yeah, absolutely. We'll focus on what he has to say then, and bearing in mind that geography. In terms of the economic impact then, Ollie, of the higher energy prices, oil and gas, what are we expecting European leaders to pledge on that front? They did quite a bit. Different countries did different things in 2022, but the fiscal story has evolved since then.
Yeah, absolutely, Anna. So at the moment, the sort of main responsibility has been really at the member state level. You've seen a number of different countries within Europe taking specific actions. You've seen energy price caps in a couple of countries, in Hungary, in Croatia. The Germans have taken some activity in terms of limiting the number of times a day you can set gas prices and these sorts of things. So that will fall within the member state level. What is going to happen potentially at the European level, and this is going to be very actively debated today, is tweaks that can be made to the ETS, the emissions trading system. This is effectively the carbon market that exists within Europe. It basically dictates the price of carbon from emissions for industrial companies, and as a consequence will be very sort of impactful in terms of what those companies need to charge. So there's a big debate. The Italians want to put the whole ETS on pause. Others are saying that it's very important. It needs a little bit of tinkering, but effectively this will be the conversation today among European leaders at the European level to try to bring down those prices. There are of course other ideas that can be discussed. You'll remember in 2022 there were talks about the EU level of gas price caps. Just the talks of those brought the gas prices down. They never had to be implemented, but that's a way in which potentially job owning can bring down energy prices in Europe.
Ollie, thanks very much. Oliver Crook, Bloomberg TV's chief Europe correspondent in Brussels for us as those leaders gather. Coming up on the programme, we will talk economics, we will talk the impact of war in the Middle East, and we'll talk about AI. Philippe Arion will be with the team, co-winner of the 2025 Nobel Prize for Economics. He joins Francine exclusively from the Bank of America conference in Paris. More insight on his research, diving into innovation-driven economic growth. That sounds useful at this time. That's next. This is Bloomberg.
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. This is the opening trade. Now, analysts are, of course, warning that the current rise in oil and gas prices and destruction of Middle East energy infrastructure will have a longer-term effect on inflation, reminiscent, perhaps, of the oil shock of the 1970s and its impact on the global economy. Perhaps it's too soon to say exactly how big that parallel with the 70s will be. Bloomberg's Francine Lacqua is at the Bank of America Investor Summit in Paris with more. Good morning, Fran.
Good morning, Anna. Now, joining us now is Philippe Aghion. He's a 2025 Nobel Prize winner in economics. Go ahead. So thank you so much, Mr. Aghion, for joining us. Look, the world seems to have changed, and this is partly because of the war with Iran. This is also trade, tariffs, and the fragmentation almost of everything. How do you see economics changing because of that?
I think it's true that we are not in the, we are beyond the full globalization phase, In the 1990s, we were all into the end of history and full globalization, value chains built on cost minimization. We would have each step of the value chain would be performed by the country where the productivity is maximal or costs are minimized. It was really cost minimization was the driving force of value chains. And nowadays, resilience is becoming much more a driving force of value chain. You want to make sure that you deal with countries that will not turn their back on you, and that you have supply assurance becomes a big, consideration to bear in mind when you build up value chains. So you are very much into Mark Carney's speech in Davos. He tells you exactly what to do. Countries that believe they share some values, democracy, rule of law, need to get together. And also, you have to make sure you deal with countries. I mean, some of them, they have terres rares, they have the scarce land, or others, they have different type of technologies, but they share the same values, and they should get together because they know they can rely on each other on the long term.
Your Nobel Prize, and congratulations for that, it was only in 2025, was basically creative destruction. The idea that because of technology and things like that, things will be, because of technology, things will change. How does this extra layer of uncertainty do with how you look at economics longer term?
But uncertainty is never a good thing when you are into innovation. I mean, innovation is by nature uncertain, but you don't want to have extra uncertainty. So any extra source of uncertainty is not, conducive to innovation. Innovators need to think long term. You see what I mean? I think they need a stable environment. We need fiscal certainty. We need stability. You know, I mean, instability is not conducive to long-term innovation. You need, but you know, we have to do with what we have. And still, there is some globalization. It's not the same as before. I think there is one good aspect to this, is that Europe now realizes it has to innovate more. I think Europe has been the kind of sleeping beauty over the past 30, 40 years. You see, they thought they could rely on the US, on others, and not, you know, invest heavily in breakthrough high-tech innovation. And now the European and defense, and now the Europeans realize, I hope, that they need to rely on themselves more than in the past, and they need to, you know, to reverse this technological decline they've been experiencing.
But with oil prices up $20, $30, with LNG prices up 20, 30%, does that completely change the way that you see innovation and technology? Because people will be distracted or will be dealing with the crisis at hand.
You see, I think the Hormuz, to have the blockage of Hormuz is not great, and to have the rise in oil price is not a great thing. I don't think it will lead to disaster. I think what it will lead to is a kind of a slight increase in inflation by maybe 0.4%, whatever, and a slight growth slowdown, but not dramatic. So it's not, of course, I'd better not have the rise in oil price, but I don't think it will have, I don't see dramatic effects. You know, it's not that it will precipitate us in another global financial crisis in the next months. I don't see that. I see a limited slowdown and a limited rise in inflation.
I mean, given the models for which you won, of course, a Nobel Prize, where do you see Europe on the technological phase? But
the thing is that Europe is stuck in midterm incremental innovation. It's not doing enough breakthrough high-tech innovation. We don't have and why is that? That's the Draghi report, the Letta report. We don't have a true single market for goods and services. We don't have an integrated capital market. We don't have enough long-term funding of research. You know, to do breakthrough innovation, you need to fail. You need to be able to fail. To be able to need risk-taking. And long-term research finance is important if you want researchers to take risk. We need more venture capital to have startups take risk, and we need more institutional investors. We don't have enough of those. That's the ecosystem that we need to put in place in Europe.
Philippe Aghion, thank you so much for joining us. That was, of course, the 2025 Nobel Prize in Economics co-winner, professor also at the Collège de France and INSEAD. And with that, Anne, I'm going to send it back to you in London, and we'll have plenty more throughout the day here from Bank of America.
Francine, thank you. Bloomberg's Francine Lacroix, of course, on the ground for us. Let's not lose track of what's happening in the energy markets. Fran was talking about that a lot, about the higher oil and gas prices. We continue to witness Brent prices going substantially higher this morning, up by 8.8% on Brent. WTI, interestingly, only up by 1.4%. Is the market thinking that the US will be able to protect itself more from what is going on globally in energy markets? Gas prices up by 24% as well in just one day. Let's get to the source. Let's get to what has been driving those moves higher. Jumana Basekci is with us from Dubai, where, Jumana, we've seen considerable disruption to, in particular, gas infrastructure.
That's right, Anna. And the energy markets really reflecting the intensification once again of this war. It's day 20 now of the Iran war. And yesterday, major development in that Israel launched these airstrikes on that gas field, a major Iranian gas field known as South Pars. In retaliation, Iran said that GCC energy infrastructure would become legitimate targets. And indeed, that is what transpired over the course of the evening. Multiple projectiles being fired at various Gulf countries, refineries in Kuwait, gas fields in the UAE. But the big one being their successful targeting of the major LNG facility in Qatar, that is the Ras Laffan facility, one of the largest LNG export hub in the world, accounting for about 20% of the global supply of LNG. So no wonder you're seeing a reaction of markets today. But Qatar Energy put out a statement saying that the damage was actually extensive. And this is the difference between the attempted strike earlier on in the war versus what's happening now. The market has to account for the fact that not only is Iran going after upstream facilities now, but they're also managing to level damage. So we've moved on from the threat of damage to actually pricing in physical destruction and not just prolonged disruption with the closure of the Strait of Hormuz. So we have most definitely entered into a new paradigm in this war, with both sides not seeing really any inclination to de-intensify.
Okay, a new phase in this conflict. Jumana Pasechi on the ground for us live, of course, out of Dubai. Jumana, thank you for that update. For a broader take on these markets then, let's bring in Morwenna Konyan, Bloomberg Markets Today editor. Morwenna, we're looking, of course, at the impacts that the energy shock is having in terms of inflation and how central bank governors are thinking about this and central bank officials. We have the BOE, which is coming up, of course. Gilts are selling off pretty aggressively in the session today. It seems like traders are looking for a more hawkish response from the BOE. What are you looking for?
Well, yeah, we will be looking very closely to see what they say about that inflationary risk. Previously, there's been some indication that perhaps they can look through it slightly. Is this short term? But obviously, the longer that the conflict goes on and shows no sign of de-escalating, the more embedded those risks become. What we're seeing this morning is, those oil and gas prices shooting up once more, and traders have been adding quite aggressively to their bets on chances of an interest rate hike from the central bank as soon as the summer, July, with that more than fully priced in, certainly by the end of the year. And that's such a sharp reversal from what we had a few weeks ago. But even, at the close of yesterday, we only had about a 50% chance of seeing one this year. So quite a dramatic change there. And that is being seen filtering across the bond market at the moment. Sort of shorter dated gilts yields up about 12, 13 basis points, which is quite a lot more than in Europe, where we're also seeing expectations for hikes ramping up too.
And so the Bank of England focuses on inflation. It's got that mandate, but it keeps one eye on jobs. And the jobs story is a bit confused, isn't it? With the unemployment rate above 5%. So a lot of people have been bracing for negative news flow surrounding the labour market. But this morning we get data that showed actually job creation wasn't so bad in the last month.
No, the job market data was actually, a bit softer than expected. It did sort of show a bit of a weakening, but actually the sort of longer-term picture perhaps was a bit more positive. Unfortunately, really that is being overshadowed because that jobs data really points to January. It feels an incredibly long time ago now. It would anyway, but I think particularly we had a lot of economic data in February, which changed the picture. People were expecting rate cuts as soon as today, and now we're looking at the prospect of a hike as soon as the summer. So I think a lot of that data is a bit anachronistic. It shows that things were looking up a bit in the labour market. It was certainly the inflationary pressures as well, with wage increases, the pace coming down as was expected. So that should have all been supporting the Bank of England's case for rate cuts. But I think in the context, it's not so much today.
January, a long time ago. Markets have quickly then, Tom, been repricing hikes here in Europe, and we're looking ahead to those central bank decisions. We're also looking ahead to more from that conference in Paris with Francine. All of the guests will be weighing in from the Bank of America Paris conference. We'll be thinking about higher energy prices, higher oil, gas prices. That's certainly the dominant theme this morning.
Gas up 25% in Europe, oil prices up about 8% on Brent. You're seeing US futures pointing lower by 0.3%, and the sell-off here across European equities down 1.8%. These are the guests to think about then across the next hour for further commentary and insights on another significant day for these global markets. That is it for the opening trade. The pulse is up next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit, and these are your top stories. European natural gas prices soar more than 20% after Iran damaged the world's biggest LNG export plant. President Trump tries to stabilize markets by calling on Iran and Israel to de-escalate attacks on energy assets. And the Fed and the Bank of Japan hold rates with rising concerns over price pressures, while the Bank of England and the ECB are expected to follow suit later today. Of course, we discuss all of these topics this hour with guests including Vincent Mortier, the Amundi Chief Investment Officer. We speak also to Richard Clarida, the former Fed Vice Chair, and Katie Koch, the Chief Executive of TCW. Now, if you look at the markets, stocks in Europe and Asia are slumping after this fresh surge in oil and gas prices seem to be intensifying concerns that the war in the Middle East will stoke inflation and hit growth. Again, the sell-off comes as Brent extended gains from the start of the conflict to around 48%, climbing over $114. You can see currently 115.52. And then, of course, the other big story is not only what we're seeing in LNG prices and gas prices, but Fed officials also continue to expect one rate cut this year, though Chair Jay Powell emphasized that to resume lowering rates, they need to see progress in reducing inflation. So let's begin with Iran damaging the world's most important LNG export plant in Qatar after Israel attacked a giant gas field in Iran. Bloomberg's energy reporter Anthony Di Paola is in Dubai. Anthony, first of all, good morning. What do we know? I mean, do we know how much global energy markets will be affected by these attacks overnight?
Yeah, well, already oil has shot up. I think we were past 113, 115 area, and gas was also rising in Europe. So, it's the fact of hitting some energy assets. We saw that natural gas infrastructure hit in Iran yesterday. The Iranians immediately came out with some threats against specific facilities in the Gulf countries, all of them linked with U.S. joint venture partners. And we've seen those facilities being hit overnight. One of the biggest ones overnight was the Ras Laffan LNG complex in Qatar. There was some damage there, particularly to Shell's Pearl GTL, that's a gas to liquids plant in Qatar, which sustained considerable damage, and other facilities there as well. And just coming in now, we've seen reports of a drone hitting the Samref refinery that's in Yanbu on Saudi Arabia's Red Sea coast. That's a joint venture plant between Saudi Aramco, the state oil giant, and ExxonMobil. And that hit on Yanbu, which again, as I said, is on the Red Sea, Saudi Arabia's west coast. That's the first time during this war that we've seen a hit on an Aramco facility on the Red Sea. The Red Sea is the key export point for Aramco's crude now because they are shipping it across country on a pipeline and sending oil out through the port of Yanbu, and those refineries along the Red Sea coast are also pumping out diesel and sending it out to markets like Europe. So it's really a key area for Aramco's continued ability to serve the global market. So this is certainly an escalation in the attacks on energy capacity, Francine.
And so, Anthony, how much are markets now pricing in long-term energy disruption as the war continues?
Yeah, I mean, we'd seen oil hovering around the $100 mark before, so markets were not pricing that in. We've seen that jump today as they react to some of the news. But if we are seeing, and if we are going to see sustained damage on facilities there, it stands that prices could go up even higher. Right now, where we've been is that traders have been watching the Strait of Hormuz, which has been closed to most traffic, cutting off exports out of the Gulf. And they've been watching that for the potential to reopen quickly. And they've been watching the state of the assets in the Gulf. So if energy facilities are not damaged and they can quickly come back into production after the Strait of Hormuz is opened, that would contain prices. But if we're seeing damage and a longer closure of Hormuz, then we're going to see prices keep ticking up, being under pressure as markets lose supply and potentially lose supply for a longer period of time. So that will be a lot of pressure on the market, Francine.
Anthony, thanks so much. Anthony Di Paola, they're a Bloomberg energy reporter, talking us through what happened overnight and the longer-term trajectory for some of these energy markets. So far, the Fed and the BOJ have decided to hold rates. The ECB and the BOE are expected to do the same later today as rising oil prices complicate, of course, their efforts to tame inflation. Well, we're joined by Vincent Mortier. He's Chief Investment Officer of Amundi, and he's with me now. Mr. Mortier, thank you so much for joining us. It feels like the energy complex is upending everything. The markets are still staying quite cool. I mean, they have days of volatility, but how does it change your investment strategy going forward?
Well, I would say the next coming days will be very key to define what will happen next, because so far, until yesterday morning, markets were a little bit logical in a way. I mean, it was an oil price.
Logical or complacent?
It depends on which markets. I mean, a short-dated oil and gas shock. Backwardation, meaning the future prices were pointing to normalization by summer or September. Rates a little bit higher because of inflation expectations, but the curves also flattened because of stagflation possible, so lower economic growth. And equity markets have decided to look through, to say it will be short-lived. Now, since yesterday, and all the news flow which is happening, there is some doubts coming. Why? What if it lasts longer? And we have seen some very strange things happening. Gold underperforming, dollar not performing that well, which is strange in a shock. Bonds not a safe haven at all. Equity markets starting to correct slowly from a high point, but so a risk-off environment, but not unfolding the way we were used to. So to navigate is not easy.
Yeah.
I continue to believe that the parties involved will have an interest to find a solution, but the new thing in the equation is that the capabilities which has been destroyed, it will take lots of time to rebuild.
But so what I struggle sometimes to understand with the markets, certainly in this period, is that they thought there would be a quick resolution, and geopolitically there was no quick resolution that we could point to. So what is the market pricing in now? A protracted energy crisis, or still like a medium-term solution that's foundable?
The market has pivoted, I would say, in the last 24 hours, from a resolution within weeks to a resolution within months. It's not the same thing. I continue to believe that between China will start to feel the pain and will be more and more hungry on the situation, Iran, which will be depleted of financial and weapons, and US, of course, that the political cost will start to become high, and Europe is hit very hard by LNG prices. There will be a convergence of interest to cool down. The issue is that it's not one single party who can decide. It's not the US who can say everything is over. So we need to find a coalition that will solve the issue. There is a Strait of Hormuz, but we see in the last 24 hours that it goes beyond. There are all the production capabilities in various countries.
So what does it mean for central banks? Again, and there's a big difference in, what people are expecting from the Fed or what they're expecting from the ECB, but it's still fundamentally the same problem, which is a higher oil price.
Absolutely.
And whether a central bank looks through it or not.
So honestly, I don't. It's one of the toughest jobs around to be a central banker today, because you have two conflicting forces. So you've got indeed headline inflation, which will go up for sure. Core inflation, it remains to be seen, because in Europe we continue to import deflation. So core inflation might not rise that much, and growth will be softer from a low point in Europe. So if I were in the shoes of the Christine Lagarde, I won't hike, because the growth is too fragile. No. And the inflation spike might be short-lived. So I don't believe ECB will want to break the European growth. Fed is another dynamic, but we believe as well that Fed will continue to cut rates, maybe later, but they will continue. There are many reasons to believe that. And yesterday, actually, the FOMC minutes were opening all kind of scenarios, so nothing very...
So what happens to dollar, actually, in your scenarios? And we saw, I think, dollar strengthening a little bit. If it weakened more, this could be problematic for the euro.
Yes, so indeed, dollar should have performed better in the sequence, in theory. So it is also showing that there are some underlying forces at play, which are pointing to a weaken dollar at trend. So it is a scenario, your dollar is overvalued. And if the Fed cuts and ECB is on hold in the next semester, then US dollar will continue to soften in the context where the US deficit remains outsized. When you got 6 or 7% deficit on public spending, there is no other way out if you want to keep rates under control to soften the currency. So that's why we believe US dollar will continue to go down, and we are positioned for that. Short term, of course, it can strengthen a little bit, but actually, the moves on US dollar has been quite soft. Huh?
So how do you construct your portfolio right now? How much risk do you want in there, and where are your safe havens?
So our big conviction is to max diversify their portfolios. So we believe emerging markets have been hit too much, and there is a long-term value to be captured in Asia at large. India is very cheap today. It used to be expensive. It has become very cheap, very under own. China as well. Europe, we should not despair for Europe. I mean, there are some interesting situations. And so it's diversification in terms of countries, in terms of size of companies, of sectors. We don't want to put all our bets on US mega caps, for example, and also to diversify in terms of currencies. We believe that it's very important to protect against weakening of the dollar. We have just added some short-dated bonds because we think the market is too extreme in pricing hikes, in particular in Europe. So we bought recently quite a lot of 2-year dated bonds, and I think it will perform a lot. And so
what Europeans, so German, French, Italians, or German specifically?
It's more Germany, Italy, Spain, and France to a certain extent.
Is there anything you buy in the UK or in Japan, or are these idiosyncratic stories?
Japan is an interesting story, actually. We think the Japanese yen is very undervalued. BOG will hike later on. And in the context, we believe to have unhedged Japanese exposures can be an interesting story. And short-term rates can go up. We don't believe JGB, so 10-year or above, can go much higher. So we quite like the 10, 20 years JGB unhedged. I think it can perform quite well. UK is more debatable. We debated a lot. We have a long position on the gilts, which has not performed that well, to be frank. But we have kept it. So we believe BOE will be on hold for quite some time. And in that context, for the carry, gilts are quite interesting.
Okay, one thing that you'd be selling right now that maybe you liked in the last couple. So either something that you think is undervalued or in the markets, or that you'd like to sell.
Yeah, in terms of undervaluation, we have added short-dated bonds, gold. We continue to add gold. Okay. The underperformance of gold is a little bit surprising, I would say. Emerging markets at large, equities, LATAM, Asia, local currency bonds, which are very cheap now for some countries. And what we find overvalued is still the tech sector at large. Not all the tech sector, but many players. We think there are still many things that will happen. It will be fast and furious, and the market has not yet repriced everything. And there is a little bit complacency here. There won't be winners everywhere at all. So we have diversified away from the mega tech names in US, but elsewhere as well. Yeah, so it's this segment of the market where we are a little bit concerned.
Vincent Mortier, thank you so much for joining us. That was, of course, the Chief Investment Officer of Amundi, and we'll have plenty more throughout the day here in Paris. Coming up, we speak to Katie Koch, the Chief Executive of fixed income-focused investment firm TCW. That's coming up next, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
This is The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit. Now, turning now to fixed income markets. Beyond the geopolitical and inflation uncertainty, the world of private credit has been under scrutiny recently as investors worry that some firms are overexposed to software lending. My next guest argues that credit remains investable, but this is not a buy-everything market. Joining me now is Katie Koch, Chief Executive of the TCW Group. Katie, first of all, I'm so happy to speak to you. So thank you so much for coming here. Look, if you look at credit in general, but actually we've seen a little bit of a difference. The spreads have been widening, right, for both corporates and fixed income. Is that a good thing? Is that healthier?
Yeah, I think in general,
First of all, spreads haven't widened that much yet in credit. We're hoping more, and the news flow today will probably drive that. Overall at TCW, we're actually underweight credit, both in public and private markets. We came into the year that way, and we're hoping some of this news flow will give us the opportunity to deploy capital in both markets.
I mean, how do you see the news flow actually impacting your world, given all of the uncertainties, but also investors are behaving in different ways depending on which part of the market you're in?
That's right. I was actually thinking about you on the way here, because the last time we saw each other, you might remember this, was at a Billy Idol concert in January.
We feel so cool right now.
Yes, exactly. That was a lot, and that was fun. I was thinking on the way over here, it reminded me of a rock star that's more popular in my house, which is Taylor Swift. And two messages from that is, A, there's a lot going on right now, and B, we all need to calm down a little bit as it relates to private credit. So let me just tell you a little bit of context on us, because I think that will build credibility in what our view is. And then I want to just talk about kind of what is it, what's changed, and where the opportunity is. So in terms of context on us, we've been doing private credit at TCW for 26 years. Actually, 98% of managers started post-global financial crisis, which is a relevant data point we'll come back to. We also don't own any software exposure in our private credit portfolios. We also don't have wealth BDCs in our private credit portfolios. And I'm saying that not to take a victory lap, just to, again, build confidence and credibility that actually we're the beneficiary of things dislocating.
Is that because you saw something in software that you didn't want to touch?
It's such a good question. And no, it's not because we were massive visionaries around what was going to happen in software. It's actually because we maintain a lot of discipline.
Fine.
So we had leverage of 3 to 4 times when the market was at 5 to 6, because we have strong covenants and documentation. So you can either say that we didn't lend to software companies, or you could say they didn't want our expensive capital that was strongly documented. But either way, it led us to not having that exposure. And so I just want to remind people, because I think we're getting a little bit confused in this asset class, kind of what it is, what's changed, and then again where the opportunity is. So this is just bank lending. And bank lending as an asset class is as old as the Notre Dame Cathedral, which we all toured last night. Older, actually. It goes back to Mesopotamia. This is just the way we've financed companies forever. And if you make loans and you approach it as the negative art it is, which is trying to avoid mistakes, so you have contained leverage and good documentation and covenants, you will get your client's money back. So we think this asset class will persist. It's been around forever, and it will continue. Okay, so what's changed, and where are the problems that people are focused on now? What's changed is actually who's lending the money.
Right.
And post-global financial crisis, as you know well and as you've reported a lot, the lending's moved from banks to the asset managers. Now, have some of these asset managers lacked discipline? Have they made mistakes that we're now looking at? Yes. And what are some of those things that we should reflect on? Number one, did we allow these funds to become too big? Is a question we should ask ourselves. Number two, when the industry made these funds so big, did it give up discipline? Were covenants eroded? Did documentation get weaker? I do think some of that behavior did happen. And
so you would answer yes to the first two questions?
Yes, definitely. We think there is some misbehavior and some lack of discipline on that part, broadly. And then I would say the portfolio construction point is important, which is that I think the industry started to approach this more as a capital markets exercise of putting loans out versus portfolio construction. So the problem with software is that it became 20 to 30% of some of these portfolios. And this is leveraged finance. Things go wrong. Most of it, a lot of time. And so you just don't want all those things to go wrong in one sector, and then you need the documentation to be able to work out of it. And so there's going to be some reflection on what people could do better. But I want to end by saying, this is a massive opportunity. We just published a paper on this, which is available on the TCW website, which essentially says, as the crowds go for the exit, this is actually the moment where people should be buying. And so we're really excited about new loans and also about rescue opportunities in private credit.
Where do you see those? Because at the same time, if the war rages on in Iran, again, we can debate on what what that means for interest rates and things like that. But you could see, the investors, the famous saying of, you see who swims naked when the tide goes out.
That's right. I would just say, though, we can talk more about the war and the impact on liquid markets, but in general, that higher level of uncertainty is actually better for prospective returns, so we're going to get better spreads. It's going to be a more lender-friendly environment. You should be able to get better returns at better terms. You also are going to have enterprise value multiples that aren't going up and to the right. That's more healthy from a lending environment perspective. Base rates, because of oil and a lot of other reasons, are probably not going back to zero. Again, that's better for private credit as an asset class. So while yes, there were some mistakes made, and while people's instincts may be to run for the door, at TCW, we think this is an incredible opportunity. And we're sitting on half of our capital base is undeployed. So actually, this dislocation should be a great opportunity for our current clients, and we're encouraging other people to step in now as well.
So, Katie, so how do you see it? Are the next 3 months a kind of reckoning time where the ones that were undisciplined will face a lot of concern and scrutiny, and the ones that actually are in a better shape can find opportunities?
This is such an important question because for most of this asset class's short history, there's been very little manager dispersion. Everybody gets to be a genius when rates are zero and lending money. If you've actually had discipline this entire time, we're going to get very significant manager dispersion. And for us, we're excited about that. We know we feel confident we'll get our money back for our clients because we've been doing it for 26 years. In 26 years, we've had 6 losses. And so this should be a great opportunity for us to differentiate ourselves and for new vintages to deliver great returns.
Where do you see the best opportunities?
Really, at this point, you can get them across all sectors. Okay. We think opportunity set will widen, particularly if the volatility increases. And at the moment, the place we're actually deploying the most capital is in rescue opportunities, where you are in the senior part of the capital structure. You can get a high current coupon. It's the only place where we'll deliberately pick and get some warrants on the equity, and we end up as equity owners in half the situations. And those rescue opportunities should not only outperform the debt market, I think it's also possible, given some of the headwinds facing private equity, that it's a very good risk-adjusted way to actually outperform potentially private equity too.
But you don't see more opportunities, and I don't know whether you look through some of these oil and gas prices, or whether that presents extra opportunities because of everything that's going on there.
First, I would say in general, across TCW, and just if I'd said what sectors that we're interested in, both in debt as well as equity markets, one is definitely power transformation in the U.S., and the other would be AI, and we can talk about the puts and takes of that. For credibility, I want to say we launched an AI equity fund a decade ago, so it wasn't like we just started using ChatGPT and said, let's launch a fund. We've been doing it a long time. But those are places where you have this great intersection of high structural demand and historical underinvestment. And so we see tremendous opportunity, regardless of what happens in the macro environment, to invest in both of those spaces.
What do you think will happen in the macro environment?
I mean, I lack the proverbial crystal ball here, but what I would say is that in these moments of dislocation, war in particular, or geopolitics just generally, it tends to create volatility, which is obviously good for active managers, but not necessarily completely change the economic regime. So the question is kind of like, how did we come into this year and how has it changed? Actually, we came into this year already very late cycle, which is relevant across all asset classes. We had a cooling economy, right? A slowing labor market, inflation was under control, and in general, it was late cycle behavior, which led us to be positioned in liquidity, quality, and we're very underweight credit, as I said, versus peers in the benchmark for those reasons. Okay, then it was potentially offset by the fact that we were going to attack affordability, that there was going to be tax relief, and all these stimulative things that the president wanted to do. I'm speaking now about the U.S., just as the world's largest economy, so place to start. And so those risks were in balance. What I would say has happened with the war is that the risks have tilted more negative. And so there is, to us, a stronger possibility that we're going to get we've already obviously had underperformance in equities. It hasn't yet come to credit markets, but we do think that there could be a break in credit markets.
Katie, thank you so much for joining us. Katie Koch there, Chief Executive of the TCW Group. Coming up, the Iran conflict, of course, and the impact on U.S. interest rates. We'll discuss all of this with Richard Clarida, the former Fed Vice Chair and now Global Economic Advisor at PIMCO. He's coming up next from Paris, and this is Bloomberg.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris for the Bank of America Global Investor Summit, and these are your top stories. European natural gas prices soar. Brent gains 10% after Iran damaged the world's biggest LNG export plant. President Trump tries to stabilize markets by calling on Iran and Israel to de-escalate attacks on energy assets, and the Fed and the Bank of Japan hold rates with rising concerns over price pressures, while the Bank of England and the ECB are expected to follow suit a little bit later. So President Trump has called for de-escalation of attacks on Middle Eastern energy sites after Iranian and Israeli strikes on major gas fields jolted global markets. It comes just days after Trump also warned it would be very bad for the future of NATO if they did not help secure the Strait of Hormuz. Well, joining us now is Benedetta Berti, Secretary General of the NATO Parliamentary Assembly. So thank you so much, Benedetta, for joining us. First of all, do you expect NATO in some shape or form to get involved in securing the Strait of Hormuz?
Well, I would say NATO has not been involved militarily or otherwise in the U.S. And Israeli operations against Iran. But what NATO has done is continue to serve its core purpose, which is to ensure the security and defense of all allies. And in that context, as you know, NATO has successfully intercepted multiple ballistic missiles that Iran launched towards NATO ally Turkey. So that is clearly the priority. That said, the NATO Secretary General has also been very clear that all allies share an interest in having an open Strait of Hormuz, and in that context, there are conversations between different allies on how to best contribute to that goal.
I mean, President Trump again said there would be some kind of consequences if NATO weren't to get involved more, and then he walked back those comments. Do you think there will be, if not retaliation, a consequence for the alliance if they don't get involved?
I think within NATO, the conversation over the last couple of years has been very clear, and that is about European allies doing more and taking a leading role for the deterrence and defense of the European continent in NATO. That is what we're focused on. We're focused on that by meeting the 5% defense spending plan, by enhancing defense capabilities, and of course by making sure that no ally is threatened, for example, by intercepting this reckless Iranian attacks against Turkey.
I also want to talk to you about Ukraine, because there's been, of course, U.S. weapons purchased by Europe and then, for help in Ukraine. Have those been delayed or affected by the war in Iran?
So I would say through NATO, through the Pearl initiative, NATO has been supporting individual allies to purchase life-saving interceptors, including Patriot missile systems, from the United States to Ukraine. And over 75% of those interceptors provided to Ukraine have been purchased through Pearl. So this program is working. And I think just very recently, President Zelensky talked to NATO Secretary General Mark Rutte about enhancing what we do in the context of Pearl. So clearly that commitment remains from all NATO allies to support Ukraine.
And you don't see any change going forward because some of the weaponry that the U.S. were selling to Europe is needed for the U.S. combat in Iran?
I think there's many lessons that we're learning from the war in Ukraine and also from what we're seeing in Iran, and that is the importance to really scale and surge productions. And we do have that issue. We do know we need more interceptors. We also need to find cheaper ways to shoot down drones. So we do know that there is a cost asymmetry that we need to address. I think we are doing that. And of course, when there are multiple threats and challenges, there is a problem of how do you surge production.
How do you do that? Again, so where are the sources where you could diversify or have, anti-missiles and anti-drones that are cheaper?
So there are many things you can do. Firstly, within Europe, we need to continue to invest more in defense so that we send a demand signal to industry that this is not a temporary blip, this is a sustained demand so they can expand production. And when we do that credibly, it works. Look, for example, on ammunitions. We see that we've been able to incredibly sixfold increase in just a couple of years of production of ammunition. So we need to do that. We need to invest more in sensors. Some of those are commercial. We can put those, we can field those relatively cheaply, and those help us to better intercept drones. We can invest in energy laser weapons. There are ways to intercept drones that are cheaper. And then we also need those higher-end capabilities like high-end interceptor, the Patriot system to ultimately intercept ballistic missiles. But we need to diversify, invest in innovation, and make sure that we address this cost asymmetry.
Benedetta, are European nations and Canada doing enough actually to make sure that Europe is able to defend itself better without the need of the U.S.?
They're doing more, and that's without a question. We still have a long way to go between now and when we get to that 5% for all allies, and between now and when we get to have all the capabilities that we need to have European allies in the lead for the conventional deterrence and defense. But it's happening. We see more forces, more capabilities, gradually also more strategic enablers, but there's no question there's a gap.
I was going to ask you exactly about that. Where are those critical gaps?
There's a few. For example, when it comes to the integrated air and missile defense, we know that Europeans, a year ago, the Secretary General of NATO said we need a 400% increase in European capabilities. Now we need a little bit less because we have purchased, but there's still a long way to go. So there's a shopping list that is pretty detailed. I would put integrated air and missile defense, deep precision strikes capabilities up on the top.
And given everything that's going on, is that list being looked at more intently? Do you think there's there's a bigger will in a way because security around the world has gotten a lot more uncertain?
I would say that's certainly the case. There's more political will, and we see that translated in more defense spending, but there's also more awareness that we need to be more disruptive, more integrated emerging and disruptive technologies. We cannot just keep doing things the old way.
I mean, are we running out of weapons because so much is being used in Iran?
I wouldn't say we're running out, but I see this is a clear signal that we need to seriously invest in our ability to surge and scale at speed, because in the future we're going to have to outproduce and out-innovate any potential adversary.
Okay, Benedetta, thank you so much for joining us. That was Benedetta Berti, Secretary General of the NATO Parliamentary Assembly. Now, coming up, analysts are warning that the current rise in oil and gas prices and destruction of Middle East energy infrastructure will have a long-term effect on inflation. Now, earlier on, I spoke to Philippe Aguillon, the 2025 Nobel Prize in Economics co-winner and professor at Collège de France at INSEAD, about what this means for innovation and technology.
I think the Hormuz, to have the blockage of Hormuz is not great, and to have the rise in oil price is not a great thing. I don't think it will lead to disaster. I think what it will lead to is a kind of a slight increase in inflation by maybe 0.4%, whatever, and a slight growth slowdown.
Where do you see Europe on the technological phase?
But the thing is that Europe is stuck in midterm incremental innovation. It's not doing enough breakthrough high-tech innovation. We don't have and why is that? That's the Draghi report, the Letta report. We don't have a true single market for goods and services. We don't have an integrated capital market. We don't have enough long-term funding of research. You know, to do breakthrough innovation, you need to fail. You need to be able to fail. To be able to need to risk-taking. And long-term research finance is important to, if you want researchers to take risk. We need more venture capital to have startups take risk.
Well, that was Philippe Aghion, the 2025 Nobel Prize in Economics co-winner and professor at Collège de France at INSEAD. Let's quickly check on the markets before we go to what we heard from the Federal Reserve yesterday. First of all, so the U.S. Fed, of course, keeping interest rates untouched. It says it won't cut again until inflation resumes cooling. Now, the chair, Jay Powell, emphasized in his press conference that it's too soon to tell what impact a surge in oil prices will have on the U.S. economy.
The thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That you know, to your point, if we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through.
Well, I'm delighted to be joined by Richard Clarida, PIMCO economic advisor, and of course, former Fed vice chair who joins us now from Paris. Richard, thank you for joining us.
Yeah, look forward to it.
Do you miss being part of the Fed? I mean, everything's going on. So if you're in charge of the Fed today, do you look through these higher oil prices?
I think that's the first inclination, is to look through. But, you know, we've gone through, for instance, we've gone through 5 years where inflation's been too damn high, and the Fed and other central banks are cognizant of that. And so they're not going to be relaxed, but their initial inclination is to look through.
I mean, how is this conflict and actually this energy crisis different to the past?
Well, what it does is it pushes up prices, which the Fed doesn't like, but it tends to slow activity and push up unemployment, which the Fed doesn't like either. So it's a balancing act. Right now, they think the trend in inflation, but for the tariffs and the energy shock, is downward, and they're banking on that, but they're going to keep looking at the data.
So I find it really interesting. Market pricing still has a Fed cuts, but not for the ECB.
Yeah.
So what? I mean, they're dealing with the same problem. So someone has to be wrong.
Well, in part, I think it reflects communication. I mean, the ECB deserves, I think, a lot of credit. They disinflated, got inflation down to target until quite recently. The Fed still has some ways to go, but the Fed's been communicating differently through rhetoric and through the dot and the other projections. I think that's the main difference.
Richard, how do you see this really impacting the U.S. economy? So we talked a little bit about inflation, but could it actually, you know, we maybe it's a bit too soon, but we're hearing of chief executives thinking about CapEx. I don't know whether this means that people go shopping less, and if it hits the consumer, then we could be in trouble.
Well, I think the longer this goes on, the more significant are the negative consequences. Obviously, the U.S. is an energy exporter, but the U.S. still imports a lot of goods that have an energy content. It'll erode the value of paychecks. And so I think a prolonged energy shock, which is not priced in right now, but if it persists, it does slow the economy, notwithstanding the CapEx boom, for example, that we're seeing in AI.
What is priced in? Because in the last couple of days, there was a belief in the market that this crisis would be short-lived.
Yeah.
But geopolitically, we didn't see any signs of that.
No, I'm not a geopolitical expert, but all the headlines look pretty concerning to me. There is an oil futures market, and the futures price of oil about a year out is around $70 a barrel, not 100. So at least right now, the oil investors seem to think this is going to end pretty quickly. But right now, that's just a guess.
You know, before this, we were talking about private credit, or before the energy crisis, private credit, but also AI and what that meant for software companies. Like, again, how do you see that? We don't talk about it, but underlying, there could be a real shakeout in private credit because of what's happening in the energy crisis.
Well, potentially, and indeed, you know, it's a market that's grown very rapidly from virtually nothing to $2 trillion. It's really not been tested in a downturn, and my PIMCO colleagues have made reference to that. We think there are a lot of opportunities in credit, but investors need to be careful and do their homework.
Yeah, where do you see the opportunities?
Well, in particular, the parts of private credit PIMCO is really focused on is really asset-backed lending against tangible assets like data centers, for example, or aircraft leases, or other tangible collateralized assets, as opposed to just direct lending into a private equity transaction.
Richard, I mean, also talking about the Fed and, you know, the appointment of Kevin Warsh, there was a legal ruling last week quashing subpoenas issued by the Fed, by the DOJ. Does that delay the appointments or the confirmation of Kevin Warsh?
Potentially, it will depend on, I think, how the administration pursues the appeal. But Francine, what's important to know is that Kevin Warsh cannot become Fed chair until he's confirmed by the Senate.
Right.
And that confirmation is being held up by Senator Tillis, who said he won't vote on any Fed nominee until this matter is resolved. And so right now, it's a game of chicken, essentially. But we do expect it will get resolved and that Warsh will eventually end up in the job.
But I mean, could you see, you know, for a while, the chair of the Board of Governors being empty or vacant? And I don't know, I mean, what happens then?
So what Chair Powell said yesterday in his press conference is that he will stay on at least until Warsh arrives. Technically, Jay Powell is two chairs. He's the chair of the Open Market Committee, and he's also the chair of the Board of Governors, and he'll remain in both jobs until Kevin Warsh arrives. And then he also said he hasn't made up his mind whether or not he'll stay on as a Fed governor, which he can do until 2028.
Do you think he will?
I wouldn't expect him to stay until 2028, but he may stay for a while because he really cares about preserving the independence of the Federal Reserve through this transition.
Richard, talk to me a little bit about what you see as the main risk for the Fed right now. And again, I don't know whether it's market pricing that that could be a little bit off or too much volatility.
Well, again, the Fed has missed on its inflation target for 5 years, and so ultimately the Fed's job is price stability. So an important risk is how quickly inflation returns back towards the target. Some of that is out of the Fed's hands, obviously, in particular, the higher oil prices right now. I think a second important risk for the Fed, although I think it will navigate this, is this transition from the Powell Fed to the Warsh Fed, and how Kevin Warsh, who I've known for many years, assumes the role and works with his colleagues. Maybe just to remind your viewers, within the Fed, as established by the statute, the chair only has one vote on interest rates. So we tend to talk about the Powell Fed or the Greenspan Fed, but ultimately the power of the Fed chair is the power of persuasion. And so a risk, which I think the Fed will navigate, is this transition to Kevin Warsh as the new chair.
So do you think the markets think that, you know, the markets think that this is going to be a dovish Fed? Are they miscalculating that or mispricing it?
Well, I think that the markets believe that the Fed, at minimum under Warsh, will get the federal funds rate, interest rate, down to what the Fed thinks of as a neutral level, around 3%. I think beyond that, the expectation is rates will probably stay there until the next downturn, whenever that is. And then the Fed does have room to cut rates if it needs to.
Have you been surprised by the way dollar's been behaving?
Well, it is one thing we have learned in the last 3 weeks is the dollar has really not lost its role in times of turmoil. You know, there was a lot of talk of sell America a year ago, and the dollar has moved up. So no, we're not surprised. We do think the dollar will continue to be the global reserve currency and reserve asset, and this episode sort of reminds us of that.
Richard, great to speak to you, as always.
Likewise.
Thank you so much for joining us.
Me.
That was Richard Clarida, PIMCO economic advisor, and of course, former Fed vice chair. Coming up, we speak to Vanessa Holtz, the Bank of America's France head and Securities Europe chief executive officer. That will also be a good conversation on the markets and, of course, this energy crisis. This is Bloomberg.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Discussions here at the Bank of America Global Investor Summit being, of course, dominated by geopolitical risk and the conflict in Iran, coinciding with key central bank rate decisions with the BOE and the ECB later today. Now, let's discuss what it all means for the banking sector in Europe with Vanessa Holtz, Bank of America France Chief Executive. Vanessa, as always, thank you so much for joining us. First of all, this dynamic with the Middle East, but also this energy crisis, does it change your outlook on banking in Europe or more on the markets?
So we've seen obviously the energy crisis and the conflict in Iran has created quite a lot of volatility in the market. We've seen obviously a substantial sector differentiation across equity, and the European banking has suffered. We've seen a lot of stock decreasing on the European banking, and obviously that has a strength. Stagflation is now playing on the cards, so banking sector obviously is impacted by potential raise interest rate. We were in an easing cycle, and now we completely shifted to a potentially hike, in Europe and obviously in UK, and that had an impact obviously on the sectors.
So do you feel like the European banking sector, I mean, it does feel it's much better at withholding anything thrown at it. Do you worry also about private markets and private credit and the impact this could have through secondary effects?
It's definitely a secondary effect we've seen, but there was obviously some concern about the private credits way before obviously the strike obviously on Iran. So I think it has to do as well with AI, the leverage that the private credit had, in loan and refinancing obviously of AI and software technology. But yes, it exacerbates as well, the private credit. Although even though we've seen some redemption, I don't think right now it's a systemic crisis, and we are well positioned.
Not systemic, but is there a reckoning coming for private credit?
Yeah, I mean, in a way, when you look at the private credit, it's about contagion and how it will affect the overall industry on that market. So, but it's something that obviously we keep watching. And the market keeps watching. And we've seen, obviously, before that it had a big impact and some kind of systemic impact. We haven't seen that yet, though.
But is that, when you look at market behavior, I don't know whether they're underpricing or overpricing a kind of, the volatility going forward, because there is a bout of volatility, but, they're looking for good news. It feels like the market just wants this war to be over almost at any cost, apart from today, where they're starting to realize it could be longer term.
And you've seen that, obviously, just following the weekend when we had, obviously, the Iran. The market was a bit in denial. There was very muted movement in the market. Obviously, afterwards, it got exacerbated. When you look at the TTF market or the older market, you have the volatility massively spiking, but then decreasing as massively, 2 or 3 days later. So it looks like sometimes the market is a bit myopic, looking at the short-term good news, and get used to the good news as well. So that means, and the pricing, definitely pricing, when you look at the oil prices on the future and the long run, they're pricing definitely oil prices below 100. So it is definitely something that is the market is getting used to, and I think probably sometimes a bit too confident.
Yeah, how do you explain that? And also the correlations between asset classes have been, I don't know if they're broken or it's just a new normal.
Well, I wouldn't think it's the new normal because we've seen some move that we haven't seen for quite some time. And you're right, it's about, the contagion across market. It started with a commodity shock. Then we had obviously a rate massive impact. Some big positions, that have been put on have been de-risking, degrossing, and winding quite seriously. Huge spike on the front end of the curve. And we've seen as well a lot of impact on the equity market. I mean, some of the equity sectors that have been overbought all 2025 and beginning of 2026 have been the ones that have been hit the most, whether it's in Asian market. We've seen a huge sector rotation as well. Yeah. The banking sector that has performed massively has underperformed, obviously, from that front. So you need to be agile in that market. But it's really looking at what our client needs and making sure that we can continue to serve them on any market.
Vanessa, as country head for France, there's a lot of political turmoil in France. I mean, how will that impact not your operations, but how does it impact actually the value that investors give to French equities and French business?
So I think overall we have election in almost a year now, in May 2027. There was definitely some instability in France, and we're looking for more visibility. Investors are definitely looking for that to make sure where they allocate their portfolio. But I think, overall, Europe is quite strong. It needs to get its act together. We need to have the single market. We need to have the saving investment union. We need to be able to offer some product to our investor to avoid all these savings that are in Europe that are huge to go away. We need financing at home. And I think that's a critical path for Europe.
Yeah, and it seems, we always say that don't let a good crisis go to waste, and that's certainly true for the European Union. But is this too big a crisis for Europe to forge ahead with some of the banking union and capital markets union that you're talking about?
I think it's actually the opposite. I think it's when we have, a big crisis, and we've seen that during COVID, where Europe gets it together, the fragmentation doesn't exist. So I think right now we have an urgent call to action. It is now, it's not in 2 years. And I think that's probably the time where they need to do, whether it's on defense, on security, on energy disruption, that Europe needs to act as one.
I mean, will we get a banking union in our lifetime? I feel like I've been asking for the last 15 years.
That's true. We've been talking about the last 14 years, you're right. But I think we're making progress. It's way too slow. We need to be able to operate at scale. We need that pace. We have the roadmap. Everything, I think, is written. It's just the implementation. But again, fragmented, making sure that Europe gets its act together now and not later, because that might be too late to compete.
Vanessa, thank you so much for joining us. That was Vanessa Holtz, the Bank of America France Chief Executive. Now, don't miss our interview a little bit later also with Martin Schlegel, the Swiss National Bank President of the SNB, for the right decision. Now, plenty more to come, of course, from Paris, including Michael Hartnett, the Chief Investment Strategist for Global Research at Bank of America. If you look at markets, of course, there's a lot going on. Oil and gas prices are jumping. Again, Iranian missiles have inflicted extensive damage on a Qatari complex housing the world's largest liquefied natural gas plant, and also other facilities in Abu Dhabi, Kuwait, Saudi Arabia. They were also hit. So we look, for example, at Brent, it's above 115. President Trump saying that, look, he's been pressing for de-escalation, certainly in the last 24 hours, asking, for example, Israel to refrain from further strikes on Iran's South Pars gas field. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Today, the FOMC decided to leave our policy rate unchanged.
They decided to just basically completely ignore the Middle Eastern shock that we're facing here.
They're basically saying all of this going on in the Middle East is a speed bump.
I'm not really taking the SEP or the dots very seriously.
There's not a huge amount of forecast accuracy here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, wrestling with escalation. Major energy assets taking significant hits across the Middle East, sending Brent crude surging and fueling another spike in gas prices, leaving President Trump struggling to stop the situation spinning out of control. That story is where we begin this hour. The White House looking to limit the fallout from an Israeli strike on Iranian gas fields. Retaliatory strikes causing extensive damage to a Qatari complex housing the world's largest LNG export plant. The president playing down U.S. involvement, suggesting no more such strikes will be made unless Iran continues to target similar assets in Qatar. It's a struggle to turn down the temperature.
Yeah, right now we're talking not just about oil barrels and gas shipments that aren't traveling in the strait, but we're also talking about barrels that are not going to come back so quickly because of energy fields that are getting struck. Halima Croft of IBC really nailed this. She said, "We think there may be too much emphasis on the taco trade, as Iran could continue attacks even if President Trump seeks to call time to restore a measure of deterrence against future American military action."
And they are continuing attacks. We saw a huge port on the Red Sea, a refinery at that port in Saudi Arabia that was hit today. Yesterday, it was all about Qatar. This is a new phase of the war. Military installations are not only the targets now, actual energy infrastructure, and I'm talking about massive energy infrastructure facilities are at play right now. And that is why you see Brent crude absolutely spiking in response to what is going on in the region.
Let's work through the price action piece by piece. Just unpack this briefly. Look at the US versus Europe in the equity market so far this morning. Equity futures stateside on the S&P 500 just about unchanged. Check out Europe on the DAX this morning, down by more than 2%. And look at this, the spread that's opening up between WTI and Brent, close to $20 earlier on this morning. Brent up by 7, WTI unchanged. What do you think that is starting to speak to?
It's starting to speak to a divergence between two markets, both the European Brent market and the U.S. market, which implies that they can stay separated for a prolonged period of time. Sure, the physical barrels that are coming from Iran and from Iraq and from Saudi Arabia are going largely to Europe. You also see, of course, natural gas and a question around exactly where they're going to get it, given that a fifth of the supplies are now potentially offline for a while. At the same time, is there no coming together of these two markets, that really raises a question.
The United States is a net energy exporter. I think what the market is reading right now, that besides the Jones Act waiver, which yesterday the president signed, which is going to mean that any vessel, it doesn't need to be a U.S. vessel, can carry energy products to any port in the United States. The market, I think, is starting to price in the fact that the next step this administration can take is banning export of products. And that is why WTI is tamed and Brent is going to go potentially parabolic.
Brent crude this morning, 115 and higher by more than 7%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management with stocks pulling back, Michael Hartnett of Bank of America as private credit concerns press on, and Krishna Gua of Evercore as Fed Chair Jay Powell vows to stay on through the DOJ investigation. We begin this hour with our top story. Crude surging past 110 following strikes on major energy sites across the Middle East. Bloomberg's Jumana Basechi joins us now for more from Dubai. Jumana, good morning. Escalation in the last 24 hours.
Indeed, John, and that's kind of been the theme every single day. Day 20 of this war, another major escalation overnight. And after those Israeli airstrikes on Iran's main gas field, the South Pars gas field, Iran did vow to retaliate in a meaningful capacity. They said that the energy infrastructure sites across the Gulf would be legitimate targets, and indeed that is what transpired in the evening yesterday. They have essentially lashed out at multiple Gulf states and at some of these key areas, including refineries in Kuwait, refineries in Riyadh. We've just heard as well in the past hour that they also launched attacks at the Yanbu port. That is a key port on the Red Sea. So they're targeting a different part of a whole different geography now, and has been a key source for Saudi Arabia to reroute some of their own oil. But I guess the biggest development, the most notable one, has been them targeting that Ras Laffan facility once again in Qatar. Now, in the early days of the war, they did target the same facility, which led Qatar Energy to announce this force majeure. But the difference is yesterday, while Qatar authorities successfully intercepted 4 missiles, one of the missiles managed to penetrate, it broke through and caused, quote unquote, extensive damage. And that is the language that was put out by Qatar Energies themselves. And so we've moved on to a new phase here where the market doesn't just have to account for the disruption of flows and the fact that the flows are being stuck in and around the Persian Gulf, but possible destruction of physical supply as well. And this is the key game-changing moment overnight. President Trump is trying to distance himself from those initial Israeli airstrikes on the Iranian gas fields. But I will say the response that's coming through from the Gulf states really speaks to one of anger and the fact that this, from their perspective, is a massive game changer. The perception is that Iran have really crossed the red line here. You don't have to go so far. The ADNOC CEO, Sultan Al-Jaber, just put up a comment on LinkedIn saying that this weaponization of energy needs to stop. Civilian infrastructure should not be a target. The Saudi foreign minister has gone one step further and said that their patience is not indefinite, and Saudi Arabia reserves the right to respond in a political fashion or, and he adds, in a non-political fashion as well. Qatar Ministry of Foreign Affairs put out several statements overnight calling this a flagrant violation of their sovereignty. They also kicked out the military and the security, I should say, security and political attachés that Iran had in the country. So a major escalation.
Jumana with the latest. Jumana, thank you. Jumana Basechi out of Dubai, leading our coverage out of the region again this morning. This is odd. The president attempting to distance himself from events in the last 24 hours. Axios standing by their reporting. We've touched on that a few times. The strike was carried out in coordination with and with the approval of the United States.
Yeah, and the same reporter who broke the news initially came back and said when he spoke to a number of officials, both in the U.S. as well as in Israel, they confirmed that the U.S. was aware of this. It is a real question. What is the signal that President Trump is trying to distance himself and distance the United States from these strikes? Is that an attempt to de-escalate things? Is this an attempt for domestic popularity? Is this an attempt to potentially placate some of the Saudi Arabian and UAE leaders? A real question about the signal more than the actual fact here.
Our reporting as well, the U.S. was aware of what was going on in terms of Israel going after South Pars, didn't participate, but was aware. Jumana touched on a really important point right now. The capitals in the Gulf are turning their back on Tehran in a very dramatic way. They are very annoyed and they think they have crossed the red line. On top of that, though, the Wall Street Journal says Arab governments are also furious about Israel's attack
and the U.S.'s failure to head it off.
Let's get to the view on Wall Street this morning. Seema Shah of Principal Asset Management writing up, base case remains that the disruption to oil markets is ultimately transient. The pullback in global equities, though, particularly in the U.S., has not yet been sufficient to warrant adding risk. Seema joins us now for more. Seema, welcome to the show. Let's pick up on a market move that we touched on at the start of this hour. The gap that's opening up between Brent and WTI. That spread is very wide this morning. What do you think it speaks to?
Hi, John. Well, I mean, as you said, it's really a focus on the fact that Europe is so much more exposed to this conflict. The economic impact for Europe could be considerably greater than what we could expect for the US. And I think a lot of this is in relation to certainly to what you're talking about with this spread opening up. From a portfolio perspective, this is really key because, as you know, international markets have outperformed the US, had outperformed at the beginning of the year. And you've seen a lot of flows into international markets, moving that kind of asset allocation to an overweight international exposure. And this is a really uncomfortable time, I think, for investors.
You mentioned dislocations and potential opportunities. Has a gap opened up, not in the US, but in international equities that gives you the opportunity to step in?
Well, so look, there has been a gap opened up, and in some ways you could look at it as an opportunity. But unfortunately, as we're seeing with exposures across all markets, it's just too early to be making any key portfolio decisions when there is so much uncertainty on board. I would say that the escalation overnight has clearly increased the downside risks. The base case scenarios of this being quite a short-lived attack, conflict where you see oil prices then returning back to their pre-crisis levels, that is receding quite quickly. So I think at some point there will need to be reallocations. At the moment, though, investors are almost paralyzed, waiting to see how the conflict ends. And we saw this certainly from Jerome Powell yesterday, and I expect that to come through from the other central banks, their decisions this week.
Seema, it does seem like to the degree that people are paralyzed, they are making some moves, and it's back into U.S. assets. And in part, it speaks to this divide between Brent and WTI. It seems like the United States, for now, is more insulated to the price shock that is really rippling through emerging markets and through Europe. Do you think that, once again, there is a haven quality to U.S. assets that you also are disproportionately allocating to?
Absolutely. I mean, one of the things that we've seen is the US has reasserted itself, has reminded everyone else again that when there are headwinds and when there are shocks, the US tends to be the outperformer because it's considered to be more resilient. Now, of course, in this situation, this is very specific, given that the US is an oil and energy exporter. But I think that for investors, you're reminded this is a safe haven. And of course, with that comes a technology trade. Tech, which had been beaten up a few weeks ago, has been a reminder to investors that, look, when you're going through tough times, particularly from a macro perspective, tech is a relatively macro-agnostic asset class. And it's one of the few asset classes which shows a lot of very strong balance sheet, strong cash flow. And essentially, that's where investors want to be focusing on in moments of difficulty and turbulence like we're seeing right now.
Seema, are you getting more concerned about risk assets more broadly? Because, as you said, the central banks globally are having trouble responding to what ultimately could be a stagflationary shock. Currently, we're looking at a Fed funds rate that's not pricing in a rate cut until October 2027.
Right, and we've seen historically that equity markets, for example, typically perform worse in a geopolitical crisis when the Fed, other central banks, hike in response to the increase in inflation. So certainly that is what markets are really looking out for, which is the way the Fed, the ECB, the Bank of England, et cetera, are going to be moving. But, at this stage, just like investors aren't really sure about how to respond to this, it certainly seems like that the same from the central banks as well, waiting to see how this pans out, how do the economic forecasts adjust. There is just so much uncertainty with this specific conflict that it is making the positioning decisions very tough.
Seema, do they not know how to respond, or have they been conditioned differently? Elisa brought up this note from RBC's Halima Croft, who says, we think there may be too much emphasis on the taco trade because Iran could continue these tactics. Do you think that the market is starting to wake up that Donald Trump himself cannot control this outcome?
Yeah, I think that is such an important point. As you said, the first 2 weeks of the conflict, their view was that, we've seen from many times in the past that geopolitical conflicts tend to be very short-lived. That was one. But the second point being that the Trump administration would essentially call victory early days because of concerns about affordability and in a midterm election year. Now, in the last week or so, we have seen that dynamic shifting, where there is greater understanding that this may not be the US's ability to call victory and leave. This is very much this is becoming an area where Iran can call the shots. And that is one of the reasons why the expectations for oil prices to jump right back down again is fading. And so we would certainly assume at this point in time that oil prices, energy prices worldwide will stay fairly elevated through the rest of the year, even if the conflict comes to an end in the next few days, which at this point in time seems very unlikely.
Hey, Seema, good to see you. Thanks for being here. Seema Shah there of Principal Asset Management. So what have we learned in the last 24 hours? There is no central bank circuit breaker coming anytime soon. And as we've witnessed over the past few days, this isn't totally in the president's hands. Someone else has control as well.
Typically, the playbook is when you get a disruption, especially geopolitical, you wait until things get bad enough, and then there's a policy response. And what you just pointed out is that there isn't exactly a policy response that's as obvious as there has been in the past. The Fed is not necessarily in play here, and frankly, President Trump may not hold all the cards to unilaterally turn this off.
Oil surging this morning, Brent crude specifically, equities just about unchanged stateside, rolling over in Europe. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. President Trump hoping to pare back attacks on Middle East energy assets after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Fed Chair Jay Powell isn't going anywhere. Powell saying he has no plans to leave his post until the DOJ finishes its investigation into him and the central bank. Powell adding that he has not yet made a decision about whether he will serve his full term as governor, which runs until 2028. And we are seeing Micron shares falling nearly 5% in the pre-market. The company warning it will need to spend heavily on production to meet demand. It expects capital spending to be above $25 billion this fiscal year, the spending reflecting the cost of keeping up with demand for Micron's memory chips, especially those components used in AI computing. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next on the program, pressing on in Iran.
We've defined the objectives of Operation Epic Fury very clearly, which is, of course, to wipe out Iran's ballistic missile arsenal. The United States military has a lot of capabilities. They still do have tricks up their sleeve.
Up next, we'll get the latest from Washington, D.C. We'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
If you saw this morning, you'd have no idea what's been happening in the commodity market overnight. Equity futures just about unchanged on the S&P, down 0.1% on the Nasdaq, down by 0.2. Check out the moves in crude. Brent overnight a high of 119.13 and right now around 115. We've talked lots about that spread opening up between Brent and WTI. It is wide and got very close to $20 earlier this morning.
These two markets are diverging at the fastest pace and the most, barring the pandemic and a couple days there, going back to 2013, at least at one point. And the argument here is that European markets are much more affected by the barrels coming out of the Middle East. Is there something more? As Anne-Marie was mentioning, is it going to be export controls? Is there going to be some sort of restriction? Oil companies going down to D.C. to talk with the president. Let's hear what comes out of that.
Some breaking news from AMH in the last 24 hours. We'll get the details of that in just a moment. Under surveillance this morning, pressing on in Iran.
We've defined the objectives of Operation Epic Fury very clearly, which is, of course, to wipe out Iran's ballistic missile arsenal, and, of course, to ensure that, yes, Iran cannot permanently cannot possess a nuclear weapon. The president is going to continue to talk to our allies. The United States military has a lot of capabilities. They still do have tricks up their sleeve.
So here's the latest this morning. The White House looking to cool tensions after attacks on oil and gas facilities, sending energy prices soaring. President Trump saying the U.S. knew nothing about an Israeli attack on an Iranian gas field. Bloomberg's Tyler Kendall has more from the White House. Good morning, Tyler.
John, good morning. Well, the message from the White House is clear. They are seeking de-escalation after we saw this surge in attacks on energy infrastructure overnight. And while President Trump sought to distance the U.S. from Israel's attack on Iran's largest natural gas field, a person familiar with the matter does tell Bloomberg News that the U.S. was aware of the operation, though did not participate. President Trump now vowing that Israel will not hit any energy infrastructure targets in Iran going forward unless Iran continues to hit the energy infrastructure targets of its neighbors. Of course, after we saw Iran release this list of potential targets yesterday, we saw the country hit multiple projects in Saudi Arabia, the UAE, Kuwait, and Qatar, as you know and have been covering. That included, quote, extensive damage on the world's largest LNG export facility. But this White House has suggested that it is now reluctant to hit that infrastructure that could impact global energy supplies. Even after President Trump reiterated a threat earlier this week, we could see attacks on energy infrastructure on Karg Island, where nearly 9 out of every 10 barrels of Iranian crude flow through, and data and imagery shows for the most part those loadings have continued unabated. But all of this escalation is really complicating the White House's efforts to help curb what has been that surge in energy costs and bring them down for U.S. consumers. Just yesterday, of course, the White House moving to issue that 60-day waiver for the Jones Act, essentially trying to make it cheaper to move energy products between U.S. ports. John, as Anne-Marie was reporting, we are expecting those oil executives here at the White House today. I'll put one other meeting on your radar as we see this administration try to find some potential solutions. President Trump next week is expected to meet with biofuel makers amid a push from some farm state Republicans to get a waiver for higher content ethanol gasoline to hit the market.
Tyler Kendall with the latest from outside the White House. Tyler, thank you. More from Tyler in the next hour. This headline just crossing moments ago. A media report suggesting the Iranian response to the damage to the South Pars gas field is not complete. The attack is not complete. That's an important line coming out of Iran this morning following the president's statement a number of hours ago.
It means they're going to continue, and you have to ask yourself a question. Does this mean the president is now boxed in? Because he said energy infrastructure needs to be off limits, and we will respond with a bigger force if it's not. Well, Iran right now, and the IRGC is saying it's not. We're going to continue.
I want to understand where exactly Saudi Arabia, Qatar really fall in here, because they said that, as you pointed out, this is a red line that's crossed. They're not happy with Israel. I'm sure they're not that happy with the United States. At what point do they get involved as well, given the fact that their infrastructure potentially is at risk?
Let's get into the conversation with Maha Yahya of the Carnegie Endowment for International Peace. Maha, welcome to the program. Have we opened up a new front in this war?
Good morning, and thank you for having me. It's not a new front, but we've moved from the kind of political, military and security front to expand on the energy front. What I mean by this is much of the targeting by Israel and the United States was focused primarily on political and military and security targets. Iran decided to weaponize the global economy, closing the Straits of Hormuz. So it upped the ante. And this is its response to the attack on its own gas fields. I mean, we're on an escalatory path. And what Iran is saying, I'm fighting for existence. I will do what it takes. And if I'm going to go down, you're all going down with me. I mean, that's the bottom line.
From Iran now, it's not just that the energy cannot pass, it's that we will not allow you to produce any more of this energy. So what is the off-ramp from here? Because it's clear from the United States, even though we have reporting that the U.S. knew about this Israeli attack going towards South Pars, the President of the United States is clearly trying to take the tone down a notch. He wants energy facilities taken off the target list. Is that even possible at this point?
I think it is possible, but Iran is going to try and extract a high price for that, or a price for that. For Iran, or this Iranian regime, let's just distinguish, for this regime itself, it really is a fight for survival. They see this as an existential conflict. And what they want is, at the end of the day, whatever ceasefire, whatever arrangements are put in place, A, they will not be targeted again. So it's not a lull between two wars. And B, economic sanctions relief, we all know how much trouble they're in on the economic front. They have no fiscal space really to address the needs of their own population. And they want to maintain some sort of regional leverage. I mean, these are basically their demands. And unfortunately, by getting into this war, by launching this war, what Israel and the US has done is given Iran the space to use its leverage. It's discovered that perhaps, having control over the Hormuz Straits is more powerful than having a nuclear weapon in some ways. It has a much bigger global impact.
Given the fact that we have seen broadly some serious figures within the regime killed by the Israeli strikes, if the United States was to have a diplomatic conversation with Iran, who would it be?
That's the big question. I mean, the killing of Ali Larijani in particular basically ended the potential of speaking with someone who has a long history. The man was brutal. He was everything you want to say he was. But at the end of the day, he was one of their longest serving diplomats, and he was someone quite well known, a known quantity, if you like. Now they'll be dealing with perhaps somewhat less experienced individuals, and perhaps more hardline individuals. Kalibov comes to my mind. He's the head of the Iranian parliament, and he's a pretty powerful figure, but quite hardline, if you like. Saeed Jalili, who's going to be taking over, as we understand from the Iranian side, he's going to take over Ali Larijani's spot. So it's a big question. Let me put it this way. And it's just made things a lot more difficult.
We have to leave it there. It's good to see you. Thanks for making time for us. A tense moment in your region. Maha Yaha there of the Carnegie Endowment for International Peace. From New York City, you're watching Bloomberg TV.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Escalation in the Middle East, close to 120 on Brent overnight. Right now, about 114. Crude higher, Brent crude higher, up by close to 6%. WTI down by 0.3, a big gap opening up close to $20 earlier on this morning. That's the story in crude. And look at the gap opening up in equities. The US versus Europe. Equity futures on the S&P down by about 1/10%. Check out Europe. Look at the European stock story so far building today. Down on the DAX by 2.3%, on the Euro Stoxx 50 by 2 percentage points. The international story being upended by a major rally in Brent crude and in gas prices too.
Yeah, gas prices in particular, given the fact that the Qatar field is now offline and potentially suffering from extensive damage. This accounts for about a fifth of supplies and is one of the main suppliers to the Euro region since Russia has been excluded from their repertoire. Our question here, how do they manage this? How do they afford to pay for some of the expensive bills that people are going to be experiencing this winter? And how does the ECB respond? We're going to hear from them later this morning.
Good luck to the ECB. If the news conference with Chairman Powell was somewhat hawkish, what choice has President Lagarde got? Chairman Powell choosing to anchor inflation expectations in that press conference yesterday, helping to send yields higher at the front end by close to 10 basis points and up another 3 so far this morning. 380, breaking through levels we haven't seen since last summer.
And they have the luxury of saying that a rate hike is not in their base case and that nobody is really considering that as a serious proposition in the near term. Does the ECB have that luxury? Right now, you've got a market that's pricing in 2 rate hikes from the European Central Bank. Can they come out and say a rate hike is not on the table?
3 hours away from the opening bell, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. It's a story we've heard time and time again this earnings season. Companies getting punished for spending big, and Micron is the latest example. Yes, demand is booming for its memory chips, with the revenue guidance coming in well above analyst expectations, but it's coming at a cost. The company saying it will spend more than $25 billion in CapEx this fiscal year, and that is sending shares lower, 5.6%. We turn to gold stocks, all lower today as we continue to see a slide in gold prices for a 7th straight day. And the story here is inflation, with, of course, oil prices surging. Then you have the hotter than expected PPI print we got yesterday. And, of course, Fed Chair Jay Powell saying no rate cuts until inflation comes down. So all that weighing on the price of gold and weighing on names like Newmont down 7.25%. And we end on a positive note with Five Below. Shares are up 6.3%. The company delivering a beat and a raise, saying that it's seeing strong spending across all income levels, with shoppers especially young ones still spending on its discretionary items. But as a value retailer, it could also be a story of consumers trading down, or in my opinion, children just having too much discretionary income. John?
Spending someone else's tax refunds. That's what's happening, Yahara. Thank you. The latest there on some of the retail stories. On our radar this morning, European natural gas prices surging following an attack on the world's largest export plant in Qatar. The site hit by an Iranian missile causing extensive damage. President Trump saying the US would retaliate if the facilities are struck once again. Elsewhere, Fed Chair Jay Powell saying he has no plans to leave the central bank until the DOJ finishes its investigation into him and the central bank. Powell adding he hasn't decided if he'll serve out his full term as a Fed governor. And finally, HSBC considering major cuts to its workforce due to the rise of AI. The cuts would focus on non-client-facing roles and could impact as many as 20,000 jobs, or about 10% of its staff.
Yeah, and this is a plan that they're going to develop in the next 3 to 5 years. It's not definite yet, but it comes amid already a real shakeup at HSBC. 2 points. Number one, how much are banks and other companies going to be using artificial intelligence as a way to curtail some of their staff in general, because some of these cuts might come in the form of selling some units. So this isn't exactly a wholesale discarding of them for the sake of AI. On the other hand, right now, Bloomberg Intelligence is expecting about 200,000 positions in the banking industry to get withdrawn from the industry as a result of AI. So definitely feeding into the fear that's out there.
And that's a story to keep on tracking. We're tracking this as well. Bank of America's Capital Markets Conference underway in Paris. Joining us now is Bloomberg's Francine Lacqua with a special guest. Good morning, Fran.
Good morning, John. I'm so happy to speak to Michael Hartnett of Bank of America. Michael, thank you for joining us. Look, you've said the markets are starting to resemble the run-up to 08. What do you mean, and what are you looking at?
Well, one big difference, of course, with 08 is that the oil shock there was demand-led. You know, it wasn't supply-led. It was China, India. So, yeah, you definitely have an environment where oil prices are rising to, high levels. Back then, the similarity perhaps is that you had these, credit tremors sort of bubbling away in the background. So that's the similarity, and certainly the price action year today is fairly similar. But the supply shocks are more sort of 73, 79, 2022, and I think that the market generally has been coming into this thinking it's supply shock, it's short term, and therefore it's going to be over pretty quickly. And I think that's the kind of revision that the market's going through in the last couple of days.
Is that complacency, or are they too complacent? At what point does it start feeding through earnings?
Well, I mean, it will feed into earnings without a question. But I think that coming into this, people are long equities, that they're hedged, but they are long. But I wouldn't say it's complacency, but everyone thought it was a short war, yeah? Everyone thought it would be folded earlier, and, there's an election for Trump to win. The market's too big to fail. We've seen this script before. We don't want to sell. So I think what's happened the last couple of days is kind of like people have said, I don't want to sell because the policy will change, right? And it's now, actually, we're going to have to sell to change the policy. Do you see what I mean? So it's kind of like it's flip-flopped a little bit.
But Michael, I mean, I thought was striking is that the market was pricing in some kind of short sort of resolution in the shorter term. But actually, if you read the geopolitics and if you read all the transcripts, that just wasn't there. So is the market looking for something?
Yes, I mean, look, the market's looking for an off-ramp. The market's looking for a ceasefire. The market's looking for an end. The market's desperate for the oil price to not move in an exponential way to the upside, but actually, back down, because the other thing that's been happening before this is that you've been having this tightening of financial conditions, yeah? And so the market needs an easing of financial conditions, but the Fed finds it tough to deliver that if oil's at, 150, 200, but I think ultimately you will get that easing of financial conditions, but this obviously delays it somewhat.
What do you think is most being mispriced right now?
Well, I think that if you look at the broader markets, I would say that equities still look rich, relative to where they could do in a genuine shock where the Fed is, not able to cut interest rates. I think that we've gone on record saying 6,600, you probably want to start nibbling at the S&P. I'd be buying the 30-year Treasury above 5%. I'd probably be fading the DXY dollar index above 100. But as I said earlier, the risk right now is that kind of those numbers need to get worse before they get better. Because you look at the Bank of America Fund Managers Survey last week, people are not sure. You know, they're still bullish, certainly on equities.
So do you think oil does go to 150 and possibly 200? Those are the levels you mentioned.
No, they'll go. No, I mean those are levels predicated basically on this is ended in weeks, not months. If it's protracted or you get an additional sort of 20, 30, 40%, no, those levels are breaking. You're going to have to wait for much lower levels to engage, certainly in stocks.
I mean, what's the risk of a policy mistake by central banks? I know you've also said there was a hike in 2008 by the ECB that you said was the worst possible policy mistake.
Yeah, look, I always have this sort of catchphrase, sort of markets stop panicking when policymakers and central bankers start panicking. I don't think the Fed... I don't think the idea the Fed is going to hike, I think, is nonsense. I don't think that's going to happen.
Will they cut?
I don't think they're going to. I think they will eventually cut. And again, I think that, Bill say with a high oil price, they can't cut. 6 months ago, they cut with the stock market at an all-time high and corporate bonds at an all-time high. So, but this is the history that we've all got in us, the DNA. We're all... the QE we're all Gen QE. Do you know what I mean? In that we're all used to central banks wading in whenever there's a market, problem, and hey ho, off we go again. So I think again, maybe you have to sort of like break that expectation a little bit first. But I think no doubt the puck now in the markets is moving like we need an easing of financial conditions, whether it's oil, whether it's yields, whether it's Fed, whether it's the dollar, and we're going to go down until the policymakers hear that and deliver that.
So where do you put your money right now?
Well, I think broader terms, as I said, I think the consumer, ironically, is what I would be nibbling at this particular moment. No one loves the consumer. Oil's up, unemployment's rising, but to me, the consumer stocks are the ones that have really discounted stagflation, yeah? And if you think post-Iran, what has Trump got to do? He's got to win the midterms. And you're not going to win the midterms by, you've got to win the midterms by addressing affordability really. He has to pivot to that just, in a really dramatic way. And again, I think that affordability, lower income consumer that everyone dislikes at that moment, that's probably where from a trading perspective, I think the best, trading opportunity is. Longer term, however, I still think international commodities, these are the true sort of secular bull markets of an inflationary 2020s.
Michael, thank you so much. Michael Hartnett there from Bank of America. I'm going to send it back to you, John, in New York, and we'll have plenty more throughout the day here from Paris.
Looking forward to it. Thank you very much, Fran. Appreciate it. Thank you very much. My favourite phrase of the morning so far, Gen QE. Conditioned, right? Conditioned from the QE we've seen over the last decade plus to keep buying this market because the Fed will step in if things go bad, and it feels very, very different in the last day or so.
Yeah, we're all Generation QE. When things get bad, hey, Papa Fed, let's get some help here. And Papa Fed saying, this isn't our bag. And guess what? Papa Trump saying, I don't know if I can, or that's what people are implying. And so suddenly the market is trying to digest what that means.
How much help is Mama ECB going to be a little bit later this morning?
Well, probably not so much. And then you're going to have the Generation QE over in Europe that's going to be fretting.
Got our own problems over there. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. French President Emmanuel Macron calling for strikes against energy and water infrastructure in the Middle East to stop. In a post on X, Macron writing, civilian populations and their essential needs, as well as the security of energy supplies, must be protected from military escalation. Meanwhile, India is sending additional warships to the Middle East to ensure the safe passage of its vessels. India anticipating that Iran may allow more of its fuel tankers to exit the Strait of Hormuz. Sources telling us here at Bloomberg the Indian Navy is deploying over half a dozen warships as a precautionary measure. And we are seeing yen strengthening after the Bank of Japan announced it was holding rates steady due to uncertainty surrounding the war in the Middle East. The BOJ decision matching the expectations of all economists surveyed by Bloomberg. The central bank voted 8-1 to hold, while pledging to raise rates if its price forecast materializes. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for joining us. Up next on the program, the Fed chair digging in.
I have no intention of leaving the board until the investigation is well and truly over. with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
We'll get the view of Krishna Gua of Evercore next on the program, live from New York City this morning. Good morning to you all. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
Live from New York City this morning. Good morning. Your day ahead looks like this. Two central bank decisions left in focus. One in the next hour. The next few hours, we'll hear from the Bank of England. Then later on this morning, 9:15 Eastern Time, you'll hear from the ECB. If you're waking up stateside, that time is slightly different to what we're used to. The time gap between Europe isn't what it was. That will flip back in the next week or so. So 9:15 for the ECB. Equity futures on the S&P 500 shaping up as follows. Futures this morning, negative just 0.1% on the Nasdaq, down by 0.3. Much greater losses over in Europe. Off the back of this, Brent crude significantly higher than WTI. Brent at 114, WTI at 96.90. Brent up by close to 6%.
This is an impact that's going to really affect the European region that much more than the United States, and that's playing out in both equity markets as well as in the Brent versus WTI gap. I just wonder what the ECB can say at this point, because ultimately the Fed told us we're out of the game. So can they really do anything about this when it's not necessarily theirs to print molecules?
I think you both said this yesterday on the Fed show, and great job on the special. The fact that There was a lot of humility from Jay Powell yesterday. We just do not know where this story goes, and they need to wait and see. So much that he said maybe we should just scrap the SEP because it is really hard to forecast in this environment.
I think there was also a lot of snark in central bank speak. I think there was some real pushback to the president of this White House yesterday. This is not my circus, and I'm not stepping in. And he pushed back across the board several times.
Yeah, until this investigation is well and truly over, I'll stay here. And until you have another Fed chair, well, the pro forma policy is that I shall stay on as Fed chair. And guess what? We're just trying to dodge the balls as they come in and do our best.
Let's get to the bond market. 2s, 10s, 30s at the front end of the yield curve, up by close to 10 basis points in yesterday's session. Add a number 3, 380. 380 at the front end of the yield curve. That's the highest yield we've seen going back to July of last year. Think about all the rate cuts we've had. 380. This is a market pricing out easing. So now basically the 2 years in line with the upper end of Fed funds, that range. To believe that yield goes higher from here, you've got to think there's a risk of hiking interest rates at the Federal Reserve. That's a much higher bar now, I think, for this Fed and ultimately for this market.
Jay Powell said that yesterday. He said ultimately that's not in our table. That's not in our bag of tricks right now that we're going to consider. That could change, right? I mean, ultimately, if this is a data-dependent and subject-dependent type of Federal Reserve, well, you have to imagine that they're going to have to consider everything, especially if the rest of the world is doing the same. My question is, how much does the ECB and the Bank of England drive the bus, and how much does the U.S. have to respond? Ultimately, there's so much unknown, it's very hard to game out.
Under surveillance this morning, the Fed chair staying put.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
So here's the latest this morning. The Fed Chair Jay Powell vowing to stay on at the central bank until the DOJ investigation into him comes to an end. Joining us now to discuss is Krishna Guha of Evercore. Now, Krishna, welcome, first of all. We've asked this question a number of times in the last 24 hours. I'd love your perspective on it. Does that provide consistency or invite controversy?
I think Powell has made explicit something that I think was very clear to anyone who knew him, that there is simply no way that he would even consider leaving the Fed under the cloud of this investigation, not really because of what it means for him, but because of the precedent that it would create, that a future Fed official, even Fed chair, could be, on the face of it, driven out or at least helped to the door by a DOJ investigation.
This line here, though, I think is interesting, Krishna. The first line from the chairman was that if my successor is not confirmed by the end of my term as chair, I'll stay on. That makes sense. That's continuity. Market wants to see that. The second line was, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. So ultimately, a lot of people will view that as defending central bank independence. Granted. The third point's interesting, though, and this is the bit where I'm intrigued, Krishna. This line at the moment. On the question of whether I will continue to serve as a governor after my term ends and after the investigation is over, I have not made the decision on that yet. What's the value of putting that out there?
Well, I think you're absolutely right that that was a very strong statement by Powell. And as you'll recall, it wasn't something he was forced to say because of questioning. It's something he volunteered. He had it written down. He knew he wanted to say that. Look, there's a sort of narrow sense in which we can interpret that in a wider sense. The narrow sense is that Powell doesn't want to look like he's offering a deal. If you drop the investigation, I walk, right? That's almost as bad as looking like you're being hounded out by the investigation itself. So there's a narrow way in which we might interpret that language. But I'm inclined to read it also in a broader way. That Powell is telling us that he is seriously considering staying on as a governor, as a regular governor, at least for some time after the end of his term as chair, even if that investigation is dropped. That is not something I would have really bought into a few months ago, but I think the DOJ investigation has backfired terribly on the administration, and I think that it feels like Powell is inclined to stay possibly either way at this juncture.
I'm struck by the historical parallel, and we were talking about this yesterday. The last person who was Fed chair who then stayed on as governor was Mariner Eccles. His term ended as Fed chair in 1948, and he stayed on for a number of years after that. This was following the Bretton Woods Accord. It followed the war. It followed a highly tumultuous period in central banking history. Are we marking another period which is sort of setting off a new era for central banks where they have less power, where frankly, they don't necessarily drive the bus, where Generation QE, as Michael Hartnett just said, is over?
Well, certainly, you know, the note we published on the Fed meeting yesterday said specifically what you've just mentioned. That, look, this was actually, in the circumstances, a pretty dovish Fed meeting, and it came with bullish upgrades to growth forecast. But we wrote the Fed is not driving the bus. Now, that's in the specific context of a war, and a war that generates a very large shock to energy prices. I'd be wary of making a generalized statement that central banks don't matter anymore. I think that would be, I'm not saying you're saying that, but I think that would be far too sweeping. But certainly in the here and now, this is a context where the central banks are to a very large degree in reactive mode. They are not setting the agenda. They are not shaping where we are going. Does it feel to Powell potentially like this is a complex moment, both in terms of the world and in terms of the Fed's institutional situation, where it may be advisable for him to stay for a while? I guess that's certainly something that, you know, he will be considering here. One question, I think, is whether it would be a disaster for Chair Walsh if Powell stayed on. Not clear to me that's the case. I'm not sure they're particularly close, to say the least. But Powell is underlying pretty dovish. And there are versions of the world where Powell staying on as a regular governor could ultimately help bridge to getting one or two cuts done later this year under Walsh.
Just real quick here, how high is the bar right now for the Fed to hike rates at some point?
Well, the term "some point" obviously is elastic, right? But I think the bar to the Fed hiking rates, let's say this year, I think is incredibly high. It's not literally impossibly high, but I think it's very, very high. You know, look, we have an economy that faces growth as well as inflation risks, but one where, you know, in the baseline case, both growth and core inflation in the U.S. ought to be relatively resilient, as in limited effect, compared with the other economies in the rest of the world. So it's not obvious at this juncture a major shift in the direction of policy is appropriate. The market obviously has been pushing back and shaving Fed rate cuts. That seems like the vector that is in play at the moment. I tell you, we still think that it's possible to get to a couple of cuts this year under Chair Walsh. So our take is more dovish than the market right now. We think the old Fed signaled yesterday they're still inclined to cut the one rather than two. And the question is, could the data plus the new chair potentially certainly lock in that one and maybe get them to two?
Krishna, good to see you. Thanks for jumping on for us. Krishna Goa there of Evercore. If the chairman stays on after another chair has been confirmed and the DOJ investigation goes away, I'm sorry, that is incredibly controversial.
I'm sure it will be discussed. I'm sure we'll get a Truth Social post on it potentially, which is actually interesting. He's been pretty quiet.
Forget the president. This is Chairman Powell. It'd be controversial for him to decide to do that.
Especially given the timing, and that's a key question.
Coming up, Dan Skelly of Morgan Stanley, Edward Fishman of Columbia University, Samantha Dart of Goldman Sachs, the former Fed governor, Betsy Duke, the second hour of Bloomberg Surveillance, up next.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
On AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
We don't know the off-ramp. We don't know the end point.
I'm increasingly nervous the market's not pricing this in.
The market's not giving us much of a buying opportunity, quite honestly.
I don't think we've priced in peak fear yet.
If it goes on for a long period of time, we would probably expect a significantly lower move in risk assets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Some calm in equity futures following yesterday's declines. We're down by 1/10% on the S&P. On the NASDAQ, down by 0.3. In the commodity market, some big moves on Brent versus WTI. Brent crude at 114, close to 120 overnight, much higher than WTI at 97. A big gap opening up between the two. That's pushing European equities so much lower in today's session relative to what we're seeing stateside.
The energy shock in Europe is far exceeding anything that the U.S. is potentially poised for. That said, this gap is raising questions about how long you can get a divergence like this. I mean, this is the widest divergence outside of the pandemic, going back to 2014. And you're looking at this and you're saying, okay, does that mean the U.S. is really going to divorce its market from the rest of the world? I also wonder what kind of policy response you can get. What can you do to bring prices down other than end the conflict in Iran and get production back going? Well, I think the spread just shows that the U.S. does have more flexibility. One, we are a net exporter, and the president, they are discussing potentially banning exports of products. Now, what does that mean for prices on the global market? Actually, potentially prices will go up. But that is a lever that this administration is discussing, and potentially they're going to discuss it today. Oil executives will be in Washington, D.C., and they're meeting with Vice President J.D. Vance.
More central bank decisions coming up later on this morning. The Bank of England, look out for that. The ECB following that one. There is no central bank circuit breaker to this crisis in the Middle East. That's the takeaway in the last 24 hours. Jeff Curry of Carlyle on this program. What was the big headline from him? You can't print molecules. You cannot print barrels of crude.
And that's really what we heard from Fed Chair Jay Powell, just trying to, as we were saying yesterday, play dodgeball, because ultimately they don't have a lot of control here. Given that, Where does the market's confidence come from? At one point, it was Taco. But as Halima Croft said, well, Trump doesn't hold all the keys to necessarily de-escalate, given the fact that Iran faces existential risk and wants to impose a real premium on any kind of conflict ever happening again like this.
And I think the last 24 hours shows that. We are entering a new phase. It's not just military facilities that are now targets, it's energy facilities. And the IRGC is saying that yesterday's strike on its South Pars gas field, quote, is underway and not yet complete. Their response is not yet complete. And this comes after the President of the United States says if this continues, I believe the words were, we will massively blow up the entirety of that field. And given all the strength and power that Iran has never witnessed before. So Trump is sort of putting himself in a box right now. And the Iranians are saying, we are not done yet. And you see that playing out as we speak across the Middle East.
There is a very real risk here. And you get that sense waking up early this morning that we're on the edge and very close to an escalatory spiral that no one has control of. That's what it felt like overnight, waking up to that post from the president following the attacks on energy infrastructure.
I keep thinking about what Jeff Curry was talking about, which is the people who are in the physical market are freaking out. And you see that reflected in the price, $40, $50 gap between that physical price and the paper price. He's saying, well, the paper market's got to catch up. Other people saying, well, the physical market's just, affected by life. And ultimately, as this goes on for a longer period of time, the paper market has a greater chance of catching up to the physical.
Lots to catch up on this morning. Coming up this hour, Dan Skelly of Morgan Stanley as equities retreat. Samantha down at Goldman Sachs as Iran's attacks on energy push crude higher, and the former Fed Governor Betsy Duke as Chairman Powell vows to ride out the DOJ probe. We begin this hour with stocks losing ground as Brent crude surges. Dan Skelly of Morgan Stanley writing, despite the Iran conflict, we're still bullish on equities for the full year. Dan joins us now for more. Dan, good morning. Good to see you.
Good morning, John. Great to see you.
What is the anchor of that bullish view in a moment like this?
You got to recall that prior to the Iran conflict, which I don't want to diminish at all, we had a really solid exit rate with fourth quarter earnings, right? And we saw earnings growing double digit again, and we saw, importantly, a broadening out. Beyond that, we still have healthy corporate balance sheets and healthy consumer balance sheets for the most part. So that's the anchor.
Are they about to get beaten up by this move in crude?
They are to a certain extent, but let's recall we still think we're in this K-shaped economy and population effect where obviously the middle and lower income folks are going to deal with higher energy prices, but so much of the wealth and spending in the country is still dominated by the upper rung of the K that maybe that helps us get through.
At the same time, can you see momentum really continue if you start to see certain deals getting pulled from the market, certain M&A transactions getting delayed, postponed indefinitely, a sense that markets are getting a little bit nervous and they're not going to necessarily operate the way that they have for the first 2 months of 2026?
Good morning, Lisa. And no doubt, I think you are going to see uncertainty start to weigh on corporate confidence, on pipelines. Having said that, at Morgan Stanley, we clearly have a unique perspective on that particular topic, and we're still hearing at this moment enthusiasm for capital market cycles, M&A, IPOs, et cetera.
I love that, the idea that I come with a big cloud over my head, but isn't the world falling? I am just wondering, though, if you pair this with the idea that central banks aren't going to step in, that potentially you're not going to get a rate cut this year. The first rate cut now being priced in for October 2027 for the Federal Reserve. The ECB might signal that they're raising rates today, not necessarily today, but later this year. Doesn't that curtail some of the enthusiasm, this idea that we can live on free money forever?
Absolutely. So two things. First off, on the monetary side, we actually thought originally that if there was a risk to this year, because we already had a solid baseline coming into the year, it was a little bit of a be careful what you wish for if we run it too hot. Remember, run it hot? That was the risk a few months back. And look, sometimes you're right for the wrong reasons, and we got the inflationary shock from this exogenous event with Iran. But as we were just talking about with John, we do think the economy, given its unique drivers today, is more resilient than ever before.
Is there an opportunity in the bond market opening up at the moment?
It's funny you mentioned that. So our asset allocation committee is thinking very hard about that at the moment. And look, you're up above 4.25 on the long end today. We do think there is room to take a little bit of duration on here.
Okay. It's not particularly exciting, but I'm thinking more about the end of the curve. I'm thinking more at twos right now at 381. The upper end of the Fed's target fund range is 375. So we're through that level. To believe we're going materially higher here at the front end of the yield curve, you've got to believe they're going to hike interest rates. That feels like a really high bar to me this morning.
It's an excellent point, John. We don't see them hiking this year. So if you want to be even more conservative, you can kind of go to that belly of the curve too, even like the 5 to 7 part of the curve.
When do you think a hike could become a real conversation stateside?
As long as the Iran conflict is going on with this kind of whack-a-mole tweets and uncertainty day to day. I don't think you're going to see anyone thinking about hikes anytime soon.
But potentially, doesn't this become, as long as Iran continues, a hike becomes more likely because inflation could spiral?
Possibly, but also on the other hand, you have a potential for a growth scare as well. So I think that's a very fine needle to thread. Having said all that, let's step back, and like everyone else, I don't have a crystal ball on Iran, but I think the necessary analog to consider at the moment is Russia-Ukraine, where, to be fair, from a military perspective, you had probably much more evenness in terms of the military competition. And secondly, you got to think about the motives in the game. In terms of Putin's motives, which are unabated today still, obviously with the midterms hanging out there this fall, it's unlikely, we think, that this is going to persist for so much longer.
Yeah, but that's based on the case that Trump has a bigger say in this than the Iranians do. But that's not the case. This is almost equal. Trump even admitted it. It takes two to tango. Do you think the market is too conditioned by this idea of taco, the way Halima Croft outlined today in her note?
I think, frankly, when you look at taco over the last year or so, you can't blame the market for going to that conclusion, because we had tariff taco, we had China taco, we had iPhone taco, so we had a full buffet of taco over the last year or so. So you really can't blame the market. But having said that, I think the one nuance to your argument is that at the end of the day, Iran's eventually going to run out of military capabilities.
In the meantime, the other pillar of support that's been coming from the United States has been the tech story, and this idea that will save all. To some degree, some of the Fed's forecasts even are underpinned by the idea of more productivity coming from the artificial intelligence sector. How solid is that, given the fact that Micron delivered amazing earnings last night and is getting totally beaten up because they're investing more than people had expected?
Totally, and people are being reminded of the fact that that particular company is a more cyclical, hyper kind of beta type stock. What a surprise. We're reminded of that finally, after frankly running up 2-3x over the last several years, as you know. So look, what we would say is we are still candidly benefiting from the post-COVID productivity wave. That was automation, yes, but really connectivity and communication, Zooming at all hours of the day. We haven't yet started to see the full benefit of AI productivity. But to be fair, when I talk to my colleagues in Morgan Stanley Research and we scrape the earnings transcripts, we are seeing quarter over quarter sequential specific use cases of AI in a lot of companies.
Does it encourage you when you see HSBC considering maybe cutting 10% of its staff as a result of artificial intelligence? Does that make you excited to buy shares of a company like that, the Blocks of the world? Or does that raise alarm bells that they'd be announcing it about what else is going on, that they feel the need to talk and sort of template some sort of layoff structure?
Yeah, so that is the million-dollar question in terms of like the long-run effects. I don't mean to be a double-handed economist, but I think in the short run, the market's going to pay attention to earnings revisions. And I think in the short run, it's going to be enough for investors, equity investors, to be excited. But in the long run, to your point, what are the socioeconomic and the bigger cultural implications of bigger job losses? We frankly don't know at this stage.
First thing I looked at when I saw the story, what's the stock doing? It's down 3%. It's not a block story. I thought that was interesting this morning, that HSBC is not rallying off the back of that.
Yeah, is this a question about how their reframing is going right now, given the fact that they've done a lot of restructuring already, that this potentially could be selling certain businesses? Does this signal that it's not going exactly as planned, or they've got more to do?
These are the kind of things we'd be talking about if we weren't talking about the Middle East. You've said this a few times. The other one, number one, private credit. I got a message from a Bloomberg subscriber moments ago, surprised that that didn't come up in the news conference with Chairman Powell just yesterday.
It's just amazing. It's frustrating for a lot of people because when you talk to investors, they're asked about private credit. They're not asked about Iran. Nobody's talking about Iran when you go to sort of investor meetings because it's not analyzable. There's nothing to say. But you can say a lot about private credit. You could analyze it and dig in. You can say a lot about AI. You can dig in. There's nothing to dig into here, which is the reason why so many people are saying, ignore it.
Were you surprised, Dan, yesterday?
It was surprising, and candidly, on our front, from the wealth management side, we are hearing a lot of private credit concerns for good reason. And look, at the end of the day, as our credit folks have said across the firm, we continue to see it more as idiosyncratic, less systemic. We would note that the lending between the interconnection between the financial sponsors and the banks, less than 2% of banks lending. So we do think, while messy and while you're going to go through this continued period of catharsis, it's not going to be a systemic issue.
Not downplaying what you just said, but I'd be shocked if someone from a bank said anything different. Dan, thank you, sir.
Fair point.
Dan Skelly of Morgan Stanley. I shouldn't have fast. Anyway, all right. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump calling for restraint on attacks targeting Middle East energy assets after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Vice President J.D. Vance and other key administration officials preparing to meet with oil executives today. Sources telling us here at Bloomberg the meeting will focus on ways to lower surging fuel prices. According to AAA, the national average price for a gallon of gasoline has surged by nearly 80 cents per gallon since the war began. And Eli Lilly's experimental weight loss shot seeing major success in its latest trial. The GLP-1 helped diabetic patients lose over 15% of their body weight, more than any other drug currently on the market, yet shares are lower. Lilly sees it as an option for people with more severe obesity who may need a stronger treatment than the company's Zepbound shot or Novo Nordisk's Wegovy. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, reining in energy attacks.
Nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. All these countries are getting hit. There was no expert that would say that was going to happen. If we did know, big deal. I mean, we have to do what we have to do.
Up next, Eddie Fishman of the Council on Foreign Relations, live from New York City this morning. Good morning.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Dan Skelly at Morgan Stanley saying it just moments ago, we've had a buffet of tacos. Why would this be any different? Is this moment different? Equity futures right now in the S&P declining by 0.2%, on the Nasdaq down by 0.3%, on the Russell negative 0.6%, opening up a wide gap between WTI and Brent overnight. Brent crude getting close to 120 briefly, back down to about 114 and up by more than 6 percentage points. WTI up by just 1.4%. Natural gas prices having a major move as well. In the bond market, that unlocks higher yields, particularly at the front end of the yield curve. 380 now on twos, up 10 yesterday and up another 3. Yields the highest since last summer. That's notable.
We're pricing out rate cuts for the remainder of 2026 and most of 2027 as people look to the potential response function from a Federal Reserve that's hamstrung. And I think that's the key takeaway. This is not a Fed that can counter this. They can be dovish all they want, but the inflation is staring them in the face at a time where the economy is chugging along, and that Delta and American are saying people are still spending. It is a difficult situation for the Federal Reserve.
This Federal Reserve constrained by escalation in the Middle East. Under surveillance this morning, reining in energy attacks.
Nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. They lived with them for years. I heard they were sending missiles to UAE. I said, that's strange. Qatar, their neighbors, they got along okay. All these countries are getting hit. There was no expert that would say that was going to happen. If we did know, big deal. I mean, we have to do what we have to do.
So here's the latest this morning. Energy prices soaring as President Trump looks to curb attacks on infrastructure in the Middle East, claiming the U.S. knew nothing of the Israeli strike on the critical South Pars gas field in Iran. Bloomberg's Tyler Kendall has the latest this morning. Good morning, Tyler.
Hey, John, good morning. Well, the White House is seeking de-escalation, though it doesn't appear that Iran is heeding that call as the country threatens we could see more attacks on Gulf energy infrastructure soon. Iranian state media reporting that a military spokesperson says that the country's response to Israel striking its largest natural gas field is not over yet. That's a pretty stark warning, considering that President Trump, in a post on Truth Social yesterday, vowed that if Iran continues to hit energy infrastructure of regional partners, then the U.S. will, quote, massively blow up what's remaining of the South Pars gas field. Still, the U.S. did try to distance itself from Israel's initial strike there, though a person familiar with the matter does tell Bloomberg News that the U.S. was aware of the operation but did not participate. This White House is now signaling that it is reluctant to hit oil infrastructure that could disrupt global flows. Even after earlier this week, President Trump reiterated a threat that energy infrastructure on Karg Island could be a target if disruptions in the Strait of Hormuz continue. And as you know, those disruptions are continuing, only complicating the solutions being put on the table to help try to bring down gas prices for American consumers. We saw just yesterday the White House issue a 60-day waiver for the Jones Act in a bid to bring down the cost to transport energy goods between U.S. ports. John, as Anne-Marie was reporting, we are expecting those oil executives here at the White House later today. The Interior Secretary Doug Burgum told us on Bloomberg Television last week that they have been in talks with domestic producers about building output when it comes to the shale basins. Some other potential solutions that you may have heard of that we could see discussed in the future includes asking Congress for a federal gas tax holiday and also potentially waivers when it comes to higher ethanol content gasoline.
Tyler Kendall with the latest from the White House. Tyler, thank you. This is what Edward Fishman of the Council on Foreign Relations has to say. Writes the following: Iran is waging war on the global economy. Its strategy is clear. Keep the Strait of Hormuz effectively closed until prices rise enough to force President Trump to back down. The author of Choke Points, American Power in the Age of Economic Warfare, joins us now for more. Eddie, good morning.
Good to see you, John.
Let's sell some books. Let's talk about the significance of this choke point. Who's got control of this?
Iran. I think that's the one thing we've learned, is that Iran has established very clear control over the Strait of Hormuz, and there's very little that the United States can do without committing ground forces to stop that. Trump entered the war assuming that Iran would not close the strait, because the theory was that they would have to put thousands of sea mines in the strait to close it. And if they did that, what would happen? Iran would not be able to sell its own oil, so it would be economically suicidal. Well, Iran has kind of created a new kind of economic warfare with just using cheap drones that cost, $10,000 a pop and only hitting about a dozen ships, right? They haven't hit that many ships. They've changed the risk calculus of the entire shipping industry. And so they've really created this very low-cost way of disrupting shipping, and we don't have a great answer for it.
I'm glad you brought up the cost, because these jihadi drones are $10,000 to $20,000 to produce. How many does Iran right now have in stockpile? Because how cheap they are to produce means they could potentially prolong this war for as long as possible.
I think that they could prolong this war as long as they want, if we're talking about producing and using low-cost drones. They've got tens of thousands of them, but I think more to the point, the room we're sitting in right now is bigger than you would need to actually produce Shahed drones. And Iran is a huge country. I think it's the 15th or 16th largest country in the world. So even in a scenario in which we've got airstrikes for the next year and destroy every single thing in the country that looks like a military target, we're not going to be able to stop them from producing drones.
Members of Iran's parliament right now are debating
GC in control. Iran still controls the Strait of Hormuz. And to your point, Anne-Marie, I mean, it's quite remarkable, Iran negotiating bilaterally with, not only the Indians and the Turks and the Chinese, but the French and the Italians, U.S. allies, about creating kind of like a TSA pre-check line to get through the Strait of Hormuz. I mean, talk about leverage. It's quite remarkable and not honestly anything I would have expected going into this conflict.
You said it's hard to see an out unless the U.S. makes real concessions or the U.S. sends boots on the ground. What would boots on the ground look like?
Sure. I think this is a really important point because I do really think there's a binary right here. There's sort of two ways to reopen the strait. One is you cut a deal with the Iranians in which you're making painful concessions, probably leaving, almost certainly leaving the regime in power, but beyond that, maybe drawing down some U.S. forces in the region, maybe providing some security guarantees to Iran in the form of Russian or Chinese boots on the ground, a kind of tripwire in Iran, the way that the United States has in the NATO countries. I think if you were to put boots on the ground, what would you need to do? If the goal is reopening the strait, you need two things. One, you need naval patrols in the Strait of Hormuz. The U.S. Navy has not wanted to do this because we could lose these exquisite warships just by short-range missiles or drones. But two, we would also need to occupy quite a lot of the coastal part of Iran in the Persian Gulf to get enough of a buffer zone so that it's out of range of the drones. To the point we made before, they're going to have drones, so we need to actually build a very big buffer zone to prevent them from using them against ships.
How much of a tipping point is this in terms of the Middle East's power as a financial center, as a place that's been attracting a lot of money, as sort of a new growth area that everyone wants to get into, at least until now?
I think this is one of the more tragic elements of this war, because I think in the last few years, Gulf countries have made really substantial strides to diversify away from just being commodities producers. We've seen, the UAE, Saudi really invest in the future economy, becoming sort of hubs for data infrastructure, AI, et cetera. Well, guess what? We've now seen, for the first time in wartime, a handful of AWS data centers struck by Iran. And the real question, I think, that will come out of this is, even if there is some stability, will investors feel confident putting these really important AI data centers in the Middle East? I'm not so sure. And then for the perspective of the Gulf countries, they're going to have a big reconstruction bill. I mean, all these investors who come on your show, who are they going to for LPs? It's the sovereign wealth funds of these Gulf countries. They're not going to have as much money, I think, to splurge on Western private equity funds if they're needing to invest in rebuilding the Ras Laffan, natural gas facility in Qatar.
Eddie, final question, 40 seconds, realm of speculation. We'll be forgiving in the future because this is a super fluid situation. How do you think this ends?
Well, please do forgive me. I do think that it's likelier that Trump escalates than that he caves. So I've always been skeptical that TACO applies in this scenario. TACO in a trade war, Trump can unilaterally suspend tariffs, and no one's all the wiser. Everyone says, okay, well, we won. In this, if Trump backs down militarily, he has to walk away with his tail between his legs. And we never know if Iran actually will even allow ships to go through the Strait of Hormuz.
Eddie, it's good to see you.
Good to see you, Jude.
Thanks for being here. Thank you very much. Eddie Fishman-Neff, the Council on Foreign Relations and author of Choke Points, American Power in the Age of Economic Warfare. Coming up on the program, we'll catch up with Samantha Dowd of Goldman Sachs as attacks on energy facilities send prices absolutely soaring. Plus, Danny, how's your morning move as Micron's big spending plans weighing on the stock? That name is down by close to 7%.
market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Following back-to-back gains on the S&P 500, the threat of back-to-back losses. Down yesterday, down again this morning. We're negative by 0.3 on the S&P, on the Nasdaq down by 0.4. Underperformance from the Russell, small caps, negative 0.7. In the commodity market, Brent and WTI. Brent rallying close to 120 again overnight, 114, up by 6%. Escalation in the Middle East. WTI 97, far behind. An almost $20 gap opening up overnight. That's notable. And a conversation, not on the record, but a conversation at least about what the US would do and the threat of export controls, just maybe part of the conversation this morning.
Remember back to 2022 when under President Joe Biden, there were certain export controls of liquefied natural gas at the same time that Europe was looking for that. That was something that was discussed because gas prices here were rising significantly. Could you see a repeat of that type of behavior this time around?
It's not been a great 24 hours for risk. You couple that with a hawkish Fed news conference with Chairman Powell. You've got yields at the front end of the curve, the highest since last July. 382 on twos, up by 4 or 5 basis points this morning, and 10s at the upper end of the range for the year so far, up 2 basis points, threatening to break 430, 429 so far this morning. As we count you down to the opening bell a few hours away, let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Starting with the U.S. listed shares of Ferrari this morning, dropping nearly 3% after announcing that they would be suspending deliveries to the Middle East. They will still have a few delivered via aircraft, but it's a significant paring back. The CEO of Ferrari saying they're not changing their production schedule for cars for the Middle East. They're just not getting out there at the moment. For what it's worth, the Middle East only accounting for about 5% of Ferrari deliveries in 2025. So not a significant stake, but it is a region that there's a lot of luxury spending, so that's enough to send shares lower. Elsewhere, some activist action. Elliott, according to people familiar, telling our very own Michelle Davis and Liana Baker that they're taking a stake in the maker of Invisalign. The shares align. They're up 7.3%. We don't know exactly what Elliott plans, but they do want to take actions to boost the share price. So you have that reaction. The stock down nearly 67% in the past 5 years as the post-pandemic boom to make your teeth better starts to fade. And finally, Micron earnings, a blowout quarter, beats all the forecasts, and yet this is what you get, a drop of 6.9% because of their capital expenditures. $25 billion is what they plan for this fiscal year. They're going to increase that by another $10 billion for 2027. That's enough to spook investors and send shares lower in the pre-market, John.
Danny, thank you. What do we always say? You can learn something from the numbers and maybe a little bit more from how the market responds to them. You're learning something this morning.
Yeah, well, there are two ways to look at this. On one hand, you could say people aren't rewarding spending because they're a little bit concerned about where the funding is going to come from. You could also say that Micron has been on a tear over the past 12 months, and so ultimately people sort of wondering about whether this really gets the job done. I'm a bit confused, to be fair, so I'm curious to see what the details are here.
That stock is down in the pre-market. On our radar this morning, President Donald Trump pushing for de-escalation after a series of attacks on energy infrastructure in the Middle East. The president warning the U.S. will, quote, massively blow up the South Pars field in Tehran, strikes Qatar again. The White House weighing plans to require ships to buy U.S. government insurance before being escorted through the Strait of Hormuz. The Financial Times reporting it remains uncertain if military escorts will be made available. And finally, the Vice President, J.D. Vance, will be meeting with oil executives a little bit later on today, with oil executives discussing the move in crude. Brent close to 114 this morning after getting very close to 120, and gasoline prices getting close to $4.
Yep, exactly, $4. That is going to be a huge psychological impact on this White House. And in some states, we are already there, especially on the West Coast, and the president's own state of Florida is at 390 this morning. So this is significant. The Vice President of the United States, an individual which lots of reporting that this is an isolationist, potentially not on board with what is going on in the Middle East, will be meeting with oil executives today. So they're going to have this dialogue on what else is on the menu of this administration, what else is in the tool box for them to pull. We saw them do waivers on the Jones Act yesterday. There is discussions with this White House about potentially banning exports of products. We are a net energy exporter. And then there's one that people push back and they're like, that's not really a case. But a la 1970s, you can see this administration potentially, if things get really bad, ring fencing the United States. This is our energy. We are not going to export it, and we're going to cap prices.
Well, and this is when we saw, for example, liquefied natural gas in the wake of the 2022 war. What happened with 2024 when that happened, when the government came out and they limited some of the licenses for liquefied natural gas going over to Europe. How does this create complications with that relationship? How does that create complications for the LNG market in the U.S. that has pledged to provide extra to substitute for where Russia left off? And how does this really insulate the United States when it's not just oil and gas? It's also fertilizer. It's also helium, which potentially could be a problem for chip manufacturing. So this is a bigger issue and a question of what these oil executives can possibly do to stave off some of these rises.
Big squeeze in gas prices, particularly in Europe. Brent, the big move overnight, of course, rising close to 120 as Iran ramps up attacks on energy infrastructure in the Middle East. We caught up with Jeff Curry of Carlyle, saying markets are underpricing the supply shock.
I like to call it molecular contagion. You know, last week we were talking about shortages in Singapore. This week, you know, it's in Rotterdam. This thing's going intercontinental. There's no more price spread. There's no more spare barrels. There's no policy fix, and it's just physics at this point. And I want to emphasize, these are physical supply chains. And that the idea of around financialization and the ability to print money doesn't apply here.
Samantha Dowd of Goldman Sachs writing the following: the developments underscore upside risk to our price forecast from longer Hormuz disruptions and persistent damage to energy production even after Hormuz reopens. Sam joins us now for more. Sam, good morning. Good to see you.
You too.
Let's start where we kicked off this program this morning. Brent at 115, WTI at 98, and a spread starting to open up even more. What do you think it speaks to?
So I think the market is pricing in this probability that maybe the U.S. government will restrict exports. And if you're not exporting TI to the rest of the world, then you have a bigger oversupply within the U.S. So WTI prices would stay on the low end and sort of disconnect from international prices.
Can we explore that a little bit further? What would happen if they actually introduced that policy?
So if you're blocking exports, I think the main risk, for example, especially product exports that everybody's talking about, the main risk is that the refineries in the Gulf Coast will lose those high margins they are seeing in the market right now, and they may choose, okay, I don't have the same incentive to produce that I did just a minute ago, I might reduce my production. So it's not obvious what the net impact will be in terms of product prices to the rest of the U.S., also because we don't know if other countries might retaliate. At the moment, if you look at the northeast of the U.S., it has to net import products. Same thing with the West Coast that Anne-Marie mentioned earlier. So it's not that easy to balance everything. Even on the crude side, yes, the U.S. produces a lot of light crude, but we import a lot of heavy crude. A lot of our refineries are set up to run a heavier type of crude. So what if other countries retaliate on exporting that to the U.S.? So it's not an obvious answer. It can lower WTI prices. It can potentially even lower product prices for the rest of the country. But we don't know what other ramifications might be. And when we saw that in the past, we saw the oil industry lobby against those types of measures. So I am curious to see where those conversations end today.
Are you saying that you think the market's wrong, that you think that this gap has to close one way or another, potentially with WTI coming up to meet Brent crude?
No, I think with these conversations happening, the market is just trying to price a probability that they go ahead with it. And I think because of the sharp spike in prices that we've seen so far, it almost puts everything on the table. And in the hopes that, okay, we produce a lot of oil, we produce a lot of products, maybe we can pull this off. So I think it's correct to price in a probability this happens. I just don't know if the outcome will be the desired one.
Are you surprised that the market, the paper market, isn't reacting more strongly to what a lot of people are saying is a real shift that we saw yesterday, where suddenly gas facilities came under attack, suddenly oil facilities came under attack, both suffering damages that could potentially take them offline for a longer period of time? Are you surprised that there isn't an even bigger reaction, not only in current futures, but also 3 months, 6 months, 12 months out?
Yes, I am. What we've seen is that your Middle East price rose up the most, and that makes sense. That's where the shock is. And when you look at Brent, not quite as much. You still see a big differential. And even in the Middle East, when you look at their physical prices, they are even higher than their financial prices. So it's almost like the market is saying, maybe this can still be a short-lived event. So you price the most your physical local market. Then second, you price your local financial market. And third, you price the financial markets elsewhere. When this is not a given today, that is going to be short-lived. In fact, the escalation that we saw over the past few hours would, I think, suggest an increased risk that this goes on for a little bit longer. So yes, I am surprised. And I would expect the longer this goes, the more those financial prices will embed those risks in it and will go higher.
I'm glad you bring up this point. The essential closure of Strait of Hormuz is short-lived because that can reopen if there's a détente. Actually hitting energy infrastructure and long-term damage is already long-term. How long for this all to be rebuilt and the supply chains to get back to normal when actually the product itself is getting hit?
That is a key point. I like to say that there are two variables for us to watch in all this confusion. One is how much volume is out of the market. And that hasn't really changed because you're hitting infrastructure that wasn't really sending product or oil or gas through the strait to begin with. So you're not changing today what's coming out of the market. But the second variable to watch is how long this lasts. And the Strait of Hormuz, to your point, is just one part of that answer. The second part is, well, if you're destroying infrastructure, this may take longer to fix. This might not be a 4-week run-up of operations in a refinery that you chose to shut down. This might take longer. It might take a few months if you have extensive damage in some of that infrastructure. So that second variable, the risk of how long the disruption lasts, you're essentially making that risk higher. The more infrastructure gets hit, the higher the risk that disruptions last longer.
As we look ahead to J.D. Vance, the vice president, sitting down with oil executives, the United States is not a monolith. If we have an export ban control, what does this do for the West Coast that are so reliant on Asian imports for their products?
Yeah, and it's difficult to move. So you produce a lot of those products in the Gulf Coast, and it's difficult to move to the West Coast in particular because you're not going to have enough pipeline capacity to do it. So you have to ship it around, and it's not quite as easy as shipping to the East Coast. So it'll be a bit clunky. Not without friction, which means prices can still stay higher for a little bit longer.
We've seen big moves in crude, big moves in gas prices. Have you started to see anything happen in ags, in soft commodities, off the back of this?
We're definitely getting a lot of questions on it. And we also see direct headlines saying Pakistan, Bangladesh, India supply to fertilizer plants in those locations already being curtailed because they don't have enough natural gas to do it. So we were talking to our chemicals analyst in the U.S. asking, well, the U.S. still has supply. Do we have any spare capacity to fill in that gap? But the answer is, well, the U.S. has cheaper natural gas than everybody else to begin with. So we're already cranking this up as high as possible. So you don't have spare capacity to crank this up. And planting season is coming, so everybody's going to need a lot of this stuff coming soon.
When do you think we'll be confronted by that reality?
Oh, I don't think it takes long at all, because already supply is being affected, the production of fertilizer is being affected, and planting season is coming.
Sam, it's good to see you. It always is. Thank you. Samantha down there of Goldman Sachs, breaking down the commodity market, something you've been focused on too.
I'm looking right now at corn futures, and they've been on a tear. And I imagine it's a direct response because this particular fertilizer is for corn and wheat and some of the other staples that people need and rely on for their livelihoods.
Soybean farmers have been hit when it comes to China not buying as much, when it comes to the trade war and the tit for tat between Washington and Beijing, and now they're getting hit with higher fertilizer prices. This administration was talking about bailout for farmers. This is going to get incredibly contentious between the White House and the middle of America.
We'll keep track of these moves for you. Brent this morning, 115 and higher by more than 7%. Let's get you an update on news elsewhere. Your news worldwide in your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The FBI is investigating former National Counterterrorism Center Director Joe Kent, who recently resigned from his position in protest of the Iran war. Sources telling us here at Bloomberg that Kent may have improperly shared classified information. The inquiry, though, has been underway for months. HSBC shares are trading lower in London, down more than 3%. Amid reports the bank is considering deep job cuts due to AI. Sources telling us here at Bloomberg the cuts could impact around 20,000 jobs, or about 10% of its total workforce. Non-client facing roles in global service centers are among those expected to be the most impacted. And Elon Musk saying his companies SpaceX and Tesla will continue ordering NVIDIA chips at scale. Musk posting on social media he is a huge admirer of NVIDIA and its CEO Jensen Huang, and thinks the company's $4 trillion valuation is well-deserved. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for this morning. Up next on the program, setting up for a showdown.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
Up next, we'll catch up with the former Fed Governor Bessie Duke from New York City. You're watching Bloomberg TV.
Take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Central bankers confronting a shock in the Middle East. Chairman Powell first up, choosing to anchor inflation expectations in the news conference yesterday. Next up, the Bank of England about 12 minutes away, and after that, the ECB. Into that, futures softer, negative by 0.4% on the S&P and down by 0.6 on the Nasdaq. Into that, crude higher. Brent pushing closer to 120 overnight, 115 right now, up by 7%. And now you start to get a move in WTI. TI up by 2% to 98.22. Unlocking this move at the front end of the yield curve, 4 basis points higher through 380, the highest yield we've seen on a 2-year, going back to last summer.
It's difficult for any central bank to cut rates significantly in this kind of backdrop, given the fact that inflation was already above target, was accelerating in certain corners, and then you add to an oil shock that has no clear end. And that is the reason why Fed Chair Jay Powell just threw up his hands and said, we don't know. What we're going to hear from the ECB and Bank of England could be a little bit more definitive in the wrong direction. And frankly, this bond market is repricing.
Not my circus. And it sounded like he was more concerned about inflation even before this shock, which was slightly curious.
Yeah, I wonder who he was channeling in terms of that, because the different Fed members have different views. Interesting also, 11-1, that Chris Waller got on board with the majority to hold things where they are and not signal another rate cut. Again, what changed if it wasn't necessarily some sort of strength in the labor market?
Even with that very weak jobs report just a week or so ago. Under Savannah's this morning, setting up for a showdown.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
So here's the latest this morning. The Fed Chair Jay Powell vowing to stay at the central bank until the DOJ completes its investigation. The former Fed Governor Betsy Duke writing the following: this could turn into a real standoff. It's unclear whether it would disrupt markets or be seen as a sign of Fed independence and continuity. Betsy joins us now for more. Betsy, welcome to the program. Continuity or disruption?
For me, it's continuity, but this is something that has never happened before. So if you unpack what Jay said, the first one is that he would serve as chairman pro tem. That's the way it's always been done while waiting for a chairman to be confirmed, although it's usually for a chairman to be confirmed to a second term. So it happened with Greenspan, Bernanke, and with Powell. So that's the way it's happened, but I'm not sure that's in statute. So with this president wanting to assert control over the Federal Reserve, the president may step in and name an acting chairman of his own from the existing board, not a new appointee, but he may want to do that, and I'm not sure what the standing would be for the Fed to fight that. But the FOMC, the group that actually sets interest rates, the FOMC actually has the authority to elect its own chairman. So you could potentially see a situation where the FOMC elects Powell as chairman, but the president names someone else on the board as chairman of that board or acting chairman of that board.
So, Betsy, that sounds like a mess. And until now, there hasn't been much disruption in financial markets. Inflation expectations somewhat elevated but stable up until this shock, not disrupted by the Fed's attacks they've been under from the President of the United States. Do you see that changing in months to come?
Well, there have been a couple of times when markets got nervous when there wasn't some sort of a move on the Fed. If this breaks out into all-out confrontation, though, it is going to be concerning for markets. Now, whether that disruption in markets then cools the situation down remains to be seen.
Betsy, do you think that Fed Chair Jay Powell is putting a spotlight on this conversation or turning the volume down, given his decision to, or the fact that he hasn't made a decision yet, to step down as governor after his chairmanship is over?
So I think that part of the reason he made the statements he did yesterday is that some of that was in the court filings, and so in the public record, but not front and center in the Fed universe. And so it looked to me like he had that statement prepared. He read it. He was waiting for the question. Oddly enough, in this press conference, it took longer for somebody to ask him what he was going to do. But he was ready with that. And, you know, he's basically saying he is not going to leave there as long as there is any shred of this investigation left. He left open, though, whether or not he would actually leave his seat and give the president another seat to fill. And I think that is going to just be determined by, you know, what happens next. And but I want to be clear, I don't think his fight is with Warsh. I think he and Warsh, once Warsh is confirmed, he and Warsh will work well together. Jay has worked under Chairman Bernanke, Chairman Yellen, and he will work fine with Chairman Warsh. I don't think that's where the tension is. The tension is between the Fed and the president.
Betsy, is this really a difficult moment for the Fed just in terms of setting policy? I mean, it seems pretty clear that if they do nothing, there's really no risk on either side. So they're sort of out of play anyway as this political fight takes place?
I wouldn't say out of play. I would just say there are many, many events that each and every one of them by themselves would be a single supply shock or demand shock that would work its way through. But there's been a series of them. And so, you know, at some point you look at it and you say, okay, we've missed our target for 5 years for very good reasons in each case, but it's been 5 years. And so when do expectations become unanchored?
Betsy Duke, appreciate your time as always. Betsy Duke, they're the former Fed governor. Right now, inflation expectations haven't become unanchored.
Which is one reason why they're not considering a rate hike, right? If you start to see those five-year forward break-even rates, some of the market established views on exactly what inflation could look like, not necessarily the University of Michigan sentiment survey,
sure.
Then do you get a response that is somewhat different in terms of gaming out a rate move in either direction in the remainder of this year?
We are all major advocates of central bank independence, and we all agree that the president's attacks on the institution are misplaced and undermine the ability of the Federal Reserve to reduce interest rates over time, or could. The issue I have at the moment, I keep going back to this, is that there is no evidence right now in financial markets that they've been rattled by those attacks. There is no evidence in financial markets that there has been an erosion of central bank independence. So I find it difficult to understand why the chairman thinks that he is the only defender of central bank independence, and without him, somehow this all goes awry.
If Congress is that much of a believer in the independence of the Federal Reserve, shouldn't they have a handle on this? And I think it's a fair point.
It's not your choice about who the president nominates and who the Senate confirms. And once your term's over, this is highly unusual stuff. Your term's over, someone else is confirmed, the chairman leaves. Sticking around because you don't like what's going to come next, I find very political.
We shall see. I mean, honestly, it's going to be an interesting couple of next months.
The third hour, up next.
A cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business
then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Today, the FOMC decided to leave our policy rate unchanged.
They decided to just basically completely ignore the Middle Eastern shock that we're facing here.
They're basically saying all of this going on in the Middle East is a speed bump.
I'm not really taking the SEP or the dots very seriously.
There's not a huge amount of forecast accuracy here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Futures declining by 1/3% on the S&P, down by 0.5 on the NASDAQ, negative 0.75% on the Russell. The epicenter of disruption once again in the commodity market, pushing 120 overnight, very close on Brent, back down to 113, higher by 6%. Gas prices spiking, escalation in the last 24 hours, with energy assets targeted across the Middle East, and central bankers confronted with a major shock. Chairman Powell first up, anchoring inflation expectations. The Bank of England follows, leaving interest rates unchanged in a 9-0 vote, and saying this: all members stand ready to act to contain inflation, and forecasting inflation at over 3% for the month of February, near 3.5% for the month of March. And this is a problem, not just for the UK, for the ECB as well.
You know, it's notable that this was actually a unanimous decision, because usually there are dissents on the Bank of England. When you hear what the individual members have to say, it highlights just how much this oil price shock changed their view. Maybe not necessarily with a rate hike, but in terms of not cutting. The Bank of England's Lombardelli said he's prepared to act over any persistent inflation. Bank of England's man coming out and saying she would have considered a lower or even some sort of hike should this continue. Really kind of coming out with this idea that this is making them more hawkish, but not ready to act just yet. I'm curious to read into all of these decisions to figure out exactly how much they endorse the idea of a rate hike ahead.
This is the issue for so many central banks, particularly single mandate central banks like the ECB, like others that have to target the inflation rate. They're squeezed by other issues as well. For the US, you've got all these tailwinds for US economic growth coming into 2026. The rate cuts we've already seen, the fiscal stimulus coming through the pipeline, the tax refunds, the amount of tech capex we're going to see over the next 12 months. Maybe the Fed's got the cushion here to sit here and wait and watch how this plays out. The problem for the UK, the employment market's not in a great place, neither's the economy. Energy prices are going to squeeze the consumer, and you've got a Bank of England leaning into the prospect of tighter monetary policy on top of that. That's a tough place to be in.
Which is the same place that the European Central Bank is in, although in the Bank of England's case, they have an even worse situation given that they're a smaller economy and are very susceptible to these shocks. Right now, you are seeing the pound gain a little bit versus the dollar, and you are seeing about 50 basis points of rate hikes fully priced into the market for the Bank of England, as it does seem like the different members would have been dovish, would have come out with cuts had it not been for what we saw. They now have one fewer lever to pull to try to bolster this economy when they have to fight inflation, and frankly, this is going to be inflationary.
The sequencing is really off as well. You'll get this shock to inflation up front all at once, then the growth hit further down the road. And for the Federal Reserve, this is what George Goncalves of MUFG was talking about. The issue is that all shocks are initially inflationary before becoming contractionary. Going on to say, we anticipate the Fed will fall into the same trap as they did in 25 by pushing back remaining cuts into the second half. That's the problem with the sequencing.
Right now, what you look at when you check out Fed funds futures is the first rate cut is in October 2027. And then after that, a bunch more rate cuts are following, which indicates that the Fed is going to remain on hold until there is a weaker financial condition. Is that going to be the same for the Bank of England and the ECB? And as a trader, what do you do with this, given that it is circumstances well beyond any of their control?
The ECB in the next hour. Let's break down the last 24 hours. So around this time yesterday, a strike on an Iranian gas field. A report from Axios confirming it came from Israel with cooperation and approval of the United States of America. Iran vowed to retaliate. We've seen that big time overnight. And then the president steps in and denies having any knowledge of it ever happening ahead of time, and warning the Iranians that if they continue to strike assets, particularly in Qatar, he'll retaliate even harder next time. That's how messy things have become in just 24 hours.
Right, so the president is trying to distance himself from this report and even our own reporting that the United States knew Israel was going to attack South Pars, which is the biggest, largest natural gas field in the world. It's incredibly important for Iran in terms of their domestic needs as well. Now Iran is targeting, in the last 24 hours, you have seen a number of installations across the Middle East get hit. We're talking about Qatar, and the president was saying that in his Truth Social post about Qatar's LNG gas facility. This morning, on Eastern time, it was in Saudi Arabia that it was hit. So this is the escalation of the news phase. Energy infrastructure is a massive target for the regime. And as their missiles start to wind down, they don't have as many more, they are going to go for even bigger targets.
Equity futures down by 0.5% on the S&P 500. Coming up this hour, Gagi Chowdhury of BlackRock as stocks wipe out weekly gains. Max Layton of Citi expecting oil prices to go even higher. Steve Rasciuto of Mizuho reacting to the latest jobs data. Here's a view on Wall Street this morning as investors weigh the Fed and Middle East conflict. Gagi Chowdhury of BlackRock writing, we're in the latter shock now, where pullbacks will likely provide opportunities in weeks and not in months. Gagi joins us now for more. Gagi, why is a pullback at this point an opportunity?
Good morning. It's good to be here. So definitely a lot of uncertainty, like Chair Powell laid out. But like we've seen, a few times before, perhaps this is a different conflict than past geopolitical shocks. But at the end of the day, whether it's in a few weeks or a month, it does always provide an opportunity to get back into the market, especially when, and I think this is the more important part that I get to in my note to you, is when the fundamentals remain solid. And I think that's the point here. Of course, this is a big shock. I think investors, rightly so, are sort of thinking about ways in which they can raise liquidity in their portfolios. But at the end of the day, in the US, the fundamentals are still solid and supportive. Earnings growth is still extremely positive. And real GDP, as we saw from the chair yesterday, is expected to accelerate.
You were precise with your words. In the US, this shock will hit different markets in different ways. Where does it leave other markets outside of the US?
Absolutely, and I did say that about the US because we are in a relatively better spot, obviously, given the energy export, being a net energy exporter. I think coming into the year, we were feeling quite positively on the emerging market complex. You know, I've come on your show before and talked about our fondness for emerging market equities and certain parts of emerging market debt as well. I think now we have to be a little bit more precise within that. Obviously, countries that are net energy importers, and you know, I'm from one of them, I'm from India, and we're already at home beginning to see the impact of LNG prices and how that's impacting the consumer. So I do think there's going to be a huge amount of differentiation. Obviously, countries within the EM, and I'm looking at LATAM specifically, which are energy exporters, I think will do a lot better, especially because their exports will not be as impacted by the crisis in the Middle East. I think we have to be a little bit more careful, certainly in Europe and emerging markets. But the US, at least for now, I do believe there's going to be continued pullback, but I think that it's going to be viewed as an opportunity to re-enter, especially the areas of the market where the earnings growth has been very solid. And I'll also say that, especially in the US, this is giving investors a chance also to diversify. I think that's one thing that clients have been asking us what to do. Where should we go for diversification? Because nothing has worked. So this is where we sort of are telling investors, listen, think about building a really diversified portfolios, which does have bonds within them, as well as US equities and parts of commodity markets.
Gargi, I love this. And that's exactly where I was going to go. Diversification earlier this year was move into Europe and move into Asia. Now have we flipped the script, and it's go into the US, but go into stocks and go into bonds and go into commodities?
Look, I think it depends a little bit on what your horizon of investment is, right? So at the end of the day, do we think this is going to impact emerging market stocks and European stocks for the next 12 to 24 months? Probably not. So those investors that are looking to build a portfolio for a very long period of time, you're absolutely supposed to have some of those international markets, especially given some of the valuations that we're getting to, and also because emerging markets, again, is another great way to get that AI value chain that we've talked about. But for those that are looking for the next, I would say month, 2 months, maybe even 6 months, I think more and more the signs are becoming quite evident that US is where the continued earnings growth is, and US bond markets are where, especially given some of the backup in rates, is where you're supposed to source your income. And frankly, investors are doing that. 75% of the inflows in the US in the first sort of 15 days of March have been into fixed income products, not equities.
What a month of March it's been already for crude. Massive moves. Gargi, I'm just going to cut in with this breaking news. A big move in crude, a big move in gasoline prices. And this president and this administration is starting to sound a little bit more rattled. This from the Treasury Secretary, speaking to the American press just moments ago. The US could do a unilateral release of oil reserves, and going on. In addition to that, saying this, the US may unsanction Iranian crude that's already on water. That's quite a line coming from the Treasury Secretary moments ago.
It feels like they understand this moment is just intolerable when it comes to what is going on in the energy landscape. So they're willing to unwind some of their key foreign policy initiatives. And that would be a gift to the regime in a sense, that we are going to unwind the sanctions we have on this regime because we want your crude, because we are so desperate. 2 key headlines also saying that, look, we're also willing to go unilaterally and tap the SPR again. What other tools in the toolbox are they discussing? Well, I'm sure it's going to be key this morning when executives meet with the vice president.
One thing that they're not doing, and this is what the Treasury Secretary said, we're not intervening in oil futures. We are not going to do financial market oil intervention. So we're trying to quash some of that speculation that continues to circulate even after they tried to quash that before.
Secretary Doug Burgum told Joe Matthew and Tyler Kendall last week, it is under discussion. He said it'll take a tremendous amount of capital. I'm not going to say more of it. To my knowledge, it hasn't happened yet, but it is under discussion. Okay, maybe it's not happening right now, but they've definitely discussed it.
Do you want to get a real move? Check out the UK right now. Get to the UK government bond market, 2-year, front end of the curve. 27 basis point move. Call it 28 at the front end of the UK curve. That's a major move, a massive move. We've got a big move stateside as well. We're at the highest level since last summer, but I'm talking mid-single digits on the session after being up 10 yesterday. You've got a central bank that needs to take tighter for longer, even though the central bank is looking at an economy that's not doing well right now because of one thing, the shock that's coming from the Middle East. And this is the second one we've seen. You've had the Federal Reserve leading to anchoring inflation expectations, the Bank of England doing the same, and in 1 hour from now, you might get the ECB doing exactly the same thing as well.
Just to give you a sense of perspective around this Bank of England decision, this was the first time of the Bank of England that all 9 members had a unanimous decision in 4.5 years. They have not agreed on anything. And what a lot of even the more dovish members said was they would have voted for a cut had it not been for what is going on in the Middle East. Even those that are more hawkish are now even more so and talking about the potential for hikes. The market's clearly reacting, 50 basis points of rate hikes getting priced in. This is a very difficult situation for all European central bankers.
Gagi, I'm working through this in real time. I keep going back to this. We've repriced energy, big move. We've repriced rates. We've taken easing out and priced in hikes in places like the Bank of England and over at the ECB in the Eurozone. Do you think we've repriced growth sufficiently off the back of those two things?
You know, I think there's so many drivers of growth in the U.S. I think that yesterday what we heard from Chair Powell, it was actually quite surprising to me to see how much they'd revised up their forecast for growth. But I think the message that the market heard was that productivity greater than oil, right? That was what they were saying, that the impact of productivity is what's driving growth. I do want to point out that, especially since you're talking about BOE and ECB, us having a central bank that has a dual mandate does make us different, right? I don't know that we're going to be at a point where we're going to hike interest rates as a result of this, because what we're not talking about is the demand shock. The demand shock that may come if prices continue to be here. And in that case, we're far away from hiking, given that it's a dual mandate central bank. We're more likely to focus on the growth shock and therefore on easing policy rates. So even though markets are repricing the front end pretty aggressively, I wonder if we're forgetting that this is a central bank that's more likely to ease if growth shock comes into the picture. Having said that, I think productivity, which has been immense, is what's driving some of the growth forecasts from the Fed, much more so than oil.
Gagi, good to see you, as always. Gagi Chowdhury there of BlackRock, breaking down these moves. We've had a 40% plus move in crude for the month of March so far. That's WTI. Brent, an even bigger move, plus this morning. And you've got a major move in gas prices in Europe as well. And this is what rates traders are doing with it. We're now pricing over the Bank of England a 50% chance of 3 hikes this year, 2026. Only a month or so ago, we were talking about the prospect of rate cuts over the Bank of England. That story has flipped and turned around aggressively.
And it's because it's a single mandate central bank, just like the Bank of England. You've seen in the past, when there has been a more hawkish projection from some of these central banks, the currency loses value. That's not the case today, but I am watching that closely because ultimately this will crimp growth potential going forward, and that I clearly see as a concern.
Some big moves here in the last hour or so. Let's get you an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump pushing for a de-escalation of attacks on Middle East energy assets. The announcements coming after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Eli Lilly's experimental weight loss shot seeing major success in its latest trial. The GLP-1 helped diabetic patients lose over 15% of their body weight, more than any other drug currently on the market. Lilly sees it as an option for people with more severe obesity who may need a stronger treatment than the company's Zepbound shot or Novo Nordisk's Wegovy. And we are seeing Rivian shares soaring in the pre-market, up more than 10%. Uber announcing a major investment into the EV maker as it ramps up its push into robo-taxis. Uber will purchase 10,000 Rivian models to be used as robo-taxis, part of a $1.25 billion overall investment. Rivian robo-taxi rides will be offered in San Francisco and Miami by 2028, with plans to reach 25 cities globally by 2031. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the programme, we'll get the reaction from Max Layton of Citi, looking for some big moves in energy. We've had them already overnight. His thoughts in just a moment, and the latest headlines coming out of central bankers worldwide. From New York City, you're watching Bloomberg TV.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets. Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's break it down. Equity futures near session lows were down by 0.5% on the S&P, negative by 0.9 on the Russell. In the commodity market, Brent overnight close to 120. This morning, right here, right now, 114, up by 6%. In the bond market, let's just focus on the very front end of the yield curve, stateside, and then we'll move things worldwide. The 2-year in the US pushing 390, up 10 basis points yesterday, up close to 10 this morning, 387. The chairman of the Federal Reserve anchoring inflation expectations in the news conference yesterday, pricing out easing over at the Fed has been the story of the past 2 or 3 weeks. In the UK, look at this right now. The Bank of England keeping interest rates unchanged and doing almost exactly the same thing that Chairman Powell did in the news conference yesterday, looking to anchor inflation expectations. A 30 basis point move plus on the front end of the UK yield curve right now. This is tighter financial conditions coming out of central banks. And this isn't the final act of today. You've got the ECB in less than 1 hour's time.
To me, the fact that this was the first unanimous decision on the Bank of England going back 4.5 years highlights the paralyzation that people, the paralysis that people have. Bank of England's Catherine Mann saying she is now considering a longer hold or even a hike ahead after otherwise potentially voting for a cut. It just shows how much the tide shifted.
And then you've got these headlines coming out of the Treasury Secretary, Scott Bessent, speaking just moments ago. Keep up with this. Bear with us. 1. We're not going to do anything in financial markets to intervene with oil. Okay, speculation as to whether they are or not. We can let that go. The US could do a unilateral release of oil reserves to support the supply of crude. The US may unsanction Iranian oil that's on water. That's controversial, given the sanctions on Russia and Iran. And then this. Will Sea of Karg, key island, key energy asset of Iran, all the exports come out of that island. We'll see if Karg is eventually a U.S. asset. That headline coming from the Treasury Secretary to the American press just moments ago.
My mind is beating because it's Secretary Bessent that's delivering that message and not the DoD head, Pete Hegseth, who is also speaking right now with Chairman Kane at the Pentagon. Now, there is this amphibious assault ship from the U.S. Navy, USS Tripoli. It went past the Chinese Strait, the South China Sea, excuse me, and it was spotted near Singapore. It is going to Iran. And there's been tons of speculation. What is the president going to do with these 2,200 Marines? Potentially, could he go on and take over the energy infrastructure on Karg Island? Well, the Treasury Secretary just opened that door.
Let's stick with our top story. Crude with a big move, surging past 116 earlier on this morning, pushing 120, with major energy assets across the Middle East taking hits. Max Layton of Citi writing, our refreshed base case is that oil flows are disrupted for the next 4 to 6 weeks. We estimate that Brent prices will rally as the conflict continues over the coming days to 110 to 120 a barrel. Max is jumping on the phone for us to break down some of these headlines. Max, welcome to the program. Very close to those levels already. What's your reaction to what we're hearing so far this morning?
Yeah, great to be on the show. So when we published it, to be fair, it was $102. So it's moving quickly. And I think the point of the report is that we need to see higher prices that bring us to either a diplomatic or a military solution to this issue. The loss of the flows through the Hormuz Strait is just so big that it can't go on. And that's why the base case is it lasts for 4 to 6 weeks. It's not because there's an obvious solution or an obvious ending. It's because when we look at the fact that at the start of the year, we were spending as a global populace around $2.5 trillion on crude oil and products. And today, annualized, we're spending more like $4.5 trillion. So this $2 trillion delta is that shift is almost as big as the first oil shock in the early 1970s. If this continues to the end of June, this kind of disruption that we're seeing, and this includes some, conservative assumptions about east-west pipelines and other diversions. So we're not even assuming, the worst case, which is that the Bab el-Mandeb Strait is affected. If this continues through the end of June, our analysis points to the prices getting back to the second oil shock peaks, not the first oil shock, the second oil shock. And that will take the spend on crude oil and products globally up towards the, you're talking 8 trillion, 8% of GDP. So it just can't, it needs to find a solution, and the market is trying to do that.
So, Max, when we spoke to Jeff Curry of Carlyle, and it's great to do this with you in real time as we get these breaking headlines, he was talking about the inverse of what we saw in the pandemic, that we had a massive shock to demand. Demand crashed, and what you needed to rebalance the market was for prices to drop aggressively lower. Now we look at the mirror image of that situation, and you need much higher prices to rebalance the oil market. Max, can you talk us through the economics of this? People band around the term demand destruction. Just what is the price elasticity of demand for energy? How simple is it?
Well, in some of the markets, we're already moving to kill demand, and you can see it in jet fuel, in some regions, in diesel. You're already trading well over $200 a barrel in those markets, and that's partly because the inventories there are more expensive to hold, so we just don't hold as high a level of them. So some countries are kind of running out of jet fuel already. So the demand destruction happens physically. The other way it happens is, just with higher prices, so people change their behavior. And I mean, we're already seeing this, certainly in the jet fuel market. This is most obvious, but I would like to make a comparison to the COVID period, because one of the big questions is a different one to Jeff's, and I used to work with Jeff at Goldman, so we go back, and I'd make a lot of people ask me, why are risk assets holding up relatively well, considering that this shock to oil supply is bigger than what happened in the first and second oil shocks. And one comparison I'd like to make is, I still remember it was late January 2020 when COVID was kind of spreading in China, and it had just reached Milan, and equity markets didn't sell off for a whole month. There was a whole month where even the Prime Minister was still going into Parliament here in the UK, and people want to believe that it's going to get better, and I think there is still, certainly in our base case, the hope that happens, but every day that passes is a day where you get closer to people kind of, the realization day that this is a really big shock.
I think you said that when you say your base case is a hope right now, Max. I don't want to really glean into the future too much, but the Treasury Secretary opened that door. I'm still struck by this headline. We'll see if Carg is eventually becoming a U.S. asset. What would that mean to energy prices if the United States takes over Carg Island?
Sure. So one of the big fears, and we put a bull case of 30% probability on the bull case. So the base case, we have 50%, but the 30% is that either the Hormuz Strait is disrupted for the next 2 to 3 months, or you get energy infrastructure attacks in the region that disrupt energy production, oil production specifically, for a period equal to or longer to what we saw during the second oil shock, which was around 6 months. And that's entirely possible. A barrage of missiles from Iran targeting one asset will be hard to stop. And it takes you, we don't know how long, it depends on the damage, but it could be 3 months, 6 months, 12 months, however long it takes you to rebuild that production capacity. So, the Hormuz Strait, if it opens, can come, the oil supply can come back really quickly. But obviously, if you hit energy infrastructure, and that may be the response of Iran to affecting its energy supplies, then obviously it takes a long time to rebuild that.
Max, I just want to break down some of the other headlines as well. Bramo, that one is controversial without a doubt on Carg Island, and there is some speculation as to what's going to happen there in the next number of weeks. But we've already had waivers for Russian crude. And we talked about how this effort is undermining foreign policy objectives elsewhere, particularly for the Europeans, given the war taking place right now between Russia and Ukraine. The fact that the US may unsanction Iranian crude that's on water right now is also really difficult to get your head around. Think about the two conflicts at the moment. You've got the Ukraine at war with Russia, and the Europeans are still buying Russian energy. And you've got a war between the US and Iran, and the US is talking about unsanctioning Iranian crude for them to sell to the rest of the world at a higher price. Try and get your head around some of the things happening right now in the commodity market.
It really highlights the dissonance between the public response to higher oil prices, the lack of preparation to have alternative sources of fuel in a whole host of different regions, and frankly, I don't want to say panic, but a little bit of a more urgent feel coming from different administrations saying, we have to do something even if it runs counter to our goals. It just raises the specter of what else do they have in their arsenal, given the fact that, yeah, you can do unilateral SPR releases. Sure, you can unsanction oil. That isn't going to unclog the Strait of Hormuz, and it's not going to solve the ultimate problem.
If they decide to unsanction Iranian oil, this would be a reversal of their own maximum pressure campaign that Trump has spoken about in Trump 1, and he went ahead and put the policy on the table, as well as in Trump 2. And the regime would be getting oil profit, petrodollars, at a much higher price right now, where you look at where Oman and Dubai crude is. I'm not talking about Brent oil, $110. We're talking about $150, $160, $170 a barrel. So basically paying the regime while at the same time the Israelis are decimating them. It's a little confusing.
Hey, Max, it's always good to get you on the phone and catch up with you in real time off the back of this breaking news. Thanks for making time for us. Max Layton there of Citi, breaking down his views on this oil market. I've got some good news, some better news, and this is the difference between the United States and the UK right now. In the UK, squeezed by energy, at the same time as the labour market is weak and a central bank is on pause, worried about anchoring inflation expectations, and two-year yields are absolutely surging. In the US, the good news, the labour market, jobless claims at 205. Initial jobless claims, Bramo, that is good news.
Yeah, and this is really highlights the data we've been getting significantly from the United States, which is the economy is still okay and people are still able to spend. I am really interested to see how much the U.S. market is moving in response to the U.K. and how much the ECB expectation is moving in tandem with what we saw from the Bank of England. What you're seeing right now, no rate cuts until October 2027 in the United States. And then once they start cutting rates, they're going to cut rates quickly. And that gives you a sense of just how much growth could get curtailed. So yes, things look fine now. But the longer that the Fed remains on hold and the longer that oil prices really cannibalize from people's spending power, there is going to be a hit on the other side. At least that is the implication for markets.
Market's really pushing this. Two-year stateside. We were talking about it earlier. A two-year at 390 is trading above the upper end of the range on Fed funds right now. And over at the Federal Reserve, there's a tremendously high bar to hike interest rates. So think about what we're really pushing in the market right now. Up by 15 13 on twos. And check out the UK curve. Keep going back to it. 30 basis point move. This is EM type stuff. It really is. 30 basis point move plus on the UK curve right now at the very front end, following this decision for the central bank to keep rates unchanged and anchor inflation expectations, with inflation set to come in much hotter than expected for the next few months.
Yeah, their message was pretty clear, which is ultimately they're either going to hold or hike rates. The fact that right now we're pricing in 3 rate hikes for the European Central Bank at a time when we still see growth potentially falling off as a result of this oil shock gives you a sense of just what a quagmire they're in. The fact that the U.S. market is following in tandem also shows the global nature of this bond market. Does the Fed still have control over the story?
To recap, Amro, and we've done this so many times over the past few weeks, we've repriced energy pretty aggressively. We've repriced rates pretty aggressively. Have we repriced growth sufficiently? And I'm not just talking about the US. I'm thinking more about Europe, Asia. Have we really priced down the hit to growth that we could see off the back of these moves?
The answer is definitively not at all. And most people do not have recession anywhere in their base case. When you start to look at this type of shock, and it harkens back to the 1970s or even the pandemic type of era, those were typically recessionary. And you start to wonder, what is the arsenal that people have to really counter that? No one wants to go there because they want to believe that this is temporary, and we all want to believe that. And until there is really a sense of exactly how long this could go on, that's when you're going to start to see it breaking.
Officials are being squeezed right now. We heard from the Treasury Secretary moments ago. Want to break down those headlines with Tyler Kendall. She's got more. Hey, Tyler.
Yeah, hey, John. Well, some new ideas being floated by the Treasury Secretary Scott Bessent in this interview as this White House plays defense when it comes to their plans to help combat rising oil prices after the escalation in attacks on energy infrastructure that we saw overnight. Now, as you've already outlined, the U.S. Treasury Secretary saying that the U.S. could, quote, unsanction Iranian oil that is already floating at sea. We have to keep in mind the administration has defended similar moves when it comes to Russian barrels floating at sea, often saying that that would only be a temporary move. The Treasury Secretary also saying that we could see another tapping of the Strategic Petroleum Reserve after this 172 million barrel release that's set to take place over the next 4 months. Just for context here, the SPR currently sits at about 60% capacity amid concerns about refilling it back up. Now, of course, the priority for the White House in this conflict is getting the Strait of Hormuz reopened. And you mentioned that headline from Scott Bessent there, seeming to indicate that Karg Island could still be a legitimate target after President Trump tried to scale back and de-escalate, as we've seen these targets on energy infrastructure. I want to point out that right now there is a Pentagon briefing that is ongoing, and we heard from the Joint Chiefs of Staff, Dan Kane, who made it a point to reiterate that the U.S. only hit military targets on Karg Island last Friday. Bessent also here appearing to perhaps pressure the Japanese Prime Minister ahead of her visit to the White House here today, touting how Japan has a lot of these mine-sweeping capabilities that could ultimately help to secure the Strait of Hormuz. He also did defend the U.S.'s decision to delay that planned summit between President Trump and Chinese President Xi Jinping, saying that it is only due to logistics and not because of China's refusal to help secure the strait. John, I did catch up with the U.S. Trade Representative Jamieson Greer yesterday, who reiterated that to me, but also said that U.S. negotiators made it clear to Beijing that it is in their best interest if they help to secure the Strait of Hormuz.
Tyler Kendall with the latest outside of the White House. Tyler, thank you. Appreciate it. Crude, close to triple digits on TI. Brent crude, 113. Major moves over the past few weeks. Gasoline prices pushing $4 a gallon now. That will get your attention in the White House. And the White House and the Treasury, just on the margin, starting to sound a little bit more rattled so far this morning.
Absolutely. 3 huge headlines. They're going to potentially hit the SPR one more time. They're going to unsanction, potentially, Iranian crude. Remember, Trump's big thing with Iran has been maximum pressure, not a single barrel. All the flows right now go to China. So they're basically saying that maybe some of these flows can go to, say, Europe, which historically, at some point, you have European refiners that took in some of this heavy crude from Iran. This would be counterintuitive to their entire maximum pressure campaign. The regime would be making more money because right now, how expensive crude is. And then this third headline that I'm still struggling to understand, because we have the chairman of Joint Chiefs of Staff, Kane, speaking, and the head of the Pentagon, the defense secretary, Pete Hegseth, speaking. And this headline did not come from them in terms of potentially the U.S. controlling Cargill. It came from the Treasury Secretary.
It's an odd one, isn't it?
At the same time, everyone in the national security space has been tracking the USS Tripoli. Came from China. It was the other day seen past Singapore. These Marines, what are they going to be used for? Everyone's been talking about potentially they could be used for this. And the Treasury Secretary basically just said it out loud.
The energy shock is turning into a rate shock. We could talk about the move in the UK, the 2-year up by more than 30 basis points so far. The US move I find slightly more curious, and I think there'll be some pushback, particularly from people in fixed income this morning, because that rate on the 2-year now is trading above Fed funds in the upper range of Fed funds, and the bar for hikes is so high at the Federal Reserve. You'll get a few people in fixed income raising questions about just how far that should be going.
Yeah, raising questions by buying the 2-year because they'll think that people are misreading exactly what's going on globally. This is a Fed that told you yesterday that a rate hike was not anywhere in a base case or even a possible case for 2026.
Jobless claims crossed just moments ago. Mike McKee's with us for more. Mike, we got some good news, at least on the labour market front.
Some good news on the labor market front, just 205,000 jobless claims last week, as you pointed out. So the low hire, low fire economy continues, and Jay Powell suggested that the labor market might be in better shape than we think at this point because the unemployment rate's not moving a lot. We did see the Philadelphia Fed index come out much stronger than expected at 18.1, up from 16.3. The expectation was it was going to be cut in half to just 8.0. However, prices paid rise to 44.7 from 38.9. This may be a sign that the first price effects of the war are starting to bleed into the U.S. economy. Generally, new orders fell. It was shipments that pushed up the Philly Fed numbers. So, again, that's a rearview mirror number, but the prices paid and prices received numbers may be giving us a little glimpse into what the future is going to hold.
Mike McKee breaking down the numbers. This is boring stuff, and boring's good news right now. The labour market's doing okay, at least when you look at jobless claims.
Yeah, at least it doesn't create a stagflationary type of environment. And for that reason, that's why people are going into U.S. equities and to some degree U.S. bonds, because the quagmire is less severe than, say, what you're seeing over in England and at the ECB.
Steve Rasciuto of Mizuho joins us around the table. Steve, good morning. Good to see you. Big moves in rates this morning. Yields at the front end of the curve. Central banks anchoring inflation expectations. What do you make of what you've seen so far?
Well, I think that the conversation you two were having before about the eventuality of people coming in and buying yield is real. We've seen this, development take place over and over again since we had the whole blow-up that took place in 2019 in the marketplace, and people are conditioned to do that. As people focus in on the oil situation, however, that tends to mute a little bit of it. But I think when you look at real risk assets, you look at corporate bonds, you look at the way spreads have come in, you look at the way deals have come into the marketplace, and we've kind of had a little bit of lull in deals yesterday and probably a little bit low today because of the volatility that's taking place. There's still a lot of liquidity. There's a lot of people grabbing duration, and that's the thing we've noticed about the corporate bond space is the longer duration assets have done, liabilities that have been sold have done better than the front end assets because people are grabbing yield. They're looking at this environment, said we've seen this before. We're going to buy yield again every time we've done it. It's been a knee-jerk response. We've done well on it, and I think that story has not changed yet. I think the market has to realize once that breaks before we'll get up to the 460 level. This may be the environment in which it happens, but I think you have to break equities through 6,500 to have that happen.
Well, I guess that this is really the key question, and we've been talking about it a lot around this table, this idea that if you have benchmark rates that are higher, if you have a Fed that's not going to cut rates, I know you never thought that the Fed was going to cut rates, but now they're doing it for perhaps the wrong reason, and you have a concern about how long this could go. Do you think that people are sufficiently pricing in the hit to growth that could potentially come on the heels of this?
Well, the hit to global growth, which I think you were talking about earlier, Jonathan, is a real issue, and that just creates more of the excess supply situation. But by the same time, it also lowers the demand for energy. So that then has an offsetting effect in terms of the price of energy. So you have to consider the way these things roll through the system. It'll also have an effect in terms of the longer-term interest rate environment. It'll have an effect on, what monetary policy needs to do around the world. So, yeah, there are short-term impacts, but there are also longer-term impacts that these central bankers have to consider. And I think, none of these things are just simple one-off transactions. There's multiple layers. You have to peel back the onion to really get to the core to see what's going on. And I think when you do that, you'll come to a situation that says, demand gets destroyed, well, then energy prices come down because there's less demand for energy. If energy prices come down, then the inflation fear is concerned. If energy prices come, the products come down, then the distribution of income changes, then people go back to spending, and you kind of moderate things out for a while.
Let's make it more simple. You've been bullish for a while. You've seen the potential to surprise to the upside in terms of growth and inflation heading into this oil price shock.
Correct.
Are you still bullish on the economic outlook, or are you getting more concerned?
Well, of course, you've got to get more concerned, but what we've done is we've taken our right tail risk out of our growth forecast. So we're at 2.7% Q4 over Q4, which is one of the stronger numbers on the street, if not the strongest number on the street. And what we've really were saying is that the right tail risk has come off. We don't see the energy story having the same impact as the near-term impact on refund check distribution. And if you notice, refunds are starting to pick up. We're about $18 billion higher than we were at this time last year. We think we can easily get to $100 to $150 billion worth of refunds being distributed between now and the end of May, extra refunds being distributed now to the end of May. And I think that provides a good deal of near-term support to the economy. Then as we lose that, we start to get the interest rate impact from last year's rate cuts, which then help offset. Now, the energy story, yes, is, Jonathan pointed out, where gasoline prices go, start to seep into the system. But again, people have ways of redistributing how they spend money. And that becomes part of the issue. I mean, one thing is, instead of taking a longer road trip this summer, if energy prices are good, you take a shorter road trip this summer. People have a way of adjusting themselves to relative prices. And I think those are the kind of things that economists tend not to really take into consideration.
Steve, can I ask you about these metal moves? Aluminum down by 7%, base metals getting beaten up, copper down by 4%, precious metals too, silver's down by 10%. Gold's down by close to 5%. What do you make of that?
That's the global growth impact. This is a serious impact. When you look at the original energy price stories in the 1970s, we were the least well prepared. Okay, most of Europe was modern electrified plant. They were dealing with nuclear power. We were old steam generation, pre-war plant. So 25% of America's capacity went obsolete overnight. Okay, and that's what helped create the stagflation environment. And it was happening in a world of excess demand for tradable goods, as the baby boom population was just moving into the labor force, productivity was going down. Now it's just the opposite story. Europe is in the weaker space. Asia is in the weaker space in their dependence on the energy. We have energy. We're not dealing with as much of a supply shock. We're dealing with a price shock. And that's the thing. In the 70s, we were dealing with a supply shock. Okay, I lived 50 miles from my school, and I had to drive back and forth each day in my car. I had a 10-gallon tank and 10 miles to the gallon. So I had to fill up every day. On an odd-even system, I'm changing license plates every morning, getting up at 4 in the morning to get on a gas line so I could get to school for 9 o'clock. Okay? And this is what I was doing every single day. You would go through gas stations. There were yellow, green, and red flags. Red, you had no fuel. Yellow, you could fill up for $3 to $5, and green, you could fill up your car. So, I mean, this is the stuff that was going on back then that's very different today. Supply is available. You're paying a different price, which means it's a relative price story.
Steve, it's good to see you.
Cheers.
Jen, thank you, sir. Thank you very much. Steve Asciutto there of Mizuho. We keep going back to it. We've had the energy shock. We're seeing a rate shock. Is the growth shock up next?
Yeah, I was listening to Jimmy Carter's Malaise speech yesterday, because that's what I was harkening back to.
Ramos spends her time.
I was just really struck by what Steve was talking about, changing license plates. Take the bus, carpool. It doesn't go over well with the American people. It didn't go over well in 1979. And frankly, it's not going to go over well this time. We are a long way from some of the prices that would really be concerning, but the level, the pace of moves, just absolutely stunning.
Put on a sweater is never a good message, is it?
Put a coat on.
Or an odd or even license plate. Yeah. My dad just went through this with me. He was telling me all about it, how, if you had multiple cars, you would be switching license plates. Headache.
This could be a tough moment. Let's give an update on everything we've heard in the last hour or so. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. We are seeing oil prices coming off their highs for the day on comments from the U.S. Treasury Secretary Scott Bessent saying the U.S. could do a unilateral release of the Strategic Petroleum Reserve. He also said the U.S. may unsanction Iranian oil that is already floating on water, and that Karg Island maybe eventually become a U.S. asset. Meanwhile, we are seeing the pound rising and yields on two-year gilts surging. The Bank of England voting unanimously to keep interest rates on hold and saying it stands ready to act to tackle any inflation surge triggered by the war in the Middle East. Traders fully pricing in 3/4-point rate hikes by the end of the year. And recapping that data we just got, jobless claims coming in at 205,000 for last week. That's 8,000 less than the previous week, and that saw 213,000 claims. Continuing claims rose to 1.86 million, slightly more than the previous week. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next, we'll talk bonds and this big move in yields. Ian Lincoln of BMO, as traders no longer price in a Fed rate cut for 2026. From New York City, you're watching Bloomberg TV.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
One of those crazy mornings. Let's get to it. Let's unpack this price action together and start with stocks. Equity futures down by 0.7% on the S&P. Underperformance on the Russell, small caps negative by more than 1 percentage point. The bigger relative underperformance, though, is coming elsewhere. It's coming from Europe. Look at these moves, aggressively lower. The DAX is down by close to 3%. The Euro Stoxx 50 off by 2.5%. And there's a reason for that. Look at these two prices, WTI versus Brent. Earlier on this morning, we're opening up a gap as wide as $20. WTI right now is at 97. We spoke to Samantha Down at Goldman earlier on this morning, and she suggested that maybe there's some speculation here about export controls coming into this market, but also highlighted that none of that is straightforward. So you've got WTI at about 97, up by 0.6. Brent up by 5, just off session highs at 113. And the Treasury Secretary in the press this morning, speaking to the media, that we may unsanction Iranian crude that's on water. That is highly controversial. It's sanctioned. Russian crude is sanctioned too, but they've issued waivers for some of that. And now there's speculation, maybe, that they're going to do the same thing with Iran. Okay, so that's your picture of crude. As if the energy shock wasn't enough. Now we've got a rate shock. Look at this move. Treasury yields at the front end of the curve, up 10 basis points yesterday, up by 12 this morning. That is nothing compared to this in the UK. We've had the Federal Reserve and Chairman Powell anchoring inflation expectations. The Bank of England doing exactly the same thing in a market that's pricing in interest rate hikes, not just in the UK, but in Europe too. A 37 basis point move in the UK, not on the year, not on the month or the week, on the session, twos at 450.
Yeah, this idea that suddenly you have a Bank of England that needs to combat inflation first and foremost, sending dovish members into a hiking posture, highlights how much the tables have turned, how much things have changed in the Bank of England, and frankly for the ECB, where we now have 3 rate hikes priced in for the remainder of this year.
Ian Lingo of BMO joins us now for more. Ian, good morning.
Good morning.
What a morning, sir. What do you make of these moves, and do you think we're overdoing it at the front end of the US curve?
So I think that the U.S. is in a specific situation since the Fed has a dual mandate, and we were already uncertain about the labor market going into this series of events. Europe, the UK, that makes more sense given how we would expect monetary policymakers to react there. I do think that it is not the type of move to jump in front of, because there's so much uncertainty associated with what's going on in the Middle East and how that's going to continue to play through to the energy sector. We could get $125, $130 a barrel oil very easily if this continues to unfold in a scale that is measured in months, not weeks, as it was originally intended.
I'm struck by the yield curve, which is rapidly compressing, rapidly narrowing. People are expecting that higher front-end yields are going to send growth substantially lower, and perhaps even more so in the Euro region. How much confidence do you have that that is the correct move, that there is going to be a move much lower, say in 2027, in response to holding rates higher, whether it's hiking or whether it's just a hold?
I think that a flatter curve in this environment makes sense. I think 10 and 30 years should outperform, because if the Fed does fight inflation, delays rate cuts, then we should see break-evens compress over time and nominal rates slip lower. What I'm worried about is I'm worried about the fact that we haven't fully integrated what happens to demand in this situation. What happens to the fact that we have higher prices at the pump that leads to consumers needing to make some hard choices, and we could see consumers under a lot of stress over the next several quarters, which undermines the strong growth argument in the U.S., which has kind of defined us for the last couple of years.
So, Ian, when you put this shock together, is it bullish or bearish for fixed income, for bonds, for treasuries?
I think it's long-term bullish for treasuries. Lower rates remains my base case. I think 10-year yields are below 4% by the end of the year, and I think that the 2-year sector is going to continue to struggle.
Super, super volatile at the front end of the curve right now. Major moves, 30 basis points plus in the UK, double digits in the US, and you're starting to see it in growth. This move in base metals, and I keep going back to it, aluminum down by 7, copper down by 5, precious metals providing you no relief whatsoever this morning, gold down by 5, silver down by 11.
Yeah, gold and silver, put them aside for a second. The aluminum and copper moves, directly speaking to what Ian Lingon's talking about, which is demand destruction. And the idea that people are starting to comprehend what that looks like as they hit to global growth looks increasingly likely. I just wonder how long this can go on before people have to start talking about other ways that this feeds through to the market, including in the U.S. I mean, we have this whole idea that data centers are going to save us. How do you build them if you don't have access to a lot of the materials? How do you build them if you don't have easy access to the energy prices? So there are a lot of questions here around, frankly, the bull case for all markets, global markets in particular, going into this year.
In 20 minutes' time, there's an ECB interest rate decision.
Good luck.
In the next hour, there's a news conference with Christine Lagarde of the European Central Bank. Is she going to follow what we heard from the chairman yesterday, from the Bank of England this morning? And if she does, what does it mean for this market? Ian Lingon, thank you, sir. Ian Lingon there of BMO. Tomorrow, full reaction for you. John Stolfus, Oppenheimer. Michael Zies of Morgan Stanley. Lotfi Karui of PIMCO. Jonathan Golub of Seaport from New York City this morning. Good morning. This was Bloomberg Surveillance.
A frustrating start at the Miami Open. Rain fell steadily all day at the Hard Rock Stadium Wednesday. Not a single ball was hit or a match completed. The good news is that the storm system has cleared out and plays expected on all courts Thursday. And when the action does get underway, Tennis Channel's got you covered all the way to the championship matches. Head on over to tennischannel.com to download the app.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options. There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. You good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
30 minutes until the start of trading. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Oil and gas surging this morning as energy attacks escalate in the Gulf. Treasury Secretary Scott Bessent suggests the U.S. may unsanction Iranian oil that's on the water.
President Trump tries to turn down the heat, distancing the U.S. from Israel's attack on Iran's prized South Pars gas fields.
And central bankers weigh in. Powell says it's too soon to judge the impact of the Iran war on the U.S. economy. This hour, we'll hear from Christine Lagarde.
It's central bankers controlling the market this morning. It was that UK rate decision that's sending yields surging, and yet stocks aren't really doing anything this morning.
Yeah, I think the UK two-year yield was up like 30 basis points. The U.S. two-year yield is up above the upper bound of the Fed funds rate. So things are really kicking off.
You can't have this kind of funding volatility and not have it have a risk market impact. I was talking with Michael Ball. This market is just really well hedged right now. What happens when that changes? But part of the market that is moving, Matt, are the gold miners this morning. Gold tumbling 6%. All of the metals are getting crushed. It's a 1-2 punch of a reversal of this momentum asset as the war drags on. And central bankers talking about doing whatever it takes, having to act. Maybe hikes are next. Anglo Gold, that falls nearly 13%. Newmont Mining down 9.5%. And Freeport-McMoRan down at 6%, Matt.
So central bankers drawing that money out of those assets and into cash. A check on futures right now, as well as Brent and the 2-year. You can see S&P futures now down 0.75%. Don't forget, we closed the cash trade yesterday down 1.33%. I've been watching, traders are watching closely the 200-day moving average, which is currently around 66.15 on the S&P. It could be finally the day that we hit that on the downside. Brent crude right now only up 5% to $112.72 a barrel. It had been back up to $119 a barrel until the Treasury Secretary made comments about unsanctioning Iranian crude, letting them sell it and keep the profits, about possibly the U.S. taking Karg Island, about releasing more reserves unilaterally from the Strategic Petroleum Reserve. So a three-pronged approach there. And then the 2-year yield, it is up 13 basis points, right now at 3.90. So, Danny, as I said, we already were up to the highest level that we'd seen in, 7-8 months on 2-year yields, but now we're up above the highest range, the upper bound, I should say, of the central bank's key rate. And that means that maybe this market expects, maybe reserve managers expect a hike rather than a cut.
And these markets, if you look at WIRP, we are pricing in 11% odds that we get a 25 basis point hike from the Fed. We've already priced that in for the ECB and the UK to the tune of 3 hikes. Connor Sen put it well that markets aren't unmoored yet, but it is the first morning where it feels like we could get there. Behind all of that, President Trump pushing for de-escalation, saying the U.S. wasn't involved in the South Pars attack and warning Iran against further retaliation. Defense Secretary Pete Hegseth spoke in the last hour.
To date, we've struck over 7,000 targets across Iran and its military infrastructure. That is not incremental. That is overwhelming force applied with precision. We've hit hundreds of their defense industrial bases directly. Their ability to manufacture new ballistic missiles has probably taken the hardest hit of all. Ballistic missile attacks against our forces down 90% since the start of the conflict.
Let's get the latest with Bloomberg Washington correspondent Tyler Kendall. Tyler, there seems to be an appeal from this administration to de-escalate, but also some signs of escalation at the same time.
Right, Danny, at this point, after we got this operational update from the Pentagon, it doesn't appear that the conflict is letting up anytime soon. As you just heard, the Defense Secretary Pete Hegseth saying that Iran's missile capabilities are now down 90%, and the chair of the Joint Chiefs of Staff, Dan Kane, going on to say that the U.S. continues in its objectives, which requires striking deeper inside of the country. General Kane also highlighted the U.S.'s most recent attack on Karg Island, but made it a point to say that the U.S. only went after military assets and not energy infrastructure amid this call from President Trump to de-escalate after what was a flurry of attacks on energy infrastructure in the Gulf by Iran. In his post on Truth Social, President Trump appearing to try to distance the U.S. from Israeli strikes on Iran's largest natural gas field, though a person familiar with the matter tells Bloomberg News that the U.S. was aware of the operation, though did not participate. This White House is signaling now a reluctance to go after energy targets that could disrupt global oil flows. After earlier this week, President Trump did say that energy infrastructure on Karg Island could be a viable military target. It's going to be something to watch here as the administration is trying its hardest to put forward some ideas that could bring down prices for American consumers. Just yesterday, of course, we saw this temporary waiver when it comes to the Drones Act in a bid to make it cheaper to move energy commodities between U.S. ports. And then, of course, as you have already mentioned, the U.S. Treasury Secretary Scott Bessent floating some other ideas, including an additional tapping of the Strategic Petroleum Reserve.
Tyler, thanks very much. Bloomberg's Tyler Kendall there at the White House. I want to get to Anne-Marie Hordern right now. She's our chief Washington correspondent and co-host of Bloomberg Surveillance here on set with us because, Anne-Marie, you made a couple of really fascinating points this morning. Scott Bessent is still the Secretary of Treasury, not of State, not of Defense, right? And he's talking about the potential that we take Karg Island as a U.S. asset. You've been tracking an amphibious vehicle that's carrying, what, 2,000 Marines up towards Iran?
2,200 Marines. They are coming from APAC. They're going towards the Gulf. They're going towards Iran. It's an amphibious assault ship, the USS Tripoli. So this is something a lot of people in the national security space has been tracking because the president would have some options on what potentially he would maybe want to do with these Marines. This question about Karg Island, given the fact that the U.S. has struck Karg Island, it is a crown jewel for the regime in terms of 9 out of 10, every single Iranian barrel goes through Karg Island before it gets shipped off mostly to China. Now, the Treasury Secretary's comments about unsanctioned crude, maybe it can go elsewhere. But potentially there's been this talk, would the United States maybe even consider taking that island? This is what the Treasury Secretary told the press. All the oil workers there are being coerced to stay there, and we will see what happens with whether that eventually becomes a U.S. asset. And what strikes me that this is the Treasury Secretary delivering this message to the American people. At the same time, Pete Hegseth, the Defense Secretary, and Joint Chiefs of Staff, Kane, were briefing the press at the Pentagon. So why did this message, this open door, potentially for Karg Island, come from the Treasury Secretary?
And you mentioned, Bessent, also talking about unsanctioning Iranian oil that's on water. What impact would that have? How many methods does this White House even have to try to open up oil markets and bring down prices?
Well, this would go against their maximum pressure campaign against the regime. And right now, oil prices are obviously significantly elevated. And I'm not just talking about Brut. If you look at the real physical barrels, look at Oman grades, Dubai grades, $150, $160, $170 a barrel. So this would mean Iran would be selling to anyone legally, because most of this unsanctioned crude goes to China. This would be opening up to other Asian countries, which right now are the front line of this energy shock, but at a higher premium. So this sends the message to the regime that your strategy is almost working by attacking these energy facilities. Now, this is going to have, I imagine, a tremendous amount of pushback from Riyadh, from Dubai, from Doha, in terms of allowing the Iranians to legally sell crude. I don't think that's the message their Gulf Arab partners wants to see this White House take.
Can I just ask you, as President Trump seems to be really attempting to de-escalate, right? And Hegseth says this is going to be the most intense day of attacks on Iran. As Marco Rubio gets ready to maybe step down and prep for his 2028 presidential campaign, is Bessent vying for another post here?
I don't know. I have no insight into that right now. I think every time the press has talking to the Treasury Secretary, myself as well, or even asked the president about them, the one slot he really wanted the Treasury Secretary to go to obviously was Fed chair, and that didn't happen. And he continuously says, I'm very happy where I am. But the Treasury Secretary does have an immense amount of power when it comes to national security and foreign policy because he runs OFAC. That's where all the sanctions come from. So he does weigh in on what is going on around the world. It was just very peculiar to hear him weigh in on actually taking Karg Island as a U.S. asset.
Anne-Marie, thank you so much for your coverage this morning. That's Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Surveillance. And you can find continuing coverage of the war in Iran on T-Live on your terminals. Now, in tech news, Micron shares are sinking after the company warned it will need to spend heavily on production to meet demand. That overshadowed a generally upbeat forecast. Bloomberg Tech co-host Caroline Hyde joins us. I think that's even underplaying it. It wasn't generally good. They smashed all expectations, and yet shares are down more than 6%.
I mean, what's the company to do? They tripled revenue for the quarter they just reported. They are smashing expectations for the quarter that they're guiding on by some $10 billion. Yes, the company has seen shares up significantly. They're up 60% just in the last 3 months alone. So to start this year, people are worried about the amount that they have to spend? And basically, if this is as good as it gets, our margin's going to cap out at 81%. Are we going to have to see, yes, a much elevated capital expenditure spending? He's saying about 25 billion for this year and then another 10 billion on that for the next fiscal year. And really, how solid are they in terms of the supply chain to NVIDIA? This is all about high bandwidth memory. This is about HBM4 in particular that is going into NVIDIA's latest GPUs. Is it going to be used in the next architecture? Is it solid? Can they fend off SK Hynix? Can they fend off Samsung? They're just some of the questions I think people are just pulling back at this moment.
Caroline, thank you very much for joining us. That's Bloomberg Tech's Caroline Hyde. And Matt, it's worth just looking at these markets again because rate markets are incredibly volatile with the move in the front end, both here in the U.S., two-year yields up nearly 12 basis points. In the U.K., it's even more stark. And look at what equities are doing. They are not even down 1% as Brent crude moves up 5.5%. It's a market that perhaps is incredibly well hedged. We're going to get an options expiry at the end of the week and at the end of the month. Does that change things? Do we finally start getting some selling and just not hedging into this market?
Well, if you look at financial assets, they're taking this much more lightly over the last 3 or 4 weeks than commodities are. If you type GLCO Go, on your Bloomberg terminal, you will see some striking numbers in the percentage change year-to-date column. I mean, as Anne-Marie said, it's not just Brent crude up 86% year-to-date. You know, you're looking at gas oil that's up 113%. You're looking at nat gas that's up 130%. And these are for the contracts that we track here.
Yeah, and that contract, the difference between WTI and its widest spread since 2020.
Brent at 113 and NYMEX at 9.
Exactly. So it's especially getting ugly in Europe. And to that point, coming up, it's Christine Lagarde's turn. We're in Frankfurt with the ECB decision up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask
Interesting questions.
Bloomberg Television. Top experts, great questions.
Quick check on markets as we await the ECB decision. These are some, no doubt, driving factors here. The Stocks Europe 600 is down almost 3% right now. And we're looking at regional indexes in Europe, the CAC 40 in Paris, the DAX 30 in Frankfurt, the OMX in Stockholm that are down 10% year to date. So real serious drops there because of the rise in Brent. Here you can see on the day we're up 5% to 112, 113. We've been up to 119 this morning. And you can see as well that we have futures, gas futures up another 20%. That's a one-day trade. One day, another 20% there. And this is a continent that relies largely on gas. The euro right now, even as we talk about multiple hikes potentially coming from the ECB, it's not even at 115. I mean, the euro is down against the dollar over the last 3 weeks. And we have a scenario where this central bank here is supposed to be cutting. And they're going to be, we heard from Casimir a week ago, and now we're hearing likely from Lagarde that...
I mean, the ECB, just out with their decision, they're not changing anything, but this seems very similar to the BOE's language. The Governing Council saying that it stands ready to adjust all instruments. It's also increased their inflation outlook for 2027 to 2%. It was at 1.8%. Similar thing for 2026. Inflation outlook goes up to 2.6%. The prior forecast was 1.9%. The ECB saying that the Middle East has made the outlook significantly more uncertain. Again, Matt, it's this line that stands out to me. The Governing Council stands ready to adjust all instruments. Is this, like with the BOE, in a doing whatever it takes moment, saying that we are standing ready to act with increased inflation?
Yeah, and also cutting down their growth forecasts, right? For this year, I think 0.9%. The prior forecast was 1.2%, cutting its growth forecast for next year as well. Let's get to Bloomberg Senior European Economics Correspondent Jana Randau in Frankfurt. So, Jana, what do we expect to hear from Madame Lagarde this morning?
Yeah, good morning and good afternoon to those in Europe. This is quite an intense policy statement they put out, of course. They are acknowledging that the situation is very, very uncertain, significantly uncertain. But also they say that the ECB is well positioned to manage what is coming at it at the moment. As you said, they revised up their inflation outlook. That is, of course, on the account of oil prices surging because of the Iran war. Growth is weaker not much of a decision here other than just monitoring the situation very, very carefully and standing ready to respond should those second round effects materialize, should inflation become entrenched.
And so with this, Jana, again, pricing in markets not changing. Perhaps some of this was already getting priced in from what we heard from the BOE. If the war is posing upside risks and downside growth risks, if that's one of the main takeaways from this, Jana, is it an ECB that would even be able to hike because of the growth factor in what the war in Iran would be doing to the economy?
It's a difficult decision they have to take, but ultimately the ECB has a single mandate, and that is price stability. And the other thing to consider is that the past inflation shock when Russia invaded Ukraine, that is still very much on the minds of consumers, on the minds of businesses. So what we heard from policymakers going into the meeting is that their patience with inflation overshoots is probably a bit lower than it used to be, 4 years ago. So people are still remembering inflation above 10%, and policymakers have, that experience, how difficult it was to get it back to 2%. So those inflation expectations are very, very crucial. And I would go out on a limb and say the hurdle to action is actually a lot lower than it was in the past. But that said, of course, growth is important. It is rather weak. So, I wouldn't want to be a central banker right now.
Well, Madame Lagarde doesn't have to be a central banker much longer, right? After the incredible impact that she's had in replacing Mario Draghi. Is this her last meeting? What's your question going to be to Christine Lagarde?
Well, it depends what she has to say, right? So far, we've just read the statement. She will have a more elaborate explanation of an assessment of the economy. But for sure, the most important or the most interesting thing is how will the ECB react to risks as they unfold? So the famous reaction function that economists are very interested in, because let's face it, we're not going to get any forward guidance. We're not going to get a commitment. We are going to raise or lower interest rates or keep them on hold. Everything is going to be data dependent, decided meeting by meeting. But what they can offer and what Madame Lagarde can offer us is, an outline of what will trigger a potential decision. And that is what certainly I'm going to ask her.
Well, now markets backing off the steepest of rate hike expectations. We're no longer pricing in 3 full hikes from the ECB, now only 2, with a total of 60 basis points priced in of hikes through 2026. Jana, we're going to catch up with you later after we hear from Madame Lagarde. That's Bloomberg's Jana Randau in Frankfurt. And stay tuned for that press conference. ECB President Christine Lagarde will be kicking off her news conference at 9:45 a.m. New York time, so in just about 25 minutes. Now, these markets digesting a lot between higher rate expectations from the ECB and BOE and higher. They are, though, pricing in a quick end to the war in Iran, according to J.P. Morgan. Strategists there called it complacency and a, quote, high-risk assumption. Bank of America's chief investment strategist, Michael Hartnett, told Bloomberg that he doesn't see a complacent market.
I wouldn't say it's complacency, but everyone thought it was a short war, yeah? Everyone thought it would be folded earlier and, there's an election for Trump to win. The market's too big to fail. We've seen this script before. We don't want to sell. So I think what's happened the last couple of days is kind of like people have said, I don't want to sell because the policy will change, right? And it's now, actually, we're going to have to sell to change the policy. Do you see what I mean? So it's kind of like it's flip-flopped a little bit.
Joining us now is Advisors Capital Management Portfolio Manager and Partner Joanne Feeney. Joanne, what a day to have you on with us. If I can just go through some of the moves we're seeing in rates. 2-year yields in the U.S., the highest since July, up 9 basis points. In the U.K., the front end is up 36 basis points. In Germany, those yields are up 11 basis points, and yet equities are only down 0.6%. Joanne, how do we have this type of volatility to funding markets and stocks that are, yes, lower, but not even by 1%?
Well, Danny, it's pretty clear that the war in Iran is going to create an asymmetric impact on European and Asian markets versus the U.S., right? We have plenty of oil and gas here, so it's not a supply shock for us. It's definitely a price shock, and that's going to affect not just the consumer at the gas pump, but it's also going to affect, manufacturers, service people, anybody that uses energy. The beneficiaries in the U.S., obviously the oil companies. But in Europe and in Asia, they're seeing potentially shortfalls in supply. And that is likely to affect, their degree of manufacturing capabilities. They're going to have to, make cuts here and there. They're going to have to improvise. It's going to affect their margins. So the impact on foreign stock markets clearly should be bigger than what's going on in the U.S. The U.S. has a lot of tailwinds for growth as well. Leading the charge is NVIDIA and AI and all the different, data center builds and the memory market, et cetera. So we're in a really different situation in terms of our companies and their ability to continue to grow even in the face of higher energy prices.
Joanne, I'm starting to see little black boxes around European equity indexes, which means that they have moved massively, 3 standard deviations away from their 90-day Z-score, and I'm seeing that on the FTSE right now. I'm seeing that on the OMX. We're, as I said earlier, seeing 10% drops year to date on the CAC 40 and on the DAX 30. Are any of these assets, you think, being sold off too steeply? Are there any bargains to be found in a place where, until this war started, people were talking about the U.S. no longer being the only game in town, the outperformance of European markets over U.S. markets last year, maybe it being an attractive place finally to invest?
Yeah, I mean, I think there are always bargains to be found. You do your homework. We've got an international team that is focused on the one hand on Europe and on Asia and elsewhere, and they're certainly finding opportunities in this. But the situation is just rife with uncertainty. And uncertainty raises risk premiums, and that's why we've seen these stock prices fall, particularly in Europe, as I said, because of the supply implications on the energy front for them. There are always opportunities. Do your homework, you can find something. I mean, defense industry obviously continues to be a strong opportunity in Europe, more so now.
All right, Joanne, you're going to stick around with us through the market open on this volatile in some markets days and less so in others. Joanne Feeney. Matt, let's get a check on markets ahead of the opening bell. Again, stocks, they are down 0.7% for the S&P. NASDAQ goes down by 0.8%, but the action is in the bond market. 2-year yields up 9.5 basis points, a decision from the ECB not to change rates, but to lower their growth forecast and at the same time increase their inflation forecast. We're pricing in just under 3 rate hikes from the ECB. 3 rate hikes is what we're pricing in from the UK. Brent crude up 4.8% with more attacks on energy infrastructure in the Middle East.
Yeah, I'm constantly pulling up GLCO, so constantly looking at what's going on with crude. We have seen gains given back a little bit today. You've seen NYMEX crude up to $100 a barrel, now back down to 97.91. Brent up to 119, now down to 112.84. And in terms of metals, you see some really big losses. Aluminum down 6%, copper down 4%, nickel down 3%, gold down 5%, silver off 10%. So some massive drops here. Actually, yesterday I was looking to see if I were a prepper,
right?
What would I need in case of a social collapse?
Right.
And
well, it's less expensive for you to be a prepper today.
Right. Well, I mean, bullion is just an ounce of bullion is too much to spend if I want to get groceries. So I was looking, and AI was recommending like pre-1965 dimes because they're actually 9/10 silver. So.
Okay, I don't know what to do with that information. Thank you, Matt. A day where markets feel like they're starting to become unmoored. We are still holding it together. We're going to have your opening bell in about 4 minutes' time. You're watching at Bloomberg Open Interest.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed, Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, looking at futures that are down 0.7% on S&P after a negative close yesterday. We were off 1 1/3%. NASDAQ futures down 0.9%. And this picture has gotten worse throughout the morning, even though oil has given back some of its gains on Treasury Secretary Scott Bessent's comments that we could remove sanctions from Iranian oil on the water, as well as open the SPR. He also said we may take Carg Island, or that's potentially a U.S. asset in the future, talking to, I think, Fox News this morning. Edison Electric Institute ringing the opening bell at the New York Stock Exchange in a very good mood on a day when things look a little bit shaky here in terms of the NASDAQ. You've got Amplify, her really leaning into the diversity play down at the NASDAQ market site. And, you know, we're all focused on what's happening to the price of commodities, because they're harder to print for central banks. But the central bank still seems to have a lot of power.
A central bank cannot print molecules, in the word of Carlyle's Jeff Curry. Yeah, I mean, look, it's a central bank that, because they are hiking, or there's now pricing in for hiking rates. Last I checked, it was about 9% odds that the Fed could hike in April, but that's getting faded out of this market. The ECB a little bit more dovish, helping to bring rates back in. The BOE just fully sending it, saying that they will do what it takes. They will step in if they have to. They are ready to take action. So as Matt was saying, that's been really hurting all of the miners. The price of gold is down sharply, and silver. AngloGold, Newmont Mining, Freeport, all of them seeing their share price really take a hit this morning, Matt, along with the price of those commodities.
All right, let's take a look across assets now as the S&P opens, and we're looking at a drop below the 200-day moving average. 65.63 is the level here. I have been watching, traders have been watching 66.15 was the 200-day moving average, so we're finally back below that on the U.S. stock benchmark. Brent crude up 5%, I'll say only because we had been up at one point like 10% earlier to 119. Right now, 112.80 a barrel, and we're looking at WTI around $97. As Danny said, that spread has really blown out, but you can look at some other crude contracts and see even bigger diversions there. The U.S. 2-year yield now up only 7 basis points at 3.84, 3.85. Makes the move look tepid compared to what we saw in the U.K., where 30 basis points was what we saw at the front end of the gilt curve.
34 in the UK right now. It's getting helped out by the ECB, ironically enough. That was divined to be more dovish because they're also flagging growth risks alongside of that of inflation, and just saying that they're data dependent. They have no set path, and that's helping to bring rates back in.
Joanne Feeney is Advisors Capital Management Portfolio Manager and Partner. Joanne, what do you make of the growth outlook? I think Secretary of the Treasury, Scott Bessent, this morning on Fox said we could still see 3% growth in the U.S. economy this year. How quickly does oil have to come down for that to work out?
Yeah, hard to tell, Matt. I think that we have to recognize that uncertainty is higher, and that generally discourages firms from making investments, and that will weigh on growth. And now we're seeing certainly growth tailwinds still from the data center and the AI investments, and that's definitely a tailwind for the U.S. I can't make a guess at total GDP growth, because what we're seeing here, right, is higher gas prices are going to hit the consumer. They're going to have to reallocate and spend less on other stuff, and that's going to potentially weigh on growth. Also, recall, we have far less labor growth. In fact, no labor growth. And so with the decline of immigrant workforce, and we're seeing firms hiring less. So we're not seeing an unemployment problem in the numbers yet. But the lack of labor growth constrains GDP growth. Now, we are seeing potentially some productivity growth. And Chair Powell referenced that yesterday in their uptick in their view on total growth. But overall, we have to worry about how long this is going to go on. It isn't just a cessation of hostilities that will turn things back on, right? We've seen real damage and increasing damage to energy infrastructure and the shut-ins of production, which take a lot of time to turn back on. So we should expect that even after hostilities and bombing ceases, if and when it does, that it's going to take a while for the supplies to come back online. So this could last quite a while, and that uncertainty, I think, is going to constrain investments. So, I think there's definitely more risk to the downside to growth than there is right now in terms of the tailwinds.
So what do you do in the meantime, Joanne? If you have this expectation that this could go on, but we don't know for certain, do you just get really low down to the ground? Do you move into cash? Do you start finding some things to short? What are the actions you take in a portfolio?
Yeah, so one set of portfolios for which I'm responsible is our balance strategy. It's designed to be conservative, and so we've been positioned for higher geopolitical risk for a while now. And the way we do that, first of all, we have overweights in the energy sector, right? Recognizing higher prices would follow any escalation which has occurred. But also, we build in some income-oriented stocks that are less vulnerable to economic and geopolitical cycles. So that means that, clients are protected even in the face of declines in stock prices because they're still getting those dividends. And oftentimes people are living on those dividends in their retirement. So, whether it's a high dividend stock in the real estate sector, in REITs, or in energy and financials, this really helps to cushion the declines for clients. Also, we like defensive consumer plays like a TJ Maxx, for example, which tends to do well no matter what is going on in the economy, but particularly when things get tougher. More foot traffic goes over to the TJ Maxx set of stores. So those are a couple of ways to protect. And again, we've been positioned for higher risk for a while. So, we have a pretty conservative outlook without giving up on our growth, though. About 25% of these portfolios are dedicated to higher growth opportunities, whether it's an NVIDIA, Amazon, or a Palo Alto, for example. We want to be exposed to the growth, too, for clients.
Joanne, we're going to have to leave things there. Thank you so much for joining us this morning. That is Joanne Feeney, Advisors Capital Management, Portfolio Manager and Partner. Let's get a check on your equity markets about 6 minutes into your trading day. Again, we're only down just under 1% this morning. Breath is decisively to the downside. 306 stocks are down. 196 are up. On the upside, you have Intuit. It was just named one of the top picks at Morgan Stanley. Johnson & Johnson, that's up there too. Salesforce, MasterCard, AT&T. You have some of the energy names up here, Chevron, so that's a bit of a macro play. To the downside, NVIDIA dragging the market down by 12.4 points. Recall the net change for this S&P is off 60 points this morning. Micron, earnings that blew it out of the water, but is spending $25 billion in capital expenditures this fiscal year. That's enough to drag it down. Tesla is also down. Uber and Rivian reaching an agreement, an investment from Uber into Rivian in order to have an autonomous vehicle fleet. So that seems to be nudging Tesla lower. Let's look at the indexes, or rather the subsectors. Yesterday, every single one of these was down. So at least this is a change from that. Materials the worst, as the cost of things just gets more expensive, down 2.3%. Information technology down 1.5%. Oh, Matt, you love to see it. Healthcare is actually up today, but that might be more because of Lilly and their new drug that has a record amount of weight loss for it. But even so, finally a day where staples and healthcare not doing really poorly. So some risk off actually making sense in this market as energy, of course, is the top performing sector.
I don't get this weight loss war, because it's like, how much weight can you lose? When you get to 15%, 20%, 30%, like how much further can they go? Right. No one's going to want to lose 100% of his weight. Let's take a look at some of the single stock movers that we've got out this morning, because there are some eye-catching moves. Fannie Mae, for example, has lost at one point almost a fifth of its value. Right now, it's only down 14%. But as you see, yields jump, especially on the 2-year, and concerns about the Fed going to hikes rather than cuts. Fannie Mae just comes plummeting down. Danny mentioned Rivian, which I think is a fascinating stock to be watching, not only because of the investment Uber is making in Rivian. I think it's $1.25 billion to put autonomous vehicles on the road. They're going to buy 10,000 R2s. That's Rivian's new, smaller and less expensive vehicle, but also because everyone now who has an electric car is like doing a victory lap as gas climbs to $4 a gallon. That's the nationwide average, right? If you live in southwestern states, the sand states, you're paying like 5 and change already. Take a look at Alibaba. That's another one that barely grew revenue, saw a huge drop in profit. I think 2/3 drop in profit, 67%. Now they do want to get $100 billion in cloud revenue, but that's like a 5-year plan right now, and so the stock is getting decimated, which, by the way, is what that word means, Danny. Reduction by a 10th. So when you hear...
Wait, sorry, that's what means? Decimated?
Decimated.
Okay, yeah.
So it's what's happening with Alibaba today. The reason I bring this up is because so many leaders right now are talking about how we've decimated Iran's military capability, and I would say we've done far better than that. You know, if we've only destroyed their military by a 10th, that's not worth $11 billion in a week, right? I think we've probably decimated it like 9 times over.
They still, though, have shown their ability to wage economic warfare. And the issue with economic warfare is that it impacts everybody. It impacts us and it impacts Europe. Matt, some breaking news just crossing now. The Fed issuing a proposal that would revise the risk-based capital framework for the largest banks. Let's get details from Bloomberg International Economics and Policy Correspondent, freshly back from D.C. for the Fed rate decision. It's Michael McKee. Mike, what are we learning?
Well, this is the latest iteration of a long effort to try to align U.S. bank regulations with the rest of the world. It's generally sort of known as the Basel III proposals. In essence, they simplify the rules, the calculations for capital retention, account for risks differently, and have different standards in some cases for smaller banks. For the biggest banks on Wall Street, Category 1 and Category 2, they've been required to use 2 risk models in the past to calculate the risks of their activities, a standardized one and their own internal risk model. Now they're just going to have one single set of risk-based capital ratios. The expanded risk-based proposal would include standardized risk weighting methodologies for credit, equity, and operational risks. It would also introduce an explicit operational risk requirement calculated based on a firm's income and expenses. It would also include a standardized methodology for calculating risk-weighted assets for market risk. And then something that folks on Wall Street are really concerned about, the global systemically important banks, the GSIBs, would be assigned surcharges in increments of 10 basis points rather than 50 basis points, and the risk models would be simplified. According to Mickey Bowman, the vice chair for supervision at the Fed, she says this will not make the banking system any less resilient. Together, she says these changes would strengthen our overall capital framework, which would remain robust under the new regime. Banks would maintain their capacity to absorb losses while continuing to provide financial services to households and businesses across a wide range of economic conditions. And certainly there are benefits to the banks, guys. The calculation, according to the Federal Reserve press release, is that Category 1 and 2 banks would see their capital requirements go down by a net 4.8%. Category 3 and 4, down, the regional banks basically, down 5.2%, and for smaller banks, 7.8%. There's been a big concern, especially among smaller banks, that the specific risk measurement models used for banks did not really apply to them because they don't do all the banking activities as the big banks, so they're getting the biggest break out of all of this.
I'm looking at the KBW banking index, and it doesn't seem to be moving very much. Right now, we're down by about 2/3, but that was the case before this announcement. 2/3 of 1%. That was down before this announcement as well. How telegraphed? How ready were financial markets?
They were ready for this. This has been going on for quite some time. Last week, Mickey Bowman gave a speech and sort of outlined the general contours of what they're going to do. But you remember, we had a proposal, and then when Michael Barr became vice chair for supervision, he withdrew that, put out another one. Everybody hated that. He withdrew that after he first proposed it, said they would do it again, and then he resigned as vice chair. Mickey Bowman came in, picked up the baton, and now this is her contribution. This obviously obviously goes out for comment before these rules take effect. But it does seem that enough people have signed off on this, that this is probably the regulations that the banks are going to get, and it's basically incorporates most of what they wanted.
Mike, we're going to hear from Christine Lagarde, the ECB president, in about 1 minute's time. We heard from the BOE saying that they stand ready to act. I just wonder if you can contrast that sort of hawkish language with what we heard from the ECB and from the Fed.
Well, you remember the U.S. is a net energy exporter, so we have a lot of oil and gas here in the United States, and these other countries are takers. And so they're going to have to pay a lot more than we are for the inflated value of these things that we can't get because of the strait closure. So they face a bigger inflation problem. And so both the ECB and the Bank of England are setting out the notion that.
By the way, it's even worse than that, right? Because when Angela Merkel was the Chancellor of Germany, they basically staked their entire economy on Russian gas. Yeah. And they decided to turn off all of their nuclear power plants. Yeah. So they've put themselves in a very, very difficult position.
But the ECB is in a better position than they were after Russia's invasion of Ukraine. For one, you already don't have surging inflation from the aftermath of COVID. So you have to imagine they're at least in a little bit of a better place than
they're in a little bit of a better place, a lot better place than they were when Russia invaded. But both the UK and the Europeans have to pay up for gas, especially natural gas. And now, of course, with the Qatar attacks, it's probably going to go even higher because they get more of their gas. We don't get any gas really from Qatar, but they're going to have to pay up. And so at this point, they're going to have a bigger inflation problem. And so that's why they're sort of warning investors that these things could be coming.
Mike, one of the other outcomes of yesterday's Fed decision was also Jay Powell saying he's not stepping down until the decision is wrapped up. Just quickly, because I think Lagarde's about to walk out. What did you make of that?
Well, it basically had to set the record straight because his views had been set forth by his lawyers in a deposition, and he did that. Gave a very strong measure to the president and said, I'm not going anywhere, and let's get this investigation over with.
All right, Mike McKee, thanks very much for that. You can see the photographers here getting ready for Christine Lagarde to start speaking at her news conference in Frankfurt. This is how it works. Everybody gets out there and takes, I don't know how all of these people get paid to take the same picture. Why not just one person, right? Because the pictures aren't substantially different. I know, but they're all the same picture.
But you're paying for a photographer, you want it.
I get it, and it's important.
By the way,
especially, how the jobs picture looks like in Europe. This is what we call an Arbeitsbeschaffungsmaßnahme.
Of course.
In German. But as soon as they get out of the way, Madame Lagarde will begin to speak. And no changes today, but everybody is anxious to hear what she has to say. Because as you said, they've put themselves in a pretty aggressive position, saying they stand ready to act.
Right. Well, that was what the BOE said. Casimir, one of the ECB officials, said that earlier this month. And then they have this to contend with. A Reuters report out right now that Iran has damaged 17% of Qatar's LNG capacity for 3 to 5 years. That is a long-term impact that this ECB will have to contend with.
All right, let's zoom in then on Madame Lagarde as she prepares to make her statement and then take questions from the press corps, including Bloomberg's Yana Rondo, surely sitting in the front row. I guess they're still playing the music. She's still... here we go. Here's the intro. Let's listen.
Press conference with President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. As always, we have some participants who are connected via video. When they take the floor, I would ask them to turn on the camera and their microphones. And with that, I would like to hand over to President Lagarde, please.
Thank you very much, and good day to all of you. The Vice President and I welcome you to our press conference. The Governing Council today decided to keep the 3 key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. The war in the Middle East has made the outlook significantly more uncertain, creating upside risks for inflation and downside risk for economic growth. It will have a material impact on near-term inflation through higher energy prices. Its medium-term implications will depend both on the intensity and duration of the conflict, and how the energy prices affect consumer prices in the economy. We are well positioned to navigate this uncertainty. Inflation has been at around 2% target, longer-term inflation expectations are well anchored, and the economy has shown resilience over recent quarters. The incoming information in the period ahead will help us assess how the war will affect the inflation outlook and the risks surrounding it. We are closely monitoring the situation, and our data-dependent approach will help us set monetary policy as appropriate. The new ECB staff projections exceptionally incorporate information up to the 11th of March, a later cutoff date than usual. In the baseline, headline inflation is seen to average 2.6% in 2026, 2% in 2027, and 2.1% in 2028. Inflation has been revised up compared with the December projections, especially for 26. And this is because energy prices will be higher owing to the war in the Middle East. For inflation excluding energy and food, staff project an average of 2.3% in 26, 2.2% in 27, and 2.1% in 28. This is also higher than the path in the December projections, mainly owing to higher energy prices feeding into inflation, excluding energy and food. Staff expect economic growth to average 0.9% in 26, 1.3% in 27, and 1.4% in 28. This implies a downward revision, especially for 26, reflecting the global effects of the war on commodity markets, real incomes, and confidence. At the same time, low unemployment, solid private sector balance sheets, and public spending on defense and infrastructure should continue to underpin growth. Looking at the economic activity, the economy grew by 0.2% in the fourth quarter of 2025, driven by stronger domestic demand. Households increased their spending as real income rose and unemployment remained close to its historical low. Construction and housing renovation strengthened, and firms invested more, particularly in areas such as research and development, software and databases. Growth was no longer weighed down by net exports as it had been in the previous 2 quarters. It was underpinned mainly by services. Staff still see private consumption as the main driver of growth over the medium term. Investment should also continue to grow, with government spending more on defense and on infrastructure, and firms increasingly investing in new digital technologies. The external environment remains challenging, including in light of volatile global trade policies. The war in the Middle East is disrupting commodity markets and weighing on real incomes and confidence. This has led to a downward revision of consumption and investment in the baseline staff projections, especially for 2026. The impact would be even more pronounced in alternative scenarios with a more severe and prolonged energy shock. The Governing Council highlights the urgent need to strengthen the euro area economy while maintaining sound public finances. Any fiscal responses to the energy price shock should be temporary, targeted, and tailored. The current energy crisis underscores the imperative to further reduce dependence on fossil fuels. Completing the Savings and Investments Union is vital to fund innovation and support the green and digital transitions. The digital euro and tokenized wholesale central bank money will enhance Europe's strategic autonomy, competitiveness and financial integration, and will boost innovation in payments. It is thus essential to swiftly adopt the regulation on the establishment of the digital euro. Simplifying and harmonizing rules across the EU's single market will help European firms grow faster. Looking now at inflation. So inflation rose to 1.9% in February from 1.7% in January. Energy prices were 3.1% lower than a year ago, after having been 4% lower in January. Food price inflation edged down to 2.5%. Inflation excluding energy and food increased to 2.4% in February from 2.2% in January. The increase reflected goods inflation rising to 0.7% from 0.4%, and services inflation moving up to 3.4% from 3.2%. Indicators of underlying inflation have changed little over recent months and remain consistent with our 2% medium-term target. Corporate profits recovered further in the fourth quarter of 25, while unit labor costs rose at a similar rate as in the previous quarter. Growth in compensation per employee slowed to 3.7% from 4% in the third quarter. Negotiated wage growth and forward-looking indicators such as the ECB wage tracker and surveys on wage expectations suggest that labor costs will ease further in the course of 2026, which should support the return of inflation to target. The increase in energy prices caused by the war will drive inflation above 2% in the near term. If persistent higher energy prices may lead to a broader increase in inflation through indirect and second-round effects, a situation which requires close monitoring, inflation expectations in the financial markets have moved up significantly over shorter horizons. Most measures of longer-term inflation expectations stand at around 2%, supporting the stabilization of inflation around our target. Let us now turn to our risk assessment. The risks to the growth outlook are tilted to the downside, especially in the near term. The war in the Middle East is a downside risk to the euro area economy, adding to the volatile global policy environment. A prolonged war could increase energy prices further and for longer than currently expected, and also weigh on confidence. These factors would erode incomes and make firms and households more reluctant to invest and spend. A worsening of global financial market sentiment could further dampen demand. Additional frictions in international trade could disrupt supply chains, reduce exports, and weaken consumption and investment. Other geopolitical tensions, in particular, Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, growth could turn out to be higher if the economic repercussions of the war in the Middle East proved to be more short-lived than currently expected. In addition, planned defense and infrastructure spending, reforms to enhance productivity, and euro area firms adopting new technologies may drive up growth by more than expected. New trade agreements and a deeper integration of the single market could also boost growth beyond current expectations. The risks to the...
This is CBS News on the Hour, sponsored by JTV.com.
I'm Deborah Rodriguez.
Stock markets falling sharply around the world. The Dow down 239 to a fresh low in early trading after escalations in the war sent oil and gas prices soaring. Treasury Secretary Scott Bessent told Fox Business last hour Washington might unsanction Iranian oil that's already been shipped.
In essence, we will be using the Iranian barrels against the Iranians to keep the price down for the next 10 or 14 days as we continue this campaign.
Brent crude briefly climbed above $119 a barrel today. Gas prices here in the U.S. up to an average of $3.88 a gallon, and they're destined to go higher. CBS's Charlie Daggett from Tel Aviv.
The world's largest liquid gas plant, Ras Laffan in Qatar, in flames after Iranian strikes on the facility. The world's largest gas field, South Pars in Iran, among multiple sites attacked by Israel. President Trump angrily berating both sides on social media.
Defense Secretary Hegseth says there is no time frame for ending the war. The UN chief telling the U.S. and Israel it is, quote, high time to wind things down now. We're just in. President Trump's pick for Homeland Security Secretary Mark Wayne Mullen has gotten the thumbs up in committee. The vote 8-7 with Democrat John Fetterman voting in favor. His nomination, Mullins, now heads to the full Senate. Spanish newspapers are reporting the wallet of a missing University of Alabama student has been found in the sea. He was last seen outside a nightclub in Barcelona. His aunt is urging anyone who knows anything about James Paul Gracie to come forward.
We really just need everybody's help to please look through your phone if you were there that night. Look for pictures. Please reach out to the authorities there.
A heat wave in the western U.S. is shattering temperature records. It hit 108 in Palm Springs, California yesterday. In Phoenix, it was up to 97. Correspondent Chris Van Cleve.
Fire crews have been busy, already rescuing multiple overheated hikers since Monday. Fire Captain Adam Skyver expects the week to only get busier.
Everybody makes jokes like it's a dry heat, but it's just a different type of heat, and it affects people differently. And if you don't know that, it can put you in a bad spot.
New survey finds a third of us don't know when or if we can retire. Here's Michael Wallace.
They told Fidelity Investments they fear they won't be able to afford to stop working. 2/3 of Gen Xers are concerned their retirement savings won't last long enough. They are the first generation that will have to fully fund their retirement from their own savings.
This is CBS News. A statue of Revolutionary War figure Caesar Rodney is headed to the nation's capital.
The monument of founding father Caesar Rodney was in Wilmington, Delaware. It was taken down during 2020 racial justice protests. The Trump administration plans to install the statue in Freedom Plaza for up to 6 months as part of America's 250th anniversary celebration. Rodney is remembered for his decisive vote for independence, but he also enslaved more than 200 people, a fact critics say must be acknowledged. Stacey Lynn, CBS News, Washington.
Another milestone for a soccer superstar.
Cutting it back in, Lionel Messi looking for a shot. He scores! Lionel Messi, the 900th goal of his illustrious career.
Call on Fox in the opening minutes of Inter Miami's CONCACAF Champions Cup round 16 match against Nashville. The only men's player with more goals, Cristiano Ronaldo. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. We're streaming live on Bloomberg.com there too. So all over the place you can find the Bloomberg Intelligence program. Scarlett Fu and Paul Sweeney with you. Busy day today. Markets on the move. We're going to check in with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. What did he take away from the Fed and Chairman Powell yesterday? Marie Pendit, Global Market Strategist at JP Morgan Asset Management, to discuss her outlook for these markets. A lot of volatility, a lot of crosswinds out there for investors to deal with. Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, going to talk to us about FedEx. They're going to be reporting some earnings this week, and they're always a good view on how this economy is doing. So we've got a lot coming up in the next 2 hours. It is Scarlett Fu and Paul Sweeney with the Bloomberg Intelligence program. We kick it all off with John Tucker and the Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by IBKR. Will the price of gold exceed $5,150 on March 31st, 2026? Turn your view into a trade at ibkr.com/forecast. Last trading day, March 31st. We're data dependent, so let's bring you the latest data. This is new home sales for the month of January on a month-over-month basis, falling 17.6%. The expectation was for a decline of 2.7%. Big miss there. Can't get away from this headline. Iran strike damages 17% of Qatar's LNG for 3 to 5 years. That's according to this report from Reuters. Stocks, meantime, pushing lower as oil, gas, and yields climb. The new jobless claims earlier today declining unexpectedly. So that signals maybe the Fed doesn't need to cut to support the job market. And bond traders no longer pricing in any chance the Fed's going to cut interest rates this year. Meantime, Seema Shah, Principal Asset Management, says investors still need to be wary of taking any risk.
Unfortunately, as we're seeing with exposures across all markets, it's just too early to be making any key portfolio decisions when there is so much uncertainty on board. I would say that the escalation overnight has clearly increased the downside risks.
Right now, the S&P 500, 32 points lower, down 0.5%, 65.92 on the index. The Dow Jones Industrial Average down 235 points. The NASDAQ 100, 142 points lower. 2-year yields up close to 4 basis points at 381. 10s unchanged at 426. Let's get right to Brent up close to 4%. 111.44 a barrel. A WTI up 1.3%, 97.56 a barrel. And one of the standouts on the screen, European natural gas up 18%. They're setting a pretty high bar. Alibaba says it aims to quintuple cloud and AI revenue to $100 billion annually in 5 years. And I can't tell you how long I haven't been waiting for this. Labubu is coming to the big screen. Toy maker Pop Mart teaming up with Sony Pictures for a movie about the collectible early development project. No date for.
I feel like Labubu's had their moment in the fourth quarter, and we're
you
past
think it's
it.
faded?
I think so. I mean, I see all the stores carrying them and carrying knockoff Labubus, but I mean, how long does it take to get a movie together? It's not going to be for another couple months, right?
Yeah, a year.
I'll wait for the book to come out. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
Hi, John Tucker. Thank you so much. We appreciate that. As always, Scarlett Fu and Paul Sweeney are live here in our Bloomberg Interactive Broker Studio in New York City. Streaming live on YouTube and on Bloomberg.com. Stocks moving lower, as John Tucker was just reporting. Let's take a look at some of the individual stocks on the move today. We can do that with Bloomberg News. Bailey Lipschultz. Billy, what are you looking at today?
Yeah, I want to start with one of the worst performers in the S&P 500. That is none other than Micron Technology, ticker MU. Really strong quarterly results when you look at the actual revenue growth that we've been able to see. Similar story, though, to NVIDIA, where the questions are around the future. Micron in particular laying out plans to spend much more than analysts were expecting. So now you're grappling with the debate that we've been kind of tracking for a number of weeks as it relates to memory chip makers. How much demand is going to outpace capacity? At what point does that kind of balance out, and what does that ultimately mean for some of these companies? So Micron right now down 4.5%. Size and Scope, which we're obsessed with here at Bloomberg, nothing special. Worst drop since last week, so nothing too crazy.
All right, next stock.
Five Below. Do you? Well, you were talking Labubu. Do you guys go to Five Below?
No, that's like a preteen kind of shop, right?
For the most part, it's a preteen shop.
Jersey saying yes.
I heard Jersey saying yes. It also caters to. Well, I also liked when I grew up going to the 99-cent store when things actually cost 99 cents or less. Now it's like 99 cents is kind of a.
So Five Below is the idea that it costs $5.
$5 or below, but now it's like roughly 5 to 25. Anyway,
factors of 5, sure.
It's tough naming a company when inflation's going to end up impacting your business. Up right now about 9%, trades under the ticker 5, F-I-V-E. Highest level since August 2021. This has been quite the kind of renaissance, if you will. This is a company that really bottomed out this time last year with uncertainty around tariffs, has been on an absolute tear, beating expectations, continuing to see comp sales beat what Wall Street was looking for. Also, analysts calling out that this is one of the many companies that could be benefiting from consumers downshifting their spending, so maybe trying to find the bargain bin opportunities, if you will.
All right, one more.
Keeping an eye on all things gold. We'll use Newmont to be the track.
Metals are trading off.
Metals are trading off. It's been a fascinating move. We were talking about on our desk how much of this sell-off, looking at gold in particular right now, it's down 10% in the last week and a half. How much of that is driven by fundamentals, uncertainty, or just the fact that we saw such a tremendous run-up in the commodity space? So keeping an eye on using Newmont as our lens to view that, ticker NEM, down right now about 7%, worst day since January 2nd. As gold goes, so go the miners.
Yeah, but for a while, people were blaming the decline on gold on the stronger dollar. The dollar is weaker today by 1/3 of 1%, but gold continues to decline.
Yeah, and I mean, some people are saying, oh, well, now that inflation's tougher and we're also looking at a war that's potentially going to lead to higher oil prices, the knock-on effects, what does that mean for rate cuts? And if you're going to argue that gold should be an appreciating asset as rates come lower, how much of that is real? How much of that is just
time to reassess?
Exactly.
All right. Thank you so much. Bailey Lipschultz with our Stocks on the Move. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for our 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We had a Fed day yesterday.
We did.
Yeah.
I mean, in all the news flow, it kind of gets drowned out a little bit.
Yeah, and coming into this, I was just talking with Michael McKee. He was saying that for the most part, he didn't think it would be anything big. A couple weeks ago, certainly we didn't think it would be anything big, but some news was made. Certainly, Jay Powell making clear that he is in no rush, or the committee is in no rush to cut interest rates. Ira Jersey is our Bloomberg Intelligence chief U.S. interest rate strategist. He talks to us about the Fed, about the economy, about rates and where they're headed. What surprised you the most from yesterday's news conference?
That it was probably the least important of the 17 central bank meetings this week.
That's right.
The Bank of England meeting obviously is what's really roiled the rates market today. I don't know if it was surprising, but I think the clarity that Jay Powell said that he intends on staying on until Kevin Warsh is confirmed by the Senate. I think that was something that most people we had speculated about, but he can the fact that he confirmed that I think is important. Will that have an effect on President Trump and what's his reaction going to be to that? I think is an open question, and clearly there's going to be a lot of debate about it. And then the other is his comment, and which really was what to set the markets off, saying that basically oil was going to determine whether or not they cut interest rates again, right? If oil prices continue to go higher, that they probably wouldn't cut again, and that's where you saw the bear steepening the yield curve. So 2-year yields going up much faster than longer maturity debt.
You mentioned the Bank of England. Is the call there, Ira, that they held rates the same, but they said, hey, we'll raise them if inflation gets warrants?
Well, they basically implied 50 basis points of interest rate hikes, which, the market was pricing in for some chance of an interest rate hike over the next 12 months or so. But 2 really set the market off. That's why, currently the 2-year Two-year gilts, so two-year GBP bonds are higher by about 30 basis points, like 29 basis points, I think, at the moment. They were a little bit higher earlier today, and that's really is what's roiled the entire U.S. market. When I came in and I sat down in my terminal this morning, two-year yields were off. U.S. two-year yields were off 17 basis points. Now we're only off 4, and this happens pretty regularly, right? Where you'll see that effectively the tail wagging the dog, right? Obviously, U.S. Treasuries are the global benchmark for interest rates. That's still the case. But when you have something that happens in Japan or something that happens in the UK that really sets off the developed market interest rate complex, that filters into U.S. Treasuries overnight because people just sell risk and sell whatever's liquid and they can sell. But then once you get into U.S. trading hours, then, I don't want to say cooler heads, but kind of more rational heads prevail at that point.
So how are you rethinking everything now, given what Powell said, given what we heard from the BOE, the ECB this morning as well?
Yeah, we had thought that the Fed would probably cut interest rates to just below 3%. Just the way that we were thinking about it was, real yields. The Fed thinks that the real funds rate should be about 100 basis points plus or minus a little bit. So if inflation is going to be 2.25, which is what we were implying for the PCE deflator for year end, that they would be able to cut interest rates down to 3%, more or less. Well, guess what? The inflation situation is far different now than it was before. I don't think they're going to hike because they don't want to necessarily be the impetus for a major recession. But I think that they're going to be much, much more cautious now in their easing campaign. And if they ease, what would cause them to ease at this point? It has to be the job market, right? You have to see like negative 100,000 job prints for 2 or 3 months. That would certainly scare them and make them probably rethink about a cut again. But when inflation expectations are rising as dramatically as they have the last 3 weeks, that's going to let them, take their foot off the gas just a little bit.
Scarlett, we have Ira in studio.
I know, this is so unusual.
So what that tells me, I deduce that someone is buying him a meal today. Lunch or dinner is my guess. To get these guys out of the Princeton office, where it's a great office, number one. Number two, great food. Great bunch of people down in Princeton.
Where are you going for lunch, Ira?
So actually, I'm not having lunch. I have a meeting with a client at 2 o'clock.
So he says.
So what I do is I try to come in and schedule my client meetings when I can come and see you.
There you go. There you go. That's the right answer. Ira, thanks so much for joining us. As always, he's the best on the whole interest rate thing, where that stuff is going. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Just looking at the bond market. Again, kind of settled down here. We're at, where are we at the 10-year? 4.26, 4.26%.
Now
had been as high as 4.32%. So there was some movement here, kind of settling back down here. But it's all about oil. And I saw that report coming out of Qatar that the attack there impacted their LNG facility.
Yeah, I mean, this has entered a new phase, the war, that is, and energy infrastructure is the target that everyone's looking at.
Yep, absolutely. We heard from Secretary Hegseth this morning. Doesn't sound like they're stepping down anytime soon. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The price of oil and gas jumping to the escalating attacks in the Persian Gulf, causing now, it appears, long-term damage to some of the major energy facilities. You have Brent crude right now 4% higher, 111.74. Natural gas, this is the European natural gas, as an example here, 14.6% higher right now. So the risk assets are falling down 344 points. The S&P 500 down 43 points, and the Nasdaq Composite Index, that is down right now 185 points. Only 2 of the 11 major industries in the S&P 500 are higher right now. That's energy and utilities, not surprisingly. Dollar DXY just below 199.71 at this point, and then the 2-year yield, it is at 3.83 as traders are pricing out the chance of a Federal Reserve interest rate cut for this year. One of Eli Lilly's most highly anticipated experimental medicines has helped diabetic patients lose more weight than any drug currently on the market. This is according to Lilly in a presentation this morning. This is an important story. The Federal Reserve has unveiled proposals to relax capital requirements for Wall Street banks. Could potentially unleash billions for lending, buybacks, and dividends. The Board of Governors at the Fed, they're going to vote formally to propose the plan, later today. And tensions building between the U.S. and Canada. Again, Jack Hughes wants the puck from his golden goal at the Winter Olympics final, but it's on display at the Hockey Hall of Fame in Toronto, Canada. The international.
He wants it for his dad. He wants to give it to his dad.
Wants, and I got to imagine it's, fetch a nice price at auction, but the International Ice Hockey Federation says the puck belongs to them, and gosh darn it, they'll put it wherever they want.
Well, it's at the Hockey Hall of Fame, so it's not like it's, behind closed doors, inaccessible to the public. You have to
why
pay.
haven't I seen a tweet about this? Anyway,
give it some time.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
Also, the puck used to score the game-winning goal in the women's final against Canada, also at the Hockey Hall of Fame.
I left that out. I'm sorry.
In Toronto.
In Toronto.
Have you been?
Yes, several times. Yeah, of course. I
She
can show
makes
you
her
pictures later on.
pilgrimage there.
Yes, exactly.
All right, let's talk about these markets right now, because according to strategists at JP Morgan, investors are getting complacent and they are making a high-risk bet by assuming there's going to be a swift resolution to the war in Iran. And in fact, the strategists say that investors are failing to price the potential economic damage from soaring energy costs. They're too fixated on what it means for inflation and less concerned about what it means for demand destruction and slowing the economy. So let's bring in Mira Pandit, global market strategist at JP Morgan Asset Management, to discuss how she thinks about this. Hey, Mira, great to speak with you. If the case is that investors are kind of focusing on the wrong consequence of rising oil prices, what does that mean for how you allocate right now?
Ultimately, when we think about risks in the market, you hedge against the risks you know, and you diversify against the risks that you don't know. And when we think about the hedging going on in markets right now, you're actually seeing that areas where you would expect to have some hedging benefits, like gold, have had a losing streak. And by the way, this is not inconsistent with what we saw back in the 2022 oil price spike, when gold had a losing run from about April through the fall, around October timeframe. You look at the dollar, that has done a better job of protecting, while Bitcoin and crypto has made headlines as a better diversifier or hedge. That has also failed to really hit the mark after sliding in the beginning part of the year. So ultimately, we're thinking diversify against these risks, because you're still seeing opportunities across the market in value as the AI trade shifts from that growth to value, in international as areas like Taiwan, Korea continue to benefit from the AI trade as well. International value when you look at industrials and banks. So there's no shortage of opportunities to diversify here, whereas some of the hedges have honestly been a little bit less consistent.
So we've heard, or we are hearing from approximately 17 central banks this week. We had the Bank of England today hold steady, the Fed hold steady, but the Bank of England was kind of hawkish there. What's the theme you're taking away from some of these central banks we've been hearing from this week?
The central banks are, while remaining on hold broadly, still attuned to the risk around higher headline inflation. And as you mentioned, that spillover effect, because eventually if headline inflation becomes high, that does start to impact how consumers spend. If food and energy prices are expensive, they may cut from other areas. And then you start to see that demand destruction feed through. Now, look, in the US, we do have a bit of an offsetting factor here with elevated tax refunds. But with natural gas prices up higher and the price at the pump rising by almost $1 relative to prior to this crisis, that could neutralize some of that positive fiscal impact that we then do see. So when you think about it from a central bank perspective, they are worried about that headline inflation becoming more of a growth issue. But it was interesting to me to hear from Chair Powell and also to see the projections going forward around inflation, that not only headline inflation looked higher for the year, but core inflation does as well. And Powell said it's too early to think about looking through the oil issues when we still have core goods rising in tariff-related challenges. So ultimately, there's a war on both fronts, on the headline and the core front, which is creating some challenges for how much central banks may have room to normalize rates this year.
And of course, inflation, oil really dictates how policy goes. But perhaps, as Ira Jersey was telling us, the key for the Fed to continue cutting rates will be a job market that really falls apart. And we don't have that right now. How are you thinking about the labor market, especially when it comes to companies and they're announcing expense cutting programs and job cuts?
It's still a labor market that is frozen, but not quite melting down. We're still in this no hire, no fire environment where, yes, you are seeing some more job cuts on the margin, but you look at initial claims this morning, even continuing claims, while they ticked up a little bit, they're still relatively well contained, implying that the labor market is not particularly strong, but it's not really falling apart. Now, notably, the Fed did remove from its statement the stabilization in the unemployment rate, and Chair Powell did make a note to say we're basically at zero job creation. So if you're existing in this very tenuous equilibrium between low supply and low demand, we may not be able to rely on that forever, but at least for now, it does seem like the Fed can wait a little bit longer before they have to cut, because we're not seeing meaningful signs or broad-based signs of labor market deterioration.
Mira, as global market strategist for JP Morgan Asset Management, where do you guys globally see the best opportunities right now with all of the uncertainty out there?
Right now, outside of the US, there's still very much a structural case for international equities. And it's not just over time the dollar will fall, over time valuations will fall, because as we've seen, the dollar and valuations internationally and locally have not worked in the favor of equities this year. But those structural cases still run deep. If we think about the developed markets, areas like Europe, Japan, that fiscal spending continues to drive areas like industrials, banks, defense higher. So it's very much an international value play in the developed markets. And then when we think about the emerging markets, it's all about Asia and not necessarily the usual suspects around India and China, but more around the Taiwans, Koreas of the world, those critical nodes within the AI supply chain that have really produced some pretty spectacular earnings growth. So we are following the earnings growth, and generally that has meant the cyclicals in the developed markets outside of the US and the tech and growth stories in the emerging markets outside of the US.
All right, thank you so much. Mira Pandit, global market strategist at JP Morgan Asset Management, giving us her view on the markets. She likes looking overseas, markets like Taiwan and Korea, particularly attractive right now. All right, let's stay with this global theme, because FedEx reported results, and clearly it's not just a barometer for the U.S. economy, but really for the global economy at large. Lee Klaskow is our senior transport, logistics, and shipping analyst, and he is joining us to give us a preview of what FedEx is likely to say. So FedEx, Lee, when it comes to FedEx, they have their own issues, right? They've been trying to turn things around, overhaul the business. How much of the results reflect that effort versus what's happening globally?
Yeah, I mean, we all have our own issues, but FedEx certainly does have a number of them. And, you know, they've been busy trying to restructure their European business, and, you know, they're kind of combining their ground and express networks, and they're kind of going through a transformation right now, and they're really hoping that they'll come out of this transformation a more nimble parcel provider that can really take advantage of some of the strong B2B markets that they're going after, and higher margin B2C business also as well. Volume looks like it's probably going to grow during the earnings. We're not really expecting that much new news because they just had an investor day the other month, but we do expect to get a lot more color about what's going on in the Middle East and how that's going to impact FedEx and its business going forward. So that's what I'm most interested to hear about. The company, like I said, does have a large European operation. The Middle East has become a huge hub for freight between Europe and Asia, and that has been dislocated. And so they're obviously dealing with higher costs associated with some of that business. There's lost volumes that'll be involved because the area is not safe to fly into. So we expect to get an update on how the conflict in the Middle East will unfold for carriers like a FedEx.
So what's FedEx saying today about just their business in general in terms of volumes and things like that? I mean, because it's such a bellwether for many parts of the economy, as you well know. What are they saying just about core fundamental business trends?
Yeah, so FedEx has two main businesses. The business that we all probably know when you get something at your doorstep, letters going to lawyers' offices, and they also have a less than truckload business. They're the largest LTL carrier in the United States. They're actually planning to spin that business.
Yeah, I would spin that out if I were them.
They are spinning that out. They're doing an analyst day next month. We're excited to attend that and find out more. But that business has been suffering significantly because of the weak industrial economy. I don't need to tell you, the ISM has been in contraction territory a lot more than expansion territory over the last 2.5 years, and that's really weighing on that business. But pivoting towards their larger business, their parcel business, that business has been okay. It's growing. Volumes are growing by low to mid single digits. They're getting pricing in low to mid single digits. The problem that they're facing right now is costs, and they're trying to kind of, if you will, reduce their overall cost curve to help drive better margins going forward. And some of the things that I kind of alluded to earlier, whether it's restructuring their air network, whether it's combining their ground and air network, these things will benefit the company. In a better demand environment globally, and B, it's going to take time for those benefits to come down to the bottom line.
So, Lee, we have FedEx reporting, and then UPS will report probably in about another 5 weeks or so. How much of what FedEx tells us, especially when it relates to global trends, can be applied to UPS?
I think a lot. They're both very, very similar. They're both going after similar growth businesses. They both want to get more into healthcare, logistics, which tends to be more profitable. They obviously have their finger on the pulse of the consumer. UPS is tied to a little more to companies like Amazon. They are trying to wind down that business, but they're more tied to it. There are some differences, but I think there's more similarities than there are differences about what it's going to tell us about the overall economy.
Lee, thanks so much for joining us. Lee Klaskow, Senior Transport Logistics Analyst for Bloomberg Intelligence. Lee also hosts a weekly podcast, Bloomberg Intelligence Talking Transports. So some good stuff there. Coming up, we're going to check in with this market, which continues to sell off here. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So it's the price of oil and natural gas jumping because of the attacks in the Persian Gulf. And now there's word these are going to cause long-term damage to some of the major energy facilities there. Yields are pushing higher as the war raises the specter of rate hikes by central banks. Right now, the S&P 500, 38 points lower. The Dow down 346, NASDAQ 100, 157 points lower. Brent crude is up 4%, 111.79 a barrel. And you have European natural gas among the standouts. That is up close to, well, 16% right now. Newmont, the miner, worst performer in the S&P 500 as you have metals decline. Micron Technology warning it's going to need to spend heavily on production to meet demand, with capital spending exceeding $25 billion this year. Right now, Micron down 1.9%. Newmont is down 7.2%. And Dan Skelly at Morgan Stanley, meantime, says, you know what, the backdrop for investors really isn't all that bad.
You got to recall that prior to the Iran conflict, which I don't want to diminish at all, we had a really solid exit rate with fourth quarter earnings, right? And we saw earnings growing double digit again, and we saw, importantly, a broadening out. Beyond that, we still have healthy corporate balance sheets and healthy consumer balance sheets for the most part.
Sales of new U.S. homes falling more than expected in January to the lowest since 2022. By the way, the median sales price of a new home, $400,500. This will get you like a studio apartment on 333rd Street around here. Are you happy? Finland is once again the world's happiest country. The U.S. actually ranks 23rd, this at least according to the 2026 World Happiness Report, which also warned that heavy social media use, especially passive scrolling, is harming young people's mental health, making them unhappy.
Not just young people. I think I'm going to say everybody below the age of my age and below.
Yeah. No.
Everybody.
What, using devices and being addicted to screens?
Oh, yeah.
Senior citizens are totally addicted to screens. You should see my parents. They're like scrolling on their YouTubes and listening to it full volume and sitting next to each other.
That's crazy.
Them and toddlers.
Yeah, no, it's the new human equivalent of picking ticks out of each other's hair. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well. One of the trends that was impacting the market was a sell-off in a lot of software companies as it relates to because potentially threatened by AI. It was certainly a theme, continues to be a theme in this marketplace as people get a better understanding of what AI is and what it can mean for across the economic spectrum. One of those is our next guest, Sukhinder Singh Cassidy. He's the CEO of a company by the name of Xero, X-E-R-O. It's a New Zealand-based accounting software company. It trades in Australia. I'm looking at the stock here. It is down about 30% year to date, but that's pretty much in line with a lot of software stocks here this year. Sukhinder, thanks so much for joining us here. You guys are an accounting software company. Is AI a friend or foe to you?
AI is definitely a friend, and I'll tell you why. And just to give some context on Xero, although we are Kiwi-born, we operate in 180 markets globally, including here in the U.S., where we are one of the larger accounting players and software players, cloud-based, as well as UK, Australia, New Zealand, South Africa. So we may come from New Zealand, but a pretty large footprint of almost 5 million small businesses and accountants around the world. Why is AI a friend? Well, to be honest, we are the builders. We are the tech partners to small businesses around the world. They are often short on time and looking for more productivity. So Xero itself was born from tech disruption, in the movement from desktop software to the cloud. And we pioneered the idea of collaborating with your accountant or your CFO on software that lets you see your profits and losses, do your bookkeeping, be your system of record, pay your taxes, pay your bills now with the acquisition of Melio. So for us, we love AI. AI allows us to build amazing new software for our customers who, quite frankly, as I come back to, are short on time and really want to focus on their core business.
And what's been the take-up among these small to medium-sized businesses? How cautious are they initially? How aggressively are they applying it? Are they embracing it?
Yeah, so look, our own AI stats are actually quite exciting. So I'm going to separate out into two types of AI because I think people often don't take the time to do that. It's important. Number one, we have about 2 million customers who use traditional AI on Zero. What do I mean by that? Suggesting what category, an expense should go into. I mean, scanning your bills, just OCR technology, machine learning. And then we have about 300,000 and growing on features within the last year. And by this, I mean generative AI features, our chatbot, more recently, effectively automated bookkeeping. So we are bookkeeping software, right? But the ability for your bookkeeping to just be auto-reconciled, that thing you hear about, which is agentic AI, by that means like, hey, you just wake up and it's done for you. So we're seeing very fast take up of our newer, what I call agentic features. But overall, about 2.3 million, excluding customer service, of our customers use some form of AI from Zero today.
So, Kinder, who are your competitors in this space, and what's your competitive advantage?
Sure. So globally, quite frankly, the competitor that people would note would be Intuit. I would note that if you think about Zero is probably far more global than Intuit. We lead in many markets outside the United States. We are the leading software provider in the United States. We are a challenger to Intuit, but we're used by almost 500,000 businesses here in the U.S. On both Zero and then our recent acquisition of Melio, which is one of the leading cloud-based providers of software to pay your bills. So our competitive advantage alongside it is very easy to use, creating quote unquote magical experiences through technology. We love that. That is our brand. And I'd say in many ways inclusive. We work with not just the small business, but also provide technology to accountants and bookkeepers who are often partnered with small businesses to pay their taxes, do their profit and losses, increasingly give them advisory services. And so we seek to power both communities through AI.
Enterprise software has been a tricky industry to navigate over the last couple months with a lot of concerns, as Paul was mentioning earlier, that it would be disrupted, displaced by AI completely. There's a lot of talk among investors, expectations certainly for consolidation in this space, especially those that are most vulnerable to the AI disruption. Where do you think we are in that? What's preventing the M&A boom from really taking off right now?
Well, I think we're in an interesting place, and we have long been a consolidator of great technologies. As I said, the acquisition of Melio for right here in the U.S. market was a $2.5 billion acquisition completed by us maybe 3 months ago. So we definitely see ourselves as someone who can take advantage of M&A to keep adding world-class capabilities to the platform. But if you think about that broader market, as you just noted, software multiples are down because the market right now cannot discern, I would say, between where are their deep moats. We think of ourselves as a system of record company. We hold, the critical financial information of all our small businesses, and they count on us for it to be trusted, private, secure, connect with their bank, connect with the tax authorities, what have you. So I think the market's not discerning. Multiples are coming down. What do I think it will ultimately mean? I think it will mean an M&A market for those who aren't able to get public. I think the stakes on getting public have now gone up again. I think you are going to need to prove to the market if you're a private company why you are going to be a net AI winner. For us at Zero, we believe AI, as I said, is a massive tailwind to our business. And so we see ourselves in a position to continue to use M&A to keep playing offense.
So, Net, what type of investments do you make in AI for your business?
Well, as I said, remember, because we are traditionally a system of record company that holds and processes your data, we've been doing traditional data science and machine learning for 20 years of our 20 years of existence. And AI has been a big investment for us for the last 2 years, mostly, if you think about it, first and foremost, to bring a whole new way for the customer to experience the product. Like if you think about what's happening for you as a consumer today, you're getting used to just asking questions, right? Natural language interfaces. So, of course, Jax, which is our super agent on Zero, allows you to ask natural language questions. But Jax also processes your bookkeeping. Jax tomorrow will help you chase your bills. So I think the way we think about, that environment is our job is to make AI accessible for our customers. And in many ways, they follow some of the consumer trends and how they're going to want to work with AI.
Sukhinder, thank you so much. Sukhinder Singh Cassidy, CEO of Zero, joining us from San Francisco. We're looking at markets, at least equities, in the red right now. The S&P 500 down 0.6%. This is Bloomberg Intelligence on Bloomberg Radio in New York. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com. Let's look at Brent crude here, up $3.50, about $110 per barrel. Earlier this morning was at $119 per barrel, as the war in Iran has some rippling effects throughout the region, including some of the refining areas and energy fields in that part of the world. So let's get the latest there. Salih Yilmaz, Senior Energy Analyst for Bloomberg Intelligence, based in Dubai, joining us via Zoom from Dubai. Salih, you're right there, right in the middle of it. I hope you're staying safe, and all the folks in that part of the world. Talk to us about how you're viewing where this energy situation is going to go here. We're at $110 for Brent. What's that mean to you?
I mean, I'd say we're still on an escalatory path. So there were three things that we highlighted at the beginning of the war that we were watching for the oil markets. And the first one was Strait of Hormuz, whether it gets closed or what happens there. And then it's essentially still at a standstill. That's very important because about 20% of global oil flows go from there. And this is obviously very consequential. The second one was that if that happens, we would be watching the shut-ins in the Gulf producers. And that number, I mean, that is already happening as well. And that number is getting close to 10 million barrels per day, which is very significant. I mean, it's these Gulf producers that are running out of storage. They can't move their crude. They can't store their crude. So they have to shut in production. And the third one, very importantly, was the third thing that we were watching was damage to energy infrastructure, damage to oil infrastructure. And this is what we are also seeing right now. And I think all of these three things are quite important and very consequential. But perhaps the third one, energy infrastructure, if we do get more of those and if we do get lasting damage to infrastructure, that's potentially one of the worst things that could happen, because then it would really take months, I mean, in some cases, maybe years, to get that production back. So all of this is obviously bullish for prices. But what we're seeing with the Ras Laffan, I mean, that's an LNG facility, but it kind of shows that these type of targets are very much on the table now.
Yeah.
It's definitely bullish for prices as well. And that's what we're seeing in Brent and other benchmarks this morning.
Right. And it's that damage that has prompted President Trump to call on Israel and Iran to stop attacks on energy facilities. You mentioned Qatar's Ras Laffan. It's the world's biggest LNG plant. We're told that it suffered extensive damage. What does that mean, practically speaking, for countries that might rely on the LNG that it processes? Just kind of walk us through what that means.
Sure, and I mean, it's not good, because Qatar is a massive producer of LNG. It's a massive exporter of LNG. And I mean, earlier today, what we heard was, as you said, extensive damage. We didn't really know what that meant. But in the last hour or so, I mean, the headlines that hit the Bloomberg terminal was that there is about 17% of the whole facility that's damaged. And what was really surprising to me was that the CEO of Qatar Energy said it would take up to 3 years to fix this damage, which is, I mean, definitely longer than I would have imagined. And we haven't really been given any other details. But for countries like, especially in Asia, that rely on Qatari LNG, I mean, places like Pakistan, where it takes almost all of its LNG from Qatar, I mean, this is not good. And it's definitely, I mean, it's almost certainly going to result in much higher gas prices there. And it's obviously going to translate into much higher living costs I mean, Pakistan is just one example, but in many, especially Asian countries. But I mean, you could argue that this is almost a leading indicator. I mean, the longer this war goes on, it would trickle down to other regions as well.
So give us a sense on the other side of this, Salih. If President Trump decides, all right, I'm bored with this, I'm going to claim victory and we're going to end this thing, how long do you think it would take for oil to return to a more normalized level, do you think?
I think, I mean, at this point, it would take at least weeks, I would say. I mean, it's hard to tell, of course. I mean, if you asked me in the earlier days of the war, perhaps I would have said, a few days, the supply chains haven't been disrupted that much, it's definitely not good, but it would have been okay. I mean, now we're into the third week of this war. And, I mean, as you know, oil and the oil derivatives are essentially in everything that we use in our daily lives. And this is very disruptive, not just for crude, but also downstream from there for refined products, for petrochemicals, and for many other industries. So it's all disrupted. So I would say it would take weeks, if not months, to get back to the pre-war levels.
And just a quick mention, you talked about shut-ins, producers halting production essentially because they can't store any more fuel. That takes a long time for them to restart, right? It's not like it's as easy to restart as it was to shut down.
No, you're absolutely right. I mean, in these fields, if you lose the pressure, it's not as easy as just flipping a switch and getting that production back. Like I said, it's not as bad as, I mean, this is perhaps obvious, but it's not as bad as getting a direct strike on these facilities and actual damage that needs to be repaired. I mean, that would be much worse. But you're absolutely right. It's not just turning it back on. It would take some time to get back to previous levels, to anywhere near full capacity for these facilities.
All right, Salih Yilmaz, thank you so much for shedding some intelligence on what's happening here with the energy infrastructure in the Middle East. He is our Bloomberg Intelligence senior oil analyst joining us from overseas. He is based in Dubai. Paul?
Absolutely, he's right in the middle of it for sure. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast. 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. John Tucker with us as well. Oil prices, they continue to rise, which means stocks continue to decline. And this comes just after Fed Chair Jay Powell made clear that there won't be any rate cuts until inflation starts to ease more. And that's all before it folds in what's happening with Iran, with the war taking place there. So a lot to get through there. And we're going to tackle all of it with our lineup of guests. Becca Wasser is our defense lead for Bloomberg Economics to give us the latest on the conflict in the Middle East. Jake Silverman is our semiconductor analyst to recap earnings out of memory chip maker Micron. These memory chip makers have seen a lot of demand because of the AI boom. We're also going to check in with David Kudla. He's the founder, CEO, and chief investment strategist at Mainstay Capital Management to get his sense on where you invest, how you invest. And Michael Halen, he is our senior restaurant and food service analyst, will join us to give us his analysis of Darden Restaurant's latest earnings. Promotions are a big part of it. First, though, let's bring in John Tucker for our Bloomberg Business Flash. John.
All right, Scarlett and Paul, the big worry now, central banks are going to have to raise interest rates to keep under control interest rates as the war continues. The worry is, well, the highlight came with the Bank of England, and that filtered over to the U.S. with the two-year yield higher. Right now, it's paired some of the earlier moves, but the two-year 6 basis points higher right now, 383. And Iran maintaining attacks on energy assets with some long-term impacts, it appears at this point. Brent crude right now up 3.4%. 111 a barrel. WTI up 1.25%, 97.49. And then you also look at European natural gas. That is a 13% pop today. The overall equity markets, S&P 500, 40 points lower. That's down 0.6%. The Dow Jones Industrial Average down 372 points. And right now, the NASDAQ Composite Index down 151 points. Industrial metals, they also tumbled. Aluminum down the most since 2018. Again, the war in the Mideast pushing energy prices higher, increasing the risk of damage to the economy. Right now, the worst performing stocks in the S&P 500 miners. You have Newmont, that is down over 7%. Meantime, Lakshman Akathan at the Economic Cycle Research Institute says even before the rise in energy, inflation was a worry.
Over the last several months, there's inflation cycle upturns. That's very different than energy. That's broad-based, and that's happening in the U.S. And on top of that, you're getting this oil shock.
And this is an interesting story, the Bloomberg. The $80 billion diamond industry kind of losing its sparkle as prices plunge.
Lab-grown diamonds.
Yeah, I guess.
It's amazing what's happening in that market.
Yeah, it's a number of factors. There's the luxury slowdown in China. As you mentioned, the lab-grown competition and Russian sanctions. De Beers, for instance, cited in this story, bled almost $1.5 million a day last year because of this. And I don't think it's unfair to say De Beers is, a cartel. They were the price setters for the market. And they would then dole out how many diamonds each dealer would get. So, take that for what it's worth. Pick up some cheap diamonds, Scarlett.
Are you in the market?
I know where you're going with that question. We check the markets for you all day long, right here on Bloomberg. I'm 63.
I don't know. I mean,
I'm
you're
set
the
in
one
my ways.
It's a new 53. Come on.
Anyway, back to you guys.
All right, thank you so much, John
Let me ask you,
Tucker.
Scarlett, would you differentiate between a real diamond and a lab-grown diamond?
Probably not. I mean, I like the fact that my engagement ring was a real diamond, but I'm not opposed to a lab-grown
I
diamond.
wonder what the youngsters are saying about that.
I think they're going with whatever's affordable.
Right? Yeah, good point. Okay.
And they're a lot more price sensitive,
Yes.
given the times that we live in right now.
Yep.
Compared to us old folk.
Exactly.
All right, let's check in on some stocks on the move this morning. It's 11 a.m. Wall Street time. I'm Scarlett Fu with Paul Sweeney, and Bloomberg's Matthew Griffin joins us. Matthew, would you be more inclined to look at a lab-grown diamond and say, yeah, this is as good as a real diamond?
Scarlett, I can't remember why. I was actually just thinking about this. I am not in the market, just to get ahead of that question at this time. But I think no. That's my instinct, but I have not really. You
haven't looked into
forced to make a call yet.
That's a conversation that has to be had, I think.
It really is.
Okay.
Yeah.
All right.
I mean, the hearts can be broken over this, right?
Sure.
All right. Let's talk a little bit about some stocks on the move, Matthew. What have you got for us?
Well, I know you are going to talk more about the numbers on Micron in a bit, but I think it's worth looking at the stock here and what it tells us about where investors' heads are. So that's ticker MU, down about 2.5%, was down as much as 8.8% earlier this morning. And what's really driving sentiment there is this forecast for capital expenditures. They expect that to be greater than $25 billion this year. That's more than the $22.4 billion that Wall Street was expecting. And it really shows how much focus there is on AI spending right now and how much skepticism there is about it. This is a company that's seeing booming demand for the memory chips that it manufactures. They're used to train and run AI models. Shares up 340% in the last 12 months on that demand. They're seeing that flow through to revenue. But again, investors are a little bit concerned about the high spending that you need to do to meet that demand right now.
How about Rivian? What do you got there?
So Rivian, that's ticker RIVN, up about 5% today after the company and Uber announced a robo-taxi partnership. So Uber says that it will buy about 10,000 Rivian R2 autonomous vehicles. Rivian, of course, they make electric vehicles. They're going to roll those out in San Francisco and Miami in 2028, eventually across the US, Canada, and Europe. And Uber also going to invest as much as $1.25 billion in Rivian. If you look around the EV space, companies having trouble selling them to consumers right now, but analysts pretty positive on deals like this. They've also been positive about Tesla's robo-taxi pivot. If you actually look at Tesla now, down about 2.3%, so maybe some competition fears there.
I mean, if they're going to add Rivians to the streets of San Francisco, they're going to have to share the road with the Waymos. That's going to be like a third of the cars there. There are a lot of Waymos on the streets.
I know.
There.
I took one in Santa Clara a couple weeks ago.
I don't like them because I feel like they don't know how to make a left turn. They kind of wait too long, and you got to get in there.
Yeah, so's my driver this morning coming up the Parkway. I mean, I can't make the difference. All right, one more. FedEx. We got earnings coming out after the close.
Yes, and FedEx down about 1% ahead of that report. Now, that may be with the market, the rise in oil prices, but that's also what's in focus when the parcel carrier reports earnings later today. That stock, ticker FDX, surged at the beginning of the year, set a series of record highs, now down about 11%, though, during the war. They're closely tied to the strength of the economy, seen as an economic bellwether, and their report and outlook are going to give us some clues about, first, how strong was the economy heading into the war, and second, what is the company seeing? Are consumers and businesses pulling back on spending as energy prices surge? So that's one that strategists and analysts tell me they're watching closely, one I will be watching closely as well.
All right, good stuff. Matthew Griffin, thank you so much. Matthew Griffin with our Stocks on the Move. He is our Bloomberg Equities reporter. And for more conversations like this, be sure to subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Okay, I've stopped counting, but I believe we're day 20 in the war in Iran. Third weekend, either way. And it doesn't look like things are easing up at all. In fact, we've entered new phases with attacks from both sides on energy infrastructure. Let's bring in our next guest. Becca Wasser is our defense lead for Bloomberg Economics on the latest in what's going on. And Becca, how do you think through the the damage done to energy infrastructure and what that means for the cost of the conflict so far?
I mean, the costs of the conflict are huge. Already we are seeing an actual price tag put to things, whether that is military equipment, some of those expensive air defense interceptors. We're also now seeing critical infrastructure damaged as well as civilian infrastructure damaged in addition to that. So just those costs alone are quite large. When you layer in the operational cost and some of the sustainment cost, we are looking at billions and billions of dollars, as well as an impact to the global economy. So it's going to be a huge cost overall, depending on how long this goes for. But the most important cost is the one that we can't necessarily put a number on, and that is the human cost of conflict.
Becca, we here at Bloomberg Television and Radio took the Defense Secretary's press conference this morning live. His rhetoric remains very aggressive. Now that's starting to be matched by some of the rhetoric coming out of Iran as they step up their attacks on other Gulf states and assets there. Is there, in your world, any of your sources, do they have a consensus of perhaps how long this might last?
So nobody has any consensus. Nobody knows exactly how it's going to go. But, we have been working through various scenarios at Bloomberg Economics for how long this could go on and what the broader impact would be. And, my thoughts right now is that we are looking at the potential for a protracted conflict, a protracted low-intensity conflict where both sides don't necessarily come to a clear fruition. For Iran, this is an existential conflict, and the United States, and as you said, the rhetoric that we're hearing from senior leaders doesn't seem like it's going to stop anytime soon. So with that, we're looking at a much longer conflict where you have periods of no fighting marked by sporadic, high-intensity periods of fighting and continued strikes. So that's not necessarily a place where any of us want to be in for global security, but also for some of the economic impact.
What's the least likely but most high impact scenario that you guys have kind of drawn up as a possibility?
I think a ceasefire is probably the least likely scenario that folks are looking at. I think initial early days, it looked like there was some potential for that to happen. But right now we do see Iran being fully trenched and dug in. We see the U.S. From the White House to the Pentagon digging in their heels. And Israel continues to prosecute a variety of different strikes against different targets, both in the Middle East, but also moving further out to the Caspian Sea, as we've seen today. So with all of that, I don't think a ceasefire is necessarily in the offing, and that's why it's one of the lowest scenarios that we are looking at.
All right, Becca, thank you so much. We appreciate it. Becca Wasser, defense lead for Bloomberg Economics. She's based down there in D.C. One of the stocks we've been talking about today, Micron Technology, sales numbers really impressive. I think some folks are concerned about some of the spending that Micron was talking about on their earnings conference call. So let's get right to it. The stock is down 3% today. but it's been a really strong performer over the last periods. Let's check in with somebody who does this stuff for a living. Jake Silverman, Bloomberg Intelligence semiconductor analyst. Jake, what was your takeaway from Micron's earnings?
Yeah, thanks. I would say that I actually think it's not really the spending that is concerning investors. I think really what's going on with Micron is more so a focus on where the cycle is at. We've seen now a couple of quarters of very aggressive price increases for the May ended quarter. We're going to see continued very strong double-digit pricing growth. And so what I really think is on the top of investors' minds is, when does this cycle end? How sustainable are these margins? Because if I think about CapEx, just because CapEx is increasing, they need to increase CapEx in order to meet the high levels of demand, because there's still a very strong supply and demand imbalance that we're seeing. So AI is really the major driver for that. It's the major tailwind. And if they're unable to match spending, then they're not going to be able to meet the demand of their customers.
Has the company shed any light on how high they think memory chip prices will go, or at least stay? Because this has huge repercussions for manufacturers of laptops and everything else that needs memory chips, because all the memory chip makers are too busy putting together high bandwidth memory chips.
Yeah, they don't really give a lot of details in terms of what their view on pricing is. Ultimately, our take is more so that we're probably going to see the peak of the pricing increases on a quarter-to-quarter basis. That doesn't mean that pricing won't continue to increase at a somewhat more modest rate. But going back to actually what I was talking about earlier with capital spending, the ability to actually increase supply is going to be a really important factor here, both in terms of actually how pricing moves around, right, higher or lower. But because there's actually a constraint in the ability to put up additional clean room space, new fab space, there's not going to be a lot of additional supply in the next 12 to 15 months, or until the next 12 to 15 months. So as a result, we think pricing still has a few more legs to go. Again, it's really just more so that we think pricing on a sequential basis, on a monthly basis, quarterly basis, will be a lot more modest in terms of the increases than what we've seen before.
Jake, who does Micron really compete against day to day today, and then in a couple of years going forward? Is it the NVIDIAs of the world? Who do they really compete against?
No, NVIDIA is one of their biggest customers, but I think it was their biggest customer last quarter, and a lot of that is for, as you mentioned, high bandwidth memory. Really, their competition is Samsung, it's SK Hynix, and then to some extent SanDisk, although DRAM is becoming an increasingly large portion of their business, so SanDisk really only competes with about 20% of their business.
So in that regard, Micron has a lot of pricing power. What advantages does Micron offer over a Samsung or a SK Hynix?
Well, I'd say that advantages are tough because they build to spec for the JEDEC standard. Micron, they do also build to NVIDIA specs for high bandwidth memory. One of the things, though, to keep in mind is that the memory market, as I was talking about the cycle before, it's very cyclical. So really the key here is how much cost can they, what's the better cost profile that they can drive relative to their competition, while also maintaining that R&D spend to keep up with the increasing demand of their customers. NVIDIA being one of them, but also a lot of other hyperscalers who need high bandwidth memory, HBM3E, but now we're moving to HBM4, so those standards keep going up. So their ability to compete on cost, their ability to compete on things like pin speed that help with bandwidth, their ability to compete with lower power consumption for their products. Those are really the keys. But again, it is somewhat commodity-like market for the products that aren't high bandwidth memory. So it really is competing on costs and the economics of their business.
Hey, Jake, about 30 seconds left here. I'm just looking at your research note. Customer agreements are now extending out up to 5 years in some cases. That seems really long. Talk to us about that.
Yeah, very unprecedented. The company hasn't given us a lot of details. There's not really a lot to say, unfortunately, right now. But it does seem like these agreements are different than the LTAs we saw just a few years ago during the last downturn or upcycle that ended up in the downturn, as things tend to go with Micron. So really what I would say is that this may be something that could reduce some of the cyclicality going forward. We don't expect all agreements to go out 5 years. Some might go 1 year, 2 years, 3 years. It's going to vary a lot by the customers, the volume, what the products they're requiring are.
All right, great stuff. Jake Silverman, semiconductor analyst of Bloomberg Intelligence. Let's get some context around the stock price. It's down 3% today, but it's a big but. It's up 56% year to date. and it's up 337% over the trailing 12 months. So it's just been on a tear as seen as one of the big winners in the AI.
It's been completely re-rated. The stock has 47 buys, 6 holds, and 0 sells.
And 0 sells, so there you go. S&P off 26 points, down 0.4%. We'll keep an eye on the markets. Oil higher today, particularly with the Brent. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Good, I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility of some investors turning to gold for stability. You get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free. Go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. So the escalating assaults in the Persian Gulf threatening long-term damage to some of the major energy facilities there, and energy prices have surged as a result. With the threat of inflation as a result, bond traders no longer pricing in any chance of a Fed rate cut this year. JP Morgan also warning investors are making a high-risk bet by assuming there's going to be any swift end to the war. We did get some data today. Applications for unemployment benefits unexpectedly falling last week to the lowest level since January. So that adds to evidence of limited layoffs and, removes another reason why you should cut rates. Initial claims decreasing by 8,000. S&P 500, 38 points lower. The Dow down 344 points. The NASDAQ 169 points lower. Two-year yield up close to 6 basis points right now at 382. Brent crude up 4.6%. We're at 112.36. And I'll keep doing this quote because it's so big. European natural gas 12% higher today. Alibaba shares sliding after reporting sales that missed estimates. The company also said it wants to expand annual AI and cloud sales to over $100 billion in just 5 years. Robots apparently need offices too. AI companies snapping up space in New York City to revive a market that has struggled since the pandemic. The arrival of AI and tech firms has lifted New York City's office market to its best year for leasing since 2014. AI firms adding about a million square feet across Manhattan alone. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, guys, I want to close out a discussion we had earlier today about lab-grown diamonds. This is what I found out. More than half of millennial and Gen Z couples choose lab-grown diamond engagement rings over mined diamonds, driven by lower costs and higher quality for the price.
More selection, I'm sure. You can customize if you want.
Yeah, I guess. I mean, that's a lot higher than I would have thought, but I guess it makes sense.
If you're going for private label food, for instance, you're going for a lab-grown diamond.
Yep. And you can't tell the difference, so they say.
No.
So, all right, that's very, very interesting. And that goes to John's story earlier. It's not good to be the diamond business.
Leave me out of this.
Exactly.
I want no more.
I think there might be something
no part in this
John
anymore.
wants to tell us. John Tucker there with the news. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube and Bloomberg.com as well. Let's get to a professional who does this investing thing for a living. He's been doing it for decades. He's seen all the cycles. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management. David, what's the messaging for your clients over the last 3+ weeks here with the conflict in Iran?
Good morning, Paul. Yeah, the message to our clients has been, what we would like is turn off the news. Don't become too excited about the headlines. Certainly we're concerned about the war in Iran for good reason, and the escalation of that war in the Middle East with the Gulf states, what that means for oil disruption now that the Straits of Hormuz have been closed, effectively closed. And that's what we're watching and analyzing very close. But what we believe is, not in a matter of days, but in a matter of weeks, the Strait of Hormuz will be reopened. There's already other workarounds like the Petro line across Saudi Arabia that moves the oil to the west coast of Saudi Arabia to be offloaded in the Red Sea, and that's 6 to 8 million barrels per day. It's not the 20 million barrels per day going through the Strait of Hormuz, but they'll keep finding those workarounds, and then eventually the strait will be opened, and we'll see oil back off from these lofty levels we're at right now, today even, and stocks will recover, and a lot of other assets. We've had the everything rally. We're having kind of the everything sell-off right now. So people are concerned for obvious reasons.
Yeah, well, I mean, and eventually that would happen. But in the meantime, there's a lot of concern, David, about stagflation, a slowing economy, rising inflation. What do you see as the odds for stagflation here?
Yeah, we've been talking about this on the show, and I think what is happening right now are just ingredients for what we've termed stagflation light. Maybe not the stagflation of the 1970s, but a stagflation light, if you will. We have 3 elements to that. It's a stagnant economy, higher unemployment, higher inflation. And we already know where the labor market is. Labor market is weak and getting weaker. The problem with this escalation in the Middle East is with oil supplies being disrupted, and there'll be ripple-on effects of that for months, even after the straits opened, is rising oil prices, energy prices in general are basically a tax on the economy. They're a tax on companies because of their fuel input costs. It's a tax on consumers at the pump. So we have this effect of actually contributing to a slower economy and contributing to inflation. The chance that inflation is higher. And we got a little bit of a scare yesterday with PPI coming in headline year over year at 3.4%, far above expectations and far above prior levels. So, if we see inflation rising, that just makes it tougher for the Fed to address a slowing economy if they need to. And so overall, we have the ingredients for stagflation, even though I know Fed Chair Powell said yesterday we don't, but we do. I beg to differ. We do.
So, David, you're based out there in the heart of America, in Michigan, the great state of Michigan. What's the economic feel in your part of the world there?
Yeah, we're here in God's country, Paul.
Yeah,
I mean, this is right. So it is. It really comes down to that K-shaped economy or bifurcated economy. The top 10% are doing well. They're actually making up at this point 50% of consumer spending. And, we have said for 4 decades that, it's about the consumer in our economy. The lower leg of that K, the people that are relying on wages and what we have happening with the labor market, those people are hurting. There's people here that are hurting. So, but it's such a disparity between the upper leg of that K in the K-shaped economy and that lower leg. But the rising grocery prices we've had over the last several years, the rising everyday cost, even in durable goods, it's having an effect.
All right, very good. We appreciate it, as always, David. David Kudla gives us the very unvarnished view of what's happening out there in the marketplace. Founder, CEO, and Chief Investment Strategist at Mainstay Capital Management from the great state of Michigan. We still got a lot of companies reporting here. Now we're starting to hear from a lot of the restaurant companies. Darden's coming up here, so we want to check in with Michael Halen. Michael Halen, he covers all the restaurant companies for Bloomberg Intelligence. He's based down there in Princeton. One of the big ones, Darden, I think is about to report here. Mr. Halen, what are you looking for there, Mike?
Yeah, Darden reported this morning. It was a strong quarter on the top line. So despite all of the cold weather and snow, they had mentioned 40% of their stores had been closed at some point during the quarter. Despite all that, they still were able to put up 4% same-store sales comp. The problem with the report was that they missed on the bottom line. So despite all of the traffic they were able to drive into their stores, they didn't really see the operational leverage from it, right? Beef prices were a big headwind, obviously in the quarter for Longhorn, which is their second largest chain.
So how is the company planning to tackle that? Because I'm not sure that beef prices are going to come down anytime soon. This is going to be a persistent cost headwind for them.
Well, the entire commodity complex is starting to become a real concern for these restaurant chains, and that's why we've seen them kind of reverse their strong gains of the previous 3 months. But so what they're going to do is raise prices, and they feel that they can because they have not raised prices much over the post-pandemic period, right? So they've underpriced competitors, they've underpriced food away from home inflation, right? So they think they have some room, but if we continue to see elevated gasoline prices, if we see a prolonged conflict in the Middle East, it's really going to weigh on restaurant spending. So we think they're going to have to be careful raising prices, but it's an interesting time right now. There's a lot of crosswinds, right? Like, they are seeing people spend more when they get their refund checks. Refund checks are 10 to 11% higher, right? But unfortunately, the spike in gasoline prices, up 30% plus now in just a few weeks, is going to eat into some of that spending, excuse the pun. and then just overall inflation is going to cause prices to go higher, which is not a good situation for, stagflation is not a good situation for restaurant consumers. We saw that in the stocks performances last year, right? When people's budgets get pinched, they spend less at restaurants, margins get squeezed for the restaurants. It's just a tough climate to operate in.
Mike, what are your companies telling you about labor availability, sustainability? How's the labor side of the equation? Because that's a big part of their cost structure as well.
Yeah, labor's been okay. There's a lot. The companies we cover are seeing a lot less turnover. Wage inflation's been, it looks like about 3% for some of the companies that have reported recently versus, this 4% to 5% range that we've seen since about 2020. So the labor piece of the equation it has definitely improved a bit for the companies in our sector.
What will you be listening for from the other restaurants that report? Are we going to see similar themes play out for them?
Yeah, so Darden's is a little bit off cycle. So they're the first ones to report, almost into this next cycle, right? So because their quarter ended late February, right? So they're giving us an early read. So when our other names report, right, we've gotten a feel for what the first quarter was, and what we think it will be is like pretty strong, considering all of the winter weather, considering the snow, still putting up pretty solid same-store sales, over 4% here for Darden. A month ago, the question was, really about the top line and how, and how much better things were looking and how much people were going to be spending in their restaurants, how much of those tax refund checks were going to get spent at restaurants. But now I think the questions are going to shift more to the margin side, right? Like this higher gasoline prices mean commodities are higher for longer, right?
Sure. All right, Mike, always a good overview of the restaurant biz. Michael Halen, he covers all the restaurant industry for Bloomberg Intelligence. Good lens on to the health of the U.S. consumer. S&P down 48.7%. The NASDAQ down almost 200 points, 0.9%. WTI crude oil up 94 cents.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, 10 of the 11 major industry groups in the S&P 500 are lower. And the only sector that is higher, yes, energy. Stocks pushing lower as oil and the yields also climb. Bond traders no longer pricing in any chance the Fed's going to cut rates this year. One of the big movers in the S&P 500 right now, one of the best performers, Accenture, those shares climbing 6%. This is the information and technology consulting company. Posted better than expected earnings in the second quarter, so that helps investors kind of look past some of the weak guidance that they've also delivered. Meantime, pushing against consensus despite uncertainty generated by the war, Jennifer Lee at BMO Capital Markets believes the Fed will move toward accommodation.
It's still early, this is week 3, and if it ends in a couple of weeks, it still will take time, but, we're still sticking to our call for a couple of rate cuts coming later on this year, but not until probably September at the earliest.
Well, right now, the S&P 500, 48 points lower. The Dow down 403 points. NASDAQ 100 down 219 points. Brent crude up close to 5%, 112.57 a barrel. The 2-year yield up 9 basis points right now at 3.85. Always get a lot of attention when we do these results. The pass rate for the first level of the CFA climbing well above the historical average. February, 45% of candidates passed level 1 exam.
Still less than half.
That's considered good, though. And apparently, one of the staying on schedule is one of the strongest predictors of exam success. So don't take deferments. You got to go, take the pain, go right through it, and the pass rates are higher. But,
anyone here sitting at this table have a CFA?
No.
But you had the option CFA or Masters, right?
When I was recruiting, when I was managing research department, my general rule of thumb was prefer an MBA or a CFA. Either one is fine, but both are valuable, and it just depends upon your personal situation.
MBA seems like a lot more fun.
It's a heck of a lot more fun.
More expensive,
particularly when you go to Duke, and the business school is literally across the street from the Duke University golf course.
Oh, great.
Perfectly situated.
Did you do your bracket, speaking of Duke?
Yes, I did.
Okay.
Yeah.
Where's Duke sit in those brackets?
They win it all. They take it all. And then I just work backwards from there.
ask.
Exactly. All right, John Tucker, thank you so much. We appreciate that. It's good stuff there. It is Scarlet Fu. It's Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and on Bloomberg.com as well. It is Thursday, which means we check in with one B. Ritholtz, Barry Ritholtz, host of Masters in Business on Bloomberg Radio. He's also got a day job. He's the founder of Ritholtz Wealth Management. Barry, I'd love to just get a sense of kind of the conversations you're having with your clients. I know you guys stress long-term investment horizon. It's a little dicey out there the past several weeks. What are the conversations you're having with your clients?
Yeah, absolutely. So the question is always, what are the odds of something that's going to significantly change the revenue and earnings situation? What does this mean for a potential recession? And we've just had a series of decisions over the past 12 months where we began with a fairly robust economy, and we began with markets at all-time highs. And we've had a series of decisions that continue to raise the risk of recession odds going higher. And what we're seeing in the oil markets, and that goes to any and everything that's transported, so it's not just energy, but food and goods, is the potential, as Chairman Powell pointed out yesterday, for stagflation. And that's problematic in terms of the economy. In terms of the market, it's a little more sketchy and challenging to try and figure out what's going on. I always like to remind people, markets bottom on bad news. If you're waiting for the old clear sign, well, it's too late.
Does that suggest that we're near a bottom to you?
I mean, there are a series of things, when we talk about the fog of war, and you guys know I'm a big fan of saying nobody knows anything about the future, but when we talk about the fog of war, initially we were told, hey, the war is over, we won in the first night. And it turns out that's not true. And there are a lot of things that can and will happen, and a lot of things that can and will go wrong. And it's no longer a unilateral decision. There's another party involved in shooting back and causing disruption. So I try and think of these in probabilistic terms as opposed to saying, here's what's going to happen, because we don't know what's going to happen. So what's the best case scenario? What's the worst case scenario? What's somewhere in the middle that's likely? The best case scenario is this ends tomorrow or today and oil prices come back to normal and we figure out where we go from here, but the worst of it is behind us. The worst case scenario is this continues for days, weeks, months. A lot of the energy that moves around the world suddenly is no longer moving. So if you lose 15, 20, 25% of oil production and shipping, you know, $150 a barrel oil is not unthinkable. Hey, we were at 118 yesterday. And so I don't want to talk about $200 barrel oil. And so the range of the dispersion of outcomes is really significant. And just to show you the knock-on effects on that, I thought the most significant headline I saw on the Bloomberg terminal this morning was bond traders eliminate any possibility of further Fed cuts in 2026. So this isn't more, hey, we launch a few tomahawks and take out their leadership. This is having multiple unintended, but certainly foreseeable consequences to a war that, to be blunt, we haven't really gotten any justification or explanation from the U.S. side as to why we're doing this. Don't get me wrong, a lot of bad actors in Iran, and the world is better off without those people either killing their own citizens or causing disruption in the rest of the world. But this kind of feels like, hey, let's just, you know, spitball this and see where it goes. And that creates problems for investors over the short term.
Yep. Barry, while we have you, I want to get your view on private credit. We had Gary Gensler, former SEC chairman, in here this morning. And he said, given the relatively small size of private credit relative to the overall global capital markets, not that big of a deal. Still, it's a concern, I think, for some investors out there. How do you think about private credit? What might be some credit risk there?
Relatively small size. I guess the old joke is true, $1 trillion here and $1 trillion there, and soon it starts to add up to real money.
I'm just going to jump in, Barry. I'm sorry. We need to head over to the White House where the president is speaking with the Japanese prime minister right now. Let's listen in.
Special person, just won a tremendous election in a record-setting fashion, so you have something in common. And I was very proud and honored to endorse the prime minister because of the fact that I felt she was really good. I thought she did a fantastic job. I respect her a lot, so I gave her an endorsement. And she had the most successful election, in my opinion, in the history of Japan, won by the most ever. So we have a very popular, powerful woman, and she's a great woman. We have a very fine relationship, and we're going to be talking about trade and many other things, and it's an honor to have you. Thank you very much.
皆様ありがとうございます。本日は非常に特別な方にいらしていただいております。歴史的な選挙の圧勝ということで、私と共通するものがあると思います。私たちは素晴らしい絆を持っておりまして、だからこそ私の方からも応援のメッセージを出させていただきました。素晴らしい人であり、私の方から尊敬している方です。
Right now we're listening to Prime Minister of Japan, Sanai Takaichi, speaking with President Trump in the Oval Office. They participated in a meeting earlier this morning. Now they're in front of the press in the Oval Office, and the Prime Minister of Japan making her comments there, which will be presumably translated for us in just a moment. But we'll head back to the White House right now.
You have a very good interpreter who I've known for a long time, with Shinzo, right?
今中東情勢も含めてそれから世界中
All right, that is the Prime Minister of Japan, Sanai Takaichi. She is in the Oval Office with President Trump and with the press corps.
Also, the entire world, we are
actually experiencing a very severe security environment.
そして世界経済もかなり厳しい影響を受けつつあります。とにかく今、中東だけじゃなくてインド太平洋の安全保障環境も大変厳しい中にあります。そんな中でドナルドが、日本に深い信頼を寄せてくれて、で揺るぎない、同盟にコミットメントしてくれていることに感謝をいたしております。
And also the security environment in the Indo-Pacific region is also becoming increasingly severe. Donald, you have shown deep trust in Japan and also the unwavering commitment to the Japan-US alliance. Once again, thank you very much for that.
今日は日本とアメリカが共に強く豊かになっていくための話し合いをしたいと思っています。
And today, I look forward to having a discussion on how we can cooperate to make our two nations, both Japan and the United States, stronger and more prosperous.
それから世界のエネルギーマーケットを落ち着かせるための提案も、持ってまいりました。
And I also brought specific proposals to calm down the global energy market.
この後、主に、経済安全保障、重要鉱物ですとかエネルギーに関する協力、そしてお互いに強い経済を作るための、成長のための話し合い、経済成長のための話し合いをしたいと思っています。Thank you, Donald.
So today, I really look forward to having our discussion, particularly focusing on our collaboration in economic security in the important areas such as energy and rare earth minerals. And also, I look forward to discussing with you how we can make our two economies stronger moving forward. Thank you very much.
Thank you very much, and you're doing a great job. Again, congratulations on the biggest win in the history of Japan. That's not bad. That's a pretty long history. That's a large nation with a great reputation, but it's a tremendous victory. Congratulations to everybody. Very proud of you. Very proud of you. We've become friends, and I'm very proud of the job you've done. It's not easy. Any questions, please?
Mr. President,
Mr. President, are you fully satisfied with the level of support that you're getting from Japan on Iran, including around the minesweepers?
Well, we're going to be speaking about it today. Go ahead, you can go.
日本から、嫌 などの支援に関して、その点について今の状況に満足していらっしゃいますか？
We're doing, we're going to be speaking about it today. We've had tremendous support and relationship with Japan on everything. And I believe that based on statements that were given to us yesterday, the day before yesterday, having to do with Japan, they are really stepping up to the plate. Yes.
非常に日本に関しては素晴らしい支援を受けていると思います。おとといのコメントから、日本からはそれに対して非常に力強いメッセージを得ていると私は思っています。
Unlike NATO.
NATO とは全く違いますね。
Please.
Mr. President, do you intend to lift sanctions on Iranian oil, and do you intend to potentially put U.S. troops or more troops in the region?
Putting troops. I wouldn't tell you, but I'm not putting troops, and we will do whatever is necessary to keep.
Mr. President, do you intend to lift sanctions on Iranian oil, and do you intend to potentially put U.S. troops or more troops in the region?
No, I'm not putting troops anywhere. If I were, I certainly wouldn't tell you, but I'm not putting troops, and we will do whatever is necessary to keep the price as low. I actually thought when I did this, look, the Dow just hit 50,000 a couple of weeks ago. They said that couldn't happen for 4 years. It wouldn't happen in my term. It's such an outrageous thing because I said it would happen. I didn't know it was going to happen that fast, but it just hit 50,000, and we did that in 1 year, not 4. S&P had just hit 7,000. They said that was even more impossible than the Dow hitting 50, and we did that in 1 year. So it was all done. Everything was going great. The economy was great. Oil prices were very low. Gasoline was dropping to, I mean, we had $1.99, $1.85. We had great everything. And I saw what was happening in Iran, and I said, I hate to make this excursion, but we're going to have to do it. And I actually thought the numbers would be worse. I thought that it would go up more than it did. But we're doing this excursion, and when it's completed, we're going to have a much safer world. And the Prime Minister agrees with me on this. She considers it to be terrible what Iran did. I think every country does, just about every country does. Iran is a serious threat to the world, to the Middle East and to the world. And everybody agrees with me. I think virtually every country agrees with me on that. So I wanted to put out that fire. And I said, you know, if I do that, oil prices will go up, the economy will go down a little bit. I thought it would be worse, much worse, actually. I thought there was a chance it could be much worse. It's not bad, and it's going to be over with pretty soon. We've obliterated their Navy. We've obliterated their just about everything there is to obliterate, including leadership. Their Navy's gone, their Air Force is gone, their anti-aircraft equipment is gone. We're flying wherever we want, Pete. We have nobody even shooting at us. They have, I mean, and as you know, their leadership is gone. Their leaders are gone. They pick new leaders, they're gone. They pick new leaders, they're gone. And now they're looking for new leaders again. We can take out the island if anytime we want. I call it the little oil island that sits there, so totally unprotected. And we've taken out everything but the pipes. We left the pipes because to rebuild the pipes would take years for them to do. But we are, I would say, we are substantially ahead of schedule. And I had to do this. I call it an excursion. I had to take this little excursion and do something that no other president had the courage to do. And everybody wanted to do it, but they never had the courage to do it. And I don't blame them. I'm not blaming them. It was left to me, and we've done a great job. Our military is incredible. We have an incredible military. We have the strongest military in the world by far. We have the greatest equipment in the world by far. In fact, Japan buys our equipment, buys a lot of it, and we're honored by that. And that's one of the things we'll be talking. They want to buy a lot of the military equipment. So it's just an honor to have the Prime Minister. We've had a tremendous relationship. Okay.
Mr. President,
I think she's going to have to go first before you. Is that okay? Do you understand? It's very good. I tell you, she's good. I mean, it's so nice that we don't have to sit. No, it's very good. I haven't picked up your language, so the next time you come, I'll have your language mastered. All right, go ahead.
The war is almost over. Why is the Pentagon going to ask Congress for an additional $200 billion?
Well, we're asking for a lot of reasons beyond even what we're talking about in Iran. This is a very volatile world, and the military equipment, the power of some of this weaponry is unthinkable. You don't even want to know about it. Oh, you could end this thing in 2 seconds if you wanted to, but we are being very judicious. But we want to do. Don't forget, Biden gave away. I rebuilt the military in my first term. Biden gave away so stupidly to Afghanistan a lot. He didn't want to move it. He was too lazy, too stupid to move it. But it was a very small amount. It was a lot, but it was very small relative to what I purchased and what I built. We want to have vast amounts of ammunition, which we have right now. We have a lot of ammunition, but it was taken down by giving so much to Ukraine. They gave so much. You know, Biden gave $350 billion worth of cash and military equipment to Ukraine, and he didn't rebuild anything. Fortunately, we have a lot. We have a tremendous, unlimited supply of what you'd call middle and upper middle armaments and military equipment, munitions, armaments, but munitions in particular. At the high end, we have a lot, but we're preserving it. We don't really need it, but we're building. Our manufacturers of military equipment are building at a level they've never seen before. They've never done before. Pete's in charge of it with all of us, really. But Pete's been very strong on it. The general and Pete, myself, the whole group. And Raytheon is building 4 factories. Lockheed is building 5 or 6 factories, and they're building them fast because we had a very tough meeting with them. They were going out and buying back stock for $51 billion in one case. They spent $51 billion buying back stock. Now they're not allowed to do that. And they are now building a tremendous, there's never been anything like it, what's taking place right now. So we're in very good shape, but we want to be in the best shape we've ever been in. We were that, you know, when I rebuilt the military, we were in great shape, and then Biden blew it, and he didn't do anything. He didn't do anything. And if you listen to the Democrats, they don't even want to have a military. Now you see how important it is. But we have the strongest military in the world. We have the best equipment. We make by far the best equipment. The other night, they had 114 rockets shot at a certain location. And out of 100 highly sophisticated rockets, out of 114 sophisticated rockets, every single one of them was shot down with our equipment, all our equipment. It's amazing, actually, how good it is. So we want to be sure, and it's a small price to pay to make sure that we stay tippy-top.
Mr. President, you said...
Mr. President, the Treasury Secretary this morning said there were defections among Iranian leadership. Are you aware of that, and is there anybody the U.S. can work with as a leader going forward?
Well, we have a man named the Treasury Secretary here, so maybe he wants to discuss it. Does anybody know? Do you know who he is? Central Casting.
Yeah, so we are seeing the defections at all levels as they're starting to sense what's going on with the regime. It doesn't get reported here in the U.S. very well, but you know, we are trouncing them from the air, and the regime will probably collapse within itself. At Treasury, we've seen where they've wired their money out of the country. We're coming for that. We're going to get it back to the Iranian people.
Mr. President, defections.
Israel.
There's a lot of military defections also. You have a lot of military defections in Iran. I don't blame them.
Thank you, Mr. President. Have you talked to Prime Minister Netanyahu about attacking the oil and gas fields?
Yeah, I did. I told him don't do that, and he won't do that. We didn't discuss. You know, we do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that anymore.
And the last one, if I could, the Fed chairman told me yesterday that he plans to stay until a new Fed chairman is confirmed, and he also plans to stay on the board until the investigation of the Federal Reserve is done.
Well, he's under investigation because he's building a building for hundreds of billions of dollars more than it's supposed to cost. The building you see over there is under budget and ahead of schedule. That's the ballroom. The ballroom is a much bigger building. It's a much more complex building than what he's doing, and it's at a fraction of the cost. Something is going on, whether it's contractors. That's what I do best in the world. I build great buildings. I've always done it. And I build them under budget and ahead of schedule. They could have $4 billion. This is a renovation job for $4 billion. And if you look at the building, it's not even, I don't know if Kevin Warsh is ever going to be able to move into it. It's been under construction for years. It's the most expensive building ever built. Now, I know it's gross incompetent because I happen to think he's grossly incompetent. Today, certainly you should be lowering interest rates, all right? Certainly, who would not lower them? But he's stubborn and he's got Trump derangement syndrome. But a lot of people have that, you know, it's not a curable disease. But he's also building, he should be lowering rates immediately. But he won't do that because he's a stubborn, incompetent person. And that's a bad thing. You know, when you're stubborn and incompetent, I think it's the worst combination. And he's also not a smart person. But he's building a complex over there that's under his jurisdiction. He started it, and it's out of control. It's billions of dollars for a little building. I could have done that building and made it beautiful for $25 million. $25 million, and it would have been beautiful. Look what I've done at the White House, fixing it up. And I mean, the place was in bad shape. You see the floors and everything. It was in bad shape. I could have made that building beautiful for $25 million. They're spending $4 billion. All right. So there is criminality. Maybe it's with the contractor, but because I know more about contractors than any human being maybe that's ever lived. But that contractor is a very rich man. Whoever the contractor is, and we know, but whoever the contractor is an extremely rich man. He's going to make, I mean, he could make millions of dollars. I'm hearing numbers from $3 to $4 billion. That would make it the most expensive building on a square foot basis ever built in history. And you're not even building a building, it's a renovation. The exterior skin is staying, the steel is staying, the structure. So all I want to do is bring out to the public that this guy is incompetent. He's a very incompetent guy. And he may be a dishonest guy, but somebody's dishonest because there's no way that building can be $3 to $4 billion.
Mr. President, on a straight of work, President.
Thank you.
Please.
Mr. President, you just mentioned Japan.
This looks like one of your people right here.
Thank you.
Is he good or bad? Good. Is he a good reporter or bad? Yes, you know?
So.
Not all right, he looks like a nice guy. Go ahead.
Mr. President, you just mentioned Japan is stepping up. What kind of support do you expect from Japan in the future?
Look, I expect Japan to step up because, you know, we have that kind of relationship. And we step up for Japan. We have 45,000 soldiers in Japan. We spend a lot of money on Japan. And we've had that kind of a relationship. So I expect, I'm not surprised that they would step up. We don't need much. We don't need anything. I mean, honestly, we don't need anything from Japan or from anyone else. But I think it's appropriate that people step up. In the case of Japan, I hear they get more than 90% of their oil through the strait. So that's a big reason to step up. I mean, we've demolished, that country is close to demolished. The only thing is the strait. It's very hard. You could take two people and they could drop little bombs in the water and they're holding things up. We don't want that to happen. But honestly, Japan, China, Europe, parts of Europe, get a lot of their oil through the strait. We get none, practically. We're less than 1%. We don't have to be any percent. We don't even, I think we do it just to be nice. But we, think of it, we don't use the strait. We're defending the strait for everybody else. And then in the case of NATO, they don't want to help us defend the strait, and they're the ones that need it. But now they're getting much nicer because they're seeing my attitude. They're getting much nicer. But it's, as far as I'm concerned, it's too late. You know, UK wants to send aircraft carriers now. And I said, I want the aircraft carriers before the war. I don't want them after the war is won. They want to send me aircraft carriers after the war. There's practically nobody to shoot at them. You know, their missile count is down, Pete. Maybe you could discuss it by about 90-something%. The drones are way down, and the factories are being demolished. Maybe.
Yes, sir. Our missiles being shot are down over 90% since the beginning. One-way attack drones down 90% since the beginning, which is a reflection of overwhelming firepower. But you mentioned the most important part, Mr. President. Their defense industrial base. If you can't make more of it in the future, then you have a limited supply. And so we're going after all of their defense contractors that make all of their exquisite weapons and ensuring that even if they wanted to rebuild more launchers or more missiles, they couldn't in the future. And that's a level of devastation for their military that they've never seen before.
So we have, in literally 2 weeks, we've demolished their Navy, their Air Force. All technology is gone. All communication is gone. And all of the leaders are gone. Other than that, they're doing quite well. Okay, how about one more question for the Prime Minister? Let me pick a beautiful-looking person from Japan. A question for the Prime Minister. Go ahead. Yeah. Oh, he doesn't believe he's beautiful. Oh, he's sounding shy.
Of course, now Japan and US are very good friends, but one question, why didn't you tell US allies in Europe and Asia, like Japan, about the war before attacking Iran? So we are very confused about we Japanese citizens.
Well, one thing, you don't want to signal too much. You know, when we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? You know, he's asking me, do you believe in surprise? I think much more so than us. And we had to surprise him, and we did. And because of that surprise, we knocked out, the first 2 days, we probably knocked out 50% of what and much more than we anticipated doing. So if I go and tell everybody about it, there's no longer a surprise, right? Okay, one more for the Prime Minister.
Mr. President.
Are you good for the Prime Minister?
Yes,
go ahead for the Prime Minister.
Thank you very much. Japan's DJ Press. Japan's biggest concern is China. Now they're giving us export control and very harsh terms to criticize us. So could you plan? Will you plan to bring out relationship between Japan and China while you are there?
Yeah. Well, I'll be going to China very quickly, but I think I'd really like to have the Prime Minister talk about China because I know they have a little bit of an edgy relationship, and I'd just like to know where it stands, how you're doing with China. So, please.
で、日本はいつも中国に対してオープンです。会話はオープンにしています。それから冷静に対応しています。で、とにかく米中関係も含めてですね、これが地域の安定、それから世界のサプライチェーン。これに貢献するものであることを願っています。日本は常にオープンです。
So first of all, Japan has been consistently open to dialogue with China. And also, second, we have been addressing our relations with China in a calm manner. And also speaking of the US-China relationship, my sincere hope is that the relationship will be something conducive for regional security and also ensuring the global supply chain in the world. Once again, I would like to reiterate that Japan has been consistently open to dialogue with China.
And I think we're going to have a great trip. The trip has been postponed for about a month and a half. It's been reset, and we look forward to it. And I'll be speaking Japan's praises when I'm in China with President Xi. But we're going to have some good talks today. And I think mostly about trade, because they want to do a lot of trade. They're a tremendous purchaser of our energy, our oil, gas from, in particular, Alaska. Because Alaska, believe it or not, is very close. It's much closer than any other source. It's just It seems a little cold compared to, but it's just a short trip.
So that's something that we will talk after the press corps leaves.
We'll be discussing trade, and a lot of the talk will be about energy. Thank you very much, everybody.
Thank you, President.
Live sound from the Oval Office here on Bloomberg Radio. I'm Joe Matthew in Washington, having listened to the President of the United States ahead of his bilateral meeting with the Prime Minister of Japan. A big state visit with all the flourish. We're going to have a state dinner later on as well. And it does seem, despite a lot of worries, that this could be a very contentious meeting. In fact, the Prime Minister herself had suggested as much, saying that she was facing an extremely difficult meeting with President Trump. That's a direct quote. She said in Japan before leaving for the U.S. because of Japan's inability to fulfill the president's request to send military vessels to try to open the Strait of Hormuz. But came packing with some news here, and it was clearly enough to make the president happy. The Prime Minister, Takaichi, saying that Iran can never be allowed to have nuclear weapons. Japan condemns Iran's actions, she said, such as attacking the neighboring region and also the de facto or effective closure of the Strait of Hormuz. So the rhetoric was being placed very carefully and well received in this case. It says Japan has urged Iran to stop strikes in the strait. And the president did talk about Japan joining that coalition, saying that we don't need anything from Japan or from anywhere else. But of course, he's been very upset with NATO allies for not doing so. Specific to the conflict in Iran, President saying some things we've heard before. We're substantially ahead of schedule. He says, I had to do this. Quote, I had to take this little excursion and do something no other president had the courage to do, knowing that 13 Americans have so far lost their lives and some 200 have been injured. We also have news today reporting from CNN that an F-35 stealth fighter jet made an emergency landing after actually being struck by hostile fire over Iran. With regard to a supplemental, there's reporting today, and you might have heard a reporter mention this, a $200 billion supplemental budget request. That number's not official, but when presented with that, the president did not deny it. He said, we're asking for a lot of reasons beyond even what we're talking about in Iran. We want to have vast amounts of ammunition, which we have right now, but it was taken down by giving so much to Ukraine, he said. We have an unlimited supply of what you would call middle and upper middle armaments. At the high end, he says, we have a lot, but we are preserving. And the president did get into the situation involving the Fed chair, Jay Powell, saying he's stubborn and he's got Trump derangement syndrome. He's not a smart person. It's out of control with regard to the building project. He said there is criminality. Maybe it's with the contractor. That's what we have so far today. And the president may well be making remarks again later. He does, as I mentioned, have a bilateral and a luncheon with the prime minister, and there will be a state dinner to follow. So we'll keep our eyes on things, and we'll check in a bit later with Tyler Kendall at the White House. We're also going to talk to Adam Ferrer, who's going to join us from Bloomberg Economics, geo-economic analyst, with the very latest from Iran. The last 24 hours have brought some very troubling headlines, which continues to send energy prices higher, specifically looking at crude oil, WTI, knocking on $100 a barrel again. And of course, Brent is way beyond that level. Let's get to Charlie Pellet right now to find out how markets are responding to all of this. Charlie is at World Headquarters in New York. What do you have, sir?
Thank you very much, Joe Matthew. In a word, lower, at least for the Dow, the S&P, and NASDAQ, but got to begin with energy. West Texas Intermediate crude, as you mentioned, knocking on $100, $99.28 on WTI, up by 3.1%. But a big spread with Brent crude. Barrel of Brent, $110.61 right now, higher by 3%. Price of oil and nat gas jumping. Those escalating attacks in the Persian Gulf threaten long-term damage to major energy facilities. European natural gas up 13.1% to about 62 euros per megawatt hour. That's the price delivered to Virtual Trading Point Netherlands Title Transfer Facility, otherwise known as TTF. About 20% of the world's LNG comes out of the Gulf. U.S. stocks lower. S&P 500 index down 39 right now, down by about 0.6%. The Dow down 346, down 0.7%. The NASDAQ Composite Index also down by 0.7%. The VIX at 25 with a 10-year a day after the Fed, 4.26%, and the 2-year 3.84%. Spot gold down 4.4%, 46.04 the ounce. And again, West Texas Intermediate crude 99.07 a barrel, up 2.9%. Brent 110.50 right now, up by 2.9%. 0.9%. So everybody clearly focused on energy. Stephen Rusciotto is chief economist at Mizuho Securities and on surveillance this morning. He told us he remembers the energy shock of the 70s, and this time it's all about price and not supply.
You would go through gas stations that were yellow, green, and red flags. Red, you had no fuel. Yellow, you could fill up for $3 to $5, and green, you could fill up your car. So, I mean, this is the stuff that was going on back then that's very different today. Supply is available. You're paying a different price, which means it's a relative price story.
Mizuho's Steve Rusciotto. European equities lower, checking trading in Europe. Right now, the Euro Stocks Index down by 2%. The FTSE 100 in London down 2.3%. The DAX in Germany down 2.6%. And the CAC 40 in Paris right now lower by 1.8%. Again, European natural gas surging 12.8%. Brent above $110 a barrel. I'm Charlie Pellett. Lots going on, Joe Matthew. That is a Bloomberg Business Flash.
All right, Charlie, this is turning into quite a day here. Obviously, the markets are listening very closely to what is coming out of Washington right now and, of course, the Middle East. The president just now speaking to reporters in the Oval Office alongside the Japanese prime minister who is in town. I was over at the White House a little while ago. I bumped into Tyler Kendall, as a matter of fact, who's going to be joining us from the North Lawn in just a moment. It's a hive of activity over there when you've got a visit like this, of course. The Japanese flag is hanging outside of Blair House right now, and a massive contingency of foreign press is in town for this. You just heard some of their voices, and of course they're going to be following her through the stages of this visit that has a couple of stops along the road here. The bilateral meeting just now getting underway following meeting the press, and they will resolve into a policy meeting later on today, and there will be a greeting and dinner later on. Dinner with the Prime Minister in the State Dining Room, 7 p.m. Eastern Time. Have you seen the menu yet, James? I haven't seen the menu today. I will tell you, it smelled really good. You know, when they're cooking up a state dinner at the White House, they start bringing everything outside the kitchen. They roll it in kind of near the briefing room because they need to make a lot of extra room. A lot of guys in white coats and gals in white coats. I don't know what they're making, but it smelled really good. Went running with Kaylee Lyons this morning, by the way, as just an aside. We checked all the checkpoints. The security was definitely busy today. One thing I learned, Kaylee has much longer legs than I do. Tyler brings us up to date now from the White House after what we just heard from the President of the United States. Bloomberg Washington correspondent ensconced in a day where we have the Japanese Prime Minister in town. Tyler, that seemed to go pretty well. She said all the right things?
Well, Joe, I have to say, I think it's fair to say that was a relatively warm welcome for the Japanese Prime Minister Takaichi, who we should say said yesterday that she thought that this was going to be a, quote, extremely difficult meeting with President Trump today here at the White House. Now, of course, there's going to be a lot of discussion behind closed doors that we don't see, but publicly this was a very cordial, even more than that, meeting. We do have to keep in mind this visit was set well before the conflict in Iran started. Actually, the understanding was that this was a time for the two leaders to connect before President Trump was expected to head overseas to meet with Chinese President Xi Jinping. That did come up, of course, as you well know. That meeting is now delayed. President Trump adding about 6 weeks from now. We're expecting that to be rescheduled. But you really heard the Japanese Prime Minister here start her remarks by condemning Iran's attacks when it comes to energy infrastructure on regional partners and also the closure of the Strait of Hormuz, which, as President Trump noted, and that data has been confirmed by Bloomberg Economics, about 90% of Japan's crude imports do go through the Strait of Hormuz, which has really been kind of behind President Trump's pressure to get allies like Japan involved in securing the strait. Now, we didn't hear any firm commitments when it comes to that, though President Trump did say behind closed doors they're going to be talking about Japan's mine sweeping efforts that could potentially help to smooth things over when it comes to the critical waterway. But he said, quote, he believes that Japan is, quote, stepping up to the plate unlike NATO allies. He did go on to say that he thinks NATO allies are, quote, getting nicer. But as far as he's concerned, Joe, he says it's too late.
Yeah. Just quickly, Tyler, he was asked about the supplemental of this report today that we're going to see a number in the area of $200 billion, which is a far cry from the $50 billion we were talking about just yesterday. He did not confirm that, Tyler, but he did not deny it either.
Right. I mean, exactly that. He said that the U.S. would be judicious, is the word he used, with its funding request, but $200 billion, a lot higher than what we've been talking about at this point for weeks, which could make this an uphill battle to getting passed in the Senate when you factor in the fact that this administration is asking for a $1.5 trillion budget request for the next fiscal year, a nearly 50% hike from the current year. And that might spell some trouble, not just for Democratic support, but also for Republican support, particularly when there's questions from lawmakers about just how long this conflict is going to go. It's going to be a tough vote to watch, Joe, but of course, as you know, we'll be watching to see if anything else maybe gets thrown in there, sweeteners, if you will, like aid to farmers or disaster relief that could maybe help grease the skids. But again, that would just add to the total number that we could see Congress appropriating in this case.
Let us know what you're hearing over there, Tyler, and let us know when the menu emerges for the dinner tonight. From the White House Live, Tyler Kendall. Thanks, Tyler. We'll get back to her in a little while and see how the meetings are panning out here. You heard from Charlie. Things feel different today. The markets are taking a very, well, I won't say terribly different, but darker tone. The losses are deepening. There is concern now following the bombing of this gas field in Qatar that this is, in fact, going the way some people had feared. Obviously, Pete Hegseth, the defense secretary, in his briefing this morning suggested otherwise. But you saw the president on Truth Social last evening. If Iranian strikes on Qatari oil fields continue, America, quote, will massively blow up the entirety of the South Pars gas field. This is the huge gas field that supplies energy around the world. This is a global market, and it would be impacted heavily by such a move. So here we are again, WTI inching closer to 100. Brent's at, well, it's just went to 110, it looks like here. Another all-time high for ExxonMobil. So questions now about strategy, objectives, off-ramps. And we turn to Adam Farah, Bloomberg Economics senior geoeconomics analyst, specializes in Asia Pacific, but we take him around the world pretty often, Adam. It's great to see you. Does this feel different today than it did 24 hours ago to you?
I think there's no question that we have this deep feeling now of the risk of an escalation spiral, and this question of whether intentional or unintentional acts by either side might lead towards a broader escalation in the war that could elongate it and increase the cost exponentially. I think what you just went through and the president's comments last night highlight the real risks of a war continuing in an area that the world relies on for core energy, driving both oil and natural gas, and posing real risks not only for those, as the president likes to say, who receive that oil, a lot going mostly to Asia, but as you said, this is a global market. So just because Japan, China, South Korea, India are most reliant on direct imports. You pull that off the market, as we've seen, we see prices go up, and now we're looking at 110 and going higher.
Well, so you add the downing, I can't really call it that, the emergency landing of an F-35. This is interesting because remember, we lost a couple of fighter jets a couple of weeks ago over Qatar, but that was because of friendly fire. An F-35 made an emergency landing at an airbase in the Middle East, CNN reports, after it was struck with what is believed to be Iranian fire, which would be the first time, Adam, that Iran has hit a U.S. aircraft since the war started. How significant is this? This is the type of scenario people have warned about sparking real escalation.
So we don't have a lot of information right now. We don't know what happened here. We don't know what kind of weapon may or may not have been used to engage the F-35. We know the Iranians are trying very hard to take down some of these aircraft. I think this was just a matter of time, right? The F-35 and other aircraft like it are certainly designed to operate in this type of environment and to do so without being hit. But there's luck out there and bad luck, and certainly
you're flying thousands of sorties.
That's right. And the longer this goes on, the more we should expect to see these types of incidents occur, right? And the other side of it are accidents, as we saw with the refueling tanker last week, where we saw 6 service members die because of likely miscommunication in the air.
Talk to us about ground troops. An important report today that the administration is considering deploying, quote, thousands of U.S. troops to reinforce the operation. The idea would be lining essentially the coast lines or both sides of the strait, but also potentially dropping troops onto Karg Island, which has been discussed. Separate reports suggest it might take actual boots on the ground to seize the enriched uranium. The 31st Marine Expeditionary Unit, about 2,200 Marines expected to arrive by next week, Adam. What should they plan for?
So those, and I think it's also important to highlight that those are coming directly from Japan, right? I mean, these are forces being moved out of the Indo-Pacific that were not originally part of the fight to potentially take a role. Now, that number is too small for some sort of large ground operation in the region. As you said, Kharg Island, maybe, but also potentially just to demonstrate to the Iranians how serious the president is and that he's willing to escalate in a different manner than he has so far. But also worth noting that in the meeting just now with Prime Minister Takaichi, he said he was not going to deploy U.S. forces into, or excuse me, U.S. troops on the ground.
Which
in the
is
conflict.
a change in rhetoric, right? I thought everything was on the table.
Yes, and I have to say, I think that's still the case. I don't think the president and his team have made up a decision right now as to where they're going. And the fact, the kind of nature of the president's comments last night via Truth Social show how quickly things can shift. So I think what we may see in the coming days is mobilization of additional forces and the potential for them to start moving to the region, because it takes a lot of time to move these guys from the United States.
Would that work? I mean, if we lined the strait, would that work? Would it work if Keir Starmer sent a bunch of ships to help us out?
It would present very real problems for security of U.S. soldiers on the ground. Force protection would be incredibly complicated. Again, it's really hard to guess what the administration wants to do with them, but a very limited operation, putting troops on the ground in any way in Iran poses new risks that will increase costs both in resources but also potentially in lives.
What do you think of this story about supplemental funding? It's where we started our talk with Tyler here. $200 billion. What do you buy with that?
Well, the implication is you're buying the munitions that we've used so far.
That we have spent. Do we need $200 billion?
Well, I think there's no doubt that we need tens of billions to just recapitalize the munitions, the high munitions that have been lost. That's both offensive munitions like cruise missiles and the interceptors that have been so key to taking down the incoming Iranian.
Now, is that just from the last 2 weeks, or as the president says, everything we gave to Ukraine?
Well, I think it's part of this broader effort to recapitalize the stockpile, right? And that needed to be done before Ukraine, right? So Ukraine dragged it down. The United States has increased some of that production, but then the operations, whether it be Midnight Hammer last year and the variety of other operations we've seen throughout the year, and now this massive engagement in Iran has drawn down that stockpile further. So we haven't seen the numbers, we haven't seen what they're actually asking for, but even that 1.5 trillion number was supposed to include money for that as well. So there's going to be a lot of questions left to answer for Congress as to why that number makes sense at this time, and whether it is actually Iran related or a general question about U.S. military preparedness.
Yeah, your specialty at the White House, as I mentioned, was Asia Pacific. How significant is this delayed meeting with President Xi? I'm sure this is something the president's talking about right now with the prime minister. We don't have a new date on the calendar, do we?
No, I mean, the president seems to imply that there is one, and the Chinese
he said I'll be going very quickly.
And the Chinese are not ones to confirm things far out. We would wait to see that.
Are they ones to be offended by a decision like this?
Certainly they could be. I think our general read is that the Chinese are happy to see this delayed as long as the relationship with the United States remains on some sort of even keel, and the United States doesn't seek to escalate in the trade war as Xi has been concerned about. But more importantly, as you and I have talked about before, Xi feels like he is in a relatively good position right now, and that there were multiple battles with the United States in trade last year, and that China emerged victorious from those. And so that he's entering this discussion from a position of strength. So if it pushes on a little bit, I don't think that changes that dynamic. It does also make the Chinese feel a little better that there's more time to continue these negotiations on building out an actual plan for both the meeting itself and the deliverables. We had this meeting in Paris between senior U.S. and Chinese officials, and they laid out some grand ambitions for a board of trade and a board of investment, and the Chinese would probably like to see that pulled out a little more and defined before they sign up to anything.
While you're with us for our remaining couple of minutes, bring me inside the mind of Prime Minister Takaichi here in the language that we heard. I want to go back to my notes from when she was speaking. Very clear, declarative statements. Iran can never be allowed to have nuclear weapons. It's almost like she was checking boxes. Japan condemns Iran's actions, such as attacking the neighboring region, and also the de facto or effective closure of the Strait of Hormuz. Japan has urged Iran to stop strikes in the strait. Is that as good as committing ships? What's their relationship today?
No, I don't think it is. I think what you said is spot on. She was checking boxes. She was there to make very clear how Japan is supporting the United States in this operation, but in the way that Japan can. and simultaneously to put on the board the things that she really came to talk about, which is Indo-Pacific security and the relationship with China. So she mentioned very clearly up front that they found a way to articulate that they don't support Iran's nuclear program, but she didn't say she supports Trump's actions in Iran or the ongoing conflict.
Right.
And she also offered this idea to work with the U.S. administration on energy prices, a key goal of the administration, and to work with the international community about bringing peace, but didn't offer direct support in the conflict, walking that thin line to show support to Trump, but also be cognizant of the fact that the Japanese people are not supportive of this war.
Well, it seemed, I think 9% approval in Japan.
Right.
It seemed pretty effective. They're getting along well. We'll see how things go toward the end of the day. Does she hold a news conference before she leaves?
I'm sure she'll talk to press. We'll definitely see that.
We'll be listening really closely with the help of Adam Farah. Thank you, Adam. Bloomberg Economics, geoeconomics analyst for the Asia-Pacific region and a friend of the show. We'll assemble our panel next. Speaking of which, Rick and Jeannie on the way here, only on Bloomberg Radio.
Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news,
geopolitical news,
economic news,
up-to-the-minute global news, whenever, and wherever it happens.
In Washington,
Buenos Aires, Argentina, Sintra, Portugal,
Ottawa, Canada,
Bangkok, Tehran,
Jackson Hole, Wyoming,
Windsor Castle, England,
the Circuit de la Sarthe in Le Mans,
and this
is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Listen carefully.
Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index on track for its lowest close since November. The Dow, the S&P, NASDAQ, all in the red as oil surges. We begin with Brent crude, now above $111 a barrel, up 3.4%. Price of oil and natural gas jumping as escalating attacks in the Gulf threatens a long-term problem for major energy facilities. West Texas intermediate crude, 98.84 a barrel, up 2.6%, but Brent right now just above $111 a barrel. The S&P down 34, down 0.5%. Dow Industrials down 0.7. NASDAQ Composite also down 0.7%, but the VIX holding just above 25. The 10-year at 4.27%. A day after the Fed announcement, we do have the 2-year at 3.85%. Gold down $216 the ounce, just above $4,600, down 4.5%. WTI 98.50 a barrel, and Brent right around $111 a barrel. European natural gas up now by 13.7% to 62 euros per megawatt hour. By the way, about 20% of the world's liquefied natural gas comes out of the Gulf. Max Layton is Global Head of Commodities Research at Citigroup Global Markets in London.
You know, the Hormuz Strait, if it opens, can come, you know, the oil supply can come back really quickly. But obviously, if you hit energy infrastructure, and that may be the response of Iran to affecting its energy supplies, then obviously it takes a long time to rebuild that.
Citigroup's Max Layton. European equities lower on energy concerns. The Euro Stoxx 50 index down 2.1%. In London, the FTSE 100 down 2.3%. The DAX in Germany down 2.8%. The CAC 40 in Paris down by just about 2%. Transportation Secretary Sean Duffy says the partial government shutdown will lead to airport closures as challenges grow for Transportation Security Administration agents who are not receiving paychecks. Now, speaking on CNBC this morning, Duffy said passengers will also see extensive lines and possible gridlock for air travel. Airline stocks are lower as the price of oil moves higher. Among some of those airline names, Delta Airlines, little changed right now, trading right around 63.82 on Delta. American down 1.2%, United down by 1.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
You're a big aviation guy, Charlie. Would you go to the airport right now for would you fly to Washington or would you go Amtrak? This has got to be Advantage Amtrak, right?
You know, it's interesting. Many years ago, Bloomberg did a story on just that issue. Do you take the train? Do you fly? It's an ongoing debate. There are advantages, disadvantages. And I got to say, you're a guy who loves to fly, but it wasn't last year, but I remember you and your co-host, Kaylee Lines, you guys got stuck in Iowa, if I recall. Was that hours or days, right?
That was took a couple days. Yeah, trains, planes, and automobiles. I just mean now, if you know you're going to be in line for 3 hours, if TSA is driving Uber, you just take the train, right?
Yeah,
I mean, I don't know.
I could not agree with you more. And that said, like so many people, I've got a vacation planned for roughly 3 weeks from now, heading down to some sunshine in the Caribbean. And number one on my mind is, you know, how early do I have to leave to get out to JFK? And you read the reports online. Online, some people will say 5 minutes. I sail right through. Other people will say, no, 4 hours.
It's getting to be hours, not
minutes. And by the way, where do you come
Charlie,
down
maybe
on train versus plane, Joe?
It depends. I think, to be honest, if you don't have a TSA not working, it's basically the same door to door from New York to DC. You start going further than that, we have the advantages of flying. Charlie, I'll see you.
And I asked that very question of Tom Keene a while back, and he said what you have to do is you have to assume, and it's a big assumption, that everything is going to work correctly, and use that as your base case.
Isn't that the truth? Boy, I don't know. If you're headed to the airport right now, keep us with you. You might need to download the podcast because there's been a lot of waiting around here. Charlie, thank you. He'll be back in 15 minutes with more on the markets. It's not been a great day, obviously. We're watching stocks. We're watching interest rates. We're watching oil. And we'll have much more on this as we make our way through the day. Of course, the Prime Minister is here. We brought you in the Oval Office to start the hour. And Prime Minister Takayashi is going to be meeting with the president, talking about, yes, Iran, along with trade and other issues, security in the Indo-Pacific, and they will resolve to a dinner later on. While they were talking with reporters in the Oval Office, it was not the most extended back and forth, but a lot of things were brought up. Including was a question from a member of the foreign delegation, a reporter from Japan, and there are many of them here traveling with the Prime Minister, who's, by the way, staying right across the street from the White House at Blair House. So only had to walk across Pennsylvania Avenue to join the president here, on why he did not tell allies. This was the question. Why didn't you tell allies about the war before attacking Iran? If you didn't see or hear this live, this is going to be all over the place and probably on front pages tomorrow and likely in the cold open on Saturday Night Live this weekend. Listen to President Trump.
When we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? He's asking me, do you believe in surprise? I think much more so than us.
Some awkward laughter and a few gasps in the room. He went there to Pearl Harbor. We assembled our political panel. I can't imagine their thoughts on all of this today. Bloomberg Politics contributor Jeannie Shanzano is with us, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, and Rick Davis, Republican strategist and partner at Stone Court Capital. Rick, you know the weave, and a lot of politicians say things when they're off script. This is somewhere that most would not go. Would you agree?
Yeah, and if you think that the U.S. media is going to have a heyday with this, try to get some translated Japanese reporting on this, because they're going to go nuts. This highly sensitive relationship over the World War II between the United States and Japan has a lot of reason to be sensitive about it. So I don't know. That's just one of those things that if it was anybody else but Donald Trump, we'd be freaking out, offended. I can't believe the insensitivity. But that's not even the least insensitive thing that he has said in a week. So I don't know. I mean, my guess is this too shall pass.
Wow. Jeannie, remember when Barack Obama visited Hiroshima in 2016 to honor the victims, to advocate for nuclear disarmament? I guess we've come a long way from there. Sisi might have said it best. Has Donald Trump ever found a third rail that he didn't want to grab onto?
That's right. Sisi right on top of it. And you just scratch your head, because is the president actually equating what Japan did in Pearl Harbor, which was a war crime, a violation of international law and order, to what he did in Iran just a couple weeks ago? Is that really the analogy he wants to draw? I don't think so. He may need to get back to history class. Underscore, as you did, the reporter asked about why didn't you tell your allies? Not why didn't you tell your enemy, but why didn't you tell your allies? So there we go, Joe. It is, a third rail, he'll cross those, but this one doesn't even work for him, for even school children who understand what Pearl Harbor means.
Wow. Well, that said, he said we didn't want to signal too much. You believe in surprise, I think, as much or more so than us. But a lot more was said here, and I'm more compelled by what we heard from the Prime Minister than the President, Rick, because there was Well, there was a lot of consternation going into this. The Prime Minister herself said this would be a very difficult meeting when she spoke with lawmakers before leaving Japan, and showed up with an agenda, said all the things the president wanted to hear, with the exception of putting a boat in the Strait of Hormuz. Iran can never be allowed to have nuclear weapon. We condemn Iran's actions, urging Iran to stop strikes in the Strait, attacking neighboring countries. Is that good enough? Is our relationship back on track with Japan? He was condemning them for not joining the coalition in the Strait just 24 hours ago.
Yeah, I mean, it kind of swings both ways quite repeatedly and often. Prime Minister Takahashi was seen as one of his closest relationships in the region. And there's been a very, very active and close relationship with the financial systems. Secretary Bessent and the finance minister of Japan have been working in concert. And then, of course, the Iran excursion interrupted some of that. But she has really perfected the art of the Oval Office visit. I'm impressed that she worked so hard to lower the bar. You know, this is going to be a disaster. This is going to be a really tough meeting. And then, of course, it doesn't go as tough as you think it's going to. She brought all kinds of gifts, billions of dollars of investment to be made in the United States on the behalf of Japanese corporations. And she immediately, starts the meeting by going after Iran. So outside of saying we've got a carrier group headed to the Persian Gulf right now, she has hit a home run, I think. It's classic how to handle Donald Trump Oval Office visit.
Wow. Boy, I guess the playbook's been written here, Jeannie. The president also said, we don't need anything from Japan or from anywhere else, even after he suggested that he would prefer or would appreciate their involvement here as opposed to NATO. Listen to the contrast the president drew in the Oval Office here.
We're defending the Strait for everybody else. And then in the case of NATO, they don't want to help us defend the Strait, and they're the ones that need it. But now they're getting much nicer because they're seeing my attitude. They're getting much nicer. But it's, as far as I'm concerned, it's too late.
It's too late, Jeannie. What does that mean about our NATO allies and our, well, I'll say our membership in the alliance?
Yeah, and unlike what the president said, I don't think we've yet seen any signs that the NATO allies are shifting on this at all. In fact, quite the contrary. Donald Trump has been threatening the allies for some time, whether it's on trade, whether it's on Greenland. He's made his disappointment, his feeling of betrayal in terms of NATO very clear. The question has long been, do we pull out of NATO under Donald Trump? I think he is, potentially signaling that may happen. But, there is a stark difference in tone between how he talks about, say, Japan in this regard, who likewise hasn't promised to help us in the Strait, versus our NATO allies, that's for sure. But, I think the most striking thing about that Q&A was these 4 words, Joe. It's not so bad. That's what the president said when he was trying to say that he knew prices were going to go up this high. He predicted all of this was going to happen. This excursion was going to be worth it. And he sat there and said to the American public, the commercials are writing themselves as we speak, it's not so bad in the face of $115, $114 for a barrel of oil, gas prices, mortgage rates at their highest in 3 months, healthcare, groceries. The president, unlike his Japanese counterpart, who are very well staying on script, does not seem to understand the pain that the American public is feeling 20 days into what he has done here. And he does not seem able to tell us what the end game is here or how we get out of it. So that it's not so bad, I think, is going to be the title of some upcoming midterm commercials.
Yeah. Well, he's said repeatedly that he thought it was going to be worse. He said, we thought oil prices would go up even more. So here we are, Rick. Crude oil, West Texas, $98 a barrel. Brent is $110. And AAA tells us the national average for a gallon of regular gas is $3.88 today. A lot of folks think that's going to be $4 by the end of the week. So I'm curious, Rick, what's going through your mind when you hear analysts talk about the spiral? Because the market does feel different today after the strikes on the Qatari energy operations, strikes on the gas fields in Iran. there is fear that this is going to get out of hand. The president is threatening to destroy all the pipes, as he puts it, and completely obliterate that gas field in Iran, which is, of course, a major hub for energy that is used around the world. Does this feel, in our remaining moment, different to you today? Is it a darker version today than it was yesterday?
Yeah, I do think there is a new phase of the war where these resources are being targeted. Obviously, first strike was on behalf of Israel in the South Pars gas field in Iran. They retaliated, attacking Qatar. This is a really dangerous increase. The president threatening to basically wipe out, Iran's ability to produce. We may be seeing the lowest gas and oil and diesel prices that we're going to see for the balance of the year if the war goes on this way. And so what's interesting is there has not been the level of pushback against this approach that you would have thought industry would have made by now.
Interesting, Rick. Let's pick up on that point in our second hour. Rick Davis and Jeannie Shanzano will stay with us as we welcome our global television audience to the conversation. Kaylee Lyons is on the way in as well, and we're going to bring you an important conversation next hour with Congressman Sam Liccardo of California on Bloomberg.
from Washington, D.C. This is Balance of Power with Joe Matthew and Kaylee Lines.
Markets darken on the war with Iran. Welcome to the Thursday edition as stocks sink and oil rallies as Iran targets energy infrastructure in Qatar. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, we're also following the money here in Washington, and it looks like the president's about to ask for a lot.
Yeah, some $200 billion worth of supplemental funding could be the request that comes from the Pentagon to Congress, not just, as President Trump says, to fund the war in Iran, but because while we're in good shape, we want to be in the best shape, to use his words, militarily.
That's right. And, of course, we haven't seen that number yet, but the president did not deny it or try to alter that approach when a reporter just asked him about it. It's the first time that we've really heard that in conversation at the White House, suggesting that we have a lot of munitions to replenish, much of it spent in the war in Ukraine.
Yeah, although the amount that the Pentagon could be asking for now actually would be more than all of the supplemental funding packages Congress has already passed for Ukraine, which is pretty amazing. Of course, President Trump was making these comments while seated in the Oval Office next to Prime Minister Takaichi of Japan, who came into this meeting with President Trump openly a bit nervous, saying it was going to be very difficult, as he's been critical of Japan as an energy importer from the Middle East for not helping out in the Strait of Hormuz, though the Prime Minister did condemn Iran's closure of the Strait of Hormuz and say that Iran cannot have a nuclear program.
Which seemed to be enough for now. They're meeting behind closed doors. It was an interesting back and forth with reporters, and we'll bring you some of that conversation. We'll also check in with Tyler Kendall, who is live at the White House today with our eyes on these markets. Kaylee, it can't be something the president likes to see.
Certainly not, and that's presidentially true across asset classes from stocks to commodities. A lot going on in metals in particular today. So let's get a check on all of it as we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lines. Right now we are looking at West Texas Intermediate Crude, $97.99 a barrel, up by 1.7%. Brent off session highs below 110 now, 109.91 for a barrel of Brent, up by about 2.4%. Oil higher, stocks lower. The Dow, the S&P, NASDAQ all declining. S&P right now down 46 at 65.78, drop there of 0.7%. We've got the Dow lower by 384, down 0.8%, while NASDAQ is down 176, a drop of 0.8%. The VIX just above 25. The 10-year, day after the Fed, 4.27%. The 2-year, 3.86%. A big retreat for spot gold, $45.81 the ounce, down 4.9%. And again, bears repeating, West Texas Intermediate Crude up 1.7%, barrel of Brent up by 2.3%. So the price of oil and natural gas jumping as escalating attacks in the Persian Gulf threaten long-term damage to the major energy facilities in the region. And by the way, about 20% of the world's LNG comes out of the Gulf. European natural gas up now by just about 12.1%. European stocks are lower. Checking European exchanges, we've got the Euro Stocks 50 index down 2.1%. In London, the FTSE 100 index down 2.3%. The DAX in Germany down 2.8%. And the CAC 40 in Paris lower today by 2%. So again, recapping, stocks lower, oil higher. Brent 109.84, up by about 2.3%, with the S&P down 0.7, and the 2-year 3.86%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Back we go to Washington. Balance of Power continues now. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York checking on the markets for us. Thank you so much. Of course, the markets, specifically global energy and wider commodity markets, are laser focused on the Strait of Hormuz, which means effectively shut, outright controlled at this time by Iran amid the ongoing war with the U.S. and Israel, which of course shows no signs of abating, even as President Trump today suggests, at least right now, he is not thinking about sending ground troops in order to secure the strait. But he also, of course, has repeatedly called on allies to come in and assist with this endeavor to a lukewarm reception, I think we could say. Of course, one of the allies who was on the receiving end of that request and had been previously berated by President Trump for not helping out more substantially was Japan, as a major importer of Middle Eastern energy products. And the Japanese Prime Minister, Takaichi, was in the Oval Office and has a full state visit today with President Trump. As we speak, they are actually having discussions at the White House right now, but the president did have a bit more of a congenial tone when talking about Japan in their bilateral earlier.
We've had tremendous support and relationship with Japan on everything, and I believe that based on statements that were given to us yesterday, the day before yesterday, having to do with Japan, they are really stepping up to the plate.
Stepping up to the plate as Bloomberg's Tyler Kendall steps up on the North Lawn of the White House in the throes of this visit. Tyler, it's great to see you. It sounds like the Prime Minister, who was projecting concern, as Kayleigh said ahead of this meeting, said all the right things.
Right, Joe, a relatively warm welcome for Japanese Prime Minister Takaichi here at the White House. As you heard, President Trump comparing Japan to NATO allies, saying that the country is, quote, stepping up to the plate, though it was still evident that some tensions still do remain. It's not totally clear exactly what Japan is offering here when it does come to the conflict in Iran or potential support in securing the Strait of Hormuz, though President Trump did indicate that the pair will talk about Japan's mine-sweeping capabilities in dialogue behind closed doors later today. The Japanese Prime Minister herself saying that she has brought to the U.S., quote, concrete proposals to help calm the energy markets, and of course condemned the closure of that critical waterway, as data shows that Japan gets about 90% of its crude oil imports through the Strait of Hormuz. And this comes as those disruptions really do continue, and attacks on energy infrastructure do too, as Israeli state media is reporting that an oil refinery in the country was hit in a barrage of strikes earlier today, as President Trump had taken to Truth Social overnight to urge a stopping to attacks on energy infrastructure in the region from both Iran and Israel. Joe and Kayleigh, in a rare public rebuke, President Trump said that he told Israeli Prime Minister Benjamin Netanyahu to not strike any more energy infrastructure after we saw Israel strike Iran's largest natural gas field yesterday, which kicked off this wave of retaliation by Iran to Gulf energy infrastructure.
Indeed. All right, Bloomberg's Tyler Kendall on the North Lawn of the White House. Thank you so much. And when we consider that retaliation against energy infrastructure, of course, the largest LNG facility in Qatar was hit, and the Qatar Energy CEO told Reuters that some 17% of that capacity could be offline now because of the damage, and that it could take 3 to 5 years to repair. So for more on this, we go to Mike McGlone, Bloomberg Intelligence Senior Commodities Strategist. And Mike, obviously, we've talked to you a lot about the near-term versus longer-term case for oil and natural gas. But if we're talking infrastructure damage and capacity that may not come back online for that long, that far into the future, how is that changing your thesis, if at all?
It's sticking with my thesis, Kayleigh. Key theme is here is the longer this lasts and the higher prices go, most notably crude oil, you mentioned natural gas, it's more of a problem for the rest of the world, the more likely this energy crisis is going to tilt over to a global recession, and did what it did in 2008. Just key thing to remember, crude oil peaked at 147 in July 2008 with CPI at 5.6%, and the end of the year down at 32, and CPI bottomed the next year at -2%. That's what I think is happening. That's what traders get. And you're starting to see that little bit in the long bond. The long bond yield's starting to tick down today because it sees an end game. And you're seeing that with metals collapsing. This is starting to show the deflationary, recessionary forces from this energy crisis.
Wow, all right. I want to hear more about that, Mike, because you're right. Metals are falling out of bed, and so are mining stocks. We're looking at gold right now down over $300 an ounce, or 6%, just below 4,600. The headline on the terminal, gold mining stocks set to erase 2026 gains as rate cut bets fade. There's more at work here than Iran, it sounds like.
Well, absolutely. Copper did it. Silver did it. Silver was up 63% in January. Now it's down almost 3% in the year. This is just getting started. And the reason I say that, Joe, is my key theme still hasn't happened. If you look at 60-day volatility on the S&P 500, it's still down on the year, despite what's happening. So to me, that trickle up from all that massive volatility in crude oil, in gold last year, and crude oil this year, it's very rare not to go to the stock market. Right now, we're seeing wobbling. And I think that's what the market's starting to worry about, is this triggering what it did with 9/11. It triggered the acceleration in the downward trend in the stock market.
Well, it's interesting. Just quickly, Mike, we've got gold down for a 7th session. What happened to buying gold in times of war?
Well, that wasn't me. Gold told us. Gold, the time to buy gold was last year. Gold preempted this. Sure. Gold warned us. And gold was it was front-rented. And now that it went up, gold's looking forward to that more secure future when Mr. Trump, by midterms, was going to say, well, Iran and Russia have lost Venezuela, Syria, Iran, and potentially Cuba. It's looking forward to the opening of the Strait of Hormuz, and potentially maybe we've reached as bad as it can get.
Fascinating, Mike, as always. Mike McGlone with us from our Miami Bureau, Bloomberg Intelligence Senior Commodities Strategist, as we consider the conversation on Capitol Hill. Yes, about oil and what we're seeing in the markets, but also about an ask for more money. It is coming at some point from the White House. The president was asked about it today, with reports now floated that the Pentagon is going to ask the White House to approve a more than $200 billion request. About 4 times the size of what was already being floated here, at least privately or quietly in Washington. In fact, we asked Senator Ron Johnson, a budget hawk in the Republican-led Senate last evening, about this idea, maybe a $50 billion request. Here's what he said.
We haven't seen any numbers. That's the number people have been talking about. From my standpoint, we went from $4.4 trillion of spending in 2019 to $7.4. I've laid it out. I mean, we're spending hundreds of billions of dollars, way in excess of what we spent in 2019, plus up for inflation and population. So if we get that supplemental, I will certainly make an attempt to offset it in areas of spending where we shouldn't.
So here's a yes, potentially, but it's going to need to be offset by cuts. And that just reminds us of the very intense debate that will likely follow on Capitol Hill, something I suspect Congressman Sam Liccardo is bracing for. The Democrat from California's 16th District joins us right now on Bloomberg TV and radio, serving on the Financial Services Committee. Congressman, it's great to see you. What would you do with a request for $200 billion?
I would reject it. We know that in times when you're facing a budget deficit, as so many American families do, struggling every day to make ends meet, they set their priorities and they fund those priorities. They have to pay their rent. That's where the money goes first. We have massive challenges in this country, and there was no voter a year and a half ago who thought where we need to spend money is $200 billion on a war in Iran. This is a war of choice by this president that is really essentially bankrupting the American public, both as taxpayers and as consumers, as we're seeing higher prices at the pump and soon for our groceries as well.
Well, and when we consider those higher prices, Congressman, I'm not sure if you just heard our colleague, our analyst there, Mike McGlone, suggesting that he sees kind of 2008 recessionary type forces at play here, that ultimately he is expecting the check on higher energy prices is going to be demand destruction and a real growth slowdown. Is that also your assessment here as a member of the Financial Services Committee?
I mean, we should look at the last year. We have just seen the largest tax cut in human history. You would think it would be supercharging job growth throughout the country. We've seen 0 job growth in the last 6 months since Liberation Day, when Trump started hiking all these tariffs. When we're supposed to be building a lot of manufacturing jobs, we've lost 72,000 manufacturing jobs in the United States. That should tell us something. They're doing everything they can to prime the pump, and jobs are not responding. That really portends a very dark future for us, particularly as we're now looking at spending on other priorities when we could be focused on critical issues here at home.
We saw a statement a short time ago from Taxpayers for Common Sense, Congressman, and pretty interesting here. The group's president, Steve Ellis, says taxpayers haven't gotten any clarity from the administration about the goals, the costs of war, which he outlines now the $200 billion supplemental request. He says, to be clear, this funding is not about supporting the troops. The Pentagon got an 18% boost in spending this year. If that's the case, Congressman, what is it about? Is this a Pentagon that's bracing for a longer war?
Well, that's a good question, and I think we're all deeply concerned about that. I'm not sure this president has the attention span for a longer war, and frankly, we haven't articulated, or we haven't seen this president articulate any achievable objective with a short or a long war. So I think we need to first understand what is the objective with this war, because so far all we've seen is certainly a degradation of Iran's military capacity. We know our troops are the best in the world, but we haven't seen the actual accomplishment of any objective. We know we have higher oil prices. We know we've got all of our allies that are furious with us and won't help us in the Strait of Hormuz precisely because of our willingness to go it alone. And we've helped our adversaries. Russia and China, of course, are benefiting from our willingness to reduce sanctions on Russian oil. This is not a war that has accomplished any meaningful objective for the American public.
Well, as we consider higher oil prices, which you mentioned, Congressman, obviously that is translating to prices at the pump. I believe on average in California, gas prices are well above $5 a gallon. If the White House were to come to Congress and request a gas tax holiday, would you be supportive of that in the name of relief at the pump for your constituents?
Well, I'm certainly open to considering many options, but we know what happens if the gas tax goes away. It means we don't have the basic infrastructure we critically need in this country. I think a better approach is let's wrap up this war and refocus U.S. public resources on U.S. infrastructure, because that's what that gas tax funds. And what we really need to be doing is investing in this country and not spending abroad.
Well, you know, a lot of economists would tell you that the gas tax holiday simply would increase demand, which sends prices even higher. Congressman, what are you paying last time you filled the tank in California?
Yeah, we're paying a lot. I drive an electric car, so I couldn't tell you what I pay, but I can tell you, my neighbors pay way too much already. Look, I think those economists are right. Fundamentally, simply priming the pump with more demand is not going to help provide tax or price relief that so many consumers are burdened by. And let's keep in mind all the other ways this is affecting consumers. We know a huge hit is being felt by an awful lot of farmers as a result of a big spike in fertilizer costs. A third of the world's fertilizer comes from this region. That means we're all going to be paying for it many months to come at the grocery aisle.
Well, and then there's also the borrowing cost consideration. We saw a red headline cross the terminal earlier today, Congressman. Mortgage rates at a 3-month high with the 30-year average at 6.22%. Obviously, there is now a live conversation of a Federal Reserve that might not only not be cutting this year, but whether rate hikes could be back on the table if we're going to see an inflationary shock from energy. On mortgage rates, though, given you sit in the Financial Services Committee, can you tell us what's going to happen with the housing bill that would address it more from the supply side? Are you going to conference? Is that your anticipation?
Well, I certainly hope we can get to conference. I know that right now the battle seems to be between Republicans in the House and Republicans in the Senate about what's going to happen. Obviously, they control both houses. I was happy to see a few of my bills get included in the version that got approved by both houses. But the bottom line is we need to get to yes. We critically need more housing supply. That is something that Democrats and Republicans can agree upon. So let's get this piece of legislation passed. There's much more we need to do to be able to help get red tape out of the way and accelerate housing production in this country.
We only have a minute left, Congressman. The Department of Homeland Security has been closed now for 33 days, and we saw the president's pick to run the department clear committee on the Senate side this morning, Mark Wayne Mullen. I'm wondering your thoughts on what happens next here. TSA agents are driving Uber instead of going to work to make money. How long will this last? We're at 33 now. What number will we be talking about when it ends?
That's an important question. I know a very painful reality for a lot of employees, our Coast Guard, TSA, many others who critically deserve to get paid. I co-sponsored legislation that would enable us to pay all the other employees, including TSA and Coast Guard, so that we can hash out what we need to resolve with regard to reforms to ICE, get them paid separately. Currently, that bill is a subject of a discharge petition because the House leadership on the Republican side won't allow it to get to the floor. So we're hoping we can get some Republicans on board and get a vote.
All right, Congressman, thank you so much for joining us. Democratic Congressman Sam Liccardo of California's 16th District, live from Capitol Hill here on Balance of Power. And we have much more coming up. We'll turn to our political panel, Rick Davis and Jeannie Shanzano, next, right here on Bloomberg TV and radio.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, oil moving higher. West Texas Intermediate 97.48 a barrel, up 1.2%. Barrel of Brent 109.38, up by 1.8%. Bottom line, energy higher, stocks lower, with the S&P down 48 now to 65.76, a drop of 0.7%. The Dow at 397, down 397, a decline there of 0.9%, while NASDAQ is down almost 200 points, lower now by 0.9%. The VIX at 25, the 10-year 4.28%, with a 2-year 3.87%. Gold at 46.09 the ounce. Gold is down 4.3% right now. And again, West Texas Intermediate crude up 1.2%, 97.49 a barrel. Brent 109 now, up by 1.6%. The price of oil and nat gas jumping as escalating attacks in the Persian Gulf threaten long-term damage to major energy facilities. European natural gas is surging. Right now, we are looking at nat gas in Europe up by 13.1%. By the way, about 20% of the world's liquefied natural gas comes out of the Persian Gulf. European equities declined today. The Euro Stoxx 500 lower by 2.1%. Elsewhere in Europe, the FTSE 100 index down 2.3%. The DAX in Germany today down 2.8%. And in Paris, the CAC 40 down 2%. All of this amid higher energy costs. So the Dow, the S&P, and NASDAQ all declining. S&P right now down by 0.7%. We were just talking about TSA workers not getting paid. Now Transportation Secretary Sean Duffy says the partial government shutdown will lead to airport closures as challenges grow for TSA agents who are not getting paychecks. Speaking on CNBC this morning, Duffy said passengers will also see extensive lines and possible gridlock for air travel. Airline stocks mixed right now. We do have Delta up 0.2%, but American down 1%. United lower by 1.4%. S&P again down 0.7. West Texas Intermediate crude 97 even a barrel, up 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Balance of Power continues. Once again, your hosts Joe Matthew and Kaylee Lyons.
Reminding us we're glad we're not flying today. Charlie Pellet, thank you, sir. He'll be back in about 20 minutes with another check on the markets as we follow the beat here in Washington. President Trump meeting with the Prime Minister of Japan today. She's still in the building, and they will have dinner in the state dining room later, having met in the Oval Office to talk about a number of things, including the war in Iran. Before we got to that point, though, there was a Pentagon briefing. Defense Secretary Pete Hegseth, along with the chairman of the Joint Chiefs, this is tends to be how they do it lately. We get the reporters out there at the Pentagon 8 o'clock in the morning to talk about what happened. And the big news today was the supplemental budget request that is looming. You've probably seen this by now. Reported by Bloomberg, $200 billion is the expectation, which is far beyond any number that we have heard yet. Remembering, of course, the Pentagon is currently enjoying its first ever $1 trillion budget. Pete Hegseth was asked about that number earlier in that briefing. Listen.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future, ensure that our ammunition everything's refilled, and not just refilled, but above and beyond.
It takes money to kill bad guys. The president was asked about this earlier in the Oval with the prime minister. He, too, did not deny the idea of a $200 billion request and said we're asking for a lot of reasons beyond even what we're talking about in Iran, pointing to vast amounts of ammunition, but it was taken down by giving so much to Ukraine. Now, lawmakers still haven't received the request, as we just established with Congressman Liccardo, who says he's already a no on this. Also standing by to pour cold water on the idea is Maya McGuinness, the president of the group Taxpayers, I should say, what's the name of it, Kaylee?
Committee for a Responsible
Federal Budget. Here's what she said.
We don't want to be deciding national security based on our budget. And we have switched to that's the situation. If there are needs for defense increases, we have to budget for them. We have to be willing to figure out where we're either going to pay more in taxes or reduce spending in other parts of the budget. But right now, this offhanded sort of approach of we can just increase the defense budget by 50%, There's no room in the budget for that. And this is the moment that people have been warning about, that the world is very risky, and we have a budget that now makes us very vulnerable.
So let's get into this now with our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are back with us. Rick, of course, partner at Stonecourt Capital and Republican strategist. Jeannie, Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Welcome to you both. Jeannie, when we consider this supplemental funding request and the size of it potentially, though clearly this number is not yet firm, this is not yet on paper and delivered to the Hill, but how difficult would you expect it to be for even a Republican-controlled Congress with the many budget fiscal hawks that are within it to actually pass something like that?
It's going to be very tough, Kaylee. We already heard from people like Lauren Boebert, who said she is a no. Usually, historically, for these kinds of things, you're going to need some crossover. It's got to be a bipartisan effort. So the big question is, will any Democrats go along? And let's not forget, Joe mentioned $1 trillion the Pentagon has. This is a Pentagon that also, for 8 years in a row since they were mandatory, has not yet passed an audit. Imagine working in a place, leading a place that can get $1 trillion and not pass an audit for almost a decade. And you go back and ask for $200 billion more on the day that the deficit hits $39 trillion. These are outstanding numbers when you think about them, and not in a good way, Kaylee, outstanding in a stunning way. And they're going to go back, a president who can't articulate what that money would be for. That's a big question. And it also seems to have taken leadership on the Hill by surprise, because today, John Thune, Mike Johnson, they seem to say, we'll consider it, we'll think about it. But it was clear the groundwork for this had not been laid by the White House. I'm thinking of this as a trial balloon, as Pete Hegseth said, we can play with that number.
Well, maybe this is just the start of a negotiation, Rick. But as we heard from Maya at the Committee for a Responsible Federal Budget, we also heard today from Steve Ellis at Taxpayers for Common Sense, who says this is much more than the direct cost of the war so far, and likely more than will be needed anytime soon. His statement begs the question, Rick, is the Pentagon just trying to pad its already massive budget, or is the administration planning for a protracted war? How would you answer that?
Well, I don't think there's a clear answer to that. I think he makes a good point. I mean, all the reporting I've seen has this war currently costing us, around $12 billion. When you add up all the money we've spent on Atlantic Resolve, the war in Ukraine, that's only a little over $180 billion. So, I mean, are we replenishing the funding and the materials for the last, since February of 2022, which includes all the expended ordnance in Ukraine? I mean, we haven't been given any information about this, but the idea that we're going to be able to pack a $200 billion supplemental in under the guise of Operation Epic Fury is just going to be an incredibly hard sell, especially because of what Jeannie said, which is with the national debt hitting $39 billion. I mean, think about the political ramifications of that ticking up to $40 trillion when we get to Election Day in the midterms. That could be a tipping point for making the national debt a real salient political issue. We've kicked the can for a long time, but those chickens may be coming home to roost now.
Well, so then I have to wonder, Rick, if that is actually going to lead to even more fissures within the Republican Party itself for the kind of Ron Johnson, or as Jeannie mentioned, Lauren Boeberts of the world versus others in leadership who may be more inclined to try to get the Pentagon and the president exactly what he wants here.
Yeah, Ron Johnson made the point the other day that, the national debt has increased by $3 trillion just in the last year. That's an incredible acceleration, leading us to the point where it could hit, $40 trillion by the midterms. And he's made a point, why don't we just return to pre-pandemic spending? I think Maya McGinnis makes the case. It's not that we don't want to spend money to support our troops and have a strong national defense. We do. And every member of Congress is sensitive to that. But we can't do it in a vacuum. We can't keep just piling these supplementals up against ever-increasing defense budgets and think that that's sustainable over the long run. So I think this could spark a complete conversation, especially around the 27 budget, that says where are we going with expenditures, and can we bring them down, especially to a point which wasn't that long ago before we really started hitting these huge, special spending increases pre-pandemic levels.
To what extent would ground troops change this conversation? Jeannie, you've probably seen this Reuters report today. It's the latest, and there have been several, but this one says the administration is considering deploying thousands of U.S. troops to reinforce the operations, including a potential deployment on Iran's shoreline to secure the Strait of Hormuz. Troops could also be used on Karg Island, if that's something that we wanted to do, as well, potentially to secure the enriched uranium that has gone missing. The Pentagon has already shipped out the 31st Marine Expeditionary Unit that they took out of Japan. That's about 2,200 Marines, Jeannie, but they won't get there till next week. So this would clearly take additional troop movements if this was going to happen. What would Democrats say in that world?
Yeah, and I'm so glad you brought this in because, of course, the president was asked about it, and some people are reporting that he said he would not send in troops. I heard him say, I'm not going to tell you, which to me is one of the typical non-answer answers. So I'm not sure he ruled it out in the White House just a few minutes ago. And of course, this intimately involves Congress. So this is the problem the administration has. They denied Congress a role in or a debate over voting to authorize this war or excursion, as the president likes to call it. But this is what this debate over funding is going to turn into. It's going to be a substitute for everything congressmen and women, senators could not talk about. And they love to talk, Joe. So everything they could not talk about because they didn't have the authorization debate. They're going to have it over this debate for funding. And that is going to be a very, very tough conversation. If that involves either really or potentially boots on the ground, that conversation becomes even more fraught for the White House. And so, again, we have no clarity from the president, who, again, in the White House just a few minutes ago, when asked, will you put boots on the ground, said, no, but I wouldn't tell you if I was going to. Another non-answer. And this sort of encapsulates this entire war that we are now involved in 20 days in.
Rick, we have less than a minute left, but do you see the president as trying to essentially keep his options open, or trying to basically not trying to rule out putting boots on the ground?
Yeah, Kayleigh, I think there's enormous pressure on the president to make this a short excursion, as he calls it. And Pete Hegseth said the same thing in the briefing he did this morning, that this is going to be not a protracted warfighting effort. So you're hopeful that that is the strategy. Look, they've really accounted for almost all their objectives. And so the question is, what are we really gaining by continuing to pound Iran? And we need that Strait of Hormuz open.
Fascinating insights, as always, and great analysis from Bloomberg Politics contributors Rick Davis and Jeannie Shanzano. Thank you both so much. I'm Joe Matthew alongside Kayleigh Lines. Kurt Volker joins us coming up next, former ambassador to NATO, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index trading close to session lows. Right now, the S&P is at 65.71, down 53. A drop now of 0.8%. Stocks lower, energy higher. West Texas Intermediate crude oil is advancing by 0.5%. Now it's 96.76 a barrel. Brent 108.85, up now by 1.4%. But stocks lower, with the Dow Industrials down 420, a decline of 0.9%. The S&P again down 0.8. Nasdaq Composite down 0.9%, and the 10-year 4.27%, with a 2-year 3.84%. The VIX at 25. Spot gold down 4.4%, 46.05 the ounce. And again, West Texas Intermediate crude 97 even a barrel, up now by 0.7%. The price of oil and natural gas jumping as escalating attacks in the Gulf threatens long-term damage to major energy facilities. European natural gas surging 13.1%. By the way, about 20% of the world's liquefied natural gas does come out of the Persian Gulf. Again, the Dow, the S&P, Nasdaq all in the red. European equities lower. The FTSE 100 in London down 2.3%. DAX in Germany today down 2.8%. The CAC 40 in Paris down by 2%. The cyber attack against Stryker Corp has delayed surgeries for some patients, adding to the fallout from the incident last week. The medical technology company says its products are safe and its systems are being restored, but disruptions to ordering, manufacturing, and shipping have held up procedures for patients waiting on custom implants. Stryker makes surgical robots. It disclosed a cyber attack last week that damaged company networks and interfered with shipping. A pro-Iranian digital activist group has claimed responsibility. Right now, Stryker shares down by 1.4%. Recapping, Brent crude 109.30 a barrel, up 1.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Checking on Brent crude at 109. Of course, it got a taste of more like 120 earlier today as Iran continues its attacks on energy infrastructure of Gulf states and, of course, effectively has the Strait of Hormuz closed, which the U.S. Is calling to be reopened, and other allies now are actually joining the United States in that. The UK, Japan, Germany, France, Italy, and the Netherlands all putting out a joint statement today that in part calls on Iran to cease immediately its threats and attempts to block the strait to commercial shipping. But it goes on even further to say that the leaders are expressing readiness to contribute to appropriate efforts to ensure safe passage through the strait. This, of course, is after President Trump requested that U.S. allies, many of them, of course, more reliant on the energy products leaving the Middle East than the U.S. itself is, to do just that, to help get the strait opened up. The question for President Trump, though, is this now too little, too late? He seemed to suggest in the Oval Office earlier that, indeed, the time has passed.
We're defending the strait for everybody else, and then in the case of NATO, they don't want to help us defend the strait, and they're the ones that need it. But now they're getting much nicer because they're seeing my attitude. They're getting much nicer. But it's, as far as I'm concerned, it's too late.
This after he posted on Truth Social, "I'm not surprised by their action," referring to NATO allies, "because I always considered NATO, where we spend hundreds of billions of dollars a year protecting these same countries, to be a one-way street. We will protect them, but they will do nothing for us, in particular in a time of need." Just yesterday, he also drew the contrast between what he sees a lack of NATO support following the United States support in Ukraine. He said, "We've helped them in Ukraine, but they're not helping us now." We want to explore this contrast with Kurt Volker, who knows more about this than most people you will hear from today, as the former U.S. Special Representative for Ukraine negotiations and former ambassador to NATO, former U.S. ambassador. Ambassador Volker, it's great to see you. Welcome back to Bloomberg TV and radio. Is the president driving down a road that will end with the United States withdrawing from NATO?
I don't think so, because even though President Trump doesn't say so, or maybe even doesn't believe it, NATO is fundamentally in the U.S. interest. It creates a vast, secure space in Europe that is beneficial to the U.S. It's a great trading partner, investment partner. They're largest investors in the U.S., largest trading partner. It's where we have our large military bases from which we can go to the Middle East. So it is vastly in U.S. interest. He's wrong when he says NATO has never come to help the U.S. either. That's not true. After 9/11, it was the only time that Article 1 or Article 5 was invoked by NATO after the 9/11 attacks. NATO went with us to Afghanistan. They supported us in Iraq, in Kosovo and Bosnia, going back in time. The U.S. did about 15% of the load. NATO did 85%. So he just doesn't appreciate NATO, but it's very much in the U.S. interest, and I don't think anyone in the country, public, Congress, others, are going to want to see him walk away from it.
Well, if that's what's in the United States' interest, what about the interests of other NATO countries who have indicated they don't want to get mired in a conflict that the U.S. and Israel began with Iran, but at the same time, they very much, Ambassador, are going to feel the economic ramifications? Is there not going to be an economic incentive for these companies to actually have to get more active in the Middle East?
Yeah, well, clearly there is, and the statement that we saw indicates that. They were taken by surprise. There were no consultations. There was no joint operation. There was no plan as to what was going to happen. They just woke up one day and saw the U.S. attacking Iran. Then when the president suggested that they send naval vessels to escort carriers through the Straits of Hormuz, that's clearly an operation that's not going to succeed when Iran is able to take out the vessels, take out the escorts as well. They've got missiles, they've got drones. So it is not ripe for an escort operation unless there is some other larger plan of taking out everything that Iran's got or negotiating with the government if it goes that way. But I think what they did is they finally got their messaging right. The message to the U.S. should not be, no, we can't do that, just simply because it's not a workable plan. The answer should be, and now is, yes, we want to help in appropriate ways. Let's talk about it.
$200 billion, Ambassador, is the number that's being reported now the administration is about to request in supplemental funding to help pay for this operation. As someone who has your experience, I'm just wondering how you read that number. If that really is about paying for a limited operation in Iran, the president says we have a lot of munitions to replenish after providing much to Ukraine, but this is beyond what we've ever given to Ukraine. What does this tell you about timeline and resources that the administration might be considering?
Well, I think it's several things. First off, it's a psychological figure. It is designed to show that we have enormously deep pockets and we can destroy anything that Iran can put on the table. So it's meant for the psychological purpose of being enormous. In addition to that, it is exactly as you said. It is paying for the expenses of this operation thus far, as well as replenishing munitions that we have been using in this war, defending Israel prior to this. Some of the things we have transferred to Ukraine for sale that would now have to be bought again by the U.S. So there's a lot that's in this. And it's partly a message to China. We can't forget that either, that we have to signal to China that we may be running low on a few things like Patriots compared to where we would like to be, but we have plenty of money to throw at this, and we will have a robust military going forward.
Isn't that, though, why the Pentagon has its first ever $1 trillion budget? What's all that money going to?
Well, also the same thing. It is designed to build up a very, very strong and capable military to show our adversaries that they will not be any match for us, that we have very deep pockets, we have the best weapon systems, we are prepared to spend the money, and we're prepared to use force if we have to.
Okay, so clearly there is a desire to continue funding the U.S. war machine. I'd also like to ask you, Ambassador, about the Russian war machine, which is getting a bit of a lifeline, or at the very least a cash injection due to not just higher oil prices, but the actual relief of sanctions as a result of this supply problem in the Middle East. Yeah, please, what impact ultimately is this going to have?
It's really remarkable. The oil price surge is, of course, a windfall for Vladimir Putin because he sells oil and now he gets a lot more money for it. The estimates I've seen are about an extra $5 billion a month that he's going to be getting from these higher prices. But on top of that, to allow them to lift the sanctions, to allow them to sell their oil, that just doesn't make any sense because they are helping Iran. And they're providing drones, their drone technology, intelligence, and targeting. Why on earth do we want to help Russia at this time?
Interesting. As someone who is our ambassador to NATO, Kurt Volker, I'm wondering your thoughts about the repeated attempts to lob missiles at Turkey. This, of course, could resolve in an Article 5 violation if Turkey, in fact, pursued it. Why do you think President Erdogan has chosen not to do that? And if he did, would we see a much wider war with Iran?
I don't think that a couple of missiles would be viewed collectively within NATO as an Article 5 attack. It's not threatening the territory of a NATO country in the sense that Iran's going to be taking over part of Turkey. And NATO and Turkey together have shot down these missiles. So we've defended that territory. And I don't think anyone in NATO wants to escalate into a wider war, a whole regional war. And Turkey is going to have to live in that neighborhood after this operation is over. So I don't think it wants to have as hostile a relationship with Iran as it could turn into if they can avoid that. They may even see themselves as part of a solution at some point. So I think they want to keep their powder dry as well.
So when we consider solutions, Ambassador, obviously you worked in diplomacy. Do you see a path forward for diplomacy here when the U.S. is openly saying we don't even know who we should be negotiating with?
Yeah, well, look, diplomacy works when the balance of forces are right to achieve the goals. So this is why, for example, nothing is working in negotiations with Russia's war in Ukraine, because Russia just wants to take over the country. They don't feel any pushback, so they're not going to negotiate seriously. In this case, it depends on how President Trump frames our goals. And I have to say, it is still unclear what the goal actually is. He seems reluctant to say regime change. But I think that is the only thing that will assure future security. If we have a different regime in Iran that we can then deal with, that'll treat its own people well, will respect its neighbors, have renounced nuclear weapons. If we have that, then I think we can build security. If we leave the current regime in place, weakened for now, it's going to be a source of terrorism. It's going to be a threat to shipping and oil and neighboring countries in the Gulf region for years and years to come. So I think we have to clarify that that should be the goal, regime change. But if it's not, if President Trump doesn't want to do that, and he's prepared to live with a weakened form of the current regime, then we got to say that, and then you negotiate something different. You try to negotiate a security framework for shipping in the Persian Gulf that a lot of countries are going to have to participate in to police.
You talked about the psychological impacts of some of the dollar figures that are being thrown around right now, Ambassador. $1 trillion defense budget, a $200 billion supplemental. To what extent are these reports about the president considering thousands of U.S. ground troops also part of the psychological warfare that's at play? Or are these leaks to Reuters and other agencies correct?
Well, there are two things. It is part of the psychological warfare to let the Iranians think that, okay, we may actually be coming with ground troops, and so maybe they should call an end to this. But on the other hand, it is to actually give the president the option. And one of the options that has been kicked around is not taking over the entire country, not going to Tehran, but taking over the oil fields, controlling Iran's energy export and production, this Karg Island terminal, the oil fields in the south, controlling these areas so that you're denying the regime the financial benefit of having them, and you're also more capable, not fully capable, but more capable of protecting shipping in the Gulf.
Ambassador, we only have about a minute left here, but as we talk about this conflict in the Middle East, knowing President Trump and others in the administration are now also openly talking about the Cuban regime, they've expressed, of course, desire when it comes to taking control of Greenland as well. Would you be taking your eye off those other balls at this point?
Well, no, I think with Greenland, if I were Denmark, I would be actively proposing what could be done to assure security in the Arctic. Everything is on the table in terms of possibilities. Doesn't need to be sovereign U.S. territory. We can do this together. So they should be proposing that, and I wouldn't sit back and wait to see if Trump wakes up and talks about Greenland again. On Cuba, this is much more a result of our operation in Venezuela and strangling the Cuban economy. That is likely to snap at some point, and we're going to have a lot of responsibility in the Caribbean to make sure that there's just not a humanitarian catastrophe that emerges.
All right, Ambassador, thank you so much for joining us. We appreciate your time and insight. Ambassador Kurt Volker, of course, former U.S. Special Representative for Ukraine negotiations and former ambassador to NATO. And we'll have much more coming up on the late edition of Balance of Power. Joe Matthew and myself, Kaylee Lyons, will see you then at 5 p.m. right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, it is Thursday, March 19th, 2026, across Bloomberg platforms. I'm Carol Masser, along with Tim Stenivek, live here on Bloomberg Business Week Daily. You have got stocks under pressure again. U.S. yields continuing to move up. We've kind of seen this trade actually globally when it comes to the bond trade. And increasingly, we're looking at a war and a military spend without an end in sight. Just check out the U.S. war in Iran update. We got that earlier this morning with U.S. Defense Secretary Pete Hegseth.
I'm jumping in, Carol, because we got a redhead crossing the Bloomberg terminal. NASA revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of propelling astronauts to lunar orbit. This is according to people familiar with the matter. I'm taking a look at what's going on with Boeing shares as we speak. They're down about 3% right now. They've been down throughout the day today, but this just another hit for Boeing.
All right, so that is something we're watching. Really, though, our focus over the next 60 minutes is about the war, the military spend, and as we mentioned, the Defense Secretary weighing in on that this morning.
Well, as far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have, ensure that our ammunition everything's refilled, and not just refilled, but above and beyond.
All right, that, of course, was Defense Secretary Pete Hegseth this morning with a briefing on the U.S. war in Iran. So no doubt about it, the war is definitely top of mind. So coming up in the next 60 minutes, we're going to get into the billions being spent. We're going to talk with Sheila Kayalu. She is over at Jefferies. She covers the defense sector. We've talked about it a lot with her. So we're going to have her kind of crunch the numbers. She's also been in D.C. this past week talking with the Defense Department, the Pentagon, officials there. There's been an event going on. So I'm curious what she's hearing, certainly from officials.
Looking forward to that conversation. Also, how the weeks of war are reshaping the global gas market for years to come. We're talking a lot about oil, but nat gas, the moves higher in nat gas that we've seen in such a short time, those are moving higher so much, Carol. Certainly top of mind for us and also for Europeans.
And then we're going to kind of tie it all together. The military spend, the higher energy prices, inflation. What does it mean for global economies and global markets? We're going to do that with the head of fixed income strategy for Merrill and Bank of America Private Bank. He's sitting down with us. We're going to get to him in just a moment. First up, though, let's get to the trade. We've got a couple of hours to go. Here is Charlie Powell.
All right, thank you very much, Carol and Tim. Yes, the Dow, the S&P, NASDAQ, all in the red. Do want to repeat the headline Tim brought us just a few moments ago. Boeing shares down 3% right now. Boeing leading the Dow Jones Industrial Average lower. This as NASA said to be revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of sending astronauts to lunar orbit. Again, Boeing shares down right now by 3%. Dow Industrials down 392 as energy rises. The Dow down 0.8%. S&P 500 index down 46 points now, down 0.7%. We're off session lows. NASDAQ down 187, down 0.8%. The VIX just above 25 now, a day after the Fed announcement. 10-year 4.27%, the 2-year 3.85%. Gold at $46.06 the ounce, down 4.4%. And again, WTI, West Texas Intermediate crude now flat on the day at 96.33 a barrel. Brent, the global benchmark, 108.37, up now by about 0.9%. Price of oil and nat gas jumping as escalating attacks in the Persian Gulf threatens long-term damage to major energy facilities. Indeed, a topic we'll be exploring right here on Bloomberg Business Week Daily. And by the way, 20% of the world's natural LNG, liquefied natural gas, comes out of the Gulf. European nat gas right now up 13.1%. Again, West Texas Intermediate crude now little changed, up under 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, got it, Charlie. All right, well, each week, the world's largest liquefied natural gas plant remains shut. The world loses the equivalent of enough energy to power Sydney's homes for an entire year. Qatar's Ras Laffan plant closing earlier this month. You know that. We've talked about it. After an Iranian drone attack, the first interruption to supply in 3 decades of operation. Now, after further hits in retaliation for an Israeli strike on the vast South Paris fields that happened yesterday, the wider complex has suffered, Tim, what Qatar describes as extensive damage.
With more on how weeks of war are reshaping the global gas market for years to come, we head to the Bloomberg News Washington, D.C. bureau. And to our reporter who covers the LNG market, Ruth Liao, joins us. Ruth, I want to talk a little about the infrastructure in the Middle East and the idea that this could shape the global gas market for years to come. At this point, what has been taken out when it comes to natural gas?
So this has been a significant development for this ongoing crisis. The latest attacks, as far as we know, have struck the liquefaction facility at Ras Laffan, which is the largest on the globe, and really massive equipment that could take much time to rebuild, and that's only presuming that there would be a let-up in the conflict. So having all of that uncertainty has really disrupted global markets with end users in Asia and Europe looking at elevated gas prices for time to come.
Well, and so I'm glad you went there in terms of what Asia and Europe is watching, because we do talk about distinctions between who is being so served by the region. President Trump saying earlier today, we don't use the Strait of Hormuz, and so the U.S. isn't really impacted. Is he completely correct on this? And then there's the reminder that markets are global, so what happens around the world often does happen to possibly impact everybody.
Yeah, the U.S. has become the largest LNG exporter globally, overtaking Qatar in terms of production. But this is such a massive supply shock that even with all of the LNG facilities in the U.S. running as much as they can, it's not going to be enough to backfill that deficit. So the impacts that we'll see will have immediate consequences for end users, Southeast Asia, the ones that are looking and using this LNG for industrial and heating purposes, for power utilities. Will there be changes in demand? This is what experts are expecting will happen because, again, this has been such a sudden supply shock.
Ruth, what about Europe? And I think back to the beginning of Russia's invasion of Ukraine and the supply shock that we saw then. And certainly it was in a different time of year when it was set to be cooler than it is set to be in the months moving forward. And that was a big supply shock and really affected Europe's economy. What about the effect on Europe with this shock?
Yeah, the distinction, I think, with the invasion of Ukraine is that it was mostly pipeline gas that was dramatically reduced by Europe, and LNG was there to backfill for that lost supply. The U.S. stepped up to provide a lot of the LNG cargoes then, and then we saw a redirection of flows. This time around, as you mentioned, storage will be on top of mind for the next few months as storage needs to rebuild. But really, if there was a time for this to occur, it's during what traders call the shoulder season, relatively lower in demand before there's the high cooling season for the summer in the Northern Hemisphere, and before there's going to be winter demand as well.
Hey, Ruth, one more question before we wrap up here. The story that you've got out on the terminal, you and the team, it's headline, Weeks of War Reshaping Global Gas Market for Years to Come. I mean, this is, where we're trying to get to, the timeline of this war and when we can kind of start to not think about the energy shock. But is this something that is going to last and impact these markets for a while, especially maybe it is for the European and Asian markets?
Given the uncertainty in terms of the extent of damage, not knowing how long it would take to repair, as I mentioned, this is massive infrastructure, not just in scale, but in terms of the type of technology that's used. It really is clear that I think those will have an enduring impact. It's not even just a matter of, clearing the Strait of Hormuz and allowing for the traffic to flow again, but really being able to have the labor, the equipment, the repairs, the workforce, et cetera. All of that still needs to be laid out. And could take a significant amount of time.
Yeah, it maybe makes sense too why you're seeing some of the energy equipment companies, the drillers, they're really rallying in today's session because you do think about what kind of demand will be for them in the future. Ruth, thank you so much. Really appreciate it. Ruth Liao joining us. She is Bloomberg News Washington DC bureau. She's there, and she of course covers the LNG market for us here at Bloomberg.
Well, global energy markets affecting global markets overall. It played out too in global bond markets as bonds tumbled worldwide. Investors rushing to bet on higher rates after key central banks signaled fresh concern that the surge in oil prices will deliver an inflation shock. Carol, 3 weeks into the war, the fallout unleashed a major repricing across markets by dashing once widespread expectations that central banks would cut rates this year to spur growth. It's having big implications.
Yeah, I mean, I feel like we are thinking and talking about the fixed income world a lot right now. With us to do that even more is Matthew Desock. He is Managing Director, Head of Fixed Income Strategy for the Chief Investment Office within Bank of America, also helping drive investment thinking, supporting B of A, Private Bank, and Merrill. He joins us here in studio. How are you?
Doing great. Thanks for having me.
Doing okay, and good to have you here. Global rates. The global bond sell-off. We kind of understand what's going on here, but are we entering, Matt, in your view, a new era when it comes to the global bond trade?
We're not overly concerned about it, particularly from a U.S. perspective, right? If you think about it, what Japan is going through now with the BOJ being a little bit behind the curve, catching inflation, we've been through that. We got through that 5 years ago. The best way to look at it's real yields, right? Inflation-adjusted yields. Not exactly, but, approaching 2% on 10s, approaching, 2.75, getting close to 3 on 30s. That looks great relative to the rest of the globe, right? Rest of the globe, you got, Germany probably, 75 basis points on 10s. You got Japan, 35 to 50 basis points. Our real yields look quite attractive here. So if there is more of a sell-off, expect it more sort of in the developed markets around the world, not as much in the U.S. We've already adjusted to higher inflation. Now, I'm not saying there's not more upside here.
All of it? Like how do you factor in the war? Are you we've been trying to assess what we got from Fed Chair Jay Powell yesterday about kind of looking through the energy shock, but time will tell, right? Whether or not this is a longer problem.
But time will definitely tell whether this is more of a problem. And you can look at it sort of either way, right? We were joking before, you could look at it that, energy prices are inflationary. All the spending on AI CapEx is inflationary.
Right.
We haven't hit the PCE target in 5 years. We can't hike rates, right? You got to hold them steady. Or you could look at it a different way. You could say, actually, productivity is going to come through and it's going to lead to higher growth. You saw that in the SEP. They ticked up a little bit in terms of their expectation for growth. You could say, actually, AI is going to be slightly disinflationary. And you can say, gasoline prices, energy prices up over the short term, much like we talked about tariffs last year, doesn't necessarily lead to economy-wide inflation. It's inflationary pressure, but you need spending on everything else at the same level and those higher prices to generate it. So we're not overly concerned about long-term inflation from a near-term spike in energy prices.
Which of those two views do you think is right?
It's a Rorschach test. You'll learn.
I mean, those are two totally
right.
Yeah, and look, it's
you're going to learn more about me from that answer than you're going to learn about what's going to happen in the economy.
Sounds like a man trained in the liberal arts, but truly, I mean, which one is more likely?
That's a tough place to be, too.
So I'm being flippant, but I mean this because you could be a policymaker on the FOMC. And you could have a principled view, depending on which mandate you think is which is more important. Is it maximum employment or is it price stability? So the question to me is not as much what is the right answer or what is my answer. What is the Fed chairman's view? What does he think?
Which Fed chairman?
Assuming, and by the way, I think Powell obviously is a professional, did a wonderful job yesterday. He is setting up the next Fed chairman, if there is a next Fed chairman near term, he's setting him up to be able to do whatever he wants.
Wait, I think it's even wild that you even said if there's a new Fed chairman.
In the near term, it's possible.
Okay.
Chair Powell said himself yesterday that he's unlikely to step down if there is not a resolution to the legal challenges. So it's certainly possible, as he said yesterday, that he stays on pro tem. But let's assume we work through this.
At some point.
We work through this, and Kevin Warsh gets appointed and nominated. The real question is, what's his view? His view's been clear. He believes, and we've talked about this at Chief Investment Office, whether it's CIO, Chris Heisey.
Yeah.
This feels a lot like the mid-'90s in a lot of ways. We had a doubling of the Fed funds rate from 3 to 6 in '94. People worried about, the yield curve inverted, a recession's coming. Everyone nervous. Didn't happen. Greenspan correctly pivoted. We had the longest recession at that point in economic history, and tech took us through. It feels very much like that now.
Yeah.
That we've had that bond bear market from the hike in rates. We might get a productivity boom. And folks, let's break it down here, right? This 2% inflation target, it is not based on U.S. financial history. It's got zero, zip, niente, nada.
But it's still a target.
But
it is a target for now. They haven't hit it in 5 years. The average inflation rate in the U.S. and CPI has been calculated is 3.3%. So there's nothing to be overly concerned about, except for the target on a 3% inflation rate. Nominal GDP, the stock market, the economy, corporate profits, spending, income, they all do fine at 3% inflation. So it's really a choice for the Fed to make. And again, as I'll say it again, Powell's a professional and is setting up a new chair to be able to position it how he wants. He's not thumbing the scale in any way.
Well, so how does a new Fed chair, how does a Kevin Warsh as Fed chair want to see things progress? I mean, do you see the rate path differing if this was indeed the second to last meeting that Fed Chair Powell decides over?
Our belief for now is that you're probably going to get another 2 cuts this year, right? We saw how candidate Warsh presented himself. And again, he's giving that story that looks much like the mid-90s, that AI is going to be productivity enhancing and will allow further U.S. economic growth that's slightly disinflationary. That is the 90s parallel. So to your question, Tim, is whether that's right or not, you're not going to learn near term, but that's his view. And so we expect him to at least try and deliver 1 rate cut before the midterm elections. That's November. So we got June, July, and September to deliver 1 rate cut, right? So expect 1, and then maybe another one before that.
But if everything is so good, Matt, taking out
I didn't
war,
say everything was
well, but you sounded like earnings. You talked about a lot of good things that were going good. Why do we need a rate cut?
I said in an inflation environment of 3%, all those things are still fine. I'm not saying the economy right now is fine. The economy right now has issues.
Right.
The slow growth job market is a significant issue that might need a rate cut or 2 to address. Again, but that's not when do you really worry about an economy? Not when job growth slows, when people started getting fired, right? And we're not seeing that unemployment claims. We're still ticking around at 200, 250.
Low fire.
So in the low fire, again, when people start to lose their jobs or afraid their wife's going to lose their job or their brother, then people retrench. We're not seeing firings, right? We are seeing slow job growth. So it's not necessary for the Fed to move a lot either direction.
But do people retrench if they think gas is going to be $1 more a gallon than it's been for months?
Absolutely. If it goes up and stays there, but that's not what the oil market's telling us. It's telling us the first month contracts, almost doubled.
Yeah.
But not the 12-month.
Yeah,
it's only up $10 to $15.
Yeah,
the market is saying...
He's been obsessed just watching the
right? The market is saying, again, and the market is smarter than me. It's telling you, it doesn't tell you what the resolution is going to be, but it's been pretty clear this is not going to be, in the market's opinion, not a sustained increase in energy. And again, you would need that sustained increase, and you would need the consumer to spend just as much on everything else to keep inflation-wide problem across the economy. Consumers will only do that if they dip into COVID savings, which they don't have, spend a lot more real income, which they're not getting, borrow against their houses to fund consumption like they did in 06. We're not seeing that. So again, energy is an inflationary pressure, but to create inflation, people need to spend as much on gas and the same on everything else. If gas prices go up, they could retrench. It could create demand destruction for the rest of the economy. Energy prices can in some way act like a rate hike, believe it or not, right?
Yeah, absolutely, right? So, okay, 30 seconds. So what's your advice to investors?
Our advice to investors, again, generally speaking, we're not saying investors have to be tactical. If they want to be strategic and hold a portfolio, not move it, that's fine. If they want it to be tactical, we are positive on the economy. We're very, very positive on the U.S. versus the rest of the world. The more dangerous the rest of the world gets, the unassailable competitive advantages the U.S. has, demographically, geographically, institution-wide, education-wise, we are believers in the U.S. So we're overweight U.S. versus the rest of the world. We're underweight fixed income, not because we don't like fixed income, but just to fund our equity overweight. We're not long or short duration.
Interesting.
We want to be neutral duration right now, but if you're looking for opportunities for high tax rate investors, long munis look quite attractive at the moment.
All right. Great stuff. Come back soon. Really appreciate it.
Thanks, Carol. Thank you, Tim.
Managing Director, Head of Fixed Income Strategy for the Chief Investment Officer over at B of A. When we come back, we're going to talk a little bit more about the war in Iran, and we're going to talk defense companies. That when we return.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are now looking at a decline for West Texas Intermediate crude oil, down 0.6% right now at 95.77 a barrel. Brent off session highs 108.13 right now. Barrel of Brent still higher, up by 0.7%. But again, right now, WTI trading lower by 0.6%. Crude 95.77 a barrel. Stocks do remain in the red with the Dow, the S&P, NASDAQ all retreating. S&P 500 index down 35, a drop there of 0.5%. Dow Industrials down 321, down now by 0.7%. And NASDAQ lower by 132, a drop there of 0.6%. The VIX is now below 25 with a 24 handle. The 10-year, a day after the Fed, 4.27% with a 2-year, 3.83%. Gold down 4.3%, 46.10 the ounce. And again, WTI, West Texas Intermediate crude, 95.77 a barrel, down 0.6%. Brent up by 0.7% at 108.18. Keeping an eye on European natural gas, up now by 13.1%. Oil and gas prices jumping today as strikes on Gulf facilities escalate. Sources tell Bloomberg NASA is revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of propelling astronauts to lunar orbit. Boeing leading the Dow Jones Industrial Average lower. Boeing shares right now are trading down by 2.7%. Briefly, Uber planning to invest as much as $1.25 billion in car maker Rivian Automotive to help launch a robo-taxi fleet. Recapping, S&P down 0.6%. The big news, though, the retreat for West Texas Intermediate crude, 95.77 a barrel, down now by 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stanovic, live here on Bloomberg Business Week Daily. Now, as we heard from the top, or at the top, I should say, U.S. Defense Secretary Pete Hegseth confirming that the Trump White House is asking for an additional $200 billion from Congress to pay for the war against Iran, even as earlier this morning he also argued that the campaign was ahead of schedule and disputed that the U.S. was getting embroiled in a quagmire. President Trump, though, also addressing the military situation earlier today from the Oval Office, specifically talking about stockpiles.
Fortunately, we have a lot. We have a tremendous, unlimited supply of what you'd call middle and upper middle armaments and military equipment, munitions, armaments, but munitions in particular. Raytheon is building 4 factories. Lockheed is building 5 or 6 factories, and they're building them fast. They are now building a tremendous, there's never been anything like it, what's taking place right now. So we're in very good shape, but we want to be in the best shape we've ever been in.
All right. So are we in good shape? We want to ask that of our next guest.
Sheila Kaielu is with us. She's managing director in equity research at Jefferies. She joins us here in the studio. That was President Trump at the White House earlier. He said a lot that we want to unpack with you. Are we in good shape when it comes to munitions?
You were in D.C. this week, right? At a big event.
We attended a conference called the MacLeese Conference. Jim MacLeese is an expert in bringing folks from the Department of War together, whether it's Army Secretary, Navy, Air Force, and critical weapon systems. And the theme there, very, clearly all appointed by the administration, so there's a view there. $1.5 trillion budget is going to come out from the president's request at the end of April and May. That's kind of new. It's delayed. We thought any day now, but we know it's going to be at the end of end of April, and they're sticking to their $1.5 trillion. And I don't know how Democrats will align with that. With that, President Trump's comments, I don't know if we're at unlimited stocks of missiles and munitions, but that's one thing that's clear from all the DoD employees, is all the Department of War folks, is that missiles is the best part of the market in terms of growth to invest in for investors. And that's why you're seeing, 4x production increases. So what the Department of War has done, working with multiple primes like Raytheon, like Lockheed, is to put forward frameworks on missile production, saying over the next 7 years, we'll guarantee you production increases on a PAC-3 missile from 600 units a year to 2,000 units a year, which is a big revenue bump. And we will guarantee that for the next 7 years. So can you build enough capacity to do that?
Can they?
Well, they're working on it, and I think that's a theme that the Department of War, more than anything, could align on, whether it's Republicans or Democrats, is that, there isn't unlimited supply. And what we do manufacture from a missile perspective is quite expensive. We're doing it in low quantities, so we have to do it in larger quantities and also find ways of manufacturing cheaper munitions and missiles.
The president's comments about what Raytheon is doing, building 4 factories, Lockheed building 5 or 6 factories, does that align with what these companies have said publicly?
Yeah, we're seeing 30% increases in CapEx for basically 15 to 20% of their revenues. We continue to see 8%, even though we're hold rated, 8% upside in our estimates if Raytheon and Lockheed could actually meet these frameworks. And those are only 3 that have been announced thus far. I think you'll see more to come. There's dozens of offensive and defensive missiles. We put out a missile primer today, and folks were emailing me, well, you missed this one. Well, you missed this one. I was like, well, there's so many opportunities to continue to invest. And I think that's one thing the government will agree on.
I mean, it's a whole supply chain, right? It's the suppliers. I mean, when you look at it, we obviously talk about the big defense companies, whether it's Lockheed Martin, whether it's RTX, but there's a ton of American companies, right, that are going to be impacted by this.
We're trying to find ways that might not be as obvious, that have also really great margins associated with it, and might not have to have the massive capital expenditures without the share repurchases. So like Woodward is a great way to play it. Solid rocket motor providers, even HEICO that does missile components, Elbit in Israel. So there's a whole slew of ways to play missile defense and offensive missiles.
So not just U.S., obviously, global.
And I would say Howmet and Woodward are great ways to play it that traditionally people might not think of.
Can I just ask you, what is the supply chain like for defense companies? Is it a global one?
No, it's mostly in the U.S. Okay. It's U.S., but what the government's trying to do is dual source it in the U.S. So having multiple suppliers, because the capacity increases are going to be pretty significant.
So I hear you talking about the opportunity that these primes have ahead of them. Yet as you mentioned, you still have a hold rating on RTX, Northrop Grumman, Lockheed Martin. What would prompt you to change those to buy ratings?
I think the Department of War, one of the things that they've done is has guaranteed the top line, but they haven't guaranteed margins associated with it. On top of that, the primes have to invest their own capital, cut their repurchases in order to invest in the CapEx themselves. So at the end of the day, it doesn't change their EPS algorithm much. It actually, keeps it the same, even though they're investing for the Department of War much more. And that was part of the executive order President Trump put in at the start of this year. He said, I'll give you these frameworks, I'll boost the budget. But we haven't seen margins associated with it. And of course, some visibility as they finally have 5-7-year contracts should be helpful in margins. Then they don't have to renegotiate a contract term every year.
Having said that, we have an administration that when it identifies something as important to national security, they get kind of more aggressively involved, whether it's the semiconductor space, whether it's rare, earths and rare minerals. And I just wonder, is there something more that we would anticipate from the administration, this administration, when it comes to defense companies, whether it's taking a stake, making some further investments? I'm just curious what you are hearing.
I think they'll continue to do that, whether it's providing frameworks, so they'll allocate the dollars so that it'll be big contracts, so the primes will have no choice but to invest. It won't be, kind of wishy-washy, like we're only going up 5. It'll be 600 to 2,000. So the CapEx investment is needed, is critical. There's a 7-year time horizon. So first, we'll see more long-term frameworks.
Right.
Second, I think you could see some stakes. We've seen some of it already.
Yeah.
Of course, these primes don't have infinite capital, and they're already spending a big chunk of their CapEx now associated with missiles. So if there's more and more needed, you could see the government get involved.
Can I just ask too, shift to drones or more drones? I think this war has been fascinating. Well, fascinating is a bad word to use because it is war.
We've seen the way that it's fought different than previous wars.
Yeah. Is there a shift in terms of the kind of weapons that these companies want to be working on or are working on in the future? Or does that kind of get sidelined as a result of these orders from the government?
There's so much going on, right? So with Russia and Ukraine, I think you've seen 70% of the fatalities associated with drones. But that's not the kind of drone warfare the U.S. might use. So we'll need more maneuverability, more electronic warfare with drones. But the key, I think, whether it's missiles, munitions, or drones, is ability to manufacture it today, readiness, and scalability, doing it in the hundreds of thousands, not only 100 or 200 or 2,000 units even, which is what we've seen from at least Russia, Ukraine, Iran is they manufacture missiles in the thousands, not smaller quantities like we do.
So how are you looking at magazine depth in the context of comments that we heard from the Secretary of Defense earlier today? He said in the Oval Office, missiles being shot are down over 90% since the beginning. One-way attack drones down over 90% since the beginning. The U.S. is going after Iran's industrial base. Does that mean a lot of the munitions that we've used up or have used, those will not be used in the coming weeks or months, depending on how long this goes, just because Iran's capabilities have changed?
I'm not sure how Iran's stockpiles look, but what we're doing is very expensive. I don't know how much the war is costing, but it could be $10 billion a day. So
$200 billion more is what, right?
Yeah, so over the last 18 days, it's very expensive what we're doing. So we have to, a theme is like readiness, scalability, and also affordability. We can't manufacture shoot down objects with $5 million missiles when they have $50,000 missiles. So we have to come up with ways, and that's what's really driven this administration has been super supportive of startups, the defense tech names in the world. It's led by Andrew, that's more publicly known, but there's a whole bunch of names we cover, like Voyager, that are out there trying to take a piece of the pie that was previously not given to them.
Hey, I want to bring in a question from our Wayne Sanders, who we talked to a lot about. He's down in Washington and part of our Bloomberg intelligence team, but he said, which programs are most at risk of funding versus revenue due to execution or industrial bottleneck?
That's such an interesting question because I asked Jules Hurst, who's the DoD comptroller, so think of him as the DoD CFO managing about $1.5 trillion. And this week I asked him, what do you think is going to get cut if the Democrats don't approve your $1.5 trillion budget? And he's like, I had a hard time getting to $1.5 trillion. I had to cut to get there. And I was like, the budget today is $1 trillion for context. So 1.5 is a significant increase. So the Republicans are going for full steam increases across everything, essentially. And I think historically what's been thought of as areas that will be reduced is F-35, a fighter of the past, or helicopter spending. And we're seeing that obviously come into the forefront of conflicts like Venezuela and even Iran, right? Where we're using older aircraft and the need for it, it's kind of reignited that need.
Can you believe we're talking about the F-35 as being something of the past, given how much we spent on it?
For investors, it was something of the past, but it's actually driven a revival in Lockheed stock, which has been leading the primes in terms of performance, as we've seen it used multiple times. So it's had a bit of a rebirth.
Okay.
All right.
Do we have time for a
30
quick question on airlines?
Like, what do we need to know right now?
I think, basically this is a month of COVID for airlines in the Middle East. You're seeing capacity cut 80%. So a lot of work is being done on how does that impact global air traffic, up 5%, Mideast accounts for 10%. How does that hit, number one, global air traffic, global aftermarket demand? And then how does that hit sticker shock for folks buying airline tickets in the U.S. as oil goes to wherever it's going to go?
Yeah, we talked about a lot of travelers like buying tickets in advance before this stuff kind of hits.
I've been doing that. So.
Lock the doors. We're not letting her go. We're just going to continue. We're going to, as Tom Keene would say, we're going to rip up the script. You are a gem. Thank you so much.
Thanks.
Sheila Kayalu, she's Managing Director in Equity Research over at Jefferies. Just a must when it comes to defense and airlines. All right, when we come back, we're going to talk about a different battle of sorts. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Crude futures in the U.S. have erased earlier gains. Investors are weighing comments from President Trump and Treasury Secretary Scott Bessent. West Texas Intermediate crude now down by 0.2%, 96.13 a barrel. Brent does remain higher. Barrel of Brent crude up 1.6%, 109.08. But bottom line here, WTI lower by about 0.1%, 96.26 a barrel. Earlier today, U.S. crude did spike above $100 a barrel before easing. Brent was above $119. Again, a barrel of Brent right now at 109.18. The Dow, the S&P, and NASDAQ, they're all in the red. S&P down 49 to 65.75, down 0.7%. Dow Industrials down 426, down 0.9%. The NASDAQ Composite Index down 182. For NASDAQ down 0.8%. The 10-year at 4.28%. The VIX, by the way, below 25 now. 2-year yield 3.84%. Gold at 46.05 the ounce, down 4.4%. WTI down 0.1%, 96.26 a barrel. Wall Street lending giants will be getting relaxed capital requirements under proposals unveiled by the Fed today in a move that could potentially unleash billions of dollars for lending, share buybacks, and dividends. Citigroup shares up 0.3%. Bank of America down 0.3%. Wells Fargo down by 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we talk a lot as of late about how something like artificial intelligence is going to be impacting all of us as workers. Yes, perhaps increased productivity, also making tasks and maybe certain jobs obsolete. But another thing that we often talk about is health, wellness, or lack thereof, that it can really matter in terms of how we are as workers and how it impacts us in the work environment.
Yeah, on that, a Mayo Clinic Proceedings study, 2023, had found that menopause symptoms cost the U.S. economy approximately $26.6 billion annually, including $1.8 billion in lost work time. The research indicates that 11 to 15% of women experience adverse work outcomes, such as missed work or reduced hours, due to severe symptoms.
All right, so let's get to the Bloomberg Business Week Women's Health segment. We focus on key issues in developing technologies impacting the present and future of women's health around the world and health really more broadly. With us is Dr. Susan Loeb-Zeitlin. She is Assistant Professor of Clinical Obstetrics and Gynecology at the Weill Cornell Medical College. She's founder and director of the Weill Cornell Women's Midlife Center, and she's joining us here in studio. Welcome, welcome.
Thank you so much.
Tell us, first of all, like we talk often about the disconnect that so many different women's issues don't get studied. Tell us, though, what's going on when it comes to menopause and research in that area.
So definitely not enough research, but the research has sort of gone up and down, and that's really affected menopause care over the years. I can expand on that. Hormone therapy came out in the 1960s, and that was great, but then we saw an increase in endometrial cancer in women using it. That dropped the use. Then we realized you needed to take estrogen with progesterone. Then we got an increase when we realized, okay, that would fix the problem with endometrial cancer. And then over the years, there were studies showing beneficial effects, maybe preventing, helping every part of our body from head to toe, but then we saw maybe it wasn't so good. And then in 1998, a randomized controlled study, which you might be familiar with, the Women's Health Initiative, came out. And that was the first a huge randomized study comparing the effects of estrogen and progesterone to nothing. And we saw in the early analysis of the study, it was cut short because it was showing an increased risk of breast cancer, stroke, and heart disease. So the use of hormone therapy plummeted in 2002. I remember where I was when that study came out, and we pulled hormones away from women kicking and screaming. But now that's 20 plus years since then, and we're starting to see an increase again because that study, where the data was not so well interpreted and released, has now been established that hormone therapy is safe for many women to use.
But not for everybody.
Not for everybody. It has to be very individualized.
And where are some challenges with that right now? Because it seems like everywhere you look, you know, whether it's social media, whether it's, you know, a mainstream publication, they are talking about this for treating menopause or even perimenopause. What's the right balance here?
So social media has been amazing because it's really gotten the word out about menopause care, right? So that's fantastic. But there's a lot of information that's being delivered on social media that's not based on evidence. There are some people that say everybody should be taking hormone therapy, but really the care of menopause women is so individualized. What's right for your friend might not be right for you. And hormones are not right for everybody. We have clear indications from the FDA about who should be taking hormone therapy. That is for the treatment of severe and bothersome hot flashes and night sweats, which maybe 75% of menopausal women will experience. So many people have that criteria. And also for protection of bones, prevention of osteoporosis. The other things, and there are many other symptoms that women going through menopause experience, are not necessarily reasons the FDA approves for the use of hormone therapy.
So, yeah, I mean, oh man, we've had so many conversations around here at Bloomberg about just women and health and not being, you know, being under-researched and just not getting as much time and attention. I think what's really important, and we talk about health in the workplace, and let's just focus on women, that whether it's, you know, menstruating or menopause, like these are things that can impact women in the workforce, and it's not always understood or respected. And so what do we need to understand, especially when there is somebody, let's go, you know, since we're talking about menopause, when a woman is going through menopause, what we need to understand that transition, first of all, why it's important for women to pay attention and the medical profession to pay attention, because it really plays into their longer term health. And then what do we need to have as an understanding in the workplace?
Those are great questions. I think the menopause transition is a critical time in a woman's life for many reasons. It is what we do during this time in our life can set us up well to live long, healthful lives, right? So there are studies that show that severe hot flashes can actually be a risk factor for developing heart disease. So they're not so benign, and they should be treated. And as far as what goes on in the workplace, you know, some people might have changes in their menstruation, right? So they might have heavy menstrual flow and need time to take care of that. They might have symptoms that are bothersome, and they might not be able to sit at their desk for as long. And I do think that educating people and the workplace about what women are going through during this time is what's critical to helping women be more productive. And that study you cited is such an important study.
We talk a lot about the supply and demand challenge when it comes to demand for healthcare and the supply that doctors actually provide. And I'm wondering, from a training perspective, as more and more attention gets focused on different parts of our lives and different parts of you know, people we love lives, like where that comes into training the next generation of doctors, and if we will start to see, because we talk a lot about the gap between women's healthcare and men's healthcare, will we start to see that gap shrink as a result of more people being trained, more awareness about this, and more doctors coming into the field? You're kind of shaking your head.
We are working on that, but we've got a long way to go. I mean, not very recently, studies of OBGYN residents, that's not residents in all the fields, but OBGYN residents who do this, less than 20% feel like they have received adequate menopause training. And only about a third of the residency programs have an actual menopause curriculum. So we're working on that. Remember, up to about 40% of a woman's life is spent in menopause. So many of our healthcare resources in women's health go to the reproductive years. But our goal is to really make sure this time in women's life is addressed.
How does it compare with kind of time and attention spent on aging overall for individuals? And I guess I'm almost trying to make a men-women comparison, but, you know, aging, is that focused on?
I think generally starting to become trendy, but not as much as it should be. I think the longevity term you hear a lot about right now, but I don't think there's a lot of research being done in it. We're getting there too.
Yeah, it's kind of fascinating. What should an individual, a woman, be asking themselves right now? Just got about 20 seconds about when they're thinking about what you were talking about and what they should be asking of their health professionals.
I think women should be comfortable discussing all of their symptoms, some of which are uncomfortable to discuss with their providers, and they should be finding a provider with whom they can speak comfortably, openly, and who has evidence-based care that they're delivering.
Always important. Thank you so much. Dr. Susan Loeb Zitlin, she is the founder and director of the Weill Cornell Women's Midlife Center, joining us right here in our studio. All right, we're coming back. We're taking a look at the markets and stocks on the move.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we just want to mention a headline crossing, which makes me scratch my head a little bit.
Okay, go ahead.
Jeff Bezos, first of all, I think it's from the Wall Street Journal. Jeff Bezos aims to raise $100 billion for an AI manufacturing fund. So it's basically like they're becoming investors. Like it's almost like, is it private equity? Or
Yeah.
like, we're going to build out AI manufacturing. We're going to create a fund that everybody can put money into.
Well, so I'm reading from the journal story. The fund would buy up manufacturing companies, then seek to use AI tech to accelerate their path to automation. So again, reading from the journal here, Bezos is meeting with some of the world's largest asset managers to raise funding for the project. He traveled to the Middle East. He met with the Sovereign Wealth Fund. He went to Singapore. That's according to people familiar with the efforts. A manufacturing transformation vehicle.
So basically,
is what it's
a fund that investors put, or investment funds.
Sovereign wealth funds, asset managers, and then they put money into it. Then they go out and buy these manufacturing firms, and then increase the speed at which they transition to automate their processes with AI. Are you going to invest, Carol?
Why is he doing this?
I don't know. He's not.
Is this
maybe he's not as busy
to
with,
create demand for AI? I don't know. I'm just trying to again, going back to, all right.
He was recently
TBD.
appointed co-CEO of Project Prometheus, a new startup that's building AI models that can understand and simulate the physical world.
Okay.
So probably based on the work that he's done.
Okay.
Or maybe that startup will then be used in this process.
Well, that's what I'm wondering, creating some kind of demand. All right, TBD.
The Journal has the story. Check it out.
We will. I have a
Terminal.
feeling we're going to talk about this a little bit more. S&P 500, folks, we're bouncing around on the equity trade, so we're down about 47 points, down 0.7%. Take a look at the NASDAQ 100. It is down about 0.8%, off our best and worst levels of the session.
I'm Tim Stenevec along with Carol Masser. Let's take a look at some stocks on the move today. We're joined by Bloomberg News cross-asset reporter Denitsa Sakova. Denitsa, what are you watching?
If you think it's a rough day for stocks, look at Fannie and Freddie. They were down as much as 22 and 16%. The tickers, of course, are FNMA, FMCC. It's been a really tough stretch for those companies. They're down about 70% in the last 6 months. There was so much support from the White House, and stock investors met this with a lot of enthusiasm. Of course, people were expecting after the election that the White House would take steps to release the company from government control. Trump, of course, tweeted that they want to take the company public, but we haven't heard anything for a very long time, and investors are not reacting quite well to this. Everyone's worried about housing affordability. Midterms are coming. You probably don't want to take those companies public in a time where people are so conscious about mortgage prices, and perhaps that's one of the reasons we're seeing this. And of course, we have a war in Iran, so the administration has a lot of other things to deal with.
I also keep wondering, this gets to this argument, they've always been quasi-public and they've gone back and forth here, but if this is something, should they be public entities? And I think we've talked with Chris Whalen about this, that says probably not, I think is what has been his argument. But really getting bumped up and banged around.
There's a couple good decliners, by the way.
I know, I was curious if you...
They're on my list.
All right.
Don't worry.
Ticker FNMA and FRE?
Yes.
Okay, just got to remember. Okay, let's go to Micron. This is something we talked about certainly after the close a lot yesterday, but we continue in today's session too.
Yeah, I have one more decliner, and that is indeed Micron. Actually, a pretty strong earnings report. Nevertheless, everyone cares about the costs. They're spending heavy on production, a lot heavier than investors were expecting. Capital spending will exceed $25 billion this fiscal year. Analysts were expecting about $22 billion, so pretty big gap. And clearly, this is a company that has been soaring for a very long time. The ticker is MU. It has risen 62% going into this report, so incredible rally. But Micron sales are very strong. They're expected to keep soaring. But memory prices have also been soaring, and clearly that's putting a lot of tension, even at a company that's like one of investors' favorites.
Listen, it's great for margins, right? But you've got to meet that demand, so that's why they're increasing probably their capex. But it's like, okay, great job, love the numbers, but why do you have to spend so much? But it's chicken or the egg. Like you got to build to be able to meet supply, but there's always that concern of overbuilding, right? And then, as we know, these markets are cyclical.
Where are we in the cycle when it comes to when this stuff gets online, and how much will people be willing to pay? And given that there's only like 3 providers, including Micron, that do this, they're in a pretty good position when it comes to supplying that demand.
Yeah, but the balance is hard. Innovation versus spending, it's always hard.
Yeah, investors are not always happy. I felt like for a while we were fine on the spend, and then it was like, not so much. Let's go to Darden Restaurants.
Yeah, we're going to talk about food and Olive Gardens. They're having some promotion, buy one, get one, and it's working out pretty well. The company is now having a small gain, but in earlier trading, it jumped as much as 3%. Darden now expects fiscal 2026 same-store sales to grow about 4.5%. This is much higher than what they previously saw. The positive outlook is for Olive Garden. That's where a lot of the support is coming. Some interesting things. They introduced those lighter portion menus that offer smaller, cheapened meals. That's not working so well for their margins. So some pressure there. Perhaps why
those are for
they
the
pair.
GLP-1s, right?
Yeah.
Really?
Yeah, they are.
I know.
So, but it didn't work. I didn't know.
It's not working that well.
I've
Pressure
always
on the
loved
margins.
the tour of Italy.
Like the
little fettuccine, chicken parmesan, little lasagna. Denitsa, thank you so much. So appreciate it. Check out our Stock Movers podcast. Find it wherever you get your podcasts. Do not go anywhere. The close coming your way on TV, and Tim and I, maybe we're going to get some food on radio.
He basically said they're going to try to push it through Congress. It's a question of whether Congress would actually approve this. But if they're asking for this much money, $200 billion, that at least potentially implies that this war will carry on for some time.
Global fuel prices have soared due to an escalation of the war in the Middle East. Tom Closa, chief energy advisor for Gulf Oil, says he does not think if the war ended soon that things would return to normal quickly.
And by that, I mean, we've seen damage rendered to natural gas and liquefied natural gas and gas to liquids facilities in the Persian Gulf that is going to take 3, 4, or 5 years to repair.
New research finds that American adults are spending way too much time on their phones, and it could be affecting their brain health.
A Pew Research Center survey finds that more than 80% of Americans go online at least 7 times a day. Psychiatrists like Dr. Sue Varma say.
You have to have awareness that on some level this is impairing my connections.
Doctors say too much screen time is causing everything from mood changes to memory problems, but there are things to try, like...
Am I checking the news? Can I use a newspaper instead?
Allison Keyes, CBS News.
Stocks are down on Wall Street. This is CBS News. Public health experts in Britain say they've never seen anything like the explosive outbreak of potentially lethal meningitis in one university town, which has already killed 2 young people. CBS's Vicky Barker in London.
A bacterial perfect storm. Someone carrying a particularly infectious strain of invasive meningitis must have visited a Canterbury nightclub packed with high school and university students earlier this month.
A close environment and a microbe that can spread quickly, I think, creates this explosive circumstance.
Epidemiologist Simon Kroll says the outbreak likely still hasn't peaked.
I imagine there will be more cases. Sadly, there may be more deaths.
But with social distancing rules now in place and with thousands of vaccines being distributed, he's confident the outbreak will soon be contained.
3 men who allege that actor Kevin Spacey sexually assaulted them at various times between 2000 and 2013 have settled their civil claims in London. Spacey denies the allegations. The case was due to go to trial later this year. Jennifer Kuiper, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we are just under 55 minutes away from the closing bell on this Thursday. Carol Masser, Tim Stenivek, live here in our Bloomberg Interactive Broker Studio. In fact, we're seeing stocks move up to their highs of the session. S&P now just down about 5 points. We saw a lot of selling earlier in the trade. We're now pretty much call it flat, unchanged on the S&P 500. Same story for the Dow in terms of a move up to its best level, still down about 76 points. NASDAQ 100 now down just about 0.1%, down 29 points. So we definitely are seeing not as much of a risk trade as we saw earlier in today's session.
Yeah, the S&P was down as much as 1% earlier in the session. So like you said, a change in tone at least, and now up to down about 0.8 not even 0.1%, as you said.
Kind of go into our Markets Live blog to see if there's anything going on here. What's going on with crude oil? I mean, certainly we've seen energy prices been pressure. We're still down about 2% on WTI crude. We had been up as much as 5.3%.
Okay, so that could be part of it. Hey, a lot to talk about when it comes to the macroeconomic environment between yesterday's Fed meeting, inflationary concerns around energy due to the war, and then the continued pressure on Fed Chair Jay Powell, most recently from the president earlier today. There is a lot to get to with Michael McKee. He's going to join us in just a minute.
I got to say, what pressure? He looked pretty cool as a cucumber yesterday, saying, I'm not going to go anywhere. Let's get this in, until this investigation's over. We'll see what Mike has to say. Hey, we're also going to get an update from the Pentagon as it asks for an additional $200 billion from Congress to pay for that war against Iran. So that's certainly been on our mind on this Thursday.
And the Epstein files fallout is a crisis for elites. And as Max Chafkin writes for Bloomberg Business Week, it's an opportunity.
Interesting stuff. We'll get to that in just a moment. Bloomberg Business Week, it is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide.
Let's get an update from Charlie Pellet. He's standing by in the Bloomberg Interactive Broker Studio. He's watching a little bit of a reversal in the trade. Hey, Charlie.
That is putting it mildly, Tim. Right now, we have got the Dow lower, yes, but both the S&P, NASDAQ 100 index, Russell 2000 index, they're all higher. Dramatic turnaround from earlier in the session. Crude, right now, we've got West Texas Intermediate crude trading lower by 1.7%. It is below $95 a barrel now. Brent, 106.42. Barrel of Brent down by 0.9%. And just like that, those gains for the stock market evaporated back in the red, but little change, perhaps the key takeaway. Certainly a volatile session, 52 minutes to go ahead of the closing bell. The VIX below 24 now, the 10-year 4.24%, and the day after the Fed, 3.77% on the 2-year. Gold down 3.4%, 46.52 the ounce. And again, WTI, West Texas Intermediate crude, trading lower now by 1.8%, 94.60. Earlier today, an Iranian missile inflicted extensive damage on the Ras Laffan complex in Qatar, housing the world's largest liquefied natural gas plant. Qatar says 17% of its LNG capacity has been restored. And by the way, 20% of the world's LNG does come out of the Gulf. Checking European natural gas, up now by 13.1%. Moments ago, Israeli Prime Minister Benjamin Netanyahu said Iran has now lost its ability to manufacture missiles. Also says Iran is no longer able to enrich uranium. Gold down for a 7th session, and the VanEck Gold Miners ETF down 6% today. It has turned negative for the year, down 3.5%. Briefly, a headline on the Bloomberg Professional, Jeff Bezos said to be in early talks to raise $100 billion for a new fund to buy and revamp manufacturing firms with AI technology, that according to the Wall Street Journal. Recapping, S&P up 5 right now, up by about 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, President Trump this afternoon, just around noon time today, he again weighed in on Fed Chair Jay Powell just a day after the Fed at its policy meeting left rates unchanged.
He should be lowering rates immediately, but he won't do that because he's a stubborn, incompetent person, and that's a bad thing. When you're stubborn and incompetent, I think it's the worst combination. And he's also not a smart person, but he's building a complex over there that's under his jurisdiction. He started it, and it's out of control.
That was President Trump in the Oval Office earlier alongside the Japanese Prime Minister. Separately, Treasury Secretary Scott Bessent said Jerome Powell's decision to potentially stay on at the Fed after his term as chair expires in May would go against historic norms.
Michael McKee is international economics and policy correspondent for Bloomberg TV and radio. He was there at the Fed. He questioned Jay Powell yesterday. He's here in our Bloomberg Interactive Broker studio. Mike, where to begin? What matters right now for Jay Powell?
Well, in terms of him staying on, it's the investigation, because they can always hold that over his head. And if he were to say, okay, I'm going to leave with this out there, he may end up indicted and on trial, even if it's trumped up charges, using that word advisedly. But if he can use this leverage because he knows the president wants him out of there, then that is one reason for him to stay around.
The leverage being that Senator Tom Tillis would block.
There's
Kevin
that.
Warsh from becoming Fed chair.
There's that, but there's also, I mean, if Tillis should change his mind and Kevin Warsh got confirmed, Powell could stay on as governor, and he may stay on afterwards, after he's no longer chair, even if he's not serving as the pro tem chair.
Did he come across really confident to you? Like, I think people were shocked that he said what he said, because he often backs off of this kind of stuff.
Well, I wasn't shocked, and I don't think most of the reporters were, because when the Judge Boasberg ruled last Friday that to quash the subpoenas, they released a lot of the filings that had been made in that case, including one conversation that the chair's lawyers had with the lawyers for the Justice Department, in which they said that Chairman, this makes it harder for him to leave, and if it might be a different situation for him to consider if there were no charges. So that's already out there. Okay. So we felt he was likely going to have to answer that. He was just, they figured that out too, and he was just very prepared with his statement.
So back to what Scott Bessent said earlier today, that his decision to potentially stay on after his term as chair expires in May would go against historic norms. Is that true?
Not really. Since Paul Volcker, basically, we have seen all Fed chairs whose terms are up basically resign as governors when they're done. That's what Janet Yellen did. That's what Ben Bernanke did. But that is not what Jay Powell did, because after his first term, he had not been confirmed yet for the second term, and so he stayed on as chair pro tem. But it's happened a couple of other times as well when they were changing chairs. One time when Arthur Burns under Richard Nixon was, under Jimmy Carter, was the chair of the Federal Reserve. His term was up, and Carter had appointed G. William Miller, and he hadn't been confirmed, so Burns just stayed on. Now, in that case, Carter took credit for it because there's this Justice Department memo that suggests the president has the power to do it. Since that time, the Federal Reserve Act has been rewritten, and that's what Powell was talking about yesterday, saying that that's what the law says, that he would be chair pro tem. It's never been litigated, and the tiny little opening that the administration sees is that it talks about this is what happens in the absence of a chair, not a vacancy. Okay. And so they're saying, oh, that's two different things. And if you're going to pick any administration that's going to try to bend the law as much as possible, it's going to be this one. So we could have a legal fight over this.
So how are you thinking? Because it almost feels like, and I can't remember, was it the president who addressed this? But this idea that, or maybe it was Jay Powell just yesterday, this idea that he could still be Fed chair or acting as Fed chair beyond his term. Is that likely? What are you hearing about kind of how this ultimately plays out? Because we talked on Friday that, you know, after that ruling, that the president had an off-ramp to basically go ahead and kind of drop everything. Yeah, and it didn't happen.
He mashed the accelerator and went right past it.
He did. So I'm just curious, how are you?
Well, we don't really know. Okay. The feeling is still that Kevin Warsh will get confirmed, that at some point Jeanine Pirro will have to admit there's no case there, and the only thing that could really slow it down is she says she's going to appeal. Well, the appeal process can take, as we've seen with all these other Trump cases, many, many months. So if Tillis holds firm, then he's not going to vote, and they don't get Warsh through until these charges are disposed of. And Tillis is not running for re-election, so this could go to the end of this year until the new Congress is sworn in January of next year. So it could be a very long period of time that Powell would stay on as chair pro tem. But the feeling is that would just make Trump so angry that he would do something to get Pirro to drop the news, drop the story, and we would get him before the June meeting.
All right, so that's going on. There's the war going on, and we just have a headline crossing. The Treasury Department's Office of Foreign Assets Control issues General License 134A, authorizing the delivery and sale of crude oil and petroleum products of Russian origin loaded on vessels as of March 12th. We are thinking a lot about the global economy, the impact of global energy markets. Is there a point of no return that there is going to be a longer-term impact on the global economy or the U.S. economy, for that matter, because of this?
It depends on how you define longer term. Every day that goes by, the term gets longer, and all the oil industry experts and people who follow the other products that are stuck in the Gulf, like fertilizer, have been saying that this is going to be with us for quite some time, especially on the oil side, because it takes a long time to ramp up again once you've shut down wells.
Or rebuild.
As we've seen in the case of Qatar and the LNG. So, yes, it's going to be an issue for some time. If it ended tomorrow, maybe not as all that long, but it doesn't seem to have an end point. So it is something that's going to affect the economy, and that's one reason I think Jay Powell was so cautious yesterday. Yeah. He was more cautious than he had been about tariffs in the past, and basically said, we admit inflation's not coming down, and if we don't see it come down, we're not going to do anything.
This is why we love Michael McKee. Can we just say that?
We got done about 10% of the questions we wanted to get to with Mike McKay.
He sits right behind us. So this one just turns
you know where
around.
I am.
Hey, Mike, what do we do with this?
You're there. Thanks, Mike.
Michael McKee, international economics and policy correspondent for Bloomberg TV and radio, right here in studio.
Coming up next, we're going to the Pentagon. This is Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Oil is declining as the U.S. authorizes delivery and sale of some Russian crude oil. The Treasury Department's Office of Foreign Assets Control moments ago issued a license authorizing the delivery and sale of crude oil and petroleum products of Russian origin that's loaded onto vessels as of March 12th. We begin with crude because right now, West Texas Intermediate is below $94 a barrel, $93.66. WTI down 2.8%. Barrel of Brent, 104.81. Brent crude down 2.4%. The Dow, the S&P, NASDAQ, they are all declining now, has been volatile in the past few minutes. We did see gains briefly for the S&P 500 index, but right now down 6, a drop there of 0.1%. The Dow down 95, down 0.2, and NASDAQ down 23, a drop there of 0.1%. The VIX right around 24 with a 10-year 4.24%, the 2-year 3.77%. Gold is down 3.5%, 46.52 the ounce, and West Texas Intermediate crude 93.66 a barrel. WTI now down 2.8%. Bottom line here, stocks swinging between gains and losses. Joanne Feeney is partner and portfolio manager at Advisors Capital. And on Bloomberg Open Interest this morning, she said the impact of the Iran war on global equity markets has been uneven.
In Europe and in Asia, they're seeing potentially shortfalls in supply. And that is likely to affect, their degree of manufacturing capabilities. They're going to have to, make cuts here and there. They're going to have to improvise. It's going to affect their margins. So the impact on foreign stock markets clearly should be bigger than what's going on in the U.S.
Joanne Feeney of Advisors Capital. Sources tell Bloomberg NASA is revising its moon landing plans, reducing Boeing's role while elevating SpaceX's Starship rocket to do the job of propelling astronauts to lunar orbit. Boeing shares, they are declining, in fact, leading the Dow lower. Right now, we do have Boeing down by 2.2%. European natural gas trading higher by 13.1%. Recapping, stocks lower, swinging between gains and losses. S&P right now down 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Our coverage of the latest out of Iran continues. This time, really thinking about the end stage or the end of this war. Defense Secretary Pete Hegseth said at a news conference today that the U.S. was, quote, winning decisively, destroying Iran's ballistic missile arsenal, its Navy, and submarines.
To date, we've struck over 7,000 targets across Iran and its military infrastructure. That is not incremental. That is overwhelming force applied with precision. And again, today will be the largest strike package yet, just like yesterday was.
The secretary declined to answer a question about a specific time frame, but said the U.S. is, quote, on plan with a, quote, clear set of objectives and would end the conflict at a time of the president's choosing, ultimately. For more, we're joined by Tony Capaccio. He's Bloomberg News Pentagon and national security reporter. He joins us from our Washington, D.C. bureau. Tony, welcome. What is the, quote, clear set of objectives that Secretary Hegseth was referring to? Is that clear to us? Is it clear to you?
It's numeric in terms of the various types of targets that they think they're going to knock down, they're going to destroy. That's his clear objectives. The problem is Iran is asymmetrically firing the rockets at major, you saw yesterday, liquefied natural gas, oil refinery places in the Red Sea and in Kuwait and Qatar. It's causing a ripple effect around the world. So winning decisively may be knocking out their boats and their missiles and their infrastructure. But this is like a Tom Clancy novel in terms of the impact spreading around the world with no end in sight.
Yeah, we've been spending a lot of time today, Tony, talking about U.S. stockpiles, talking about, where defense spending is going, who benefits off of this, and, the upcoming military spend seems to be giving probably a lot of the big defense contractors and the whole supply chain a lot of visibility going forward because the spend's going to continue. What are your expectations? Is that it? We are now living in a world where it kind of blows my mind. I thought the whole idea was that we didn't have to spend so much on defense going forward. Do you see this as the whole world kind of upping their defense spending because we kind of have to going forward? Or is this just an administration right now that is really focusing on this?
I think it's the administration. Here's a couple things you need to keep in mind. there's $1 trillion was passed for 26. The Pentagon got another $153 billion from the big, beautiful spending reconciliation bill. And now there's a talk of a $1.5 trillion 27 budget, and now this potential $200 billion supplemental. So if I'm the Office of Management and Budget, I'm scratching my head thinking, how can the defense industry absorb all this money? How can it be spent efficiently? So that's the conundrum that they're dealing with right now. You can throw all these figures out, thinking it through, though. How can the money be spent so efficiently if our industrial base is as problematic as Secretary Hexeth says it is, especially on all his Arsenal of Freedom tours? So there's a lot of talk here. We'll know a little bit more. We'll know better in April about how the dollars spread out. But how do you absorb all that money? And then the other thing, if polls show that drop in support for the war, for this endless, even though we're decisively winning war, that's going to embolden a number of congressmen, I think even Republicans, to vote against massive increases because they'll have top cover from their voters.
Listen, I'm going to ask the idiot question in the room. It's like if we're winning decisively, like we all keep asking this in the newsroom. I think everybody's asking it. I think the president was asked her, if we're winning decisively, why do we need to even continue spending? Why do we need another $200 billion? And as you say, how do we absorb it? I mean, is there a good chance that this money is there and it's actually can't be spent because we can't absorb it?
Yeah, there's a good chance that could happen. OMB, one of their jobs is to decide on spend rates, what the capacity is of the industrial base, and how the money can be. Are there enough workers to make all the equipment they want? There's a new hypersonic weapon that the Army is going to field. A couple of days ago, the head Army general in charge of the program talked about how a lot of Lockheed's program was hand tooling on specific components. I was scratching my head on that. So there's a question of absorbing. You can say all you want about the big figures, but then in the end of the day, how can it be spent efficiently? And will Congress go along if a number of their voters are increasingly disenchanted with the war? That gives top cover to say, enough is enough.
Yeah, that's what I'm wondering, the politics of this, Tony, and to what extent that money even ends up being released, because do Democrats get on board here?
Not really. I don't think they will. If you've got a $200 billion supplemental, which, by the way, that was a trial balloon floated yesterday by the Washington Post through the administration, that is still being vetted by OMB. I guarantee it's going to be a bit less than $200 billion. But the politics and the money on this, that's going to drive a lot of the debate. I think the poll numbers are going to drive a lot of the debate. And also, if we're decisively winning, nobody asked this today of Hexeth. He only called a lot of his right-wing softball artists.
Are they the only ones there?
Nobody asked him that.
Yeah, are they the only ones there, though?
No, I was there. There were about 20, I would say about 20 mainstream reporters who all left in October. But he didn't call on any of us. He's got like a seat. We all have seating chart, names on the seats. There's a seating chart. So he calls the comfortable right wing who aren't going to press him. Nobody asked about the Strait of Hormuz. When do you open it? What is the purpose of the 31st Marine Expeditionary Unit, General Kane? Nobody asked those questions. And if we're decisively winning, how do you explain oil prices skyrocketing because Iran is able to knock the hell out of certain places in Saudi Arabia, Qatar, and Kuwait?
Can I ask you something? And yeah, I know I'm talking our book, but I am thinking about the new environment, new era in terms of media and media coverage of the White House and the administration. And I think this is a fair question. If you guys called out and yelled out, which I feel like we used to be able to, as reporters, kind of yell things, would you be banned?
No, you wouldn't be banned. I'm not a fan of it, to be upfront. But there's a certain reporter for a TV network who's been pretty effective. The last two times she has yelled out questions, Hexeth did answer her query. He goes, and to the shouted out question, this is my answer type of thing. So I'm not a fan of it, but it's effective in this case.
Tony, I was commuting in during the press conference, so I was only able to listen to the part where I was above ground. You know, this is like a boring New York City part of it. But I heard the beginning of it, and so much time the secretary spent on attacking the media, which I thought was really notable, and it just maybe I take it personally because I am a member of the media, but it's our job to hold those in power to account, and we don't do it in a political way. We do it because we answer to the public, and that's who we serve. And it doesn't seem like that. It seems like there's a real separation with what he sees as the role of the media versus what the media sees its role. Can you talk about that a little bit? Because you've covered, you've been in this situation for a while.
Just so you know, this is part of a coordinated strategy by the White House. FCC's Brendan Carr, Trump attacking the media, Hexeth doing his part. This is all part of trying to erode the credibility of the media. So it's just not Hexeth doing it by himself on his own. There are talking points. He's guided by the White House on a lot of this. None of it's spontaneous. Huh. This was Brother Pete's traveling, enduring freedom, salvation show we saw today. He's good at it, but it's not from him. It's the White House talking points to attack. So just keep that in mind.
So when it comes to, and I want to go there because we're listening to what you were saying, I think about the Bloomberg audience, a really smart audience. I'm sure we're going to get emails off of this conversation. But I do think about, when we think about this spend, I mean, obviously if we spend money on this, we're not spending on other things in the country or that might benefit U.S. citizens. And what's the reality? Because off of everything we do, we think about the intersection of money and markets. And I do think about what this means for defense companies. So put it all together. Help me understand what our audience should be taking away from what they see in these briefings or these numbers and requests for more spend when it comes to military.
Okay, the briefings are theater. They're aimed at Trump. He has these briefings Hexeth has these briefings at 8 o'clock in the morning because what I found out today is because that's when Trump watches TV. So they want to target to him. He's playing to an audience of one. That's basically it. Our viewers and readers should care about what the appropriations committees mark up. Mm-hmm. Not so much what Brother Pete talks about and the dollars that come from OMB, but what the House and Senate appropriations committees come out with in their markups. That's what counts. The House Armed Services Committee and the Senate Armed Services Committee, they set policy. They don't set the spending limits or the actual dollars being released. So our viewers should care about what Ken Calvert, the HAC-D chairman, says. Would Mitch McConnell, to a point, no matter what you think of him, he's the head of the SAC-D, Senate Defense Appropriations Subcommittee head. Mm-hmm. Susan Collins, that's where the money meets the politics and gets distributed and approved. That's where our readers should focus their attention when the FY27 budget comes out and when the supplemental comes out.
Okay. Hey, listen, thank you so much. We need you to kind of weed through all of this and really understand what matters. Tony, thank you so much. Tony Capaccio, Bloomberg News, Pentagon, and National Security reporter out there in D.C., covering it every day.
Coming up next, we are driving to the close on a day when we're seeing a little bit of late buying. That's next on Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Volatility is easing on Wall Street. 20 minutes to go ahead of the closing bell. With the Dow, the S&P, NASDAQ, yes, they are in the red, but just about 30 minutes ago, we did see a move higher. Yes, higher for the S&P 500 index, but volatility easing. Right now, we got the VIX just above 24, but the Dow, the S&P, NASDAQ, as of now, trading lower. S&P down 13. That's a drop of 0.2%. Dow Industrials down 127, a decline there of 0.3%. NASDAQ down 55. For NASDAQ, a decline of 0.3%. The VIX just above 24. The 10-year, day after the Fed, 4.25%. The 2-year, 3.79%. Spot gold down 3.7% now, 46.39 the ounce. And West Texas Intermediate crude back below $95 a barrel, tumbling now by 2%. Brent giving up earlier gains. Right now, a barrel of Brent, 106.53, drop there of 0.8%. Stocks and bonds did bounce from session lows after Israel said it is helping the U.S. open the vital Strait of Hormuz. Natural gas surging in Europe. Nat gas up by 13.1%. Coming up after the close of trading today, going to be hearing from FedEx ahead of earnings. FedEx up by 1.1%. Energy stocks, specifically the oil majors, trading higher. ExxonMobil up 0.5%. Chevron right now up 1.3%. ConocoPhillips up by 1.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Daddy, can I drive?
Yeah, sure, why not?
Do I look like I drive a minivan?
Shut up and drive.
Don't drive angry. Don't drive angry.
I'll drive. Shotgun.
This is the drive to the close.
If you had access to a car like this, would you take it back right away?
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes to go until we wrap up trade on this Thursday. Carol Master, Tim Stanovic, live in our Bloomberg Interactive Brokers studio. Definitely off our worst levels of the session. In fact, I believe on that headline that we got that Treasury seems to be moving forward to allow the removal of sanctions or allowing the passage of Russian oil amid this war, that seemed to certainly ease energy prices. We did see an uptick in certainly stocks. We're still down about 15 points or 0.25% on the S&P 500. NASDAQ 100 still down more than 60 points or around 60 points, down 0.25% as well.
But when you say ease energy prices, Carol, you're still seeing Brent above $105 a barrel, close to $106 a barrel, and WTI around 94.50. Just this year, 74% higher for Brent. So
no, really fair, right?
Drop in the bucket.
But we were up a lot more, right, earlier in the session. So I don't know.
111 for Brent.
Yeah, I mean, it's just a market that we just continually bounce around based on the headlines. So we'll see where we end up. But let's also see what Mark Travis has to say.
He's president and CEO of Intrepid Capital. He joins us from Jacksonville, Florida. The firm has about $1.7 billion in assets under management. Mark, good to have you on the program. I want to talk about some of the stocks that you own, that you're bullish on, what you're thinking about buying next. But first, I just want to get the lay of the land from a macroeconomic perspective from you, specifically when it comes to higher energy prices, and really what you think the war could do to this economy.
Well, thank you for asking, and thank you for having me. I, on an absolute basis, oil's obviously up a lot here in the last 3 weeks. On a relative basis, inflation adjusted, it was probably a good bit higher in the last several years. So I think we can adapt to $100 a barrel oil despite all the, people's hair that's on fire with that price. It certainly flows through. I think over time we'll adjust. We'll find new ways to supply the market, whether it's pipeline or sources of our own. Or Venezuelan, who knows? But I look at events like this as the VIX gets toward 30 as an opportunity to find high-quality companies to acquire and hang on to.
It sounds like you're seeing this as more of a longer-term situation than a short-term situation, at least when it comes to high energy prices. that, you know, we will make changes as a result of this. Companies will invest as a result of this. We'll find new sources of energy as a result of that. That's kind of contrary to what we hear from a lot of folks. I mean, even the president saying just this week that as soon as this war is over, which he says will be soon, energy prices will drop like a rock.
Well, in commodities, the cure for high prices is high prices. You know, I'd also point out to listeners, you know, oil was negative in the post-pandemic. Yeah. So, you know, there are obviously people making money at $100 a barrel.
Is the point that you don't think it's going to stay this high, that you actually do think, like you say, the cure for high oil prices is high oil prices? Do you anticipate that we're going to move back down?
I think that I think that we will adapt to it. I think the conundrum, Carol, is that we found ourselves in something we maybe didn't prepare as well as some would like in terms of having the Iranians, you know, mine the Straits of Hormuz, and what's involved to be able to have oil flow through that strait is not insignificant in terms of deployment of boots on the ground or otherwise. But, you know, I think that I would be looking over my shoulder in the dark if I was somewhere in the hierarchy of the theocracy of Iran or the IRG with the way the Mossad has infiltrated that country. And, you know, we'll see if we can, with our Navy and Marines, if necessary, capture Karg Island and allow the oil to flow through. But again, I think if you look at the history of the markets, and both of you, I'm sure, have seen them going back to, you know, 50 years from now, you can mark 1979 when the, you know, the Americans were taken. You can mark 1990 when the first Gulf War occurred. And the truth be told is the story of the U.S. equity market is up over time. So when you feel really bad and kind of bad stomachache, that's usually probably not a bad time to invest, in my opinion.
It doesn't seem like we're there yet, though.
Well, I don't know. Well, are we? Like, tell us, are you buying? We know a name that you like is Jefferies, and I think you already own it. And this is certainly one that's been having its own share of troubles. It reports on March 25th after the market. It's down almost 40% year to date. So we're going to see, you know, what we get from that company. You like it, you're holding on to it. What do you want to hear from the company? And this is, of course, the problems have to do with the troubled credit markets, private credit. I would point out, Carol, and I'm going to date myself. I remember when this company was called Lucadia. and part of what I'm interested in is what I call founder-led businesses. And today, the largest person in the capital table, equity capital table, is Joe Steinberg. And Rich Handler, the CEO, is number 2. So the reason I like a founder-led business, I think they're more careful. One of my favorite business quotes is from the great race car driver Mario Andretti. For those that don't know it, he won the 1969 Indianapolis 500. And the quote is, "To finish first, you must first finish." And I believe a lot of these founder-led businesses are, built to last, and they're going to finish. And I just think they're more careful. But again, it's a broker-dealer. You're dealing in the problems of the credit market. I'm sure there's a high degree of panic in the private credit world. Of course, as some point out, and I would too, what does that mean for private equity? Because the way the capitalization of a business works is the debt holders eat before the equity holders. I've held it for a long time, and I really don't see that changing. Is the answer, Carol?
Hey, Mark, we're out of time. I wanted to get your thoughts on Levi. I'm sorry, but we only have like 10 seconds left, and I just can't do it.
Well,
Mark Travis.
I hope a private equity buyer will buy it from me, but it's certainly taken a long time.
Oh, interesting. Okay. Nice. That was succinct. Thank you, Mark Travis. You got to come back. President and CEO of Intrepid Capital, joining us from Jacksonville, Florida. A lot of stocks that he's optimistic about: Jefferies, Garmin, Levi Strauss, J.M. Smucker, and more.
Yeah, Carlyle Group among those that he's considering buying. So we'll get him back real soon so we can continue talking about some of those specific names. Do not go anywhere. The close coming your way in just about 10 minutes. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, coming up on about 7 minutes before we wrap up the trade on this Thursday, Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Brokers studio. Just a reminder of where we are, kind of flat on the S&P, just down about 18 points, or down